What's driving the markets this week? What's on investors' minds as they look ahead? Find out in 10 minutes or less on the Markets podcast from Goldman Sachs. Listen now.
News when you want it with Bloomberg News Now. I'm Doug Krisner. Congress has voted to compel the Department of Justice to release its files on sex trafficker Jeffrey Epstein. This legislation passed the House 427 to 1, and now the Senate has unanimously passed it without further action. Senate Minority Leader Chuck Schumer says the American people and Epstein survivors have waited long enough.
This is about holding accountable all the people in Jeffrey Epstein's circle who raped, groomed, targeted, and enabled the abuse of hundreds of girls for years and years.
That is Senate Minority Leader Chuck Schumer there. Now, President Trump has said he will sign the legislation after initially opposing the release of the files. It requires the release of all files and records related to Epstein. That would include investigations, flight logs, and internal DOJ documents. Earlier today at the White House, President Trump hosted Saudi Crown Prince Mohammed bin Salman. It was there, the prince said, his country would be increasing its financial commitments to the U.S. from $600 billion to $1 trillion. And later in the day, Trump said he has signed the U.S.-Saudi Strategic Defense Agreement.
I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally.
Now, that designation does open the door for further collaboration between Saudi Arabia and the U.S. military. President Trump has reportedly signed off on possible operations inside Venezuela. The New York Times reports Trump authorized the CIA plans for covert measures that could be meant to prepare a battlefield for further action. The Trump administration is taking more steps to shut down the Department of Education. Officials say some of the department's largest grant programs and major portions of several offices will be transferred to other federal agencies. Education Secretary Linda McMahon tells CBS News she hopes this action will convince Congress that these steps are necessary.
If we can do that, then hopefully then we can get Congress to vote and to codify those transfers and make it a permanent move.
That is Education Secretary Linda McMahon speaking earlier to CBS News. Paramount Skydance is rejecting a report claiming the company is working with Middle Eastern sovereign wealth funds on an offer for Warner Brothers Discovery. Paramount calls it categorically inaccurate. Earlier, Variety reported Paramount Skydance is working with Saudi Arabia's Public Investment Fund along with the Qatar Investment Authority and the Abu Dhabi Investment Authority on a bid worth $71 billion. President Trump said today he thinks he's identified a choice to be the next chair of the Federal Reserve. He said people are holding him back from firing the current chair, Jay Powell. Here is Trump speaking with Bloomberg's Anne-Marie Hordern in a Q&A inside the Oval Office.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
Yes.
Who have you interviewed?
I think I already know my choice.
Who is it?
Well, I liked him, but he's not going to take the job. He refused. You like Treasury better, right?
Much better, sir.
That is Treasury Secretary Scott Bessent, who is incidentally leading the search. Now, Bessent has said the pool of contenders has been narrowed to current governors Chris Waller and Michelle Bowman, along with former Fed Governor Kevin Warsh. Also, the director of the White House Council of Economic Advisors, Kevin Hassett, and BlackRock executive Rick Rieder. Before the opening bell tomorrow, Target is set to release its third quarter results. Bloomberg's Tom Busby has a preview.
Despite a lot of U.S. consumers pulling back on their spending last quarter, investors will be looking for signs that heavy promotions, strong back-to-school demand, and a new CEO help the discount retailer snap out of a recent sales slump. Although Bloomberg consensus calls for comp sales to fall about 2%, revenues are expected at $25.33 billion on adjusted earnings per share of $1.73. Tom Busby, Bloomberg Radio.
A Gustav Klimt portrait of a young Viennese woman sold for a record $236 million at Sotheby's in New York. The portrait of Elizabeth Lederer was part of the unwinding of Leonard Lauder's art collection. The former executive and billionaire died in June at the age of 92. This portrait was part of a trove the Nazis stole from Elizabeth Lederer's wealthy Jewish family in Vienna. And that is News When You Want It with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out on the Markets podcast from Goldman Sachs. A breakdown of market moves and macro signals in 10 minutes or less. The Markets podcast from Goldman Sachs. Listen now.
Carol Masser.
And I'm Tim Stenevec, inviting you to join us for the Bloomberg Business Week Daily Podcast.
Now, every day we are bringing you reporting from the magazine that helps global leaders stay ahead.
We've got insight on the people, the companies, and trends that are shaping today's complex economy.
That's right, Tim. We're all over global business, finance, tech news, all as it is happening in real time. And we've got complete coverage of the U.S. market close. Gotta say, basically, if it impacts financial markets, if it impacts companies, if it's impacting trends and narratives that are out there, we are on it.
We also have a lot of fun doing it. Bloomberg Business Week also brings you the analysis behind the headlines through conversations with our expert guests.
And we are doing this all live each weekday. And then we bring you the best analysis in our daily podcast.
Search for Bloomberg Business Week on YouTube, Apple, Spotify, or anywhere else you listen.
Check it out on your way home from work to catch up on the conversations that you missed during the business day.
And on the weekend, check it out for a complete wrap-up of your business week.
That's the Bloomberg Business Week Daily Podcast. I'm Carol Masser.
And I'm Tim Stenevec. Subscribe today wherever you get your podcasts.
कहीं सीलन की बूंदें आपके घर में भी संगीत बनके ना गूंजे, इसीलिए घर बनाएं एसीसी गोल्ड वाटर शील्ड सीमेंट के साथ।
In terms of safety, Saudi Arabia has never been as safe as it is right now. You always had a little cloud over your head, and sometimes that cloud was very big. That cloud is not there anymore, and we want to keep it that way. So that's why tonight I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally, which is something that is very important to them, and I'm just telling you now for the first time because I wanted to keep a little secret for tonight. I just heard him say, "Oh, that's nice." That's another point you won today. And signing a historic strategic defense agreement, which we just signed a little while ago. So congratulations.
Hello everyone, good morning, good afternoon, good evening to all of you. Welcome once again to this live analysis. स्टार्ट करते हैं सेशन। कल देखोगे क्रूड ऑयल एक रेजिस्टेंस पे था, वहां से थोड़ा बहुत सेल ऑफ आया था क्लोजिंग होते होते। नेचुरल गैस कल बहुत वॉलेटाइल हो गया, पहले सपोर्ट था वो ब्रेक किया, फिर रिटेस्ट भी नहीं किया एंड देन सडनली कैंडल ओपन इक्वल टू लो बना के वापस रिटर्न कर दिया था। तो कंप्लीट फेक ब्रेकडाउन yesterday in natural gas. Let's see क्या प्लान कर सकते हैं। निफ्टी को भी देखोगे, बाय द वे क्रूड ऑयल का ध्यान रखना है, फ्यूचर का चार्ट है नेक्स्ट मंथ का, ठीक है। बाकी वैसे मैं सोच रहा हूँ ना, एक नेचुरल गैस से क्रूड ऑयल को रिमूव करके गोल्ड का चार्ट लगा दें। व्हाट डू यू थिंक गाइस? कैन वी ऐड गोल्ड चार्ट एज वेल? ठीक है, क्रूड ऑयल और नेचुरल गैस को ही रहने देते हैं। इंडियन मार्केट भी देखोगे 15 मिनट में ओपन हुआ, मॉर्निंग पे पहली कैंडल वॉलेटाइल थी, देन थोड़ा बहुत मोमेंटम बाइंग में ही आया, फिर से साइडवेज हो गया। ठीक है, लेट्स सी, देखते हैं कुछ ट्रेड अगर बनता है यहाँ पर। डेटा आज अगर बात करें तो अभी 1:30 लंदन सेशन ओपन होगा, शाम को 6:30 न्यूयॉर्क सेशन, 8 PM यूएस मार्केट, और फिर 9 बजे क्रूड ऑयल की इन्वेंट्री है। उसके अलावा और कोई डेटा नहीं आज।
Power the future. We must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech. Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
We have in Singapore the state-of-the-art technology, and then we export that technology into our Meta plant in Georgia.
The Smart Factory brings software-defined manufacturing to life using digital twins, AI, and automation.
Our Meta plant was the largest investment of the company outside of Korea, at 3,000 acres, with an investment of $12.6 billion for a capacity of 300,000 cars a year.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
This is Horizons Middle East and Africa, our top stories this morning. Asian stocks struggling for direction as investors weigh a sell-off in the world's biggest tech firms that drag global stocks to a one-month low. US President Donald Trump is formally designating Saudi Arabia as a major non-NATO ally as the two countries look to strengthen ties. And we speak to Josephine Teo, Singapore's Minister for Digital Development and Information, live from Bloomberg's New Economy Forum. Well, it's just gone 9:30 a.m. across the Emirates, 7:30 a.m. here in South Africa. I'm Lizzie Burden in Johannesburg in Fisherman Basechi. A very good morning if you're just joining the programme. Checking in on these markets, and we have futures pointing lower on both sides of the Atlantic following the losses that we've already seen in the Asian session. Treasury yields pretty steady on the 10-year at this point, and we have Bitcoin back above that $90,000 a token level, having dropped below it earlier in the week. Of course, traders are really holding their breath for those Nvidia earnings. And if we flip the board over, you can see past sales and future estimated sales. This is what markets are focused on. It's pretty much a macro moment at this point, these earnings. And actually, that data center revenue is very much the focus here, as you can see in the white on your screen. So we await those earnings. But before that, let's go back to Singapore, where Bloomberg's New Economy Forum is underway. We've got some exciting guests lined up for you from the event, and one of them is with Bloomberg's Haslinda Amin. They join right now.
Hey there, Lizzie. It's been an exciting conversation here at the New Economy Forum. Of course, conversations around AI in particular. With me today, the Singapore Digital Development and Information Minister, Josephine Teo. Minister, good to have you with us. You know, we talk about ensuring equality when it comes to AI access. And some people point to China's model, open source, as a way to ensure that equality. What are your thoughts on open versus closed?
Well, in any economy, if you would like to see widespread adoption, that would eventually have to mean many applications that are built for different functions, different sectors, and different users. So thinking about how these AI applications come to be built, if there were no open source models, open models that developers could rely on, then you could see potentially that this becomes a very big problem. The cost of developing these applications would go up considerably. And what it means is that access to users could become more constrained. And in terms of getting more people to benefit from the technology, that would also be less than potentially possible. So I think there is a place for open models. Is it open source or just open weights? I think you can have a debate about that. But the important point is to say that having open models is essential and quite helpful in terms of getting widespread AI adoption.
Are there concerns about adopting an open model?
If you are an organization with proprietary information, data, knowledge, insights that other people would like to get their hands on, if you are concerned about your AI models being hijacked, I think there is a place for models to be fine-tuned and then kept within the organization. But are there many organizations like that? It would depend. Even within an organization, there will be certain functions, certain aspects of the work that you want to rely only on a closed model, something that only you have, that is fine-tuned on your own data sets, that others cannot access easily. But for other usage, for example, workplace productivity, do you really need to rely on an in-house model, a bespoke model, one that is fine-tuned for your needs? Maybe not necessary. Yeah.
It is hard to talk about AI without talking about the US versus China, because they're right smack in the center of a tech race and AI race. And Jensen Huang has come out to say that he thinks China is ahead of the game. China could be winning. How are you looking at the race between the two and the implications that we're likely to see even in countries like Singapore?
Well, this contest has been ongoing for many years. And if you look at what China is able to offer, is a breadth and depth of their industries. So in applications, very clearly that they will have many use cases. And these use cases, once they have proven effective use of AI, will be very interesting benchmarks and reference points that other companies elsewhere in the world would also want to look at. Does that mean that they are ahead of the game in every aspect? The AI technology stack has got many different levels. At the applications level, it is entirely possible that China will have an edge. But if you talk about developing the most sophisticated models, and I think today there is also the recognition that it's not just language models, even multimodal models that will be important. There is a shift towards the development of world models. These are models that learn not using textual information, they are using visual information, and it has also been described that these world models respect the laws of physics. So if you look at how AI development is continuing at a very fast clip and in more varied ways, I think the question is still open, who gets to take the lead. But regardless of who's ahead, I think there is room for cooperation. There is room to bring the leaders together, particularly in time to come, to set standards.
Might China win because of its access to energy and power? and rare earths. I mean, those are essential when it comes to this tech race.
It will certainly try, and you can't stop it from trying.
The thing about AI is also causing a lot of fear when it comes to jobs. And people point to this paradox, proximity paradox, where the closer you are to AI, the more concerned you are about losing your jobs because you see its abilities. Are you seeing that as you implement the AI strategy in Singapore?
Well, it's kind of interesting. Most of the enterprises and the workers I interacted with where AI tools have been introduced to their workplaces, the feedback has been largely positive. Yes, they know that this technology is powerful and it can do many things, but they also see where it falls short. And they also see how they continue to be needed as part of the equation. It's been said often enough that what will replace workers is not necessarily AI, but another worker with relevant AI skills. I think that is the realization that more and more people in our workforce have. And there is a healthy attitude towards wanting to learn how to use this technology, how to apply it in the work context, and also how to level up, one's skill sets with this technology.
But it's hard to ignore when you hear companies like Amazon cutting 30,000 jobs and what that might mean for the rest of us.
Well, it is to be empathized with. People can appreciate that a company would always try to see how they can use technology better and rely on people less, and it can be concerning. But I think it is also perhaps not quite right. There could be other factors that cause a company to either expand or to trim. And what's very important, I think, in every economy is the ability to continuously create new and better jobs. And that's the challenge that we set for ourselves.
Minister Chiu, always a pleasure to have you with us.
Thank you, Haslinda.
And of course, Lizzie, we're coming to you live from the Bloomberg New Economy Forum, where conversations have revolved around AI and how do you get equal access to that technology. The debate continues.
Yeah. Fascinating, if disconcerting conversation. Bloomberg's Haslinda Amin, we thank you so much for bringing it to us. Well, the group CEO of Etihad Airways has been speaking to Bloomberg's Guy Johnson on the sidelines of the Dubai Air Show. He says that the airliner is seeing growing demand in Europe, India and Southeast Asia, but also highlighted some of the constraints around plane deliveries.
We see the premium demand strong in the GCC, in Middle East, in Europe. But of course, right, especially when you talk about the US market where premium demand is extremely strong right now, there is some influence, right, on what you see in wealth and with stock market appreciation, right? So we're very conscious about that. Our growth actually over the past 2 years have been concentrated in Europe, India and Southeast Asia. Yep. And these markets, we believe it's a long-term trend that premium is here to stay.
Are you surprised, though, how much money people are spending? Like in India, maybe less here, but also in Europe. Is it? It's extraordinary in some ways.
It is. If I tell you I'm not surprised, I wouldn't be telling the truth. So we were not expecting that to come so quickly. I think the pace is more important than the size of money, right? The pace and actually the amount of people, right, willing to do that. But reality is the following, right? We forget that when you travel abroad and you go for leisure, right, with your family, right, the airfare is 20% of the expenses, right? I think people are starting to realize, right, that as part of the entire experience, right, having a business class seat is also important, right? So why not saving, right, in 4 or 5 dinners so that I can buy a better seat, right, and do something different with my travel experience. So I think people are starting to think more about, look, I deserve that, and that's good. That's good.
Can you get the airplanes you want right now?
I mean, we can't. To be really direct, we can't. We'd love to. I mean, our load factors in September were 90%, 90, right? There's a bit of delay, but I think things are improving, right? I mean, we got good news from Airbus recently, right? We had a plane that was arriving in Q1 2026. They offer us to anticipate, right, to Q4 25. So that's really nice, right? These 321 LRs, our plan was to get 10 in 2025. We got all 10 in 2025, right? We have 7 now, and we have 3 that are coming between the end of November and early December. But it's a challenge. I would like to have more wide bodies. Today, I have 120 planes. I could take 20 wide bodies today.
Okay.
So that's how constrained the market is.
So that was the Etihad Airways Group CEO speaking very frankly to Bloomberg's Guy Johnson on the sidelines of the Dubai Air Show. Meanwhile, Emirates said that it was placing an order for 65 Boeing 777X airliners, valued at $38 billion, to renew its fleet of current generation 777s and phase out its Airbus A380s. Emirates President Tim Clark told Bloomberg that his airline would still use the aircraft to serve premium travellers despite any turbulence in the global economy.
Increasing demand on the premium cabins predated all of this. Okay, you could say that with quantitative easing going on at the pace it was, a lot of money was printed. Banks are pretty flush. People are making decisions because inflation is kicking in. They want to get the value for the money now. It could be something like that. Frankly, I'm not altogether sure. There are so many things going on in the global economy at the moment, both economically, politically, geopolitically. You can never be certain what is happening. What we do know, people are getting on our aeroplanes, not just ours, in the premium cabins. You see a lot of the US carriers now attending to premium products because they seem to have been behind the curve anyway, realizing that something has to be done there. So at the moment, it's very good. I can never say, Guy, that this is going to go on forever. The cyclical nature of the global economy, the kind of upheaval that we get for all sorts of strange reasons, whether it be natural, geopolitical or whatever, you just have to deal with it. But at the moment, the going is strong for our part of the world. I'm not going to say that it's going to be the same for the US. I know there's a bit of weakness on the North Atlantic at the moment, but we're not seeing that here.
So that was the Emirates Airline President Tim Clark also speaking to Bloomberg's Guy Johnson. Well, coming up on the programme, we're going to check in on the B20 South Africa Summit to find out what role sustainability has to play in enhancing trade and market access on the continent. That conversation next. This is Bloomberg.
A lot of our inspirations for new features comes from experiences in our own daily life.
The other day, I needed to double check an important meeting schedule by finding a specific call recording. Thankfully, with call summarization feature on my Galaxy, I could quickly find it.
Our users ask complex questions, and our model has to be able to speak multiple languages. What seems impossible now can quickly become possible.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We would pretend that you're just an average person who's visiting for the weekend.
Okay.
And then we'll just see if we can win some money that way.
Do you just have one court?
I have
Several
one
courts.
court per house, yeah.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
We're bringing it right back here to Johannesburg. We can now head to the B20 South Africa Summit, where we find Bloomberg's Jennifer Zabasaja. Hey, Jen, the importance of sustainability in focus today. That's right, Lizzie, and it has been an integral part for the B20 to focus on sustainability-related financial disclosures, to help inform investors. And the guest that I'm standing by with right now has been a part of that journey for the B20. I'm standing by with Dr. Ndidi Nnolli-Ndozian. Thank you so much for being here, Dr. Ndidi. Talk to us about sort of what you and the team have been focused on in terms of catalyzing more capital and alleviating some of the risk premium that we're seeing African and emerging markets really facing.
No, absolutely. First of all, it's a great joy to be here at the B20 this year, and of course for the B20 to be on the African continent. And how that leans in and connects with the international sustainability standards is that really Africa is leaning forward and on the early adoption journey. You already have 8 countries with roadmaps, and not just Africa, but actually emerging markets. So among the leading countries were Nigeria and Brazil, but also you're looking at large economies like China and Japan, who are leaning in on these sustainability-related financial disclosures that form part of general purpose financial statements. So you have a more holistic perspective on the risks that economies face and countries, entities in particular face, so that when investors are looking at these financial statements, they have a holistic picture that is comparable, that is concise, that is decision useful, and can be used to allocate capital.
What evidence do we have that investors are actually taking this into account when they are deciding where to deploy capital?
Well, first of all, the ISSB is really, first of all, not reinventing the wheel. So the 123 trillion that has formed some prior standards like the TCFD and those 4 frameworks of governance, strategy, risks and opportunities, targets and metrics has become a part of the ISSB. Likewise, recently with the TNFD, who have decided that we are going to essentially become the custodians thereof. IOSCO, the largest convener of capital markets around the world, has endorsed the ISSB standards. Only the second set of standards it's endorsed after the International Accounting Standards Board. But most importantly, the ISSB standards are informed by investors. And not just that, we've also incorporated the industry-specific standards, the SASB standards, that are also very much investor-driven. They've also become part of the ISSB global baseline is what we call it. How do we have one common language that investors can lean on to get the information that they require to allocate capital?
How do we ensure, though, that this remains in place moving forward? Because there is still quite a bit of uncertainty that investors are facing right now. What is going to be in place here at the B20 to ensure that this is a continuation of alleviation for some of the risk that these economies are facing?
So, you know, the challenge with risk very often is the distinction between the perceived risk and the actual risk. And when the perceived risk is disproportionately high, you're looking at higher costs of capital for those who need it the most in order to create that transition. So better information enables better information to make better investment decisions. That's on the one hand. Secondly, we really need to lean in on the transition. So one of the things that you've seen very powerfully here is the B20 and the various task forces and the leadership of business across the world, not just in South Africa and across the African continent, lean in with policymakers, for example, integrity and compliance, and the anti-corruption working group, which was co-chaired by Brazil and South Africa, that led to the FATF grey listing being lifted. What that does is it creates that public investor confidence, the assurance that there are actually guardrails to make sure that when you do make an investment, that you're sure that there are regulations in place, there's enforcement in place to protect your investment going forward. But very important with all of this is really information. You need information and you need a proper understanding of risks and opportunities, including sustainability-related risks and opportunities. Things like water have become such a big issue in order for you to look to the future and be future fit.
And so maybe really quick, what's the ultimate goal then of this week?
The ultimate goal this week is, first of all, to consolidate everything that the task forces have come together with, convene in this country. It's Africa's first G20, B20, and for the B20 recommendations to work their way from business into what the government makes in terms of its one core decision-making forum that moves things forward. I think resilience is a very big issue. Resilience of global supply chains and sustainability plays a huge role in that regard. Trade is really critical. And when you have investments into these economies, what you're doing is you're securing jobs, which is also a huge issue. And of course, you've got the teeming, bright young population on the African continent, and digital transformation was one of the big concerns. From an ISSB perspective, obviously leveraging technology, leveraging also digital to make sure that information is accessible, is machine readable, can be compared, is concise, so that you have a level playing field and capital can flow all across the world, especially to the African continent and emerging markets.
And we know that's been a priority of the South African presidency for this G20. Dr. Ndidi, thank you so much for being here. Lizzie, I'll send it back to you.
So much full coverage from Jen right here in Joburg of the B20 and G20, of course. And staying in South Africa, the country's foreign minister has been pushing back against what he describes as Washington's white supremacist agenda. And we'll turn to that conversation in the final part of the show. This is Bloomberg.
We have in Singapore the state-of-the-art technology, and then we export that technology into our Meta plant in Georgia.
The Smart Factory brings software-defined manufacturing to life using digital twins, AI, and automation.
Our Meta plant was the largest investment of the company outside of Korea, had 3,000 acres with an investment of $12.6 billion for a capacity of 300,000 cars a year.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
From business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news.
Technology news. Geopolitical news.
Economic news.
Financial news.
Bringing you the latest news in private markets.
Whenever,
and wherever.
Wherever
it happens.
In Washington, Beijing,
Cape Town, South Africa.
Las Vegas,
Davos, Switzerland.
Rio de Janeiro, Brazil.
The south of France. And this is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Johannesburg, where South Africa's foreign minister has told us that the world and the G20 will move on with or without the United States, while pushing back against what he described as Washington's white supremacist agenda. Ronald Lamola told the inaugural Bloomberg Africa Business Summit in Johannesburg that the US administration isn't listening because of its ideological bias.
They are not listening because of ideological basis. It's not because the message is not getting across. As you are aware, the DEI views of MAGA is an ideological question to feed the agenda of white supremacy. When you look at the program of Afrikaners, that white South Africa, that for you to qualify to be a refugee, you have, firstly, you must be white. Secondly, you must be an Afrikaner. It's a race-based policy, executive order. The Geneva Convention is very clear in terms of who qualifies to be a refugee, must be persecuted and all that. So they don't meet this definition. As someone living a property nicely, not being chased by any army, and then they go into a commercial flight. So all those, it doesn't meet the definition of a refugee. So it's a clear agenda to pursue a fear-mongering.
Well, that was South Africa's Foreign Minister Roland Lamola speaking to Bloomberg's Deputy Editor-in-Chief Reto Gregori at Bloomberg's Africa Business Summit. Well, as we end the programme, let's just check in on these markets again, shall we? Because we're still treading water. We've got futures pointing lower on both sides of the Atlantic. S&P E-mini futures only down about 0.1%. Euro Stoxx 50 futures flat to the downside. FTSE 100 futures notably in the green, only just at this point. And we have the 10-year US Treasury yield extremely steady, not doing anything at 4.11%. But of course, we are looking ahead to those Nvidia earnings. Tom McKenzie is coming up next. He'll be giving us a preview. And that does it for Horizons Middle East and Africa. I've been Lizzie Burden in Johannesburg. Stay with us for Daybreak Europe. This is Bloomberg.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
And supporting the usage of the ammonia as the alternative fuel.
It's more expensive than normal standard fuel.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Wednesday. These are the stories that set your agenda. Stocks remain on the back foot after a sell-off that's wiped $1.6 trillion from global equities. We're going to preview today's earnings from Nvidia for a health check on the AI boom. President Trump described Saudi Arabia as a major non-NATO ally as the Crown Prince makes a vague pledge to invest $1 trillion in the US. Plus, with UK inflation expected to ease, we're going to look at the implications for the government's budget due 7 days from now. And we will be live at the Bloomberg New Economy Forum in Singapore, speaking to guests including Euroclear Group CEO Valerie Urbane. So a rough day for stocks yesterday. The sell-off, of course, pronounced on the Nasdaq 100, down more than 1% by the close. A loss of 0.8% on the S&P 500. European stocks closing low by 1.7% yesterday. Today, though, the equity markets, yes, they're slightly on the back foot when you look at the US futures picture. But there is a sense of modest stability that is percolating through these markets, just in recent minutes, in fact. European futures now modestly in positive territory, but again looking for that catalyst, and that is likely to come from Nvidia. Of course, the earnings dropping later, and we'll cross and bring you all the details in terms of the preview and the run-up to that event through this show. FTSE 100 futures currently pointing to gains of 0.1%, but US futures still in negative territory. S&P evenly down 0.1%. Nasdaq 100 futures looking to drop 55 points. Let's flip the board and have a look cross-asset then. Treasury markets, the last time I checked, relatively stable. 411, there you go on the benchmark US 10-year, unchanged so far in the session. Euro dollar at 115, just a little stronger by 0.1% on the single currency. Bitcoin had crossed back below 90,000 just a minute ago or so. Now just holding above that level, but under pressure again today, down 2.3% for the cryptocurrency. And Brent also, oil prices under pressure, $64 a barrel and 71 cents, down 0.3%. Reports of inventories building up in the US. Let's cross over to Asia right now. Check in with Winnie Su in terms of how the Asian markets are faring. Winnie's standing by in Hong Kong. Winnie.
Yeah, morning, Tom. It seems like Asian markets also under a bit of pressure today for declining for the fourth day, and its longest losing streak since August. And here it really is that nervousness ahead of Nvidia's earnings, as that's going to give us more direction in terms of where this AI outlook is going to be, especially when we already have so much concern around the valuation for technology shares. And hence, yes, we're seeing lots of pressure on technology names today, specifically with the Kospi down about 1%, and that is inching closer to that technical correction level. And another market that we're closely watching is the Japanese market. And we flip the board and take a look at the Japanese bonds, because we just had that 20-year bond auction today. And here you can see that the auction results actually came in line with the 12-month average, but it's not particularly strong, and hence yields remain elevated. You can see that the 20-year bond yield and also the 30-year bond yield still around the highest level in more than 2 decades. And it really goes to show how investors remain very cautious in terms of Takaichi's fiscal expansion policy, and ahead of her first economic plan expected to be announced later this week. Now, another thing that we're really closely watching is that development when it comes to the relationship between China and Japan. Now, we take a look at how markets are reacting, because here it's a very clear picture when it comes to the seafood stocks. You're seeing top 2 stocks from Chinese seafood companies jumping while the Japanese ones are falling. And this is coming after the Japanese local media said that Chinese government is now going to ban Japanese seafood import. And it
Exchanges on navigating macro uncertainty. Exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on Exchanges, the Goldman Sachs podcast. Listen now.
News when you want it with Bloomberg News Now. I'm Doug Krisner. Congress has voted to compel the Department of Justice to release its files on sex trafficker Jeffrey Epstein. This legislation passed the House 427-1, and now the Senate has unanimously passed it without further action. Senate Minority Leader Chuck Schumer says the American people and Epstein survivors have waited long enough.
This is about holding accountable all the people in Jeffrey Epstein's circle who raped, groomed, targeted, and enabled the abuse of hundreds of girls for years and years.
That is Senate Minority Leader Chuck Schumer there. Now, President Trump has said he will sign the legislation after initially opposing the release of the files. It requires the release of all files and records related to Epstein. That would include investigations, flight logs, and internal DOJ documents. Earlier today at the White House, President Trump hosted Saudi Crown Prince Mohammed bin Salman. It was there, the prince said, his country would be increasing its financial commitments to the U.S. from $600 billion to $1 trillion. And later in the day, Trump said he has signed the U.S.-Saudi Strategic Defense Agreement.
I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally.
Now, that designation does open the door for further collaboration between Saudi Arabia and the U.S. military. President Trump has reportedly signed off on possible operations inside Venezuela. The New York Times reports Trump authorized the CIA plans for covert measures that could be meant to prepare a battlefield for further action. The Trump administration is taking more steps to shut down the Department of internal DOJ documents. Earlier today at the White House, President Trump hosted Saudi Crown Prince Mohammed bin Salman. It was there, the prince said, his country would be increasing its financial commitments to the U.S. from $600 billion to $1 trillion. And later in the day, Trump said he has signed the U.S.-Saudi Strategic Defense Agreement.
I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally.
Now, that designation does open the door for further collaboration between Saudi Arabia and the U.S. military. President Trump has reportedly signed off on possible operations inside Venezuela. The New York Times reports Trump authorized the CIA plans for covert measures that could be meant to prepare a battlefield for further action. The Trump administration is taking more steps to shut down the Department of Education. Officials say some of the department's largest grant programs and major portions of several offices will be transferred to other federal agencies. Education Secretary Linda McMahon tells CBS News she hopes this action will convince Congress that these steps are necessary.
If we can do that, then hopefully then we can get Congress to vote and to codify those transfers and make it a permanent move.
That is Education Secretary Linda McMahon speaking earlier to CBS News. Paramount Skydance is rejecting a report claiming the company is working with Middle Eastern sovereign wealth funds on an offer for Warner Brothers Discovery. Paramount calls it categorically inaccurate. Earlier, Variety reported Paramount Skydance is working with Saudi Arabia's Public Investment Fund along with the Qatar Investment Authority and the Abu Dhabi Investment Authority on a bid worth $71 billion. President Trump said today he thinks he's identified a choice to be the next chair of the Federal Reserve. He said people are holding him back from firing the current chair, Jay Powell. Here is Trump speaking with Bloomberg's Anne-Marie Hordern in a Q&A inside the Oval Office.
We're getting closer to the end of the year. Have you started the interviews for the Fed chair?
Yes.
Who have you interviewed?
I think I already know my choice.
Who is it?
Well, I liked him, but he's not going to take the job. He refused. You like Treasury better, right?
Much better, sir.
That is Treasury Secretary Scott Bessent, who is incidentally leading the search. Now, Bessent has said the pool of contenders has been narrowed to current governors Chris Waller and Michelle Bowman, along with former Fed Governor Kevin Warsh. Also, the director of the White House Council of Economic Advisors, Kevin Hassett, and BlackRock executive Rick Reeder. Before the opening bell tomorrow, Target is set to release its third quarter results. Bloomberg's Tom Busby has a preview.
Despite a lot of U.S. consumers pulling back on their spending last quarter, investors will be looking for signs that heavy promotions, strong back-to-school demand, and a new CEO help the discount retailer snap out of a recent sales slump. Although Bloomberg consensus calls for comp sales to fall about 2%, revenues are expected at $25.33 billion on adjusted earnings per share of $1.73. Tom Busby, Bloomberg Radio.
A Gustav Klimt portrait of a young Viennese woman sold for a record $236 million at Sotheby's in New York. The portrait of Elizabeth Lederer was part of the unwinding of Leonard Lauder's art collection. The former executive and billionaire died in June at the age of 92. This portrait was part of a trove the Nazis stole from Elizabeth Lederer's wealthy Jewish family in Vienna. And that is News When You Want It with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
Exchanges, the Goldman Sachs podcast featuring exchanges on navigating macro uncertainty, exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on exchanges between leading minds at Goldman Sachs. New episodes every week. Listen now.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. edition.
Allow you to look to the future with confidence.
They're also feeling that markets are perhaps a little overbought. So I think across the spectrum, we are seeing cause for concern.
When we talk about where the concern is, does that lie with the consumer and their ability to spend? Is it more about the CapEx cycle that we've seen with AI, or, as you just references, with regards to Jamie Dimon and the cockroach comment, the idea that you have a whole private credit, private equity industry that, at least what we know publicly, seems to be obscuring maybe a bit of pain underneath the surface?
Before I came on, you highlighted all the information that markets are having to deal with, this deluge that we're seeing right now. And it certainly is a lot to cope with and a lot to analyze. But what we do know is that there is a system there and there is an interdependency. So the cockroaches are dependent essentially on consumers' ability to repay their subprime auto loan, for example. That's a sign of strain at the lower end consumer. We've spoken about the K-shaped economy, and that consumer is at the bottom right-hand corner of that K. They are definitely under strain, and that's some of the sentiment there. And then where all the hype has been, where Main Street has been celebrating Wall Street, has been in the concentrated positions in big tech. And big tech, we know, is really trading at some unsustainable valuations. And then bringing it back to Main Street, we know that Michael Burry has been in the news. We've seen some other big shorts. We've heard about Peter Thiel selling down of NVIDIA. These are the kind of celebrity owners that definitely the retail buyers will latch onto. When we see them calling a top, that I think sends some kind of trickle of fear into markets that maybe that 40%, that concentrated bit of the stock market, is overbought. So I'd say we're really seeing concern across the board, and it is a system. They are interconnected.
Yeah, well, let's talk about this interconnection a little bit more, because you think about the last few weeks, really one of the hot topics has been how interconnected these different deals are between the mega cap tech companies, happy Monday, and whether or not, that introduces a bit of daisy chain risk, that you're basically tying together the fortunes of all these different companies, at least to some extent, Ethan. And I wonder, if you are concerned about that, just how much that raises the stake on NVIDIA earnings, for example.
It absolutely does. All roads lead to NVIDIA. All roads also lead to OpenAI. That's obviously not a traded stock, so we can't be reading too much into that in terms of the stock price or earnings. But we know that there is this interconnectivity, and we don't know how this house of cards will fall if it does. And you mentioned a daisy chain. I think the issue is there are some very large players, some very small players. And the small players, for the most part, have been really riding on the crest of this wave. And so there's actually such a lot of contagion that is possible. The way investors and how we are recommending at Moneta that we address this is you really have to assiduously rebalance away from that chain, away from that interconnectivity. We cannot do it completely in that we know a lot of small cap depends on that. But if we focus on some of the global diversification, get away from big tech, get into pharma, get into financials, get into some of the energy stocks, this, I think, will be giving us better diversification. Energy, we know, is linked to all of this data center talk, but we also know that the demand for energy seems to be massive right now and not showing any signs of that falling.
Well, Ethan, I also wanted to ask, of course, when it comes to sort of what we have to look forward to this week, NVIDIA earnings obviously loom large here. We also have a lot of retail earnings. We also have plenty of delayed data reports that we're going to finally get to see. But how much water can you put into that, so to speak, given that they are so delayed at this point, maybe still beyond the point of being useful?
Even before these delays, we knew that some of this data was not necessarily 100% reliable. We saw a lot of backward-looking revisions, and that did undermine some of that credibility. But this data is really critically important right now because we know that this is probably what the Fed will use as its final deciding data points when it comes to its December decision. So the lack of that, the kind of data, the absence of black hole was definitely a problem. They said they were navigating in fog. Now we say there are trade-offs that have to be made. They've been talking about tug of war. All of this imagery around a Fed that is not necessarily seeing a very clear path. This data, if it is weak, it's going to be that good news, bad news, kind of conundrum that the bad news on data will be good news for interest rate cuts. And that will be good news for homeowners, for borrowers. And it should be a nice run into the end of the year, which is otherwise looking a little uncertain because of all of these cracks, so-called, in the tech space that we've been highlighting.
Ethan, always great to talk to you. Ethan Devitt, Senior Investment Advisor at Moneta, keep kicking us off to the close here on this Monday afternoon with stocks now testing fresh lows here, and a big focus this week on the consumer. Some big earnings reports out of some of the biggest consumers. The holiday shopping season just around the corner. We catch up with Naveen Jaggi, President of Retail Advisory Services at JLL.
And speaking of consumer sentiment, Butterball CEO Jay Jandrain discusses America's appetite for turkey this year and what he's seeing in terms of demand heading into Thanksgiving.
And then it's wheels up for the holidays. Flyjets. We're going to talk to Jessica Fisher, giving us her outlook on travel this season as things are as turbulent in the post-government shutdown up above. That's coming up next here on The Close. This is Bloomberg.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Amazon's first U.S. bond offering in 3 years, set to raise $15 billion. Another testament to the need for funding flexibility in the era of AI spending. Here to break this all down is Robert Schiffman, who covers tech and credit over at Bloomberg Intelligence. Robert, great to have you with us. This seems like a real sign of the times, the fact that Amazon is tapping the public bond markets for the first time since 2022. What does this say? Why tap the bond markets versus look to free cash flow, for example?
Well, I think you better get used to it and get used to having me on, because this is not going to be the first conversation. There is a lot of money to raise over the next few years because there's a lot of money to spend to build infrastructure, because there's just a tremendous amount of demand. The type of demand I don't know if we've seen for any product, maybe since the automobile started to come around to chase the horse and buggy. So what does it mean? It means that Amazon, along with Meta and Microsoft and Alphabet and Oracle and probably a host of others, think that there is money to make out there. And the reality is they can't make that money over time unless they put the money into infrastructure right now. Many of the companies are very differently positioned. Amazon is much differently positioned than some of their peers, which gives them, I think, an enormous leg up. We can talk about that in a second, but this is just the start of things to come.
just the start of things to come. And it's an interesting chicken and egg situation because, I mean, you think about Amazon and some of their peers, they have best-in-class credit ratings, but part of the reason they have those ratings is because scarcity creates value. They don't issue that much debt, and I'm not suggesting that they're going to get downgraded anytime soon, Robert, but I wonder what you make of that dynamic.
It's actually a bit of a misnomer. They do have a lot of debt. You know, Amazon's got $50 billion of debt out there, and if you include all their leases, it's $350 billion of debt. If you look at names like Apple, they're sitting on $100 billion of debt. Oracle's over $100 billion of debt. These companies have raised money over the last handful of years. The real question is, why haven't they raised more? And simply, the vast majority of the funds that they were making were used for shareholder returns. And now that they have something real to spend it on, quite frankly, the government limited a lot of what they can do from an M&A perspective. And we always thought they should raise more. If you think about their weighted average cost of capital, you know, their weighted average cost of debt is effectively zero, and their cost of equity is 10%. So why weren't they issuing even more? Why didn't they have $200 billion of debt and buy back more stock? And I think these guys have foresight. It's as simple as that. The CEOs, whether it's at Meta or Microsoft or Alphabet, these guys saw this sort of spending spree coming, and they wanted to make sure that their pockets were deep enough that when they needed to spend the money, it was going to be there. But quite frankly, the amount of money they're going to need to spend over the next few years is even bigger than that. We wrote a note the other day saying that the big 5 or 6 were going to spend about $3 trillion over the next 5 years on AI CapEx. And when you start throwing in the others like CoreWeave and Anthropics and all the others, you know, maybe that number's more like 4 or 5 trillion.
But to your point, though, Robert, just about the idea that some of these companies were already sitting on a lot of debt, I do want to go back to Oracle's sale a month or two ago, $18 billion bond sale. I mean, they were already sitting on like $100 billion in debt as it was. They kind of dominate several of the key investment grade indexes. And I'm wondering if, as we see more of these larger companies take on more debt for something that, at least right now, is still a questionable ROI, is there any concern about any sort of risk, systemic risk, to some of those broader bond indices if anything does intentionally go wrong?
Well, the general answer is no. It's certainly company specific. You know, other than Oracle, the other names that we're talking about are all AA or maybe AAA companies. They're actually generating massive amounts of cash. They've got little to no leverage. In fact, many of them have negative net leverage. So the amount of financial flexibility that exists in those systems is extraordinarily high. If they ended up making mistakes and their sunk costs, and they have to pull back in the next few years on their CapEx, I don't think that's going to matter whatsoever in terms of their credit rating. We haven't seen one of these big companies have a credit rating turn negative. Oracle's a little bit different. Oracle, over the last handful of years, has been spending money on acquisitions and shareholder returns, levered their balance sheet to BBB, and is really pushing the limit. The way to get around that for a name like Oracle, though, is you start doing off-balance sheet financing. They're not the other ones. You know, Intel was the first really to start this with Foundry JV. And then we saw Meta, and we're likely to see Oracle. So there's still a lot of flexibility in the system. This whole concept that we're about to enter some sort of bubble that's about to burst, I don't think people could be more wrong. There's a bubble, but it's a bubble of demand, and it's going dramatically bigger. I don't see risks throughout the system at all. Now, listen, could there be idiosyncratic risks? Yes. As you move down the curve, as you move into high-yield land, and you start thinking about names like CoreWeave, the risks get higher. But the reality is there's revenue on the back end of that. And for all those naysayers that don't believe that those revenues are there, I think they're going to be proved sharply wrong.
All right, Robert, we got to leave it there. Robert Schiffman over at Bloomberg Intelligence. A closer look here at Amazon and some of the other big hyperscalers going to the debt market to fund their AI dreams. When we come back, we're going to talk about an unlikely player in the AI race, and it's Caterpillar. A conversation up ahead with Tammy Zakaria when we come from JP Morgan when we come back after the break. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Let's get to our top calls. Big movers on the back of analyst recommendations. And we start off with Yum Brands, the owner of the fast food chains KFC and Taco Bell. TD Cowen upgrading to buy, boosting the price target to 173, saying the decision to sell the lagging Pizza Hut franchise would amplify Yum's growth profile. Those shares unchanged on the day. Next up, let's take a look at Gap. Barclays upgrading to overweight, boosting the price target to 30 from 19 to analysts, lauding the retailer's new leadership for turning around the company and saying that they see long-term sales and margin recovery across all three of Gap's primary brands. Those shares, though, down about 2% here on the day. And finally, we got to talk about Dell. Morgan Stanley double downgrading to underweight, the only sell equivalent rating right now among the analysts tracked by Bloomberg. The analyst also slashing his price target to a street low $110 a share, saying a memory supercycle brings downside risk to the computer maker's earnings in 2026. Dell, those shares now near session lows, down about 10% on the day, and those are some of our top calls. We're also keeping eyes on shares of Caterpillar, despite the broader sell-off, trying to hold their own. They're only down fractionally here on the day, trying to hold on gains on a year-to-date basis. The catalyst? AI. As the AI boom continues to ramp up, Cat is capitalizing on the excitement by doubling the capacity of its gas turbines to help meet demand to power data centers. Our next guest says it's one of her top picks. Here to discuss is Tami Zakaria, Head of Machinery, Engineering, and Construction Equity Research at J.P. Morgan. Great to see you, Tami.
Great to be here.
Let's go back to that earnings conference call, because they did talk a lot about the AI boom and how they actually stand to potentially benefit it, particularly when it comes to their production of, to their supply of gas turbines.
So I would say when it comes to Caterpillar, one interesting thing we saw in the last few weeks was they hosted an analyst day. And there, two things stood out to us. One is they shared long-term 2030 sales and margin targets, unlike a traditional cyclical company, but more like a multi-industry growth company. And the other piece is, like you said, AI. They talked about more than doubling revenues tied to power generation products through reciprocating engines and turbines. And in a nutshell, the way we say that this is one of our top picks, and that is because Caterpillar will benefit from some of these mega trends, be it construction tied to infrastructure investments, Fed rate cuts benefiting construction, and eventually data center-driven ecosystem growth that will benefit Caterpillar over the next 3 to 5 years.
Do you have confidence as an analyst covering this sector that data center growth, the power generation demands, et cetera, that is going to be long-lived, or is this maybe potentially a shorter cycle?
That is a great point, and I would say Caterpillar's capacity expansion extends beyond just backup power generation for data centers. The reciprocating engines, the turbines we're talking about, it's not just for prime power, it's for prime power, backup power, oil and gas extraction, transmission, refining, marine applications, mining. So there's a whole host of use cases which will help to eventually add power to the grid, and Caterpillar should benefit from that whole ecosystem developing.
And looking forward, I mean, earnings season never ends. We have Deere reporting next week. When you think about, what we learned with Caterpillar, especially some of these potential AI tailwinds, can you extrapolate any of that into Deere earnings next week?
Unfortunately, no. And I remember I was here around this time last year ahead of Deere's earnings. And the way this year has played out is their earnings have contracted because of the weakness we've seen in farm income. And unfortunately, right now, it's not looking a whole lot different as of the moment. And that's because this is not a new news that China has not been buying soybeans from the U.S. pretty much at all this year. And so this has impacted farmer sentiment. It has impacted farmer earnings. Earnings are getting somewhat of a buffer from all these care packages and the handouts the government has paid out. But sitting here today, the big question is what happens to tariffs? There is still significant tariff headwind, which, if not mitigated, will impact earnings and margins. So while we think the worst of the demand destruction or decline in large ag equipment is probably behind, there are still lingering issues which make us relatively unenthusiastic heading into the Deere earnings report.
Well, it's interesting to hear you say that because, I mean, we've been having this conversation about farm incomes for a while now. They predate, of course, the second Trump term. And you have to wonder, I mean, what sort of breaks the cycle. And at this point, we could be entering into a situation where Deere especially that they're up against pretty easy comps, just given how long this has been an overhang.
So that brings up an interesting point. The farm economy is actually pretty cyclical. We saw record high farm income not too long ago, back in 2022. Since then, corn prices have come in more than 50%. Soybean prices have come in more than 50%. So farm income actually is correlated to crop prices. Mm-hmm. So you need crop prices to rebound. How do you get there? Either there's a supply shock or there is incremental demand or use cases. And that brings me to your AI question. Let's say in an effort to add power to the grid, you come up with technology and solutions that use biofuels, biodiesel, in which case we will see increased demand for corn and soybean. In that case, companies like John Deere can be a beneficiary of the AI boom. But as of now, the technology is not developed yet, right, or commercialized to that extent. And hence we are seeing this sort of normalization of income from very peak levels back in 2022.
All right, Tammy, great to get some time with you, especially ahead of those Deere earnings next week. That is Tammy Zakaria. She is head of machinery engineering and construction equity research over at J.P. Morgan. Romaine.
Meanwhile, we want to go down to Washington. The President of the United States was just speaking. He was asked a few questions about his relationship with Mexico. He said, quote, "I'm not happy with Mexico," and he seemed to allude to the idea that some of the tactics that the United States has been taking against Venezuela could be applied to Mexico. You're now seeing the Mexican peso at its weakest levels of the session. Remember, the peso had been strengthening versus the U.S. dollar for most of the year. Also, keep an eye on Lockheed Martin, ticker LMT, right around session highs on the day after Trump also said that he will approve the sale of F-35 jets to Saudi Arabia. This is Bloomberg.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Rough Monday for stocks, of course. The S&P 500 continuing its downdraft. And boy, we have a lot of earnings to get through this week. NVIDIA, sure, of course, it's coming on Wednesday. But we also have a lot of retail names as well.
Yeah, this is actually, believe it or not, I think one of those weeks where I actually am less interested in NVIDIA. Not that it's not going to be, I know, it's a bold statement.
Yeah, given that we'll be breaking those earnings.
Send your emails at katiegreifeld.com. but in all seriously, we get Walmart, we get TJX, we get Lowe's, Home Depot. I'm forgetting a few others. So you're getting a lot of these big retailers, and all we've been talking about for the last few weeks has been what's the health of the consumer? Are they spending? If they have the money, do they not have the money? Are they delinquent? Are they not delinquent? And look at this chart here, Katie Greifeld. You were just telling me about this chart.
Yes.
First time I've seen it. Tell me what it's telling me.
So the blue line is general merchandise stores, and then the white line, Bloomberg's U.S. second measure consumer spend. The point being that you take a look at both of those lines, especially the blue one, they're going down, Romaine. That is typically a bad sign, and it just speaks to what we've been talking about, what you're talking about right now, about how consumers are feeling, whether they're willing to reach into their wallet. So let's keep the conversation going with Naveen Jaggi, President of Retail Advisory Services over at JLL. Naveen, great to have you with us. So I want to start with more of the home improvement type stores, because we have Home Depot coming up tomorrow. We have Walmart a little bit later on in the week. And there seems to be this reluctance, if you take a look at the past couple months, to spend on big ticket items. And I wonder, in your view, whether you think that we're going to see that reluctance front and center this week.
Yeah, I think that the desire by the consumer to spend on big ticket items, whether it's homes or cars or large tickets, will continue to go on through the holiday season. There's been a continual drive by consumer to save their dollars and get the most that they can out of their spend. And we did a survey of consumers, over 1,000 consumers a couple of months ago. What we found out was the broad spectrum of the 1,000 consumers said they were spending less this year in 25 than in 24. Of course, when you break that down, though, just the top 10% of the U.S. earners are spending more. So that means that the bottom 90% of the U.S. consumers will not be spending as much. So they'll be going to value retail to get their most bang for the dollar. So when you look at Walmart, for example, I'm bullish on them, and I'm very bullish on TJ Maxx and Ross's example. I think people like Home Depot and Lowe's are struggling to find a way to get that consumer to come into the store more often because they're not spending money on home improvements today because they just don't know where their dollar is going to spend.
That's really interesting, Naveen. So to kind of crystallize that point, it sounds like you're saying there's a trade down trade that exists when you're talking about a Walmart, a TJX, for example, but Home Depot, Lowe's, they don't necessarily have that.
Yeah, they don't bring the massive consumer in to spend across the board. I mean, one of my examples would be Walmart, for example, saying that Walmart's one of the only few retailers, besides maybe Target and a couple others, but that can bring a family in and do all their shopping at one time. Walmart is the #1 grocer in America today. 20% of all grocery sales are going to Walmart. That tells you can go to Walmart and you can pick up not just groceries, but blue jeans, toys, and home accessories. That's a distinction that Walmart plays. I think they can lean into that much more in the holiday season.
I am curious, Naveen. I think the last time we spoke, we kind of talked about the idea that, you kind of had this upper income group of people who were kind of keeping the whole economy afloat, basically the top 10% or so of earners out there, and they were accounting for the vast majority of spend. Not to be pedantic about it, but does it matter if the other 90% is not spending? I mean, if we know that the top 10% has the money and is willing to spend?
I'm not sure that's a sign of a healthy economy. It may be a sign of an economy that's doing well because of the top 10%. But I think we've talked about this for years. What we need is a healthy economy that's across all income brackets. And if we lean too heavily on that top 10% to drive it, over time what we're going to see is that second, third, or fourth tier consumer will continue to hold on to their dollar longer and longer. And they may actually say, you know what, we just won't spend money this year. We'll hold back for sales post-holiday. When you look at sales post-holiday, what does that mean? That's margin contraction for the retailer. We need all consumers to be able to have a healthy approach to consumer spend. And right now the sense is they're not seeing the biggest bang for the buck across the entire consumer spectrum. That, to me, is worrisome long term.
I mean, based on the work you do, I am curious about just how some of these companies are approaching this. Earlier this year, I was looking at some data showing the number of retail closures, of physical store closures, and this was backdated, to 2024 data, but still, it gave you a sense that there has been a retrenchment, even heading into at least what at the start of the year was a relatively decent economy for spending. Are you seeing more evidence that retailers will pull back even further, either this year or into next year?
I'm not seeing evidence of retailers pulling back. I think the healthiest retailers, and we've got them on the list that you had showed a little while ago on the graphic, to me, they'll continue to grow and they'll continue to spend. I think the big burst of closures and contractions we saw, that's probably at its peak in 25. I don't see 26 repeating that. Between Joann's and Bed Bath & Beyond, Party City, a number of those are significant closures that provide a lot of opportunity for a lot of retailers to grow. That I see will continue on in 26, maybe into 27. But I think I look forward to that area between 27 and 28 as the big challenge as we don't see development feeding new opportunities for retailers to grow. I think that's when I'll start looking at concerns about the real estate sector. Can they support the supply of the value retailer?
Well, I'm curious about something you just said there. The idea with some of those closures, like Party City, Joann's, when you say the ability to grow, is that business transfers to the surviving businesses that maybe pick up some of what those companies did?
That's right. So there's a lot of retailers that actually took advantage of those closures, right, to make sure they could grow. So whether it's Dollar General and many others, for example, that were doing that, Burlington, as a prime example, took advantage of that back in the summer this year and prior to last year. Well, all those stores have been swallowed up, and you can't count year after year on more and more closures to provide the supply for retailers that want to grow. So at some point, that's going to catch up to the retailers. I think, to me, because we're at historic lows on development, that 27 to 28 time period is when I start getting worried about the fact that counting on bankruptcies to supply the growth of retailers is a challenging game you can't count on for too long a term.
And Naveen, I do want to acknowledge that we're having this conversation on the 17th of November. Of course, we are rattling into the holiday season. Holiday shopping has certainly started. And when you take a look at where we are right now, what are you seeing in terms of promotions, in terms of, deals coming through? And how does that compare to maybe last year and the year before?
Well, we're in a heavily promotional environment right now. We also have a very, very short holiday season, right? Thanksgiving is at the end of the month. So we'll have less than 25 days for the holiday season, if you want to call it that. And so to me, Black Friday is no longer the significant retail consumer day. Promotions from every retailer I know of, and I'm on their mailing list, is very heavy right now, 20, 25, 30% to spend online. To me, if we continue to see that, it may be a good sign for consumers who are bargain hunting. But from a retailer standpoint, that to me shows challenge, because once you get to December 26th and 27th, you'll have to slash prices even more so to make room for your spring and your summer gear. So I'm thinking low probability of a big boom in retail consumer spend after December 25th.
It's funny you say that, because Naveen, I've been getting a ton of emails already with some of those discounts you just talked about. Is there a sense, though, that those discounts will ratchet up as we get closer to Christmas, or will it be like kind of stagnant?
No, I think we'll see a lot more ratcheting up because we're having such a short holiday season. The consumers are looking for the best bargain. Every retailer is fighting for the same dollar. The quicker you can get that sale and promotion out there to move that product, the better. So I'm seeing those promotions happening now, and we'll continue to see them. Don't be surprised that the last week to week and a half of the holiday season, we'll see massive discount cuts to get that product moved off the shelf.
All right, Naveen, always appreciate it. One of the best in the business there, Naveen Jaggi, President of Retail Advisory Services at JLL, as we count you down to the closing bells here in New York. Just about 20 minutes to go. When we come back, we're going to take a closer look at the Oracle of Omaha's firm adding to its alphabet position. That's coming up next in our Stock of the Hour. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/NTech.
All right, more than 400 stocks in the S&P are lower on this day, but one big one is higher. Alphabet. The shares at one point on the day hitting a record high on an intraday basis. This after Buffett's warrant Berkshire Hathaway revealed that it's building a stake in the parent company of Google. Joining us right now is Nora Melinda, our markets correspondent, to talk a little bit more about Warren Buffett's affinity for Alphabet. What's going on here?
I mean, this was a surprise to some, not too much of a surprise to others. Of course, we know that Warren Buffett has definitely been a critic, a bit skeptical of a lot of these tech companies, but we do know that he actually did have position in Apple since about 2016, 2017. So some people are saying, hey, it's not too surprising that he would hop in here on a tech-related company, but I do think this felt as though a departure from a lot of people's perception of where he stood here when we think about tech companies more broadly.
And we should just be clear, too. I mean, a lot of the investment decisions being made by Greg Abel and a couple other folks, too. So I'm sure they had a big sway in whether to buy this.
Yeah, absolutely. You have to wonder why now, because it's not as if Alphabet is cheap or if it's even been on sale this year. It's higher by about 51% on a total return basis. I know that, it's been spoken about in the past in the context of Berkshire Hathaway, but the timing is certainly interesting here.
The timing is something to really dig into. I mean, if you think about Alphabet shares, we came into the year actually at a negative. So you did see really a massive surge that we've seen so far year to date. And of course, a lot of people are really concerned about how they are going to match up against a lot of the AI chatbots. Think of ChatGPT. There's a worry, a concern about the fact that people are going to start using these platforms as opposed to Google search. And so they did see a lot of sensitivity in that space. But then as we looked at the third quarter, it seems as though they actually did okay in terms of the Google search capabilities and the traffic that they were actually generating. So there is some discussion as to whether or not this may have seen to be an opportune time period for Warren Buffett's Berkshire Hathaway to hop in here.
Now, it's kind of interesting. There was another story involving Alphabet that crossed the terminal a little bit earlier, and this has to do with a lot of the online travel agencies here. There was a report out that, I guess, Alphabet is testing like a new sort of search tool for flights or something, and we saw like Booking, Expedia, all these stocks just crash on this. What's going on?
So as I was looking into it, it kind of reminded me a little bit of what it's like with ChatGPT. Say you're going on a trip with friends and you're saying, hey, these are the dates that I'm going.
Yeah.
Build a plan for me. That's essentially what this AI tool should be able to do on Google. And so as you're thinking about booking hotels, you're thinking about booking airline flights, anything of the sort, if you're able to do all of this on the Google platform without actually having to go to, say, booking.com, there is some discussion as to whether or not this will pressure those individual companies here.
As somebody who was just, stuck in the airport 2 weekends in a row, let me just say, Google failed me both times.
Oh,
so.
no.
Sorry to hear that. I hope you're recovered. Or, I don't know.
I'm a little bitter, but I'll get over it.
You did fly this past weekend, so
I
clearly
did.
you're
I'm here
in the studio.
You're here.
I mean, hey, if Rob Schiffman can make it here, then,
That's true. That's true. Nora Melinda, great reporting as always. That is our markets correspondent. Meanwhile, we're getting some interesting Fed speak headlines. This coming from Christopher Waller, backing basically a December rate cut for, quote, risk management, Romaine. He delivered these remarks in a speech called explicitly the case for continuing rate cuts. So maybe not a surprise, but
case for continuing rate cuts. That's a little on the nose, isn't it?
Yes,
It's kind of interesting, too. We should point out, he's kind of said something similar to this before, this idea of kind of risk management. But I want to sort of put that up against what we heard earlier today from the vice chair of Philip Jefferson, who kept talking about things being transitory. He didn't use the word transitory, but he basically implied the word transitory. So I'm a little confused as to what Fed members are actually going to debate at that December 9th, 10th meeting. Because you have some people think we need rate cuts now, and others saying, this will all pass.
I'm sure it's going to be a robust discussion because
how would you vote?
How would I vote? No comment. Coming up, we're going to take you to the closing bell with Venu Krishna, head of U.S. equity strategy and global equity linked strategies over at Barclays. This is The Close.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
CPA. 3 letters that stand for limitless possibilities. Because a CPA Australia designation makes you a trusted advisor in tomorrow's economy, gives you leadership qualities for a seat at any table, and expertise to create a sustainable future. With the letters CPA after your name, you will always be limitless.
Nvidia, all roads also lead to OpenAI. That's obviously not a traded stock, so we can't be reading too much into that in terms of the stock price or earnings. But we know that there is this interconnectivity, and we don't know how this house of cards will fall if it does.
Ethan Devitt over at Moneta kicking us off to the close just about 50 minutes ago, and not getting a whole lot of help today from Nvidia and the rest of the tech horde, dragging the entire market down right now. In fact, we're setting up for a third straight day of losses for the S&P, something we haven't seen, Katie, in about 2 months.
Yeah, absolutely. You can see we're off our worst levels of the session, but still, that means the S&P 500 is still down about 1%. What's interesting to me, Romaine, is that you take a look at volume right now, we're below average, actually, relative to the 30-day average, about 5% below that. So, again, not a lot of muscle behind this selling, but, I mean, it doesn't matter when you're still off by 1%.
Yeah, I was looking at that. So volume a little lighter, but you're still seeing volatility up. And then, but I was looking too at the turnover that you're seeing in a lot of the, at least when you take SPY, for example, which tracks the S&P. I think I saw a great stat by the folks at Bloomberg Intelligence, how we were over 60 billion the last couple of sessions. And I have to check to see where we are today. I know we were tracking a little bit below that, but that's a bad sign.
Yeah, absolutely. They have like a panic level. And when you see it over that specific threshold, which I can't remember what it is, it might be 60 billion.
Can I just say something? I talk to you a lot.
Yes.
And usually you just look at me with this dead look in your eyes. But anytime I mention anything ETF related, you perk up.
Right, the
like
light
that
comes
is,
down.
that's like your...
I thought I was doing a good job at hiding it. But anyway, stocks are down.
Stocks are down here as we move closer to the closing bells. Just about 8 minutes until we get there. Vinu Krishna joining us here in Studio 2, head of U.S. Equity Strategy and Global Equity Link Strategies at Barclays. Great to see you.
Thank you.
I do want to talk about investor sentiment right now. There's been a lot of talk about this pullback that we've seen over the last few days, but it's really kind of been playing out really over the last few weeks. We haven't had massive sell-offs like this, but certainly a bit of a retrenchment. And I'm wondering if there was anything you saw that maybe it would have tipped the people off to the idea that this was coming.
So two things I think have happened, which sort of gave an indication. One was that increasingly the market realized that, one, the AI capex needs were quite substantial, and two, that funding started moving to the credit markets, where equity markets in general started getting a sense of where risk is being priced and where it's clearing in the credit markets, right? And the sheer volume of that, at least initially, has overwhelmed the credit markets. The second thing is what I would say a little bit of a pullback from the retail investor. So as we were talking about earlier, we launched a Euphoria Index in equities, which picks up information from the options market and covers a fairly broad swath of the market. And what we noted about, call it 3 weeks ago, is that it had peaked at close to 15%. That is 15% of the stocks we track, 1,500 sample, were trading at euphoric levels. And this compared to a long-term average of, call it 6 to 7%. So our view was that this is very high, and that always suggests that be ready for a pullback. And what you're seeing is a pullback indeed, and retail specifically so.
There's evidence that a lot of the run-up that we had in stocks this year, that truly indeed was driven by the retail segment? I know we've said that anecdotally, but is there data to back that up?
Yeah, I mean, I think based on the work we have done, it suggests to us that retail, in fact, has been more consistent buyers, and they've been more right than wrong in the big picture. In fact, on the other hand, institutional investors, including hedge funds and long only, have broadly been underweight the sectors of the market which have powered all the gains, which is mainly tech, especially big tech. But that said, more recently, we have seen some caution on the retail side. There's been less upside chasing through calls. There's been incrementally a greater share of protection buying from that particular group. So just a little bit of a caution. Doesn't necessarily mean that it's a complete meltdown, but a little bit of a pullback from the retail side. Yeah.
Well, when it comes to the institutional side of things, an optimist might hear what you're saying, that institutions are underweight some of the areas that have driven the market higher, and they might build a bullish case that actually you have some money on the sidelines from some of the big guns here. Do you share that view? What should we make of that positioning?
Well, generally, we remain optimistic, right? When I peer into next year, and this is coming off an extremely robust earnings year, which is surprise to the upside. You look at Q2, you look at Q3. Q3 is running at almost 15% earnings growth on sales growth of about 6.5% to 7%, which means a tremendous amount of operating leverage in the sort of S&P 500 companies. And if you look at next year, we still expect earnings to increase 10 to 11%. So I think we are coming off a very strong base, and things don't look to decelerate significantly next year. And don't forget, we're also in a rate cutting cycle, right, which is, broadly speaking, positive for equities. Right. On the other hand, you're balancing it with the labor market being somewhat weak and inflation being somewhat sticky. So I think on the margin, though, it's hard to say that there's an imminent big pullback in the horizon, even though there are pockets of optimism certainly riding out there.
Well, I'm curious to get your thoughts on big tech, and I'll ask you the question of the month that I've been asking, which is you take a look at what's going on with a lot of these big tech companies, Amazon in particular today, the announcement that they're raising $15 billion, their first U.S. bond sale since 2022. When you have your mega cap tech companies really hitting the bond market, I wonder if that changes how you think of them as equity investments, because one of the reasons that folks like big tech and find it attractive attractive is the fact that they have these pretty disciplined balance sheets. Not saying that they're not disciplined, but it seems like that dynamic is changing a little bit.
It's a very good question. First, a disciplined balance sheet doesn't mean zero debt, right? In fact, traditional finance theory would argue that there's an optimal amount of debt you need to have in the balance sheet to, by the way, maximize the value for equity investors as well, right? So I think companies like the hyperscalers who are tremendously cash rich, and you throw out a huge amount of free cash flow from their core businesses, them tapping debt markets in itself is not a big flag for worry at all. So if you think about Amazon, market cap is what, in the $3 trillion plus range?
A gazillion.
Right? And you're talking about $15 billion in dollar amount of debt.
Right.
So that's not, in itself, not a big deal. I think the bigger question is, if we are talking about trillions in capex to come over the next, call it, 2-3 years, and then so far the funding has been done through organic cash flows for the hyperscalers, but increasingly now they have to look at the credit markets as well. So the question is, what is the scale of funding? How much of it goes to credit markets? What parts of credit markets are going to absorb that paper? And like I said, most importantly, where does that risk get priced? And where does it clear? That certainly will give important indications to the equity markets. Because if folks, theoretically higher up in the capital structure, are worried about credit risk, then equity investors should care. If you look at Oracle, that's a great example. You've had, after a lot of enthusiasm, its credit default swaps have more than doubled in the last 3-4 years. You have had equity wall pick up and equity decline. So there is a relationship between these markets. It's just that now as equity investors, we have more data points to look at across the capital structure.
All right, Vinu, great to have you as always. Always smart. Vinu Krishna, head of U.S. equity strategy over at Barclays, as we break down all of the price action here on this Monday and push ahead to what comes next.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell with a global simulcast. It starts now. Carol Massar, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. A third straight day of losses here for the benchmark indices. And more importantly, Carol Massar, this is going to be significant here. All of the major indices right now set to close below their 50-day moving averages for the first time since April.
All right, that sounds pretty significant, right? Technicians would certainly say it is. So is that a buying opportunity or a sign of more things to the downside? This week is a big one, guys. NVIDIA earnings on Wednesday, Fed minutes on Wednesday. You also get a jobs report finally. It's an old one, but finally we start to get some government data. And then, of course, you get a read on the consumer with retail. So I think there's a lot coming out. Investors will see whether the news pushes stocks higher or to the downside.
Yeah, kind of seeing selling everywhere, risk off today. Look at Bitcoin down below $92,000 right now. It's at its lowest going back to April 22nd of 2025. Down from that 126,000 high just a few weeks ago.
And what's interesting is that it's not sending too much of a bid into the bond market in a having-seeking way. I mean, you're seeing 10-year yields down 1 basis point or so. Certainly not much to speak of there. At the same time, you are seeing the VIX above 22. We were higher above 23, coming back a little bit, but still certainly quite a jump in the fear index.
And it's kind of been holding above or around that 20 level now for the last few sessions. And that actually is relatively rare, even though a 20 handle isn't necessarily extreme, but it gets to this idea here of the jitters out there. And of course, as Carol was alluding to, with all the data and the earnings that we get this week, this market could really flip in either direction. Today, it's a flip to the downside with the Dow Jones Industrial Average down more than 500 points or about 1.2% on the day. As we wait for these numbers to settle, it looks like the S&P will end lower by roughly about 61 points or down about 0.9%. The NASDAQ Composite down 0.8%. Similar drop for the NASDAQ 100. But your biggest laggards, you're going to find that in the cyclical space, the mid-cap space and the small-cap space. The Russell 2000 down 2% on the day.
All right, going back to the S&P 500, the big caps, guys, most names in this average lower today, 413 names. Katie losing ground on this Monday, 89 to the upside, 1 unchanged.
Similar story when you take a look at the circle at the sector level. You can see there is a lot of red on that screen. What did do well was communication services as a sector higher by more than 1%. A lot of that, though, is Alphabet getting that endorsement from Berkshire Hathaway. In terms of what your worst performers were, you have financials, energies, and materials bringing up the rear on overall a very heavy selling pressure day.
All right, Katie, so you mentioned Alphabet. So let's start there because, folks, that is your number one gainer in both the S&P 500 and the NASDAQ 100 on this Monday. Stock was up as much as 6.3% intraday. So we did see an intraday high, closing, though, with about a 3% gain. This, as Katie mentioned, we got news over the weekend. Warren Buffett's Berkshire Hathaway disclosing a stake in the company in what was seen as a sign of confidence in its prospects. The stake, as of the Friday close, was worth about $4.9 billion. So that was certainly an outperformer today. I want to mention two names. We're going to bring them up on the boards for you. This was also a top gainer in the S&P 500 throughout the day. The news was lithium prices and shares in producers of the metal surged today after one of China's major suppliers delivered a bullish forecast for the battery material that had been languishing in a global glut. So shares in major producers, including SQM and Albemarle, were both higher. Albemarle up about 2.2% here in today's session, and SQM up about 9% in today's session. So some outperformance there. And then just one more, just kind of something different. Vita Coco, that one hitting a record today. It's up about 27% year to date. Heavy volume. B of A coming out, upgrading its recommendation on the coconut water company to buy from neutral, raising its price target to 54 from 48. That after President Trump issued an order on Friday reducing tariffs on hundreds of food products we know that can't be produced in the United States in sufficient quantity to meet domestic demand. The company issued a statement this morning saying that under that executive order, it believes that its coconut water products will be exempt from reciprocal tariffs as of November 13th. And so, yeah, investors kind of liking that one.
I don't know. Romaine strikes me as like a harmless harvest sort of coconut water guy.
I love coconut water.
Yeah.
I was an OG on the coconut.
You were
water.
back in the day?
Oh, yeah.
Are you still?
Yeah.
It is.
It's the best way to hydrate. You know
I am a fan.
Are you?
Oh, yeah.
I never see you drinking it.
Wow, she just called you out.
I know. And we do spend a lot of time together.
I know what he drinks. Water.
Hey, let's talk about some of the decliners. I want to start with the worst performer in the S&P 500 today. Dell down about 8.4%. Worst performer on a percentage basis in the S&P 500. A double downgrade from Morgan Stanley analysts who write that a memory supercycle increasingly poses a risk to earnings of hardware, original equipment, and design manufacturers. The analysts cut their ratings not just on Dell, but HP, Pegatron, and Asus Tech to underweight. Shares once again down 8.4%. NVIDIA shares also taking a hit today. This is the worst performer in the S&P 500 on a points basis, down 1.9%. Certainly the big report that comes this week, Wednesday after the bell, so keeping an eye on shares as a result of that. Also, Peter Thiel's hedge fund, Thiel Macro, sold its stake in NVIDIA during the third quarter, offloading its whole position of more than 537,000 shares. That would have been worth about $100 million based on the closing price from September 30th. And finally, shares of Blue Owl Capital down 5.6% today. They were under pressure. There was this big piece in the Wall Street Journal late yesterday. It goes into detail about how the firm is financing data centers and its exposure to the AI trade. Blue Owl, among the fund managers that have brought in trillions of dollars in recent years and of late put much of that money toward financing data centers. We spoke to Chris Whalen, chairman of Whalen Global Advisors, a little earlier. He referenced that article when we were talking about the financial firms involved in the AI ecosystem. Whalen is not sold on this technology. He doesn't see this, the output from this, as being as exciting as so many others think.
Can I just say, I listened to that interview. You guys got to let him finish his answer, by the way. But I stayed to listen to the whole thing. Sit in the bathroom the whole time. Let's check.
Thanks for the feedback.
I did, actually. It was good. But anyway, we get to the idea. You talk about data centers and AI. That's actually been a big driver of what we've been seeing in the bond market. I want you to take a look at Treasury yields. They didn't go a whole lot of places here. Obviously, some people did bid in as a potential safety play. But the move was kind of constrained because of the gigantic corporate bond sale out there by Amazon. And we've seen this play out over the last few weeks here with Oracle and a couple other big behemoths coming into the corporate bond market, and that kind of sucks life out of the Treasury market here. So that could be a big story here going forward as more of these companies look to capital markets to fund their AI dreams. Carol Massar.
I'm kind of stunned.
What are you stunned about? Romane's feedback?
Yeah, about not interrupting.
Yeah. Who were you talking to, me or to Carol more so?
I don't know. Or were you talking to yourself?
All three of you, probably.
All three of you. You know what I was really doing, guys? So I have to confess. So I was in the mirror admiring my new tattoo. So Katie and I, we've been working together for the last couple of months. And to commemorate that, we went out this weekend and got matching tattoos.
Held hands the whole time.
It's true. Katie, show them.
Should I? What camera should I look at?
I don't know.
For this? There's
Who
a
knows?
camera to my left. Here's my new tattoo. It's
Wow.
real. I swear to God, that is a lovely close up. My first tattoo, and
Last
it hurt
one?
a lot.
Do you know, I saw that on social, and I'm like, she's just playing. She's just kidding around. Because you have a great sense of humor on social. And I'm like, this is not a joke. Oh,
Yeah,
my God.
Not a joke, not a joke. Finally took the plunge. Have been talking about this for years, and on a whim,
didn't it hurt back there?
You know, it did. It did, and it still does, but, you know, doing okay.
So what did Romaine get?
You're hilarious.
Yeah. Well, now, Romaine, you know, you have to go.
Now I'm committed. Maybe Carol and I, maybe we can increase our bond here.
Yeah. Carol, do you?
Sorry, Tim. You have to
Do you have a
wait.
tattoo?
I do
Till we
not
get
have a
fit
tattoo.
banker here.
No comment.
No comment.
Okay. Hey, there maybe is a connection here to the labor market. I'm going to try to make one.
Okay, go
Yeah.
off.
Maybe
Are people
there
hiring
is. I
tattoo
don't know.
artists out there?
I don't know what the demand looked like for. Did you have to wait in line
This is
for a
actually-
while? Were there a
this
lot
is
of people?
Troubling story.
There is a troubling story. It's among the most read. Michael Sasso out with a piece talking about how there are different jobs that historically have been unloved. If we're talking about a trash sorter, a prison guard, somebody standing for hours on end in traffic under the hot sun that years ago wouldn't have gotten many applications, but as a result of a labor market that is starting to weaken, are getting a lot more interest.
Yeah, I mean, I've read this story earlier today, and I mean, it was kind of fascinating. There was that anecdote about the guy who said he would get, like 10 calls a week or something, and he's getting like 80 applications for, let's face it, a lower wage job. Not that there's anything wrong with that, but the idea that there just wasn't that much appetite for that just, even a year ago, according to him.
Kind of a sign of the times, perhaps. We'll see when we get that monthly jobs report. It'll be for September, but we'll see whether or not it's troubling. So what do you guys got for us?
Well, cars,
Take it,
yeah. Here's an interesting story that Ford is going to, or it has struck a deal with Amazon to sell certified used cars through its e-commerce website. Another interesting sign of the times that now you're going to be able to buy your used cars online.
Who's delivering them?
That's a good question.
Drones.
Apparently,
Can you get it overnight?
Car buyers will take delivery of their vehicles through Ford dealers participating in the program. Apparently, about 200 of dealers nationwide have expressed interest in selling on Amazon. It's going to be really fascinating to see the uptake here.
It's going to be really fascinating to see what the packaging looks like, because last time I ordered from Amazon.
Okay, my dad's bought a car at Costco before.
Yeah.
Really?
Yeah.
Did he
And
really?
you only had to buy one, despite the joke that he makes all the time. You had to buy six of
you
them.
have to buy.
pretty good
I like your dad. That's a good dad.
It's a good joke, right?
Yeah, it is.
All right, and for all of you interested in, like Romaine, what tattoo he should get, just send us an email.
A terminal, obviously.
Yes,
A terminal. Nicely done.
Yeah.
That's a good idea. Real company man, right? All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romaine continuing there on the close. Tim and I continuing on Bloomberg Business Week Daily. We will indeed see you same time, same place tomorrow.
And our coverage continues here on Bloomberg Television as we prepare you for a deluge of backlog government data set to dump on investors as the week plays out. A conversation up ahead with Joe Davis, chief economist at the Vanguard Group.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A third straight day of declines for the major indices here in the United States, with the S&P 500 down about 1% here on the day. This is actually the first trifecta of daily losses that we've had right now in a couple of months, and that's giving some investors concerns. Even more importantly, you take a look at the Dow Jones Industrial Average. That drop of 1.8% today erases all of its gains for the month of November. Meanwhile, at the bottom of your screen, that 1.5% drop in Bitcoin, well, that erases retraces all of its gains for the year. Maybe a little bit of a harbinger of what has been a bit of a retrenchment by investors. Maybe taking profits, Katie Greifeld, maybe something worse.
Yeah, absolutely. Going to keep a close eye on what's going on in crypto. But let's take a look at the equity side of things, the individual movers. We start, of course, with Alphabet, actually rising on the day, the biggest gainer in the S&P 500 on a points basis, getting that endorsement from Berkshire Hathaway up on a down day. So too is Johnson & Johnson, paying just over $3 billion in cash for Halda Therapeutics. But still, we didn't see it decline. Usually you see that for the acquirer, but J&J shares higher by nearly 2%. Can't say the same thing for Dell. A double downgrade from Morgan Stanley, dragging shares down by more than 8%. But let's get to our top story this hour, and that is investors bracing for a deluge of data. The end of the longest ever U.S. shutdown means that agencies will start releasing key reports that they've held back since the start of October. Now, this includes the September jobs report, which is due this Thursday, as traders look to solidify expectations for just how quickly the Fed will continue cutting rates. Romaine, of course, that is one of the biggest debates in the market right now.
All right, well, let's bring Joe Davis into the conversation, chief economist and global head of investment strategy at the Vanguard Group. And Joe, a lot of this data is going to be way, way backward looking, even more so than normal. A lot of this data will be incomplete. How much faith can we put in what we're going to see over the next few days?
Well, I think you put faith in the pattern. And again, we're going to have a lot of noise. We're a little bit more receded from the past than we'd like to be. What I will be looking for is what is that pattern in the labor market? We've clearly had a downshift. Everyone knows it. The question is, how weak are some of the indicators underneath the surface? Our own proprietary indicators suggest that we're stabilized at this low rate of job growth, but that's what I'm looking for.
Well, so when we talk about just what the economic picture is, Joe, and you have a better read on this than most, just a few months ago, we were talking about an economy that, certainly had some cracks in it, but wasn't showing any real material signs of deteriorating significantly. Do you still believe that heading into 2026, we have a stable economy?
I think we do, but again, it's not just completely clear. You have parts of the consumer that are, modestly impaired. It's the lower income households. They're the ones dealing, with some of the high food prices, for example. You have, weakness in the labor market, yet the indicators that matter from business decisions and broad consumer spending, incomes, earnings and revenues are all strong. And so at the end of the day, I would hang my hat on those and just keep an eye on the weakness on the other parts. But they shouldn't bleed into those indicators I mentioned if they continue to show strength.
Well, Joe, how do you think that the Federal Reserve should proceed then? Because you think about the concept of a rate cut next month. We've seen odds come in sharply. Yep. We just heard from Fed Governor Chris Waller saying that he backs a December cut basically as a risk management tool as the job market nears stall speed. But certainly we've been hearing from a lot of hawkish members as of late.
Well, again, I think the big debate at the Fed and I think in the market and why the Fed cut is actually a close call is how much you ascertain the slowdown in the labor market do what some would call supply, fewer workers available, as well as just less hiring. Some of it has been fewer workers. If that's the case, you have a case for holding and not cutting. Obviously, Waller is taking the other side of the ledger. We have a very close call. And at least over the next year, we have some modest easing, but not as much as the bond market, I think, because we see some of the supply factors at work.
Yeah, well, let's talk a little bit about the other side of the mandate, too, and that is inflation. So you take a look at the data, and your view sort of speaks to maybe holding here, not easing as aggressively as maybe the bond market is still expecting. Talk to us about the risk of inflation, not just staying at these levels, but potentially moving higher. How much weight do you put on that sort of scenario?
I wouldn't put a high lot of weight on it. Again, I don't mean to be complacent on inflation. It's above the Federal Reserve's preferred level. Many people see it at the grocery store every day. It's been sticky and persistent. But nevertheless, I'd be more concerned if we saw aggressive easing over the next 6 to 12 months without a slowdown in the labor market and in business spending, which, again, is not our expectation, because then I would be concerned about a retightening of the labor market. Unless we're talking about that scenario, I think some of the headline inflation risks are more of a push and perhaps a modest case for modest easing because of the spillover into the economy.
Joe, I have to ask you, too, about kind of what's been going on in the world of technology, artificial intelligence, and how that factors in to the economy and, more importantly, investing. You wrote a whole book about this that was released earlier this year. And I am curious because, you know, if we had had this conversation a few months ago, we'd all just be singing the praises of AI and all the things it's going to contribute to us. But over the last few weeks, of course, there's been a lot of doubt about just how far AI has taken the market, how far it could take the economy, and whether some of the optimism that we've had might have been a little bit too extreme. Are you concerned at all, and I'm talking long term, are you concerned at all about where we've gone with regards to the investment and pace of investment in artificial intelligence?
I'm less concerned about the rate of investment in terms of the AI, in terms of what companies are doing. I'm more concerned around the investment sentiment. I've been solaced by seeing some debating whether or not technology stocks continue to grow to the moon. We have been unwavering in our view and our data-driven analysis that we're somewhat guarded on the stock market, largely because of large cap growth companies. And a lot of great news in AI's advance is baked in today's prices. And so we're not pessimistic on AI as an economic force as we are as much as on an investment thesis. And we see more compelling opportunities out there. History is very clear. Over a full technology cycle, you do not want to overweight the technology itself. And we spent 2 years looking at that feature.
So the stock market is not the economy, but the wealth effect is a real concept, Joe. And I wonder, if we did see a big pullback in some of these magnificent 7 names that have such a high weighting in these benchmark indexes, what that might mean, the sort of unraveling of the wealth effect, the impact that would have on the economy.
Yep. It's a really good point. Again, so 2 things. One is we're starting at a very high base. We have a significant increase in consumer wealth, as you mentioned, than we have had in some time. So that provides you some cushion. However, if we were talking about a 30 or 40% drawdown in the U.S. equity market, which we saw after the late 1990s, then you can clearly get a drag and even potentially the recession. But we would have to be looking at what drove that price collapse to begin with. So you have to start painting those pictures and scenarios. So it's possible a 10 or even, dare I say, a 20% reduction in prices in of alone would not do it. Something else would have to be happening in the world for that to happen.
Well, back here into the here and now, though, Joe, and with regards to AI investment, Christopher Waller, the Fed official, has been talking all day long. This headline's crossing the wire. He keeps talking about this idea of fixed investment and the idea that when you pull out the AI spend, you basically have no fixed investment right now. Is that a fair characterization?
I don't think it's totally fair. Again, there's not like a pure metric that I can say, here's the world of investment, X AI, and then with AI, but you can do a triangulation. And I think that's a little bit too strong of a statement, seeing that on the tape. Our analysis shows that, again, we're in the early stages, but in the past year, it added roughly 50 or 60 basis points to growth. That's not all of the growth, but it's a catalyst. Again, I think many of us would want to see AI investment if it leads to higher earnings and productivity down the line. We've been in a world 20 years with not that happening. There is going to be misinvestment even if we enter that world, and that's something that we have to be prepared for. I think that's the one good news coming out of the recent market volatility is that there's for the first time in a while, some healthy skepticism in terms of what is the payoff of these investments going to be.
All right, Joe, we got to leave it there. Hope to pick up this conversation with you soon. That is Joe Davis. He is Chief Economist and Global Head of Investment Strategy over at Vanguard. Now coming up, the top 3, where we focus in on the top 3 movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
All right, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, Colm Kelleher, the UBS chair, reportedly speaking with Treasury Secretary Scott Bessent about moving the Swiss bank's headquarters to the United States, Romaine.
Yeah, this is interesting. That the talks took place. Also, a bank that gets the vast majority of its revenue from outside the U.S. Only about 35% is actually here in the U.S. But I understand here he's concerned about some of the regulatory requirements here, though he does know that the regulatory issues here in the U.S. kind of shift pretty fast. So,
indeed.
What's good today may not be good,
maybe
4 years.
Trying to sort of negotiate in public with the government, but we'll see how this shapes out.
Yeah, maybe this is. Yeah, that's exactly probably what this is. You know who's not negotiating right now?
Tell me.
Elliott Hill. He's the relatively new CEO at Nike. He's been in charge now for about a year, and he's really put a big focus right now on the athlete, as he likes to talk about. I had a chance to catch up with him out at their headquarters in Beaverton, Oregon, and they're really going after these big sort of chunky shoes, kind of made popular by Hoka. You can see me. I was actually wearing a pair here.
Oh my God, yes.
And you really feel it. But this whole thing, I mean, they're really focused on this idea of kind of the elite athlete and using them as a vehicle. You watch the New York City Marathon.
Athlete.
There's me.
Is.
I'm not an elite athlete, but you saw the New York City Marathon, right? The men's winner was wearing Adidas. The women's winner was wearing On Holding shoes. And Elliott Hill wants to make sure that the people on that podium in the future are going to be wearing Nikes.
Absolutely. Really trying to tap back into the running community. Let's also talk about Jeffrey Gundlach.
You don't wear Nikes, do you?
No, I'm more of a Hoka gal, but don't tell Elliott Hill. Anyway,
He's
Jeffrey
watching
Gundlach,
now.
He is the Double Line Capital founder. He spoke on the Odd Lots podcast, warning the $1.7 trillion private credit market is engaging in, quote, garbage lending that could tip markets into their next meltdown. Let's take a listen.
The next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
And actually, his is 20% in cash, and stay away from private credit.
Well, as we know, cash is for the cool kids, as one of our guests told us last week. But I thought it was interesting. If you haven't had a chance to listen to the full interview, just definitely check it out on the Odd Lots podcast. But he kind of talks about, I thought, the anecdote he used of like, okay, you can either value this at 100 or value this at 0, but you have no idea what's happening in between. And the idea you can start at 100, the mark might be coming down, but you're never going to know that until it finally hits 0 and you have to finally sell. You know, it might be a little overstated, and we know Gundlach's tendencies on some of these issues.
He's a bit of a bear.
But he's a bit of a bear. But he does bring up a salient point, and a point that several guests have made. We were speaking a little bit earlier with someone, Ethan Devitt, right, about cockroach dependency.
Yeah, dependency on cockroach. It certainly really encapsulates a lot of the fears out there, though.
Do you listen to the Odd Lots podcast?
I do.
The only thing more surprising in that Gundlach interview was I didn't realize it had been around for 10 years.
10 years.
I know.
Well, that's the beautiful thing. They were sort of operating in obscurity for a while.
Obscurity.
And now they're...
Well, actually, he was operating right next to me because he used to be my co-host next year. I didn't know he even had a podcast.
He did. I'd have one too, but...
The CEO of Butterball, the world's largest turkey producer, is coming up on the show next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Well, food inflation, a hot button issue ahead of Thanksgiving, with the Trump administration serving up tariff carve-outs on key food items. The president also claiming credit for a 25% drop in the cost of Walmart's Thanksgiving package from last year, which fact checks determined were tied to downsized or removed items. Our next guest, who runs the world's largest turkey producer, says his latest survey shows more than half of consumers won't compromise on their table stakes for Thanksgiving spending. Joining us now is Butterball CEO and President Jay Jandren. Jay, great to have you with us. So talk to us first about how prices compare to this time last year. Obviously, you have a very unique seat here. So what sort of trends are you seeing when it comes to food inflation?
Well, the good news is that we're seeing prices the same or in some cases lower than what they were last year for turkeys for Thanksgiving. As you mentioned, we've seen retailers coming out with a lot of very strong pricing to help the consumers out there. And the lead on that is turkey. The consumers are telling us they do not plan to compromise on turkey. And the retailer is certainly passing on some really attractive feature prices so that consumers will get into their stores and get their holiday basket there.
That's interesting. I mean, and you think about turkey being the centerpiece of any Thanksgiving meal. It makes sense that that's not the item that you would want to compromise on, Jay. But I know that you've been with Butterball since 2002, so certainly you've seen plenty of economic cycles. And I wonder, you know, this resilience and this hesitation to compromise on turkey specifically, how does this compare to past periods where we have had sticky, higher prices?
Well, it actually has been very consistent from a pricing standpoint, and we see that in the data and talking to consumers. 89% of the consumers that we talked to this year prior to the holiday plan to celebrate Thanksgiving, and 84% of those plan to have turkey on the table. And that's very consistent with what we've seen over the last numbers of years. So we're fortunate that with this very unique American holiday, folks don't want to deviate much. They want to kind of stick to the tradition and do what they've done in the past, and that's certainly good news for the turkey industry and great news for Butterball.
I am curious, Jay, just overall, not just with the holidays, with regards to turkey consumption, have you seen any changes in consumption habits based on what we've all been talking about, at least on this show, the idea of the rise of GLP-1 drugs, people being more conscious about their weight and other things? Has there been any sort of shift that you've seen in consumption patterns?
Well, it hasn't shown up in all the data just yet, but we certainly do hear a lot of consumers talking about more of a focus on protein, particularly low-fat protein, and turkey is a perfect candidate for that. You know, we have a very good value for the consumer when they're looking for a high-protein source. There are certain categories that we've seen tremendous growth in, particularly ground turkey. Our Butterball brand has continued to grow throughout this year, double-digit growth. So we're seeing consumers really paying attention to those, which is great because that goes into their everyday meal, and not just as we think about turkey often as the holiday food, but it's something they can eat year-round, and it does fit great with that lifestyle.
Have you had any issues with regards to sourcing your birds and rearing them as well, with regards to either availability or, more importantly, the cost to raise and get them out the door?
No, we actually have a number of family farmers across the country, over 600 that grow turkeys for us. We've got a great partnership with those folks. We provide the turkeys to them, give them the feed to make sure they can grow the animals to our specifications. It's a great situation for us to work with those farmers to grow those. So we have a constant supply. We don't have to go out and look to purchase product from other companies. It works within our system, so we can plan very, very carefully for it throughout the year. And if there are any bumps in the road, we can make adjustments throughout the year to make sure that we've got an adequate supply to ensure that the consumer has the product on their table.
Well, Jay, related to that, bring us up to speed on what's going on with bird flu, because certainly we saw a lot of concerns about that, what that meant for the nation's chicken supply and also the egg supply. Was that as much of an issue for our nation's turkey flocks as well?
Well, it has impacted turkey for sure. We've seen that for the last several years. We're very, very fortunate that we're not in a short supply standpoint. We're confident that consumers are going to find the turkey for their Thanksgiving table, so that's great news. And we're also very, very positive that the federal government has invested in trying to find a solution to this. They've looking for prevention and intervention systems. They've allocated $1 billion to go to help prevent the spread of this disease. So we're very positive in our thoughts about finding a solution that ultimately will help eradicate this disease that we've been facing for the last several years.
All right, Jay, enough with the hard-hitting questions here. I want to get down to brass tacks here. Do you roast? Do you fry? Do you smoke? Do you grill? How do you cook your turkey?
Actually, all of the above. So it's funny you say that. I always do two. I always have one that's roasted. And I actually just asked my kids to put in their vote for what the second one's going to be. Is it going to be fried, smoked, or grilled? So you hit on every process that I look at to make a turkey this year. And the jury's still out. I'm waiting for all the votes to come in, and we'll decide what we're going to do for that second turkey.
I think my family is frying this year, which really makes me nervous. It feels like there's a lot of ways where that can go wrong, Jay. But you touched on this a little bit earlier in the conversation, and I do wonder how you make turkey extend beyond just Thanksgiving. Of course, there's ground turkey. That seems to have its use cases. But how do you sort of appeal to the average American consumer and make them think of turkey outside of just Thanksgiving?
Well, you might be interested to know that about a third of our business is evolved around the holidays between Thanksgiving, Christmas, Easter, and the rest of it is year-round. So one of the things that we're doing is really looking at how we're talking to those consumers, and we're finding, our consumer base is changing. The people who are making the buying decisions now are getting younger, as they are with many other categories. So we're finding new ways to talk to them, to reach them in the places they're getting their information, and to make sure that as they're now beginning to be the shoppers in the household, that they look for turkey as a good option. And great news, as we mentioned earlier, it fits in very, very well with the kind of the diets that folks are looking for these days. It's a very healthy protein, and it's great for people who are active and looking to get the most out of their food dollar as well, being a very economical protein to purchase.
All right, Jay, we really appreciate you taking time for us. Have a wonderful Thanksgiving. If we don't talk to you before then, that's Jay Jandren. He's the CEO of Butterball.
All right, let's take a look at how markets closed on the day. It's not
Why are you scared of frying?
I don't know. I feel like you can really set things on fire when you're talking about boiling.
Got to be careful, set the oil below the line, put it in slowly. There's a whole process here.
My brother...
Your brother's not one of these people that just tosses the thing in there and just runs for the hills.
I believe this is in our family lore that a couple years ago, my brother fried a turkey on my parents' driveway and burned a hole in the driveway. And my mother still talks about it, so...
Interesting. I'd like to meet your brother someday.
Yeah, I've got two of them, so...
Is he allowed to come to Thanksgiving this year?
He'll be there.
Okay.
Yeah. Anyway, this is The Close on Bloomberg.
All right, the successful launch last week of Blue Origin's New Glenn rocket, putting Jeff Bezos' space company on track to maybe challenge the hold that Elon Musk's SpaceX has had on the launch industry. And as they shoot for the sky, along with NASA and others, a lot of questions about, what do we do when we actually get up there? Ariel Ekblau is founder and CEO at the Aurelia Institute, a space architecture research institute and venture incubation studio, which is a lot of words to say that when you get out into space, you're with that company that would actually help us sort of build infrastructure when we get up there. And I never really thought about this because I guess we're just shooting rockets up and just trying to test to see out. But at some point, in theory, we might be on the moon permanently or on Mars or somewhere else. So where does your institute come into play with regards to establishing bases in those areas?
Yeah, so building on the amazing success of Starship and now New Glenn, instead of having to fold things up into a rocket and really cram them into that constraint, we can now build essentially space Legos, so modular pieces that are autonomously self-assembled in orbit. They have really powerful magnets on their edges, and they autonomously come together. And this lets us build really large-scale space infrastructure for the first time. Massive solar panel arrays, big phased array antennas.
Yeah, I was watching a presentation online that you had given a while back at the MIT. And, you have to speak to me like I'm a 5-year-old, because I'm obviously not as skilled as you are. But is that viable? I mean, I understand. I mean, it sounds great. And when I think of it, it's like, oh, wow. Yeah. But how far away are we from that actually being realistic?
Yeah. I think if you think about it, it is it's a common sense way to build. How do we build on Earth? With bricks. Let's bring space Legos to orbit and have it be more modular. We've tested it twice on orbit already, so that's how we know that the actual technology of the algorithm that brings the tiles together works well. This assembly that's actually inspired by nature, like how our proteins self-assemble in our bodies. Same idea, brings these big pieces now together at scale. And one of the things we're most excited about is the bottleneck isn't rockets anymore, it's real estate. And so how do you start to build things bigger than your biggest rocket payload fairing? And we just announced a partnership a couple of weeks ago with StarCloud, AI data center company. How are they going to build this infrastructure in space? They're going to need a lot of solar power to get energy to power the data centers. They're going to need to reject heat, which is really important in space, to get the heat from the electronics off. And we're really excited to be able to partner with groups like this to support their infrastructure activity in orbit.
Well, when it comes to realizing some of these visions and the future that you describe, I wonder, what the role is of NASA, for example, and some of these government programs, because we're talking a lot about private companies trying to open up space. Exactly. And it feels like sometimes NASA is an afterthought in that conversation. But what do you think is the ideal relationship? What does that look like?
Yeah. NASA really underpins a lot of the commercial success that we've seen in the industry. So their model of public-private partnership is what got SpaceX going. They've taken that winning playbook, and they're now doing it for the moon. So NASA has a taxi to the moon, this program called Commercial Lunar Payload Services. And now with new leadership like Jared Isaacman, I think what NASA can really do is free NASA up to go do what NASA does best, which is explore the deep extent of our solar system. Is there life on Europa? And then that makes room for commercial activity in low Earth orbit. What I've been telling people to think about is space is not a sector that may or may not be relevant to your business. It's a domain. It's an envelope around Earth, more like an emerging market, where all sectors will play: hospitality, entertainment, heavy industry, and in my case, science and manufacturing. And so we're really excited to see NASA kind of chart this next era where they free up this opportunity for commercial activity in low Earth orbit, and I think people should be paying attention to the commercialization opportunities there.
Well, when it comes to this next era, what kind of timeline are we talking about? Because I'm sure to a lot of folks listening, this sounds like science fiction, you know, something you would read in a novel. So, I mean, how soon is the future?
That's the remarkable thing about the space industry right now. 15 years ago, it was $50,000 a kilogram or more to go to space. Today, it's around $2,000 a kilogram. With Starship and New Glenn coming online, it's $200 a kilogram. That's what the anticipation is. That's like FedEx. If you can ship something around the world, you can ship it to space. So the future is here. I think for our company, Rendezvous Robotics, we expect to be able to do an in-orbit free space demo of those self-assembling tiles next year at the end of 2026, outside of the International Space Station, like a bigger deployment. So it's really, we're knocking on its door. The future is here.
I am curious just about the interplay between the U.S. and other countries that are also doing this. And there's been a lot of concern that some of the space programs overseas are maybe have caught up with the U.S., in some cases surpassed us. Is there any cooperation right now between the various nations on this, or are we all just kind of doing this independently?
Yeah, there's wonderful collaboration with our allies in Europe. And on the other hand, we have a very serious space race with China, just given the politics of the two nations and some of the restrictions like ITAR and export control. It's really hard for me in the U.S. to do any collaborations with China. Their version of their space program is all military. They don't have a civilian agency like NASA. So I'd say great opportunities for collaboration with our allies in the EU, some cases in Asia, a little bit more of a space race dynamic right now with China, and certainly some tensions with Russia over the international.
Where's the money coming from for all this? Is this primarily coming from the government, or is it private investors? Where?
Yeah, I'd say three categories. Government is still, in many cases, an anchor customer for space. And in the VC world, we run a VC fund. That's actually a good thing. Our companies should be getting non-dilutive funding from the government. Then there's private actors like Bezos and Elon putting a lot of their private wealth into it, and that really seriously has spurred a lot of success in the industry. The third is we're now seeing a burgeoning space economy. So broader players, even companies like John Deere, are starting to get involved in space to be able to use satellite data to guide the activities of their farmers. Or things that we're working on, what's an application of our big space structure that we haven't talked about? An orbital biolab. Make artificial retinas in orbit that are more pure and perfect than you could ever make on the ground because they're floating. Stabilize them and bring them down. That's the kind of stuff that we're seeing in that third bucket of, you know, it makes sense now to be VC backable for space.
Unfortunately, we have to leave it there. Such a fascinating conversation. Hope to see you again soon. That is Ariel Ekblad. She is founder and CEO over at the Aurelia Institute. And from outer space to airspace, the FAA lifting all remaining flight restrictions and allowing U.S. airlines to resume normal operations. And though some private jets were previously barred from major U.S. airports during the shutdown, our next guest says that the government-mandated flight reductions actually helped spur business jet demand. Jessica Fischer, she is FlyJet's founder and CEO, here to discuss. Jessica, great to have you with us. So the average American traveler, of course, wasn't firing up the private jet, but talk us through a little bit more.
I could have used that private jet the last couple of weekends.
One of them is sitting to my right.
I
could have too, right? Certainly a lot of feelings there, a lot of emotions, but talk us through a little bit more of what you saw develop during that shutdown.
So I think the biggest theme was that the cohesiveness and resilience that I think all of us saw in the charter and commercial aviation spaces was just presented such a sharp contrast to the chaos going on in Washington. And I think we really saw members of both the charter and commercial spaces really rising to the challenge. I mean, I took a Delta flight back and I was blown away by the entire crew, the flight attendants, the pilots, everyone from start to finish on that flight, communicating with passengers, explaining, hey, we're at this taxiway. Here's why we're stopped for 20 to 30 minutes and that doesn't feel right. We're going to get through this together. I think everyone came away saying, we've never seen anything like this before. I mean, the airports, I went through it myself, not this weekend, but last weekend. But it was, I've never seen anything like that in my life. Just what kind of things just really stalled and the waits and the chaos. But, you know, I think making things safe really people got from A to B. As for the business aviation sector, despite those 12 airports, which were designated to be closed since as of this morning when they reopened everything, we actually, I think if you look at charter activity in North America between November 2nd and November 8th, there was actually an increase in business jet aviation, in business aviation. I think there was about an 11 to 12% increase in the week of November 2nd to 8th in that time frame versus the week before, when typically if you look at a year-over-year increase, that increase has been about 3% between 2025 and 2024. So it's been significant, and I do think that, you know, it's an unfortunate situation, but the charter business aviation segment did benefit.
Well, I do wonder, you know, how much of that benefit is sustainable, because I'm sure for a lot of these businesses, this was a very unique, extreme circumstance here.
Yeah, I do think that, look, if you compare this to COVID times, you saw that what went on, it was unfortunate. It became a lift for the sector, right? Private aviation, business jets, charter jets kind of took off because people got a taste and they said, this has been working really well for me. We saw people throughout the industry, you know, whether from helping the air traffic controllers to working with clients, being hands-on, making sure that they were using reliever airports when they could to get people from A to B. I think this was really, I think everyone in aviation really came out looking really solid. Yeah. And this will be a strong, you know, it will have strong sort of tailwinds for both sectors.
One thing I'm curious about too, I mean, when we talk about the prioritization of flights, and I guess I never really thought about the idea that, you know, private jets were kind of still kind of beholden to obviously what was going on with commercial traffic. And we saw some of the restrictions in place as they tried to get things back to normal here. But is that the relationship between what the private operators are doing and what the commercial operators are doing? What is that symbiosis as far as the FAA and the regulators are concerned?
Yeah, so at the commercial, there are about 500 commercial aviation, like heavily trafficked commercial aviation airports in the United States. There are tens of thousands of airports, right, that private charter jets can fly into. So at the main airports, they're subject to the same ATC. Gotcha. But when it comes to the reliever airports, or even Teterboro or Opelika, which are the very heavily trafficked general aviation airports in New York and Florida, it becomes, you know, it's completely separate just because there are no commercial operations there except for the semi-private airlines. Yeah.
Has there been any discussion about expanding the private airports that would be available to these folks?
Yeah. So I think that really that's dependent on runway length and what can be accommodated based on the jets. And you want, you know, you want to be able to fly into an airport with a control tower, which not everyone has when you can. So that's kind of the way that is more.
Is there an infrastructure issue then? Because, I mean, we talk with a lot of folks in the private jet, and they've talked about how private jets are essentially getting bigger, or at least the types of private jets that people are buying are a lot bigger than the ones of old, where you do need an actual tower and more skilled people to get that thing on the ground.
Yeah, I mean, it just depends. I mean, look, typically, whenever you can fly into an airport with air traffic control, obviously, for obvious reasons, you want to. Will people use other airports? Yes, of course. Do they exist? Yes. Those are the much less heavily trafficked airports throughout the country.
All right, Jessica, really fascinating. We have to get you back to talk a little bit more about this. Jessica Fisher, she's the founder and CEO over at FlyJets. Stick with us. We'll be back in a moment, setting you up for what to watch over the next 24 hours. This is Bloomberg. All right, let's set you up for what to watch over the next 24 hours, and it includes several of those key earnings that we've been talking about.
Absolutely. Looking forward to Home Depot, Baidu, Klarna, and Amer Sports. Home Depot, probably the headline there.
Yeah, I'm really curious, too, because we talk about them, Home Depot really being a barometer, not only for consumer spending, but obviously the housing sector. And the idea that, people would upgrade their homes, or maybe they don't if they are not going to, flip them or something. So it'll be interesting to see what they have to say. I think we get Lowe's later in the week as well. We're also going to get a lot of Fed speak, which I'm not sure it's helping matters, because we got a lot of Fed speak today, and you had Philip Jefferson saying one thing, Christopher Waller saying the exact opposite. I guess we get to do this tomorrow with Barr and Barkin.
Absolutely. Of course,
Logan's speaking too.
That's true. She's also there. Heated debate underway as to what the Fed is actually going to do next month. I think it's a little bit heated. You have the Hawks on one side, Waller leading the Doves there. So we'll see what Barr, Barkin, and Logan have to say. But we also have the Microsoft Ignite conference in San Fran kicking off tomorrow.
Yeah, spark it up. And also, we got to go down to the White House tomorrow as well. President Trump is actually going to be hosting Saudi Crown Prince Mohammed bin Salman at the White House. First time he's been here at the White House in 7 years. The team at Balance of Power is up next. Maybe they'll have more on that for you right here on Bloomberg.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular. Markets heavily focused on this AI dynamic. Are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the NVIDIA earnings later today. That'll be a very important moment for the markets. Second topic I think is very much on the minds of investors is labor. We've had government shutdown, which is obviously behind us now, but the statistics will lag and the data will lag. So the market is not quite sure what to make of labor. So I would say labor is a major issue and a major concern. And the third topic, I think, is inflation, which remains pretty stubbornly high. And we obviously saw in the election cycle in the U.S. a lot of focus on affordability. And so I think those three topics are really shaping markets right now. Markets have had a good run, and so you're seeing investors kind of pull back, and I would say protect gains.
Do you think we need more of a correction? Like, when do you know? Or is the AI in an actual bubble?
Well, I think we'll find out in NVIDIA's earnings today, kind of what they say about their own prospects, which has been a bellwether, and I think will have some impact on the psyche of the marketplace. It strikes me that the market could pull back further from here. I do think that the technicals are kind of more biased for more protection and more downside, more short activity, more macro hedging, and kind of protecting the gains that have been garnered this year. So I think there probably is a bit more bias to the negative, but I don't know that it'll be that much more pronounced from here.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out in 10 minutes or less on the Markets podcast from Goldman Sachs. Listen now.
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Caroline Hepke.
Global stocks have fallen to their lowest level in a month as traders question frothy valuations and whether billions in AI spending are delivering meaningful returns. The sell-off's already wiped roughly $1.6 trillion off equities, with the S&P 500 down more than 3% in November. But not everyone believes that's a bad thing. Here's the view of Atlas Merchant Capital CEO and former Barclays boss, Bob Diamond.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Bob Diamond's comments were echoed by Grace Peters, co-head of global investment strategy for JP Morgan Private Bank. She told Bloomberg Radio that a correction of 5 to 8% is not unhealthy and could help pave the way for a fourth year of double-digit equity returns for the S&P 500 in 2026.
The big earnings event of the day comes after the Wall Street close, when we'll hear from Nvidia. Traders will be looking for reassurance about the sustainability of spending at the $4.4 trillion AI chip giant, as well as evidence that it can continue to outrun its competitors. With more, here's Bloomberg's Charlie Pellet.
The report could either reassure Wall Street that the AI computing boom is continuing or fuel fears that the tech industry is in a bubble. Margie Patel is Senior Portfolio Manager at Allspring Global Investors.
The PE is around 40 times, and that's higher than the average stock, which is around 27 times. But on the other hand, they're leaders in their sector. They should have an above-average growth as far as the eye can see.
The Bloomberg consensus revenue estimate for NVIDIA is $55.19 billion. In New York, Charlie Pellet, Bloomberg Radio.
The United States Congress has voted to force the Justice Department to release files on sex trafficker Jeffrey Epstein. The legislation overwhelmingly passed the House in a 427-1 vote. Hours later, the Senate passed the measure with unanimous consent. The manoeuvre allows the Senate to approve the bill without a vote as long as no senator objects. Democratic Minority Leader Chuck Schumer introduced the request for unanimous consent and called on House Speaker Mike Johnson to send the bill to the White House right away.
There's no reason it can't be on the president's desk in an hour. Second, the president has to sign it. You never know with him. He said he would. Let's wait and see. But third, we have to make sure that all of the documents are released.
Chuck Schumer speaking there as Senate Republicans ignored calls by the House Speaker to give the Justice Department additional leeway to withhold documents.
The European Union's top diplomat has said that the bloc's deep economic ties to China are limiting its ability to pressure Beijing over Russia's war in Ukraine. At a Bloomberg event in Brussels, the EU's High Representative for Foreign Affairs, Kaja Kallas, said that without China's support, the war would be over. She added the EU should strengthen its language on Moscow's recent aggression against the bloc, referring to a railway explosion that took place in Poland over the weekend.
These sabotage acts that they are organizing on our territories in different countries, these are extremely serious. And I would quote a good friend, Secretary General of NATO, Mark Rutte, who said that why are we saying, hybrid attacks, which seems like, something soft, when we should call them by its name, which is state-sponsored terrorism.
That was Kaja Kallas, the EU's High Representative for Foreign Affairs, adding that Russia is really trying to test how far they can go on Europe's home turf, as she called it, following an uptick in incidents of sabotage, cyber attacks and drone incursions. Kremlin spokesman Dmitry Peskov rejected the accusation, saying Russia-phobia is flourishing.
The UK's Domestic Security Service has warned lawmakers about a new Chinese espionage threat. MI5 says there have been efforts backed by the country to target MPs online, reigniting concerns associated with Parliament. Security Minister Dan Jarvis set out the government's response in the House of Commons yesterday.
I'm setting out a comprehensive package of measures we are taking to disrupt and deter the threats posed by China, as well as by wider state actors. Supported by ministers from across government and coordinated by myself, we are launching a counter-political interference and espionage action plan.
Minister Dan Jarvis speaking there after an alert was raised over 2 online accounts claiming to represent headhunting groups that MI5 says are run by Chinese intelligence agencies. The Chinese embassy in London dismissed the British claims as malicious slander, saying it had lodged stern representations with the UK for undermining China-UK relations.
US President Donald Trump has said that he would formally designate Saudi Arabia as a non-NATO ally following a visit from Crown Prince Mohammed bin Salman. The announcement capped a day of deal-making between the two leaders and will include the provision of financing and priority access to purchasing military equipment from the US. A defence cooperation pact, including the future sale of F-35 advanced fighter jets to the kingdom, was also agreed. Speaking about the arrangement, President Trump explained its significance.
A stronger and more capable alliance will advance the interests of both countries, and it will serve the highest interest of peace, and we all share in peace, and we've never had and been so close to truly everlasting peace in the Middle East. All my life I've heard, peace in the Middle East, but it'll never happen. We did it. Now we have to make sure it matures properly and is really as strong as we think it can be. But we've gotten all good signals.
President Trump speaking there. Saudi Arabia will become the 20th US ally designated under that status, joining other countries in the Middle East, including Egypt, Israel and Qatar. Crown Prince Mohammed bin Salman was also joined by prominent figures, including Tesla's Elon Musk, investor Bill Ackman and Nvidia's Jensen Huang at an evening event on Tuesday.
New analysis by Bloomberg shows that the pay premium for graduates over minimum wage salaries in England has halved since 2007. Bloomberg's Ewan Potts has the details.
For years, the advice to teenagers considering their options was clear. If you want a well-paid job, head to university. But new analysis by Bloomberg suggests the picture these days is not so simple. Back in 2007, average graduates in their 20s earned twice as much as the typical minimum wage worker on a 40-hour week. By 2024, the rising value of the minimum wage has shrunk that premium to 43%. And accounting for student debt repayments, the gap comes down to just 32%. A separate ranking by the OECD says that UK graduates get some of the worst financial returns for their university education anywhere in the developed world. In London, I'm Ewan Potts, Bloomberg Radio.
And those are our top stories for you this morning. Just looking at the market, so the tone very much still risk off this morning. The All Country World Index is flat. The MSCI Asia Pacific Index is down by 0.25%. Stock futures in the red for the US. Nasdaq futures dropping 0.2. US Stocks 50 futures flat right now. 10-year Treasury yields this morning trading at 4.11%. So again, flat. Bloomberg Dollar Spot Index is slightly weaker. Gold is up by 0.7%. Bitcoin still struggling well below $91,000. Those are the markets.
That's news when you want it with Bloomberg News Now. I'm Stephen Carroll.
I'm Caroline Hepker, and this is Bloomberg.
Exchanges, the Goldman Sachs podcast featuring exchanges on navigating macro uncertainty, exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on exchanges between leading minds at Goldman Sachs. New episodes every week. Listen now.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
In terms of safety, Saudi Arabia has never been as safe as it is right now. You always had a little cloud over your head, and sometimes that cloud was very big. That cloud is not there anymore, and we want to keep it that way. So that's why tonight I'm pleased to announce that we're taking our military cooperation to even greater heights by formally designating Saudi Arabia as a major non-NATO ally, which is something that is very important to them. And I'm just telling you now for the first time because I wanted to keep a little secret for tonight. I just heard him say, "Oh, that's nice." That's another point you won today. And signing a historic strategic defense agreement, which we just signed a little while ago. So congratulations.
LGT's investment solutions allow you to look to the future with confidence.
This is Wall Street Week. I'm David Weston, bringing you stories of capitalism, playing dice with the universe, the strange new world of quantum computing, and how it may change our lives even more than AI. Plus, coming to terms with growing older and lower interest rates. As Western nations face growing problems providing for the elderly, we take a look at the largest set of pension assets in Europe and why the Dutch are changing the way they invest those assets. And turning concerns about data center energy consumption into a way to heat our houses. That's what they're doing in Finland. But we start with banking and how regulators in Europe and the United States are taking increasingly different approaches, creating both opportunities and challenges for Ana Botín, executive chairman of Spain's leading bank, Santander. Banco Santander has had a big year. Give us a sense of how big a year it's been.
It's been a great year. Our numbers will be totally on track to deliver all the numbers in our 3-year plan. And again, in 25, we're going to reach our profitability, 16.5%. And for shareholders, great value creation, increasing dividend per share. Our share price is up 100%, but there's still a lot of inherent value in our stock. Our multiples are still very attractive compared to US banks, for example. We're trading at a bit under 10 times price earnings. And we deserve a premium to Europe, and I would say even to the US banks, because our profitability is getting better and we have growth.
What were the main drivers of the success you've had this year?
So I say it's an overnight success, 10 years in the making. So since I took over, I inherited a group of banks. It was a big bank, but many different geographies, different business models, very disconnected. And the whole vision is to bring them all together under a single open financial services platform. And that's what we have been working on. So this year, every single one of our 5 businesses is growing. We have simplified the organization. We sold Poland. We bought in the UK, so our UK business now is at scale. And this is really the opportunity at Santander. We have profitable growth for many years organically.
Santander succeeded in selling half of its Polish unit this year, while other European banks, including Unicredit and BBVA, had a tough time getting deals done. As you say, you sold Poland, you bought in the UK. There were other banks in Europe that tried to do transactions this year that didn't go so well. How come you got it done?
Well, the sale of Poland was the largest cross-border M&A in Europe in a decade. And in today's world, where governments defend their countries and regulation is what it is, friendly deals are the way to go. And so I believe that's the secret.
As you say, Banco Santander, as you inherited it, is pretty far flung. I mean, you've got obviously Spain, you've got Europe, you've got UK, you've got US, Mexico, Brazil. How much is that helping Banco Santander, that diversification?
So in today's economy, either you're large and you have global scale or you're very specialized. And we have the scale. We're one of the largest banks in the world by number of customers, 180 million. That's more than the number 1 and number 2 bank in the United States together. We have added 60 million customers in the last 10 years. And so, that scale, to benefit from that scale, to have the operating leverage, you need to work across the company. You cannot just work separately by business or by geographies.
One of your goals has been efficiency, increasing the efficiency of the bank. How much success have you had? How much further can you take it?
We're only just scratching the surface of our potential as a group. We have Gravity, our core operating system. We have our payments core system, which is allowing us to reduce cost per transaction in the last few years by 1/3. What is now coming is what you as a customer are going to see, which is the open bank, the front end. This year, we'll have flat to down cost and growing top line. And this should continue into the next few years. And again, organically. We are in markets with 1.2, 1.3 billion people, where we are at scale in each one of them. And building our own platforms is something that very few banks, very few companies have in the world today.
One of Santander's strongest verticals is its auto lending business, working with dealerships at 14,000 points of sale, as well as through its digital platform, OpenBank.
The last 2 years, delinquencies were very low during COVID, have normalized, so they have been going up, but our final loss rate is actually stable over the last 12 months. And consumers are actually, getting up to date on their loans, even though they get a bit behind, so the loss rates are stable. And we're not seeing anything right now that tells us the U.S. consumer, on average at least, is having any issues. It's very solid.
We see interest rates coming down in Europe now. What does that do to your bank and to banks generally?
So the way the terminal rate, and we can have a debate about what that is in Europe or in the US, given the size of and level of government debt, given demographics, defense spending, decarbonization, we don't see that rate being below 2% in Europe, probably below 3% in the United States, something like that. And that is a very good level for banks because it is high enough for us to have a margin, but not that high that the credit gets bad. Rates are at a level that I think will allow growth to remain around 3% globally right now. By the way, that's not fast enough, but at least we're growing.
Regulation may be one thing holding down growth in Europe. In the last 6 years, the EU has added 13,000 new banking rules, while the U.S. came up with only 3,500. Give us your sense of regulation of banks in Europe versus the United States.
Well, I think regulation, like life, is all about balance, right? And so we do believe in smart regulation, but we've gone way too far on certain items like capital. Soundness of banks doesn't just depend on capital, as we've seen. If you look at the capital ratios of some of the banks that had problems, they're pretty high. And so we think, again, Santander, look at our CDS. It's one of the best in the world, including the best banks in the United States. Why? Because it's about a strong balance sheet, liquidity, scale, business model, etc. So, we have gone as far as I think we need to go on capital, and now we need to be supporting growth.
Mario Draghi came out with a famous report. What's been done with that report?
So if the ambition is very high, even if you don't get to that, you're going to do pretty big things. And so this is the thing in Europe. What is our ambition for growth? Mario Draghi gave us a diagnosis. How much have we executed? Not more than 10% in 1 year. So we have to have a much greater ambition on delivering on those recommendations. I've said it publicly, if taxes, every euro we make in Europe, 58 cents go to the government. Every dollar we make in the United States, 42. That's not a small number, but it's, significantly lower. So excess regulation, excess taxation actually is a tax on the economy and growth. At some point, people don't invest. And so this is the balance we need to find. And Europe is getting further apart from the United States, not coming closer.
We also have regulation of banks at both the European level and member state level. To what extent do member states hold things back?
Well, and there's one thing you didn't mention. So there's the regulation, and then that's the level 2 and 3. Here in the United States, there's a lot of talk about the agencies. Clearly, there's work to do in the United States. In Europe, there's even much more work to do, right? And I showed at our conference on regulation, only financial services regulation without the rest of the interpretation of the rules, which is thousands more, 97,000 lines, which is 100 Don Quixotes. I showed it there. And so that is a second level. And then the third is what you say, which is the national rules and regulations.
How do you decide how to allocate your capital for growth? And to what extent is it affected by things like the relative difference in regulatory levels?
Well, that of course matters a lot, right? If other things equal, every dollar I put in Europe, 58 of the profit goes to the state and 42 in the United States. Well, Europe is going to have to give me higher growth or higher profitability or both for us, other things equal, to go there. So yes, it matters. It matters a lot.
There's innovation and creativity in Europe, entrepreneurship in Europe. Do the capital markets support it?
We have been pushing for a long time for capital markets union. We now have the savings union, which is not exactly the same, but is going to be helpful. The reality is that most of SME commercial lending comes from banks. And that is why it's so existential and urgent that we increase the ambition for change. Because we will only be more competitive if there's more investment. This is coming from smaller and medium-sized companies, and a lot of that lending comes from the banks. And that's why capacity to lend has to expand. And that is what, again, regulation, smart regulation would be very helpful.
Is there any prospect of a unified banking regulatory system in Europe?
Well, how many years did it take to build the United States? 200? Europe, we've been going at this for 50 or 60 years. So it will happen. I'm not sure I will see it.
Coming up, we try to make sense of something that Einstein threw up his hands trying to understand: quantum mechanics and the revolution it may bring to computing by doing some things better than AI. This is a story about
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
But God playing dice with the universe, something Albert Einstein told us he didn't do back in 1926. Einstein was criticizing physicists' theory of quantum mechanics. Yet, a century after Einstein's denial, billions of dollars are being invested today in taking that theory and turning it into reality, with the prospect of a revolution in computing potentially larger even than generative AI.
Quantum computing is very high potential.
Investors are increasingly asking us about the implications of quantum computing.
Quantum computing.
Quantum computing.
Political and state level economic support to develop quantum, and we want to be part of that.
IBM is one of the companies leading the charge in quantum computing.
At IBM, we developed some of the very foundations of quantum information science, starting as early as 1970.
Jamie Garcia is the director of quantum partnerships at IBM. A PhD chemist, she's working on quantum computers transforming healthcare at places like the Cleveland Clinic.
Quantum computers are just a totally different paradigm to calculate solutions to problems. And so what most, experts have done today that are studying quantum computing for different application spaces is to really sit down with the math and figure out, are the algorithms here that I can use and that I can exploit using a quantum computer going to bring me any sort of advantage over what can be done today in classical sort of state-of-the-art techniques?
At the core of classical computing are bits, single pieces of information that can have the value of 0 or 1. But quantum technology relies on qubits, a unit that can have multiple values simultaneously. It's like holding a coin in your hand that is heads, tails, and everything in between until you open your hand to check. Physicist Jerry Chow is IBM's Director of Quantum Hardware System Development.
Really fundamentally, there's a different math, right? It's the mathematics of quantum mechanics that is governing how you actually manipulate these quantum bits, which then gives rise to a whole host of different opportunities for algorithms and types of problems that you can actually solve using quantum computers.
As we're studying things today, we're using a lot of something called error mitigation as our approach to dealing with errors and noise in the system and in the quantum computer itself. This is going to continue to evolve. In fact, we think that next year we're going to see examples of what we call quantum advantage, which is where you're able to come up with a solution to a problem that is cheaper, faster, or more accurate than with classical alone.
A turning point in IBM's efforts to make quantum computing a reality came when it made it available to the world on the cloud.
2016, the IBM quantum experience was really a pivotal moment for us in terms of getting quantum computers for the first time out onto the cloud and into the hands of anybody, really, people, right? What's interesting is that before that period, I'd say it was really much more in the realm of physics, right? That we were doing experiments on small devices, qubit devices that we were looking at, understanding how they worked, trying to make them better. But we didn't have any kind of real thought about how is this going to be used for computation.
In the 9 years since you put quantum experience up there, what have you learned at IBM?
I think what I learned from that experience really was that there was a whole lot of people out there who wanted to touch and learn about quantum. I think we were sitting there that first night after we launched it, watching these circuits coming in, and people were actually running things, and we were like, oh wow, this is picking up some steam here. And then to this point, we've had tremendous uptake in terms of using the platform to actually generate new papers and research. Thousands of papers have been generated, which would have been impossible for us to do just as individual scientists or researchers studying these devices in our own lab and working with other scientists in collaborations.
And in success, that community could go places that classical computing, even using the large language models of AI, could never take us. So it's not just speed, it's actual accuracy. When we're using classical, no matter how infinite we get, it's an approximation.
Right, absolutely. It's absolutely not a question about speed. The whole point of the quantum computer and what it can do is that it can give us the ability to actually get potentially more accurate results, also get results that otherwise are unattainable using a classical computer alone.
Companies like Google, Microsoft, and Intel are all exploring the potential of quantum computing. But there's also a new group of contenders, startups that are betting it all on the hope that quantum tech will one day become profitable. One of those firms is Maryland-based IonQ. Its CEO is Niccolo De Masi, who believes he has the best horse in the race.
We supply quantum computers to our both federal, state, and commercial customer partners. We also provide quantum key distribution, and we do that both on the ground and up in the heavens. Quantum key distribution is effectively quantum cyber security. And we're very focused on this not being just proof points in the lab, but doing useful quantum advantage examples for our customers and embedding ourselves into their workflows on an ongoing basis.
So what will it look like as we go beyond showing so-called quantum advantage in the lab and embedding it into real-world workflows? One place people look to first is in the life sciences, work like Dr. Garcia is doing at the Cleveland Clinic.
An example of something that we've done is we've taken some of the algorithms that we've worked on for chemistry, and alongside Cleveland Clinic, we've started looking at different chemical processes that they really care about. So you can think about this in the larger context of, therapeutics design, drug discovery, that kind of thing. And really what we're doing with Cleveland Clinic is pushing the boundaries of algorithm development, methodology, of using quantum computers, again, in concert with classical computers to come up with solutions to problems that they care about. Protein folding is definitely one area, mRNA, secondary structure understanding, how things like come together and how they look in sort of 3D is a very interesting area, as you can imagine, as you're trying to understand how these things fit together in a biological system.
It isn't just life sciences that could be revolutionized by the addition of quantum computing. Financial markets are another target of opportunity. IBM scored an early advantage this year when HSBC said it used the tech company's Heron quantum processor to make a 34% improvement in predicting how likely a bond will trade at a given price.
I think there's a lot of excitement in the market space as well, right? Especially because optimization is certainly in another area which we know is a classically difficult problem. And from the point of view of actually using a quantum computer to address optimization, there are many threads there in terms of leveraging this kind of large exponentially computational space to handle problems such as portfolio optimization, right, or risk management, right? So there's a lot of interesting ideas there that are being looked at by various financial institutions.
What I can say at this stage is portfolio theory, options pricing, these are very much now accessible from a quantum advantage perspective using our new Tempo system. Quantum key distribution and cybersecurity, that is, of course, front and center for financial services on a global basis. And so security and integrity of the data flow is, of course, vital. I always like to jokingly say that you can spot our quantum security customers because they are not in the news for data breaches.
Even agriculture could benefit from quantum computing in ways we haven't yet imagined.
Understanding processes such as nitrogen fixation to make things like better fertilizer, right, to help us grow better crops, right? Understanding things that are critical in impacting climate change, right, and in terms of how carbon is handled, right? Other things including in better batteries, right, in terms of materials discovery.
The potential may be great, as are the investments being made, but when can we expect to see these potentially dramatic results? It turns out that depends on whom you ask. IBM has made getting to quantum advantage in the real world a strategic priority and has a timeline of getting there in a big way by 2029.
Our roadmap really shows the detail in terms of how we want to get from today to 2029. In between, we have this real important milestone also that we believe that with the community we'll be hitting quantum advantage, right, where there'll be some problems and claims of advantage where we'll see quantum really surpassing any classical methods of solving certain types of problems, right? And we are looking at various ways of showing that academically, scientifically, and also empirically from the ground up in terms of compared with various kinds of classical methods today. And then we're building a lot of it's in the end, it's like architecting a large skyscraper. We're building a lot of the foundational elements so that when we hit Starling in 2029, all the applications that people have been developing, all the software stack, all the eventual software libraries, they're still going to work, but they're going to work on a machine that's even more capable, something that can run hundreds of millions of gate operations compared to several thousands of gate operations on the advantage level machines that we're building today.
IBM says it's on track to have quantum computing pay off in a big way by 2029. But IonQ's Damasis says they're already there.
So our machines we announced on September 12th at our Analyst Day are 36 quadrillion times more powerful than anyone else's machine, and that gap is increasing. Not only do we believe we are 5 years ahead of anybody else in the quantum computing business, whether it's government programs, adversaries, or commercial companies, but we also have the lowest unit economics. So we're able to build a fully fault-tolerant 2 million qubit system and keep our cost of goods sold under $30 million. Taking that together, it means that we're a fully fledged quantum internet solution. We can provide our customers a platform of computing, cybersecurity, networking, communications, and sensing, and there's no other company in the history of the world that's ever been able to supply a complete quantum internet.
Everyone in the quantum business seems to agree that Einstein was wrong, that it's either coming soon or is already here, and that it will be big. But figuring out who's ahead in this race sometimes feels like predicting those dice. IBM says it's ahead because it has more total qubits in its machines. IonQ says it's not the number of qubits, but the number of algorithmic qubits, putting it in front. And quantum company Quantinuum has yet a third measure of quantum volume. Maybe we shouldn't be surprised that there isn't a single measurement. It's like those qubits that are both ones and zeros at the same time, until they're observed. And it looks likely that we will all be able to observe what quantum computing can do for us in the very near future. Up next, an aging population meets lower interest rates. It's a problem countries throughout the West are facing. We tell the story of what the Netherlands is doing about it. This is
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
This is a story about nest eggs. Those nest eggs we're all supposed to be putting away for our retirement years, with or without the help of the government or employers. Unfortunately, too many of us count on support that may or may not be enough to carry us in our later years.
We have still 57 million Americans who don't have any savings or any retirement plan.
Whether it's state-funded pension plans for teachers and policemen or Social Security for everyone, we all know about the looming problems in providing adequate income for retirees in the United States. But it's not just the U.S. that has a problem.
Many countries made provisions for those promises, and now promises are being cashed in. And many countries are saying, oh, wait, we don't want to pay the bill.
Teresa Ghilarducci is professor of economics and policy analysis at the New School in New York and author of Rescuing Retirement with Tony James. The challenges faced by retirees around much of the world are reflected in higher poverty levels of those over 65, with the OECD reporting that 40% of the elderly in Korea live on less than half of the median income in the country, and the United States just under 25%. Ghilarducci says one of the reasons is lower interest rates.
The life expectancy does not put a strain on pension system, but what has changed is over the past 20 years, there was a regime of very low interest rates, for lots of reasons. One of them was the financial crisis. A lot of it was the way that we managed our economies was to make sure that capital investment was low. That distorted a lot of decisions, but one of those things that it distorted is that the safe assets, like government bonds, didn't pay as much.
The U.S. is hardly alone in facing the coming retirement crisis, but one country, the Netherlands, is doing something about it. Adrian Rijker's firm is one of those putting those funds to work.
In the Dutch pension system, in the second pillar, there are around 1,600 billion euros of assets under management, which equates to around 1.5-2 times the GDP of the Netherlands.
That 1.6 trillion euros in Dutch pension assets accounts for 59% of all European pension funds, while having only 4% of the population, which means that it ranks near the bottom of the OECD numbers in elderly poverty at just under 5%. But despite having more assets set aside for retirement than any other European country, the Netherlands is about to overhaul the fundamentals of its pension system.
Now we are moving from defined benefits to defined contribution. And the reason for this change is mainly to increase the sustainability of the fund towards the future.
At first glance, the math seems straightforward. The old model wasn't sustainable. It was time for something new. But the debate over restructuring the system was anything but simple.
The private pillar is what is in the process of getting reformed now. That reform took a number of years to reach. Discussions started in the early 2000s after the dot-com crisis, when a number of Dutch pension funds saw their coverage ratios drop. It came to a conclusion sort of around the start of the pandemic, when the shape of the current pension reform was decided upon.
Stan Voiger is a senior fellow in economic policy studies at the American Enterprise Institute and director of the Netherlands America Foundation.
That didn't mean, of course, that the political discussions around the reform completely dissipated. In the outgoing government, the Schoof cabinet that was in place for the past year or so, there was one political party, the New Social Contract Party, that was quite aggressively opposed to the pension reform as it had been designed, and they in fact tried to derail it by letting individual workers and retirees vote on an industry by industry or occupation by occupation or even firm by firm basis on whether to remain under the old pension system, which is a defined benefit system, basically, or whether to accept transition to the new, more collective defined contribution system. That effort by them ultimately failed. It lost a vote in Parliament, but only barely. And I think that was really the end of political uncertainty around this pension reform. Not only because that vote failed, but also because the Schoof government fell this summer. We had elections, and the party most associated with those efforts to basically undo the pension reform to a significant extent, that party lost all of its seats in Parliament.
The Dutch pension plan changes may be controversial, but necessary, given the larger forces that all retirement plans in Western countries are facing.
The move to defined contributions is something that we see all across the globe. If we look at the pension index that is published yearly, if you look at what pension advisors and actuaries are saying, exactly, these changes are not specific to just the Netherlands, but because we have such a large pension buildup, we have so much capital in the system, very high adequacy rates, it is very prevalent in the Dutch system. Since the global financial crisis, interest rates have been in steady decline, mainly because of monetary policy and because of the way that pension liabilities are valued. They have a direct link with interest rates. And as interest rates decrease, the liabilities of pension funds increase and thus place a burden on the pension fund's sustainability. But also on top of that, you have longevity, which has increased amongst the participants, and coverage in the Netherlands of the second pillar pensions is very high. The way in the old system that we had, the way it worked is that employees would usually stay at the same firm that they started at or stay within the same industry and work until their retirement age. And if this happened, the current pension system was perfectly equipped for this. But nowadays, we see more and more people moving away from a lifetime employment and moving more into self-employment.
One way to address the increased number of people relying on their pensions amid lower interest rates might be to extend the time when people start receiving their benefits. But that is not the way the Netherlands chose to go.
The reforms mainly are in the way we invest and changing from defined benefits to only defining the contribution.
The Dutch system is designed to increase the size of the available pie by permitting pension asset managers to invest in higher risk and higher yield assets for younger workers with many years to go until their retirement.
You now go to a more individual approach with your collective investments in that you have to see what individual investors need at certain age groups. So for instance, a young person on average has less financial capital, but still has a lot of years to work in its career. And what that enables younger investors to do is to take on more risk, because the biggest determinant of capital buildup at a young age is the contributions you get each year. But as you near the end of your career, contributions become less of a big part, less of a big influence on the income that you will have on retirement. And the income or the focus shifts from contributions to investment results that should be stable and lower in shocks.
Whether permitting more flexible investments, particularly riskier ones for earlier in a worker's life, will work or not, it does relieve the pensions from facing obligations greater than their resources, but also means that one's benefits could go up or down depending on the markets. Getting people to agree to this big change took time and all the stakeholders working together.
One distinguishing feature of the Dutch system of policymaking is that there is a lot of focus on consensus building between employers, employees, and the government. The fact that the Netherlands has these structures that facilitate the coming together of business and labor, I think is particularly helpful in the pension context. There are lots of political problems where there are all sorts of other stakeholders involved, but in the pension context, it really still is employers and employees who have to come together and reach agreement on how to design the pension system.
What can the rest of the world learn from the Dutch in providing for retirement? Perhaps a lesson in persistence. The most recent changes are just the latest in a series of attempts at pension reform. Go back to the 80s under Ronald Reagan, when they did take steps to try to extend Social Security. What made it possible then that doesn't make it possible now?
Well, what made it possible for a bipartisan commission and a fix to happen was that the crisis was only 1 year away. It had to do with surprise inflation and a surprise among the actuaries that they wouldn't have enough money in the shortfall. So money needed to be infused into the system immediately. And so the Greenspan Commission under the Reagan administration recommended that the payroll tax be increased. And everybody agreed. Later, when it came to Congress, there was some political effort to say, well, if we're going to raise taxes, we have to really look to see how much the taxes have to be increased. And so that's when they looked at the past and said, well, since everybody's living longer, then we should have a system that represents that and will raise the retirement age to 67. But that cut and benefit was going to be in the future. And they all agreed they needed an infusion of cash and taxes were increased. Maybe that's what we need to raise taxes, is to have a real look at what taxes pay for. And everyone likes their Social Security benefits.
Whether it's relying more on the capital markets like the Netherlands or turning to taxpayers to contribute more, the United States and other Western nations have some tough choices to make. And they need to be made sooner rather than later as people live longer and we want to provide for them without stealing from the future. Coming up, getting to zero emissions despite those data centers. Finland leads the way. This is a story about
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Featuring a problem instead of fixing it. This month at COP30 in Brazil, world leaders are trying to get back on the path to net zero emissions, despite the huge and growing demand of data centers for more energy. But one European country is already a decade ahead. Finland has set the most ambitious climate target in the world, pledging to reach carbon neutrality by 2035. And it's featuring the problem of data center growth to get there. Bloomberg's Tom McKenzie has the story from Helsinki.
Finland, home to 5 million people and 3 million saunas. Here, warmth isn't just a comfort, it's a culture. But now, the nation that has perfected staying warm in any condition is finding a new way to do it. 50 meters below the streets of Helsinki, a hidden network of tunnels hums with the sound of machinery.
Wow, so where are we? We are at the Helen heat pump station, where we do cooling for the Helsinki data centers. And we take the cool and sell it as a heat for the Helsinki households.
Our guide through this underground maze is Olli Sörkö, CEO of Helen, one of Finland's largest energy providers, and the company turning data center heat into power for the city. Here's how it works. Above ground data centers, the engines of our digital lives, generate vast amounts of heat as they power everything from AI to streaming video. That heat is captured and piped into Helen's system, where heat pumps raise its temperature even more and send it through the city's district heating network. The same system then returns cooled water back to the data centers. It's a test case for whether our growing digital appetite for energy can be contained.
When you have partners like Equinix and Microsoft and Telia come to you to work with you and partner with Helen, what are they getting exactly in that partnership?
They have a problem with heat, and they need to cool down somehow their premises. And our job is to sell heat. So the starting point for discussion is really good. And in the end, we can actually monetize their problem.
Can you just unpack the business part of that?
So in normal case, if you build for example, 100 megawatt data center, almost all of that power, practically all of that turns to heat. And they need to get rid of that. They need to invest in heat pumps and all kind of cooling equipment. And if they cooperate with us, they don't have to do that investment. We do it for them, and we take the heat out. And on top of that, we monetize the excess heat by selling it to our customers. So they save all the cooling cost, and it turns to business for us.
So that's a big CapEx outlay for you.
Yes.
And CapEx that they don't have to be putting and factoring into their spending plans.
Exactly. The CapEx is needed, but it's done by us, and we can get a very good, profitable business around that CapEx, so it works for us.
For the local community, the benefits are tangible. Electricity prices that sit below the EU average. Helen's newest partnership is expected to provide warmth for roughly 1,500 homes.
We have been able to increase our profits. At the same time, we have now lowered our prices 2 times in a row during the last 2 years.
The impressive progress in Helsinki is set against a challenging global backdrop. According to Bloomberg New Energy Finance research, data centers could consume about 4.4% of global electricity by 2035. If they were a country, they'd rank 4th in electricity use, just behind China, the US and India. And cooling them already takes up nearly a third of that energy, according to the World Economic Forum.
So this is the bus of the internet and our digital society. So in here you have what we sometimes refer to as clouds.
Helen manages the heat, but it's Equinix that runs the data centers, more than 270 of them worldwide.
A data center is a part of everything we do digitally.
Regina Donato Dahlström heads their Nordic operations.
So inside of these are servers that are co-located by enterprise customers of Equinix, and connectivity, so connections. So altogether we host over 490,000 connections at Equinix.
490,000 connections, and those connections and the work that's being done by these servers creates a lot of heat. You can feel it here in the data center.
It does. Managing the heat is one of the larger parts in operating a data center.
The heat, a reminder that every click, stream and search has a footprint somewhere in the real world. Managing it is one thing, finding a way to use it sustainably is another.
The way we measure our data centers is very thoroughly with efficiency measures per each square meter. That's on top of mind of any data center operator, because that's money. And it's also a proof point to how good of a data center you have towards your customers. On top of that, we add back to the society in which we invest in infrastructure.
Around the world, the race to build for AI is putting new strain on power grids and sparking a backlash. A Bloomberg analysis of wholesale electricity prices across the US found that electricity now costs as much as 267% more for a single month than it did 5 years ago in areas located near significant data center activity.
When you look at some of your competitors in the data center field, is there ever a sense of frustration or kind of head in your hands moment when you look at the fact that a lot of these data center operators don't seem to be thinking about all the different components that go into it in terms of addressing the energy needs and the sustainability piece?
No, saying that a data center is a data center is like saying a factory is a factory. We do co-location services for enterprises. And I would say that respecting my peers in that part of the data center industry, most of us do care about sustainability.
I guess the critics would say in this rush to build out for AI, that corners are going to be cut when it comes to energy and to sustainability.
And I think in any of the technology waves that we've seen, whether that was IoT or 5G or building out broadband, yes, there are some that get it wrong. There are some that cut corners. There are some that think they've got it right, and then actually the application of the services changes. I think this is no different.
The question now is, can the race to get there first coexist with the desire to get it right? Nowhere is that question more urgent than in the US, home to more than 5,400 data centers, more than all other major economies combined. And most of the electricity to run those data centers still comes from gas and coal, which are also expected to meet much of the country's new power needs over the next decade. Put simply, Finland may offer a glimpse of what's possible, but the real test is whether that model can scale worldwide. It's a question that Noah Nkonje has put a lot of time into answering.
The Finnish case is slightly different, and across Scandinavia, because they have a lot of existing heat networks, and in a lot of other countries they're not as well developed for heat networks. Having said that, it is still possible to apply some of the learnings. One of the key ones is working with a utility or heat network operator that's keen and supportive.
Nkonje pioneered the technology Equinix uses here in Finland and says its applications could be endless.
It's important to point out that the heat export will tend to only work in the right types of climates, so those climates where there is a need for heating. So it won't be applicable, for example, in Dubai or South Africa where it's a very hot climate. So it'll be probably mostly Northern Europe and the northern part of North America as well. And so what tends to be the limiting factor isn't whether you can technically connect to the data centers, but it's usually whether there's a partner who's actually willing to develop a heat network and make the capital investment.
Do you also do it because it's a valuable revenue stream?
It's not a really significant revenue stream compared to the overall data center business. So we're not looking at heat export as a new revenue stream. We're looking because it supports our customer sustainability targets and reporting. It also helps the communities where we operate to cut carbon emissions and also to become more energy independent as well.
And the model hasn't gone unnoticed. Microsoft, one of the world's largest cloud operators, is building its own version, expanding the idea at a massive scale. Ian Doherty leads the company's cloud operations in Europe, the Middle East and Africa.
We're very proud of the project that we're working on in Finland. We're working with Fortum to leverage the waste heat from our data center to decarbonize their local heating system and provide heating to local homes. Over 250,000 local homes, in fact.
In the data center race, efficiency is the new currency, and even the world's biggest hyperscalers aren't immune from the pressure to balance growth with sustainability.
Clearly, AI is growing in its use case and diffusion across the globe, and we're seeing that in our own business. And clearly, we need to do more of the same things in sustainability and contract further renewable energies. And so there's a lot of great opportunities that we have ahead of us.
Momentum is building. In Finland, almost 100 data center operators are in discussions with Helen, exploring projects that would feed their own excess heat into the city's energy system.
What do you think your example says about Finland's approach to decarbonising its economy, but growing at the same time?
Well, I think and I hope we can show to the rest of the world that you can do the decarbonizing in a profitable way. Because I don't believe it's going to happen if it's forced by state or EU or any other regulatory issues. You have to find a way how to go to CO2 zero so that you can make money with that. Then it starts to happen. And I really hope we can be an example how that is done.
In a moment when our digital lives demand more than ever, Helsinki offers a quiet reminder that progress isn't measured only in speed and scale, but in the balance we keep as the world races ahead.
Up next, the chips that quantum computing will need. We've
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We've heard so much about the GPU chips AI needs, which have catapulted NVIDIA to the top of the leaderboard. But what about quantum computing? How are they different? And who's making them? Jerry Chow of IBM gave us a tour at the Thomas J. Watson Center in Yorktown, New York.
So this is our IBM Quantum System 2.
Which is the most recent one.
Most recent one. It is also a infrastructure that is built with modularity and scalability in mind, built for data centers. Right? So the way to think about it is really this is a modular architecture. What's right behind us right here, this is actually the cryogenic part of it. So inside here, there's actually a cryogenic system which cools down.
That chandelier that we saw in the other room.
Chandelier, yeah. Cools down in the moment there are 3 Heron processors, 156 qubits each, that are cooled inside of this cryogenic infrastructure. And the idea is that over time, that kind of cryogenic infrastructure can be modularly scaled. The footprint can be increased. And then hanging off on the wings over here are actually classical control electronics. So the pieces that generate the signals to manipulate the qubits, read out the qubits, they're all in here, right? And they're actually located right next to it because we need to make sure that they have short time scales for the control and latency. But similarly, as you need to scale to a larger footprint, we can scale the amount of control electronics that are located right around it. But overall, this is really designed with that in mind.
But if I look behind there, it would look like a rack like I see in a data center, like a classical computer.
It would look like classical racks of electronics. We have, at the moment, these are based off of FPGA control board. So this is actually our latest Nighthawk quantum chip, right? And so the Nighthawk is 120 qubits arranged in a square lattice, so it's more connected than we had in the Heron processor in the previous generation. But what you're looking at is the chip mounted into a printed circuit board. This printed circuit board, you can see it has space for where the connectors come down. These connectors come down to bring the signals to manipulate the states of the qubits or to read them out. And then this is basically bolted and mounted at the bottom of our dilution refrigeration systems at 15 millikelvin.
But is this the chip right here?
That's the chip right there.
And other than this is the printed circuit board on the flip side.
Yeah, so it's mounted up into this printed circuit board, and then the signals are being carried out to all these various connectors.
And does one of these chips go into one of those chandeliers?
Yeah, so effectively we're able to fit a varying number of these into cryogenic infrastructure. A big part of that comes down to not necessarily limitation of the size of this, but the size of the kind of wiring that comes down. And so a big push of how we're scaling infrastructure comes down to miniaturizing some of the wiring and the cabling and miniaturizing other components, right, that are within so that we can get more control for larger numbers of chips within the same kind of cryogenic footprint.
So I'm going to go way past what I understand. Back in the old days of sort of electronics, you talk about whether they're rigged up in series or in parallel. Right. If you put multiple chips inside one, is there an analog to
so that
series or parallel?
That's actually a funny point there. Like, so you can place these multiple chips inside. We actually are going to be connecting them with cryogenic quantum links over the next year. So we actually have this technology that we actually demonstrated at first last year as part of a different architecture that we called Flamingo. But it actually allows us to actually scale these and network in a quantum way these various chips together. Wow. So that's one thing. There's already this kind of this strategy for scaling module by module. Another way is actually that there's classical communication networks in the control electronics that also lets you communicate between these chips too, so that you can actually perform a circuit on one, measure the qubits, and in almost real time decide to do something on another chip. So this kind of dynamic circuit piece is also another capability that we have built as part of our overall infrastructure and platform.
Does adding more chips reduce error?
So that piece is, that's not how we're approaching the error correction strategy, right? So error correction strategy comes down to actually a fundamentally different layout of how we are arranging the various qubits on the device. What that does in terms of having multiple chips really allows us to run a variety of different types of quantum circuits. So you have different kinds of applications and algorithms that might be possible by leveraging this kind of tight coupling of different chips. So this chip is actually what's on. So this is actually a stack of 2 chips. So there's actually a butter side down and another chip that comes on top. That's what you're seeing, the back side of that.
Right.
And this is the piece that gets mounted up onto the bottom of this board.
But there are several of these, right?
Yes, this is several of these.
There's a lot of these.
Yes, these are many night hawks, right? So we will cut. We
So
dice
you
these
cut
out
these and then you
package them and then put them in.
Back to front, essentially, on top of each other.
Yeah, and you can see this is 300 millimeter scale.
This is silicon.
Silicon.
And then it's etched with a sort of lithography
all kinds of lithography tools and techniques that you would certainly be familiar with for your standard CMOS processes.
For GPUs or
yeah.
something.
So this is actually the inside of one of our testing fridges. This lab actually we're in is our quantum test and characterization lab. We're
testing the chips?
Testing the chips. So a lot of the either Heron or Nighthawk processors, right? After they come out of fab, we go through a series of qualification steps. Some of them are room temperature tests. Some of them are actually cryogenic tests when they're ready. So that's what this lab is for us to actually qualify and characterize the performance of some of those devices before we decide whether it's good enough to go into, for example, a data center for deployment.
So this basically you recreate the temperature from what you'll use in the quantum computer.
Right. We effectively recreate the environment in which it would be deployed in, but in order to get out all the salient parts and characteristics of the device to judge that, this is going to be a good one.
And how cold does it have to get?
15 millikelvin, right? So
okay, so explain that to those who don't think in Kelvin.
You don't think in Kelvin. I guess 0 Kelvin is absolute 0, right? Minus 273 Celsius, right? And then 0, we're at 15 millikelvin, which is 0.015, right? And if you think about, we always say colder than space because space is in around several Kelvin, right? Cosmic microwave background is in the several Kelvin range. So, orders of magnitude colder than that.
And you get there through liquid helium?
You get that through 2 stages of cooling. Okay, so there's liquid helium itself. If you just had had it as a liquid, is 4 Kelvin. We actually don't use it in its liquid form per se. We have what's called a pulse tube cooler as part of this. It's actually the noise you hear. It's driving a compressed circulation of helium. That part of it gets a large part of the infrastructure down to around 4 Kelvin. It's actually up at the top stage there that gets down to 4 Kelvin. But hanging off that is another closed loop refrigerator. It's called a dilution refrigerator. And it uses a different cryogen. It uses a mixture of helium, which is balloon helium, and helium-3, which is an isotope of helium. So helium typically has two protons, 2 neutrons. You knock off one of those neutrons, you have helium-3. So it's a rare isotope of helium that doesn't exist a lot of places, but we have enough of it in the world. But it is part of the mixture that is used to make these machines actually cool down to that 15 millikelvin.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.
News when you want it with Bloomberg News Now. I'm Tom Mackenzie.
And I'm Caroline Hepker.
UK inflation has fallen for the first time in 7 months, driven by a slowdown in energy price increases. Consumer price inflation rose by 3.6% in October compared with a year earlier. That is down from a 3.8% rise in September. The figure is slightly higher than City economists' expectations for inflation to ease to 3.5%, but remains in line with the Bank of England's forecast. David Goodman, who leads our team covering FX and rates in London, says the data keeps alive hopes of a BOE rate cut at its December meeting after policymakers voted 5-4 to hold earlier this month.
I guess the big picture is this doesn't really change anything in terms of what the BOE may or may not do in December. I think the people who were going to vote for a cut in December probably still will, and those who were going to vote for a hold will too. So this is a kind of, I guess, a decent reading for the UK, and also if you're hoping for a rate cut in December, I don't think this is going to be something that prevents that.
David Goodman speaking there as attention now switches to Rachel Reeves and the UK budget next Wednesday to see if it includes any measures that may be deemed inflationary.
Global stocks have fallen to their lowest level in a month as traders question frothy valuations and whether billions in AI spending are delivering meaningful returns. The sell-off has wiped roughly $1.6 trillion off equities, with the S&P 500 down more than 3% in November. But not everyone believes that that's a bad thing. Here's the view of Atlas Merchant Capital CEO and the former Barclays boss, Bob Diamond.
We've seen risk assets be repriced. In my sense, this is a healthy correction, not something that's turning into a bear market.
Bob Diamond's comments were echoed by Grace Peters, co-head of global investment strategy at JP Morgan Private Bank. She told Bloomberg Radio that a correction of 5 to 8% is not unhealthy and could help pave the way for a fourth year of double-digit equity returns for the S&P 500 in 2026.
Well, the big earnings event of the day comes after the Wall Street close, when we're going to hear from Nvidia. Traders will be looking for reassurance about the sustainability of spending at the $4.4 trillion AI chip giant, as well as evidence that it can continue to outrun its competitors. With more, here's Bloomberg's Charlie Pellet.
The report could either reassure Wall Street that the AI computing boom is continuing or fuel fears that the tech industry is in a bubble. Margie Patel is Senior Portfolio Manager at Allspring Global Investors.
The PE is around 40 times, and that's higher than the average stock, which is around 27 times. But on the other hand, they're leaders in their sector. They should have an above-average growth as far as the eye can see.
The Bloomberg consensus revenue estimate for NVIDIA is $55.19 billion. In New York, Charlie Pellet, Bloomberg Radio.
The United States Congress has voted to force the Justice Department to release files on the convicted sex offender Jeffrey Epstein. The legislation overwhelmingly passed the House in a vote 427 to 1. Hours later, the Senate passed the measure with unanimous consent. Democratic minority Senate leader Chuck Schumer called on House Speaker Mike Johnson to send the bill to the White House right away.
There's no reason it can't be on the president's desk in an hour. Second, the president has to sign it. You never know with him. He said he would. Let's wait and see. But third, we have to make sure that all of the documents are released.
Chuck Schumer speaking there as Senate Republicans ignored calls by the House Speaker to give the Justice Department additional leeway to withhold documents.
The European Union's top diplomat has said the bloc's steep economic ties to China are limiting its ability to pressure Beijing over Russia's war in Ukraine. At a Bloomberg event in Brussels, the EU's High Representative for Foreign Affairs, Kaja Kallas, said that without China's support, the war would be over. She added the EU should strengthen its language on Moscow's recent aggression against the bloc, referring to a railway explosion that took place in Poland over the weekend.
These sabotage acts that they are organizing on our territories in different countries, these are extremely serious. And I would quote a good friend, Secretary General of NATO, Mark Rutte, who said that why are we saying, hybrid attacks, which seems like, something soft when we should call them by its name, which is state-sponsored terrorism.
That was Kaja Kallas, the EU's High Representative for Foreign Affairs, adding that Russia is, quote, really trying to test how far they can go on Europe's home turf following an uptick in incidents of sabotage, cyber attacks and drone incursions. Kremlin spokesperson Dmitry Peskov has rejected accusations from Poland that it was behind the train line explosion, saying Russophobia is flourishing.
Finally, new analysis by Bloomberg shows that the pay premium for graduates over minimum wage salaries in England has halved since 2007. Bloomberg's Ewan Potts has the details.
For years, the advice to teenagers considering their options was clear. If you want a well-paid job, head to university. But new analysis by Bloomberg suggests the picture these days is not so simple. Back in 2007, average graduates in their 20s earned twice as much as the typical minimum wage worker on a 40-hour week. By 2024, the rising value of the minimum wage has shrunk that premium to 43%. And accounting for student debt repayments, the gap comes down to just 32%. A separate ranking by the OECD says that UK graduates get some of the worst financial returns for their university education anywhere in the developed world. In London, I'm Ewan Potts, Bloomberg Radio.
Those are your top stories on the markets. European stocks currently posting very, very modest gains. Here in the UK, the FTSE 100 is flat at 9,552. And on Wall Street, S&P E-minis, so futures in the S&P 500, currently pointing to very modest gains of 0.1%. These markets very much on hold, it seems, ahead of those Nvidia earnings.
That's news when you want it. With Bloomberg News Now, I'm Caroline Hepker.
And I'm Tom Mackenzie. And this is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence.
The most ridiculous argument of all for private credit has been private credit belongs in every portfolio because it lets you sleep at night, because it helps you ride out the volatility of your public credit. Again, that's just a repackaging of the volatility. If you don't market to market, there's no volatility. But if the price goes from 100 to 0 in a matter of a few weeks, there's something untoward is going on. And so I'm very, very negative on those types of non-transparent markets. It reminds me, I've been saying this for probably 2 years now, that the next big crisis in the financial markets is going to be private credit. It has the same trappings as subprime mortgage repackaging had back in 2006. Now, it took a couple of years for it to totally unravel. So this stuff doesn't happen in a week or a year even. But I'm very negative on that.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We've been talking about circular deals. There's concern about how investments have been plowing through the AI ecosystem and talk of froth, a bubble. What are you seeing in terms of demand?
Yeah, so it's interesting. I think if you ask the question of a bubble, you can think about it two ways, the technology itself or valuations. And I think they are separate questions. I think if you look at the technology itself, there's no doubt over the last 4 years, we've seen an absolute step change in model performance, the usage of those models in a lot of different areas. So I think the technology paradigm shift is very real. You then get to the question of valuations. And I think that's actually a more complicated question. You can definitely say valuations are high, but I'll just give you a couple stats that I think about a lot. You have basically the big tech companies whose earnings are very material. So it's hard to argue that in their cases it's a bubble given that performance. And then if you actually look at the AI space, it's something like 3 companies are 30% of the total funding.
Yeah.
And about 100 companies are 70% of the total funding. So what you really have here is about 100 private companies with a lot more demand than capital access at the moment. And none of them really are public. And I think that is the interesting thing. This is not a retail dynamic. This is not a situation where, I mean, an interesting fact I saw the other day is that public software multiples today are 1/2 what they were in 2021 today. And actually, if you look at the number of IPOs, it's still only about 2/3 of what it was, or actually 1/3 of what it was in 2021. So it's not a public markets dynamic. I think what you have is capital scarcity around a smaller number of AI companies.
Now for you, I mean, you've managed to raise, what, 100 million back in September, and now you're telling me more than 200 million?
130, yeah. We did get, after that, we had a lot more interest in, so we actually did end up upsizing.
What are you doing with that capital?
We are investing all of it in our core technology software platforms. So I think, if you think about the history of our business, we've trained all the large language models. We're involved in statistical testing and what's called reinforced learning human feedback, where you basically test and validate the large language models. What we found is that cycle is where the enterprise is going over the next 10 years. So if you're a big enterprise company and you're looking to deploy a model, let's say for credit memo generation, let's say you have a bunch of credits and you want to generate 10-page documents to do reviews of those credits. You need to do all the same stuff that we've been doing kind of at the model builders over the last couple of years, where you create a rubric for does the output look good, you score it, you test it, you train it. And so a lot of our capital now is going to enterprise focused and training all these similar models.
How difficult is that to have the adoption at the enterprise level, and how does it differ from consumers?
It is difficult, and I think this is actually, and you asked about the question of a bubble. If you look at actually the uptake so far, so KPMG had this report, interestingly, that 60% of people worldwide, I think it's across a panel of 80 countries, use GenAI once a month. So you have enormous adoption on the consumer side. On the flip side, on the enterprise side, MIT released a study that 5% of AI projects make it to production right now. And it's hard. I think you need to have clean data. You need to have testing and validation. You need to know that, I always give the answer, if you had to generate 1,000 memos and you had to bet, your annual bonus that those memos would be right, how would you know? How would you train that? How would you test it? How would you get comfortable that these memos are right. And I think that's really the journey of the enterprise is looking for extreme precision and kind of human equivalence in output. And I think that's harder than people expected.
When it comes to data, I mean, this idea of rubbish in, rubbish out, right?
Yeah.
So the cleanliness, to your point, is important. But what do you see in terms of the scale of the market in data labeling? I think some estimates put it at 2 billion last year, quadrupling by 2030. And how will your company play in that ecosystem?
Yeah, I would say we're in the first inning of that. I think if you extrapolate what I just said to the enterprise, you actually have all of the big enterprise companies over the next 10 years as they start to label things like contact center conversations or video image data. Basically, the enterprise has barely started in the context of kind of data cleanliness. The other thing I'd say is we're talking about unstructured data in the context you just brought up, but a lot of the pain for the enterprise has actually been structured data as well. So like if you think about, I have 12 ERP systems, a CRM system, I have this huge fragmented landscape of data that underpins my AI, and I've got to get that all organized before I can do any AI. My favorite joke is that when good AI meets bad data, the data usually wins, and I think that is the story.
When it comes to enterprise segments, where do you see the most opportunity?
It's an interesting question. So I think the investment so far in the enterprise has predominantly been in the sectors you'd expect. So financial services and healthcare. I mean, they tend to have the largest technology organizations, so they've put the most capital into it so far. But there are a lot of really interesting spaces where we are seeing a lot of opportunity. To give you a few examples, agriculture. So we think about, like, if you think about crop yields and herd safety and all the different dynamics of, there's a lot of things you can do with video and image data in agriculture, for example. I actually look at some of the areas we've played in. So Swiss Gear, like Swiss Army, the luggages, we've done a lot of analytics for them around inventory forecasting. So most consumer goods companies, for example, are still pretty basic in the information they bring together, and we saw a lot of opportunity there. My favorite one is sports. So I actually think everyone loves sports. If you think about the potential to look at the spatial movement patterns of players and who you might want to draft, we did that for the Charlotte Hornets. That's been another big area.
Super quickly, how do you differentiate with competitors, scale, Surge AI?
Yeah, I think, look, there's kind of 3 to 4 of us or so that have done this for the last 5 years in the AI training space with model builders. I think the difference for us is that's really only half or a third of our business. A lot of what we're doing also is on the enterprise side. I think we are a tech-centric platform, and I think on the enterprise side where we serve, I think, 8 different sectors now, I think that's a pretty different part of our business than the rest of those players.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
What we are not seeing is a deterioration between what we were expecting in the credit cycle in any of the portfolios. So I think that credit remains solid from credit cards in the US all the way to big corporates. But we will see how it plays and continues once the economy. I don't think that the economy will go into recession. It's likely to slow down. And the credit cycle will continue to normalize. But I don't think that in the credit cycle we see a deterioration beyond what we were expecting.
If the economy slows down, where do you stand on the interest rate debate in America at the moment? Do you think the Fed is going to cut again in December or hold off?
I think that it may be some inflation is being quite resilient. Growth is slowing down, but it's still, this quarter I think that we should discount the numbers wherever they can because of the shutdown, that it will recover, whatever it is, it will recover in the next quarter, in the first quarter of next year. So we do see some deceleration. We do see some reduction in consumption, but still for healthy levels. So I think that the economy may grow less next year, but most likely it will avoid recession. Tariffs, they haven't had the full impact, but some will have a further impact next year, but also some will be compensated by the fiscal expansion. So I am relatively positive on what we are seeing. Having said that, markets are pricing a very, very benign scenario and quite a bit more. So that I don't know. There may be issues or not, but the S&P at 6,700 or so, 23 times is quite healthy, to say the least.
You're not giving us a new S&P target.
Well, whoever was giving target missed it all, so no. But I think that from here, you would have saw that the upside is relatively limited.
Obviously, no on-stage interview these days can't include AI, so here's the AI question. Where do you stand on the continuum of hype, bubble, and it's going to solve everything?
Well, the technology is real, and we are, even though we've been dealing with traditional AI for the last 10 years, we are now working in large language models, and we deploy that to almost every employee that we have. We are using different forms of this to improve productivity across operations, technology, detecting fraud, surveillance, credit decisioning, improving client experience. It's all over the place. But it's still at a very early stage. So large language models that are still not having the impact that they should have, and we're still very, very early in the agentic journey. Clearly, this will have an impact in the labor market. Some jobs will be created and some jobs will be eliminated. But I think that one thing that ones want to keep an eye on is how much capacity is being created, and how all these companies, how much revenues they are going to get to compensate, to pay for that capacity. Is likely, I don't know the probabilities, but it's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
So I did go back and listen to some of the interviews you did with us at the beginning part of the year in Davos with Jonathan and Lisa. Essentially, you were saying risk is on, and that there are a lot of tailwinds. And you said U.S. at the epicenter of all negotiations as the deal flow. Looking back, are there a little bit more headwinds now than there were then? We hadn't gone into the Trump administration yet. We hadn't seen the ferocity, if you will, of the tariff regime. How is your assessment going into 2026 differing from that?
On the face of it, a lot of the headwinds seem to have more clarity. So remember, coming into this year, tariffs were kind of a main feature. Looks like we've landed kind of on most of the tariff framework. If not, it's work in progress. Net, the market is taking a lot of comfort that every country will land in some zone which will be palatable to the U.S. and to that nation, and net, life goes on. So I think those tariff headwinds, there is an element of kind of acceptance in the market and an expectation in the market that we'll get to a good place. And then if you look at the other headwind we talked about, it was all the geopolitics. You had the Middle Eastern war, you had Russia, Ukraine. Some of those things have still got to play out. But generally, it looks like, there is at least, peace in the Middle East, or we are in the process of peace in the Middle East. So I would say, given the amount of liquidity that is out there, I'm quite, reasonably optimistic on the outlook.
And you're bullish on the AI trade as a whole for deal flow, and also internally as well, what you guys are going to be doing with AI. But again, where does that take the M&A train going into 2026? If AI, some have called it a bubble in the markets, but where does that take us for deal flow into 2026?
Look, I think AI is becoming almost existential to most corporates. The transformative powers of AI. I mean, everyone realizes you don't quite know what's around the corner, but everyone knows, wow, this is going to just change the way we consume, change the way we live. And this is beyond data centers and compute and water, power, and all the rest of the stuff. Companies today are all evaluating, what does AI mean for me? And that means compute for yourself. It means R&D. It means apps. It means how do you re-engineer your own processes in an AI world? All of which is capital heavy. You need to spend money. You need to invest to harvest and harness the power of AI. So beyond just the kind of the capital needs that the tech industry is needing to build all these infrastructures and data centers and the like, every corporation is sitting now and saying, okay, what does this mean for me? Yeah. What is it going to cost me? What are the efficiencies? What does it mean for my top line? What does it mean for my cost of goods sold? And more importantly, what does it mean for my workforce?
What does it mean for deal flow? Again, you have a reputation for being a relentless deal maker, and I think you've pushed your team. Now you've been on the job about 17 months, right? Just about a year and a half. So what does that mean for deal flow within AI, and what does that look like in 2026?
I mean, this is going to be absolutely hectic. I mean, just when we look at our own pipeline, our M&A pipeline, looking forward to next year, it is one of the richest it's ever been. If you look at this year, I think it's like the second biggest M&A year on record. I mean, we've had over $4 trillion of M&A announced or prosecuted, during the course of 26. Yeah. Roughly $1 trillion or plus, 1.3 trillion or thereabouts was sponsor-led, and we forget the sheer amount of dry powder that the financial sponsor, the private capital pool is. It's like they got about $2.7 trillion waiting to deploy, and they incentivize to deploy. So they're paid to put that to work. So so for M&A, there's a lot of tailwinds with regard to just the ability to power activity. AI is going to be a big part of that. I think the other key driver in M&A, and this is an important one, is valuations. Yes. So when you look at how equity markets have performed, share prices have gone up and up and up. And with that comes responsibility. So if you're a board, you're basically saying, I need to justify the share price. I need to show growth. And if that growth is not forthcoming, investors are going to vote with their feet. Activists are going to be knocking on my door. So boardroom CEOs are saying, okay, where am I going to get that growth from? And if it's not coming organically, I need to go buy and effectively, buy that growth. Yeah. And that has been a big driver because we talked a bit about the sponsored dry powder. Yeah. This year has been a mega, corporate M&A, good old-fashioned company A buying company B has been incredibly dominant in the market.
So how obsessive are you looking at the tables, the ranking tables? The latest Bloomberg ranking put Citibank this year for the first time since 2019, number 4 in M&A advisory work. How important is that to you? Obviously coming over from JPM, which is oftentimes at the top of the table.
Look, I think this is a barometer. For good or bad, in the investment banking business, you have a daily mark-to-market. Yeah. When a deal hits the tape, there's another mark-to-market. So, you have to be all over, whatever deals are happening, not just for league table or, revenue kind of reasons, but deals that happen are very often indicative of the direction of travel. So when one deal happens, very many are likely to follow. So you want to be kind of early, you want to be kind of the lead indicator of themes and trends, but very often when one company in a peer group moves, it's very likely that the rest in that peer group are also going to be likely to move. So you want to be absolutely on top of it.
I can guarantee everybody who's watching this that's in the banking industry is wanting to know about bonuses this year. How is this going to translate into this deal flow if it's going to go into, strong tailwinds into 2026? What are bonuses going to look like for you and for your industry?
I think, look, like every other bank, we pay for performance. And, where there's performance, you absolutely end up, paying for it. So I think those themes are, almost kind of, it's a doctrine, and that is something that, culturally institutions really adhere to. So.
What's your overall plan for China? Obviously, a few years ago, you guys did withdraw from your retail banking, along with other nations as well. You still have the security license, a wholly owned security license application that is still pending. What's your overall strategy for you, how you want to tackle this market? You've brought a big presence here to this China conference this year.
Look, I mean, you can see the energy in the room here, right? I mean, you have over 2,700 clients, investors. I mean, there's a buzz. I think there have been over 7,000 one-on-one meetings and the like. I mean, the energy is palpable. I mean, it's not just in this room. Just, meeting clients and, just kind of looking at their aspirations and ambitions. I mean, this market is just absolutely, you can see the energy and the vigor. This market is absolutely going to flourish. And we are, we are absolutely everywhere our clients are. So we serve Fortune 500 globally and their desires and their needs into China, and same way we service our China clients into their global ambitions. So it's a very key market. I think you can see the energy here, and they're going to be a key part of the entire kind of global tech boom that you're seeing. So,
what kind of employment footprint would you like to see? I know some of the tech staff have been withdrawn from here. You got rid of the retail banking about 3-4 years ago, but are you looking at really building up Hong Kong because of the IPO boom that we've seen there? Also, wealth management. I think you sold your retail wealth portfolio to HSBC a few years ago as well. So, does wealth management and also the IPO underwriting emphasis really focus on Hong Kong and to another degree Singapore?
So look, our expansion will totally mirror Jane's mission around the 5 clear lines of business, and each of those businesses have incredible kind of corporate clarity, ownership, accountability, and the idea is as we grow, those will be the pillars along which we grow. And you talked about the Hong Kong market. I mean, the market has had, it was up, 28% or thereabouts, the Hang Seng Index this year. And when you look at the valuation of the market, it's trading at 13 times forward PE. 13 times forward PE. Just so you can imagine the amount of inward interest and the upside it is going to attract. So I think there are multiple kind of tailwinds, and in the region, I think China is slowly having a renaissance, and as all the kind of the global streams, etc., calm down and the like, I think once again you'll see a lot of Chinese companies want to access international capital. And you're seeing the beginnings of that capital formation happening already.
How confident are you, though, and I know you don't want to get ahead of regulators, of getting that A-share securities license fully owned here?
Look, we are super committed to China. You said exactly where we are, and I think nothing more to report on top of that. So.
Japan also has seen a new prime minister, pro-stimulus kind of candidate. You've seen the market react upwards as well. What's your outlook there, as well as on the deal flow as well in other parts?
I was just in Tokyo yesterday, so I came over from Tokyo. Similar theme. I mean, we had our global TMT conference in Pebble Beach over the last weekend, and you thought you could see the energy in the valley on the whole kind of the AI tech wave that is coming. You follow that through to Asia, it's almost a continuum.
Yeah.
Because for every company absolutely at the forefront of that AI wave, there is another company in this part of the world that is part of that whole ecosystem. I think Japan is really having its moment. The whole drive towards corporate clarity, in where companies are now focused on optimizing their net asset value and looking at either sweating their assets better or demerging. You have activists now who are mounting campaigns if you see a sleepy company. Private equity is all over Japan. I mean, first there were like 3 or 4 players. This year, I've seen 10 more come in and open shop. So I do think that Japan is going to be very interesting to watch. Yeah. It's got some.
The foreign interest there is quite strong right now, with the yen at 155.
Spot on. It's a bit nuanced too. There's an aging demographic. Most Japanese corporates cannot entirely look organically or domestically for acquisitions. So you will see more and more Japanese corporates and look abroad to effectively get their acquisition. And we saw that. We advised Nippon Steel on buying US Steel, for instance. So you'll see more of that.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Dip buyers, where have you gone? On track for a fourth consecutive day of losses. 30 minutes ago into the start of cash equity trading, I'm Danny Berger. Matt Miller is off the show today. Bloomberg Open Interest starts right now. Coming up, JP Morgan's Daniel Pinto warns AI valuations are due for a correction, while a potential AI bubble was ranked the biggest tail risk in a Bank of America survey. Meanwhile, earnings from Home Depot point to a weak consumer as the retailer faces mounting headwinds, and a widespread worldwide outage at Cloudflare blocks access to websites including ChatGPT, X, and the New Jersey Transit. I think this is like the second day that you're facing a delay if you're on the New Jersey Transit, so good luck to you. At least this time it's because of tech and not because of weather or rail derailment. Anyway, some of the stocks we're watching this morning, it's the big tech players. Microsoft and Amazon, both of them were downgraded at Redburn. The analysts calling their generative AI returns misplaced. Home Depot, they also cut guidance as shoppers stop buying those big ticket items. Those shares down 3.5%. Let's start on Home Depot. Let's get more on it. We're joined now by Bloomberg Intelligence Senior Analyst Drew Redding. Drew, your initial take on what we heard from Home Depot.
Yeah, so Home Depot is facing a lot of challenges, not altogether new, but the most important being a weak housing market. U.S. housing is really stagnant. Volumes are down about 25% from normalized levels. And what we're seeing, and I think what the difference here is heightened consumer caution. You have consumers who have grown increasingly cautious about the outlook for the economy, the outlook for their employment situation. So I don't necessarily think the underlying trends in Home Depot's business have gotten significantly worse from last quarter. They actually called things out as being relatively stable. The difference is their guidance last quarter had assumed an acceleration in activity in the back half of the year, and that has not materialized.
What changed? What changed that would have made them think that that won't materialize as they did in their last earnings?
So I think the hope for Home Depot and for the broader housing market was that we would get lower mortgage rates, and that would spur increased housing turnover. You'd get more big ticket purchases as people would become more willing to finance that. But as we've said in the past, rates are certainly a big component of affordability and crucial to what happens in housing, but they're not the only thing at play here. We've heard across the housing space, whether it's the home builders, building product manufacturers, and now Home Depot, is that there's just increasingly cautious consumer. And when you have, a poor sentiment in regards to the outlook for employment, you're less willing to take on those big ticket discretionary purchases. So think of things like kitchen remodels, bathroom remodels, flooring projects. And that's, one of the areas where we're seeing particular weakness.
Hey, Drew, thank you for that. Home Depot shares again down this morning. Drew Redding of Bloomberg Intelligence. Now, elsewhere on shares that are moving to the downside, Redburn has cut Microsoft and Amazon to neutral from a buy, breaking rank with peers. Analyst Alexander Hassel says that underlying economics of generative AI are far weaker than assumed, with high capital intensity and weak pricing power. Bloomberg Tech co-host Caroline Hyde joins me at the desk. Caroline, how rare is it to get a downgrade on some of these names that everyone, I guess, was loving and maybe not this morning?
Well, let's put it into perspective. Microsoft has 2 neutral ratings, 0 sells, the rest of them are buys. So Alexander's going out on a limb here more broadly, and you're seeing this similar with Amazon. Amazon has 0 sell ratings, a few neutrals, but most consensus, more than 90%, is these stocks are buys. In fact, we've seen the price target go below where Microsoft is currently trading at. $500 is below its 507 current levels. So clearly, this particular analyst and Rothschild more broadly feeling that too much is baked in here, too much optimism around the return, the margins in particular, because this rollout is going to take an awful lot of money. And the margins are not like they are in cloud more broadly. And he felt that really some of the innovation had more broadly been baked in with cloud. We'd seen actually the economies of scale make sense before the huge rollout and infrastructure build-out came. And now we're sort of building it and hoping they will come. And at the moment, people are still wondering how we're going to charge for all of this use case, particularly if you can't get on your ChatGPT today, like if you're impacted by Cloudflare.
Okay, can we just talk about that? Because I feel like, if anything, it just does underscore how much of this new future is being driven by infrastructure that is not even seen to us. I mean, how many people think about Cloudflare on a day-to-day basis? And because of that, the most popular AI app can't be used.
Yeah, how much are you thinking about Akamai? How much are you thinking about Cloudflare? How much are you thinking about your content distribution? If you use TikTok, you're using Akamai. If you're using, seemingly, ChatGPT, if you're trying to get the New Jersey Transit, if you're making out, it seems more broadly that you do need content distribution. You need these cyber companies to be fit and working. Now, we have heard from the company. We put in a statement. Matthew Prince joins the show often, and he's someone who's really worldly wise about the way in which we're adopting AI as well. They're thinking about AI agents, and particularly they want to be the guardrails and the protocol of our future of AI. Well, they need to be up online if we're going to be able to do that. They're talking about an unusual traffic spike that they've currently seen at Cloudflare. It began at 11:20 UTC. They saw the traffic, therefore, being an issue for them, and they are all hands on deck, they're saying, to make sure the traffic is served without errors, but at the moment, still errors occur.
It feels like the worst time to get downgrade to some of the hyperscalers who have concerns that ChatGPT won't work, because it does feel like a piling on recently of some real skepticism, and all that piling on coming ahead of NVIDIA earnings. Can they do anything? Can Jensen Huang at this point say anything to soothe markets?
I mean, his numbers could deliver, and the numbers are going to be good. $55 billion is what the market price is in. That's a 57% increase in revenue. Extraordinary for an almost $5 trillion company. Bloomberg Intelligence have been saying we think they're going to beat, because remember, just back in October when we were hearing from Jensen Huang over in DC, he articulated that over the next year he's got line of sight on $500 billion worth of demand for his Rubin, for his Blackwell infrastructure. If he can continue to show that level of demand, and that he's not seeing any falling away in capital expenditure, he sees AI really reaping rewards in terms of actual productivity, well, then we could steady the ship some. But at the moment, we need that fundamental base case, because the hopes and prayers about AI are starting to get a little bit quieter.
Yeah, Daniel Pinto not helping either.
Yes.
Maybe Jensen Huang needs a word with him. Caroline, thank you so much for joining this morning. Tune into Bloomberg Tech. It's going to be a big one today at 11 a.m. Now, the crypto market also adding angst in overall risk assets. Bitcoin fell below $90,000 for the first time in 7 months. It's just back above that level, but it did erase gains for the year. Crypto-linked stocks, those are sliding as well this morning. Scarlett Fu co-hosts the Bloomberg Crypto Show every Tuesday at noon and joins us this morning. Scarlett, I mean, it's been a tough run with these things. I guess it's hard to say what exactly is behind it, but what are some of the people you're talking to saying about this fall?
Well, definitely investors are repricing the early stage innovation, frontier tech parts of the market, and crypto really embodies that, right? We know crypto trades as a risk asset, especially with stocks, and in the near term, you mentioned NVIDIA. There's anticipation before NVIDIA's results, and then, of course, there's a lot of macro data at the end of the week, but overall, you've got a lot of concerns over the shifting macro environment. Is the Fed going to cut rates in December? Is the Fed going to cut rates in 2026? We don't know. Stretch valuations in stocks, especially that AI story getting a little bit wobbly, is just concerning for anyone in risk assets overall.
And I hear you brought this cool chart with you. What are we looking at,
Scarlett? So I think what this chart really shows, it's very busy, is that Bitcoin has repeatedly come back from massive drawdowns. So that big spike up in 2021, 2022, money supply is a purple line. And of course, during the pandemic, people were stuck at home. They got a lot of money. There's money sloshing around. So it went into unprofitable tech stocks, like the white line, meme stocks, which is the yellow line, and Bitcoin, which is the blue line. The difference is, you could see in 2022, 2023, Bitcoin made a comeback. And even though the bubble deflated everywhere else, Bitcoin has repeatedly come back from these massive drawdowns, down 55% in 2021, down 77% in late 2021 to late 2022. So this idea that, perhaps there's another drawdown isn't so much super concerning. It's not an existential crisis for Bitcoin. It's like, okay, this happens and we come back from it.
I guess the question, though, is it a concern for other markets if people have been using leverage, if they're getting margin calls and they need to liquidate other assets in order to fund those margin calls?
Absolutely. So there's an element of forced selling, or at least questions being raised about whether there's forced selling, right? We know that a lot of traders borrow money to enhance their positions. So when the prices come down, they get exposed. And we're now looking at this $100,000 level. It was previously support. It's now resistance. And it's definitely this key line here. Options traders are also betting on further declines. We've seen a demand for downside protection at $85,000, $80,000 strikes. Those are dominating flows. And we've seen 12-spot Bitcoin ETFs see net outflows over the last 2 weeks of $2.8 billion in November alone.
All right. Well, Alisa, maybe you can call today a bounce because we're back over 90,000. So
we'll see, though. I mean, there's Bitcoin trades 7 days a week, so there's a lot of room for.
Well, again, it is the day to tune in to Bloomberg Crypto. Scarlett, thank you so much. And again, that's at noon. And the guests today include former Hut 8 CEO Jamie Leverton and OpenSea CEO Devin Finzer. A check on futures this morning after 3 consecutive days of declines. We're headed for a fourth. The S&P and NASDAQ are down 4.5% respectively. It has been the worst run for the Russell 2000 in equal weight since August. For the S&P 500, the worst 3-day run since April. And it's been NVIDIA leading that drop again. It's accounted for a quarter of the losses from the highs of this market. Some of the individual movers on our radar this morning. Klarna, they've agreed to sell as much as $6.5 billion of longer-term loans to funds controlled by Elliott Management. Elsewhere for Elliott Management, a busy day for them. They've built a large stake in Barrick Mining. That's according to the FT. The investment could be as large as $700 million. Intuit, they have struck a deal with OpenAI that will be putting applications like TurboTax and QuickBooks on ChatGPT. Those shares up 2%. You just got to hope Cloudflare works while you try to do your taxes. That would be unfortunate. Speaking of which, coming up, we're going to talk about that. What we know about the Cloudflare outage impacting AI chatbots, social media, tri-state transportation, all of that coming up next on Bloomberg Open Interest.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Now to high interest, a look at what's making headlines around the world. And we start with U.S. companies shedding 2,500 jobs per week on average in October. That's the latest from ADP Research. A number of large companies, that includes Amazon, Target. We heard they announced job cuts during the month. So that ADP snapshot of the labor market has helped bridge the gap. Official employment data was delayed by the longest government shutdown in history. The September jobs report that is set to be released on Thursday. Elsewhere, Saudi Crown Prince Mohammed bin Salman is meeting President Trump at the White House today. It's a rare visit for the Saudi leader, who's bringing a massive delegation to Washington. The two will sign deals on defense, nuclear energy, artificial intelligence. But analysts do warn that the partnership hinges on MBS's personal ties with Trump. So there are no guarantees that the agreements will survive future administrations. Finally, Blue Owl Capital shares tumbling to their lowest in 2 years after the firm froze redemptions from one of its private credit funds. The $1.8 billion vehicle will merge with Blue Owl's $17 billion listed arm early next year, but that leaves investors unable to cash out in the unlisted one and facing paper losses up to 20%. In a statement, Blue Owl says the deal strengthens returns and liquidity. ChatGPT, X, and the New Jersey Transit are among the companies impacted by a widespread outage that Cloudflare is working to fix. Let's discuss with Bloomberg cybersecurity reporter Jordan Robertson. Jordan, just at this point, for people trying to get into X, ChatGPT probably having a hard time. What do we know as to what's behind it?
Yeah, so the technology that's behind this outage is called Cloudflare. It's one of the world's biggest cybersecurity companies. What they do is they act as a buffer between your website and the outside world, and most importantly, criminal cyber attackers. And what that means is that if Cloudflare has a problem, so does your website. We've seen this before. Cloudflare is a very, very large company. They're essential to kind of modern cybersecurity on the internet. But it's had problems before, and it's had glitches. It's a constant target of cyber attacks. And what's happened today is, the Cloudflare service itself has been experiencing outages for a number of hours today. And the company itself has issued a statement that implies but doesn't confirm that there may have been some sort of cyber attack. The company has indicated that there was an unusual, what it calls an unusual spike in traffic to one of its services that may have contributed to this outage. So there's a lot we don't know at this point, but we do know this is a pretty prolonged outage that also illustrates how important this company has become to modern cybersecurity.
And it feels as though it has echoes, Jordan, to July of 2024 when CrowdStrike went down and it meant that airlines were delayed. A lot of Microsoft Windows run things couldn't operate. And after the aftermath of that, it was CrowdStrike faced a lot of issues, a lot of scrutiny that it took a while to work through, and maybe is still working through some of it now. What does it mean for a company like Cloudflare, for their reputation and for customers willing to use their software?
Yeah, Cloudflare, again, is one of the biggest and most important cybersecurity companies, in the world. Its market penetration and just the scope of its services, is really unmatched. And you're exactly right. What the CrowdStrike incident, showed was that these security technologies are deeply embedded inside digital infrastructure, whether that's websites or payment services or what have you. And, in order to implement these security technologies, organizations have to allow the security technologies to do things at a very deep level inside their IT infrastructure. What that means is if there's an outage, whether that's caused by a cyber attack or just a technical error or a glitch or a bad update, what that means is that there can be really widespread ramifications. And what these incidents kind of highlight is the degree to which these security technologies, they work mostly fine. They mostly work okay. But when they go wrong, it can have really lasting ripple effects.
Well, Jordan, I'm really excited because in just over an hour's time, we're going to be speaking to Martin Schroeder, who's the Kyndryl CEO, a spin-out from IBM. They run a lot of these consulting for IT tech and infrastructure for companies. And he's going to talk about the immense amount of spending on AI that companies are doing. Is there a real risk that companies have been siphoning their spend and investment into AI at the sake of IT infrastructure, at the sake of things that would lead to issues like this in the future, just because of the way that investments are being made in mostly and predominantly and more often in AI?
Yeah, we don't know enough yet at this point to kind of articulate what happened at Cloudflare, but I can, comment on generally what I've seen in covering cybersecurity for, a pretty long time, is that, companies are, of course, investing a lot in AI. They're spending a lot of money on, developing internal tools, trying to improve their cybersecurity, trying to improve their defenses against hackers. But I talked to a lot of cybersecurity professionals, and what they've told me is that outside of kind of some fringe cases where hackers are starting to experiment with AI-enabled technologies, that they're just not seeing a lot of actual use cases of AI being used by hackers. So at this point, a lot of this is kind of like preemptive posturing, if you will, and trying to preemptively plan for potential future attacks using AI. But just generally, we haven't seen a lot of it. And it could come to pass that, perhaps this Cloudflare incident was informed, or maybe there was AI involved in some way. It just, at this point, we don't have enough information.
Hey, Jordan, thank you very much for this. As Bloomberg cybersecurity reporter Jordan Robertson, a conversation I'm going to watch back as well as I wait for my ChatGPT to load. All right, a check on futures ahead of the opening bell. We continue to push deeper into the red, down by more than 0.5% for NASDAQ 100 futures. Your S&P down by just about 0.5% for a fourth consecutive daily loss after the worst three-day run since April. The VIX at a 4-week high. A lot of broad weakness. We'll see if turnaround Tuesday can take hold. So far, though, the dip buyers nowhere to be seen. Coming up, BlackRock's Gargi Chaudhry says that the market outlook is turning neutral with fewer bulls and bears. She joins after the break. That's coming up next. You're watching Bloomberg Open Interest.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
JP Morgan Vice Chair Daniel Pinto at the Bloomberg Africa Business Summit. Bank of America this morning also flagging concerns in its monthly fund manager survey, where it says 53% of respondents say AI is already increasing productivity, but companies are overinvesting. That was the response for the first time in 20 years. Let's bring in Gargi Chaudhry. She is BlackRock's Chief Investment and Portfolio Strategist for the Americas. Gargi, man, there's a lot of kind of bearish sentiment out there starting to swirl around AI. It feels like these have always been in the background, but it's finally starting to impact markets. A real sell-off, especially driven by NVIDIA, occurring right now. Would you agree with the Daniel Pintos, the respondents of Bank of America surveys of the world, that there is some overhype going on right now?
Good morning. It's great to be here. Thank you for having me. So, I was obviously looking at the Bank of America survey, and we actually, and I shared some of these results with you guys, we do a survey of our own when we do client calls, where what we're seeing actually is quite the opposite. We're seeing about 66% of respondents are quite bullish AI, but unfortunately, or maybe fortunately, given the last couple of days, they don't actually reflect that in their portfolio. So they haven't quite had that overweight to AI and tech yet, but they want to have it. So that is what we're seeing from our clients.
That sounds like a good thing, by the way.
It is a good thing for now, and more importantly, it's good because historically, and especially in 2025, the other thing that we found is that buying the dip behavior has been quite strong, which has worked out for so far. So every time we have more than a 1% dip in the S&P, we've looked at ETF flows coming in that following week, and they've been about 20 to 30% higher than the non-negative weeks, so the positive weeks.
Right.
So there is that going on as well, and I think that healthy backups, cleansing, if you will, are good for the market.
What's the difference, though, between a backup and healthy cleansing versus just like a narrative shift that takes us down longer? Because there's a real fear that, okay, tech sells off, Oracle spreads widen on their CDS, that maybe this is more of a narrative that has longer legs. How do you kind of distinguish between
Absolutely.
the two?
Great question. And I'll say a couple of things. Number one, let's think about what has led to this more recent narrative shift. First, I would say it's the hawkishness or the perceived hawkishness from some of the central bank speakers that we heard from over the course of the last 2 weeks. That's number one. We'll have to see what happens with the data once we start getting it, right? So the second one, which has been somewhat surprising to me, has been the negative reaction despite strong earnings that we got over the course of Q3. I think it's surprising how strongly so many companies have beat, and given where the expectations are, looking at about 14% earnings growth, that's been a very strong sort of relative to expectations, a very strong market reaction, but we haven't seen that follow through. So maybe there's more there. And then the third thing I would say is just the absence of data. Once we begin to get that deluge of data on again, which will hopefully happen starting this week, I think there's going to be a little bit more clarity. So that's what we're looking at. And I'll say, if you think about, what sustains us, it's just fundamentals.
Okay, well, let's talk more about those fundamentals after the market open. Gargi will be staying with us. That's coming up next on Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
We are just moments away, seconds, from the start of U.S. equity trading. You are watching Bloomberg Open Interest. I'm Danny Berger. Not exactly how you want to start your Tuesday, is it? Especially after a Monday that declined, a Friday that declined, a Thursday that declined, a three-day run that rivals the worst from April. S&P futures down 0.5%, NASDAQ down 0.6%. The Russell 2000 futures session also doing poorly. All right, here at the opening bell over at the New York Stock Exchange, we got MP Materials. What a great year it's been for them, up 265%. The rare earth minerals producer, they got some investment, some help from the U.S. government, so that's not too bad. On the other hand, over here, we have Chagi Modern Tea House. It is a U.S.-listed ADR of a Chinese tea company. They IPO'd back in April. Not as great for them. They're down about 13%. I think whoever was at the front of the podium there was just throwing leaves, maybe tea leaves, so that's pretty cool. But again, down 13%. All right, let's look at some of the stocks to watch this morning. And it's been a lot of the tech players that are feeling the pain. Microsoft and Amazon, both those shares are down roughly around 1.5%. They both got downgraded at Redburn. It's not too often you get downgrades on these companies. The analysts calling their generative AI returns, the hopes around them, as misplaced. Home Depot, those shares down 4.2% after cutting guidance as shoppers stop buying big ticket items. I want to, though, let's go back over to the desk because Gargi Chaudhry is still there. She's, of course, BlackRock's chief investment and portfolio strategist of the Americas. So, Gargi, before the market opened, we were just talking about the ability for earnings to underpin things and the fundamentals. Torsten Slok has talked about a K-shape, not in the consumer, but in companies. Maybe Home Depot kind of underscores that this morning. How are you looking at fundamentals when you can have strength from many companies, but a Home Depot can say consumer strength is just not there for us?
So recognizing that there is very much a K-shaped recovery that's going on, and that will obviously have impact on equity markets and bond markets alike. So making sure that when you are thinking about your investments, investing to those quality areas which are likely to have that profitability, that ROI, that earnings growth, which is what we've been telling investors to do. So use this pullback, and maybe as we go into the year end, recognizing there might be further illiquidity concerns, but being cognizant of that and using that pullback to go into AI, which we still think is a very resilient part and earnings-led part of the market. And in particular, we're telling investors to go in with an active lens in mind. So BAI is the ticker that we're telling investors to allocate to for that high-quality AI exposure. And then you ask about fundamentals. I'll just point to maybe two other things quickly. In addition to earnings growth, really focusing on coming into Q1 of 2026, we will see that reacceleration of economic growth. We might see some slowdown given the impacts of shutdown in the near future, but after that, we see that reacceleration. And then secondly, even if the Fed rate cuts do get pushed out in December, just listening to some of the Fed speakers, we will continue to have a rate cutting cycle back towards that 3% neutral rate in 2026, perhaps even in 2025. I think both of those are very positive for the fundamentals.
So a couple of things I want to ask about there. So you mentioned one of the tickers. I'm guessing that's one of the BlackRock ETFs to capture AI. Why do that and not just like an overall S&P 500 fund? Because aren't you essentially getting the same thing? I mean, NVIDIA is such a huge weight. So why go into an AI-specific fund versus just market cap weighted S&P?
Yeah, no, it's a great question. And listen, there are certainly a lot of investors, given their risk tolerance and given their budgets, that are focusing on funds like IVV, which is exactly that. You get the S&P 500, and that is what you need, and you're still getting a large component of AI within that and everything else. But then again, as I said before, 66% of clients are looking for that AI exposure. They have an underweight to it. So in your portfolio, if you have discovered that underweight and you want that AI-specific theme only, you've got the industrials, you've got the financials, you've got everything else, but you're really underweight AI. That's where we think that very specific AI exposure makes sense. So it's really a portfolio decision.
Got it. Okay, so the other thing you mentioned is the fact that cuts are on their way. But we've had a lot of division among Fed speakers. We had more recently one of the first Fed speakers to really come out and say, yeah, we're going to get a December cut. It feels like a lot of the Fed governors have been actively avoiding that conversation when we've had Williams more recently being more dovish. Is that enough, you think, to turn around this market and the negative sentiment? Getting cuts priced back into December, is that going to be the thing that saves equities from this downfall we're on?
I think that some of the reason that the downfall happened was this divisiveness. Because think about it, we haven't had any data at all. What have we had? Yes, we've had earnings, but those haven't been bad. What else had we had? We've had the divisiveness. So I do think if we get some more clarity, and frankly, some of that clarity will come from many of the payroll prints that we're going to get, the 3 of them that we're going to get between now and call it end of December. And within that, if we see that, the economy is not slowing down massively, but there is still a slowdown in the labor market, I think that allows the Fed to be able to cut. And especially with inflation, if we continue to see services inflation decelerating as we did in the last October 24th print, I think that allows them more sort of firepower, if you will. Is it enough? No. But that in combination with the growth dynamic that has always been positive and will probably accelerate in the beginning of next year, as well as earnings growth dynamics that, again, has been extremely powerful and positive and higher than expectation, I think all of that does allow for us to have a smoother year-end process.
If divisiveness, though, is the issue, Evercore brought up this really interesting point last week, and their idea is essentially that what's happening now is you're getting Fed speakers who are being more hawkish because they're anticipating a Trump pick coming in to run the Fed. And they want to get out ahead of it and show that they're not just going to roll over and listen to whoever is in at the Fed. Does that show, or are you concerned that the divisiveness is going to continue into 2026, that this is just the new posture of the Fed? And if it is, does that mean the rough patch that we're seeing now might be more common?
If that is the case, I think that'll introduce more volatility for sure. Because markets, more than anything, like certainty. They like certainty of data, certainty of policy. And I think some of this wobble has been certainly illiquidity, but uncertainty as well. So if what you're postulating is correct, then yes, I think that'll inject more volatility. But at the same time, isn't that a great opportunity to choose and pick and prepare your basket for those areas of the market that you really want in your portfolio? So fixed income, we think, sort of clipping that coupon in fixed income markets is a great way. And again, if we have these spread widening periods, great way to allocate more to fixed income. Similarly, with high quality parts of the equity market, this is a great time to do that. And then add some hedges. We've been talking about that from the beginning of this year. We've seen this massive 50% rally from the April lows in tech. A pullback is normal, healthy. Add some hedges, add some gold, add some front-end bonds, add some non-U.S. market. Emerging market comes to mind. And I think that diversify your portfolio, and that's another way in which you can weather the storm, if you will.
Gargi, I'd love to end kind of where we started on this idea that a lot of your clients still are underinvested to AI. When you talk about them and investing in AI, is it hard to convince them to go all in, especially sort of the headline risk that we keep seeing every day, that companies are overinvested, that maybe there's a bubble? Has that kind of dissuaded some people from really getting into the trade?
I think that's sort of come up a lot more over the last month or so with respect to, is AI in a bubble? That really wasn't a narrative at all. I think it's come through now with the fears of circular financing, which is why, in fact, it offers us more of an opportunity, you and I, to sort of help clients to understand where you should be thinking about picking stocks and what are some areas of the market, frankly, like small caps, which might not ever get their shine back.
All right, Gargi, this has been so fantastic. Please come join again soon. That is BlackRock's Gargi Chaudhry. All right, about 8 minutes into your trading day, let's see where stocks stand right now. They are lower and, not as bad as we were in the future session. We're down by a third. Looking at the upside, Apple, one of the biggest gainers in terms of points. It's only up 0.7%, but there was a report that maybe some of their sales in China are doing better than expected. Alphabet, Broadcom. By the way, Alphabet, kind of the thing that saved the market yesterday or made it not as bad after that Berkshire Hathaway investment. To the downside, it is NVIDIA. This continues to be the thorn in the side of the market just because of the weighting of it. It's dragging the S&P down 8.5 points. It's down 1.6%. It's going to have earnings after the bell tomorrow. But shout out to Dan Curtis pointing out that it's contributed to a quarter of the S&P's fall from the top. Microsoft close by, Amazon, Meta, Amazon and Microsoft getting that downgrade from Redburn this morning. Let's look at some of the sectors. Might not surprise you that tech is one of the worst ones, down 0.7%. Consumer discretionary, a lot of that's going to be Home Depot. Home Depot with those disappointing earnings dragging down lows. We're also going to hear from Walmart this week, from TJX, from Target, so we'll get some other consumer names too. At the top, we have staples, utilities, materials. It's that little bit of a flight to safety kind of flavor this morning as we are down by at least 1/3%. Coming up, we're going to hear those comments again and get more into them from JP Morgan's Daniel Pinto, joining the growing choir of those warning about a potential AI bubble. That's coming up next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Three Picks by StockAxis team. Discover 2025's growth picks. Start your 14-day free trial and receive StockAxis 3 growth stock ideas for
You are watching Bloomberg Open Interest about 15 minutes into your trading day, and we're on track for the fourth consecutive day of losses. S&P, the NASDAQ down. NASDAQ underperforms, down almost 1%. But not that much is being spared. The Russell 2000 down 1/3%, so not as bad. Where do you go for hedges? We're just speaking to Gargi Chaudhry of BlackRock, saying that gold is something you certainly want in your portfolio. We've seen how popular that's been. That's up 0.8%. Looking at some of the individual movers this morning, Cloudflare down 2.5%. An outage there. We don't know why yet, but it's shut. Things like ChatGPT's OpenAI's ChatGPT. X is having problems. The New Jersey Transit is having problems. So I am so sorry if you're in your morning commute this morning. Bitcoin, that also continues to fall, was under 90,000 at one point. Home Depot, some poor earnings from them. Those shares fall 3.3%. But here's the weird thing about this environment. They say the consumer is weak. But look at Amer Sports. Those shares up 7.33%. They've boosted their full year earnings forecast. They're seeing sales accelerate. Their brands like Wilson, as well as Solomon, because everyone owns those shoes right now. It's like the Adidas ones, what those used to be, but now everyone's wearing the Solomon ones and looking like they're about to go on a hike, but like in the middle of West Village. I don't know. I don't get it. Nvidia, those shares are down 2.3%. It's the big cap tech, the fear of an AI bubble. Also, the darling children like Palantir Technologies that are so richly valued, having a bad day on that. Now, on that front, JP Morgan's Daniel Pinto, they are warning of a possible correction in AI valuations. Pinto sat down with Bloomberg's Rado Grigori at the Bloomberg Africa Business Summit in Johannesburg. They discussed the AI bubble debate as well as other risks facing investors.
What we are not seeing is a deterioration between what we were expecting in the credit cycle in any of the portfolios. So I think that credit remains solid from credit cards in the U.S. all the way to big corporates. But we will see how it plays and continues once the economy. I don't think that the economy will go into recession. It's likely to slow down. And the credit cycle will continue to normalize. But I don't think that in the credit cycle we see a deterioration beyond what we were expecting.
If the economy slows down, where do you stand on the interest rate debate in America at the moment? Do you think the Fed is going to cut again in December or hold off?
I think that it may be some inflation is being quite resilient. Low growth is slowing down, but it's still this quarter. I think that we should discount the numbers wherever they can because of the shutdown. That it will recover. Whatever it is, it will recover in the next quarter, in the first quarter of next year. So we do see some deceleration. We do see some reduction in consumption, but it's still for healthy levels. So I think that the economy may grow less next year, but most likely it will avoid recession. Tariffs, they haven't had the full impact. But some will have a further impact next year, but also some will be compensated by the fiscal expansion. So I am relatively positive on what we are seeing. Having said that, markets are pricing a very, very benign scenario and quite a bit more. So that I don't know. There may be issues or not, but the S&P at 6,700 or so, 23 times is quite healthy, to say the least.
You're not giving us a new S&P target.
Well, whoever was giving target missed it all, so no. But I think that from here, you would have saw that the upside is relatively limited.
Obviously, no on-stage interview these days can't include AI, so here's the AI question. Where do you stand on the continuum of hype, bubble, and it's going to solve everything?
Well, the technology is real, and we are, even though we've been dealing with traditional AI for the last 10 years, we are now working in large language models, and we deploy that to almost every employee that we have. We are using different forms of this to improve productivity across operations, technology, detecting fraud, surveillance, credit decisioning, improving client experience. It's all over the place, but it's still at a very early stage. So large language models that are still not having the impact that they should have, and we're still very, very early in the agentic journey. Clearly, this will have an impact in the labor market. Some jobs will be created and some jobs will be eliminated. But I think that one thing that ones want to keep an eye on is how much capacity is being created, and how all these companies, how much revenues they are going to get to compensate, to pay for that capacity. Is likely, I don't know the probabilities, but it's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
JP Morgan Vice Chairman Daniel Pinto speaking with Bloomberg's Rudder Gorey at the Bloomberg Africa Business Summit. Now let's check back in on Cloudflare, which says that its outage should be over. Shares are still falling this morning. They're down 1.33%, but they were down as much as 2.5%. They say that they have implemented a fix. We're going to have more on that story coming up, as well as a downgrade for Microsoft and Amazon. That comes just ahead of a market-moving report from NVIDIA tomorrow. That's coming up next. This is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Three Picks by Stock Access Team. Discover 2025's growth picks. Start your 14-day free trial and receive Stock Access 3 growth stock ideas for
Let's get you some top calls this morning. The analyst action that we are watching. First up, Honeywell. That gets its first sell recommendation on the street. It comes from Bank of America. They expect shares to lag as elements of its spin-off strategy disappoint investors. Analysts there also say that the company likely will not deliver earnings growth next year, those shares down 1.6%. Next up, Wells Fargo initiates coverage of Flutter Entertainment with a buy rating, those shares up 2.2%. They see a compelling valuation following a recent sell-off. The analyst is positive on management and says that the stock provides exposure to high-growth digital markets. And finally, the bull case for generative AI may be losing steam. Analyst Alexander Hasel at Redburn is cutting his rating on Microsoft and Amazon to neutral, saying the Gen AI boom is not the next cloud. He says weak economics, costly infrastructure, fast depreciation hardware raise the risk of an industry overbuild. Let's dig into some of this and some of the recent outages in tech that we've seen this morning that have been weighing on the AI players. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, we can get to those downgrades in a moment, but we just heard from Cloudflare very recently saying that they have fixed some of the outages. Just what's been going on this morning? It feels like a particularly chaotic one.
It was, and actually they haven't said why. There was a surge in traffic. They now need to understand what that surge in traffic was and why did it so destabilize their offering. But this is a content distribution network. This is what makes your apps work, your websites work, and ultimately many didn't today. Whether you're on X, whether you're trying to do ChatGPT and get all your productivity done, or food jokes for your kids, as I tend to use this morning, or whether it's just trying to commute, a lot of it suddenly went offline. Immediately, they said they were trying to tackle this. They were all hands on deck. Now it seems as though it's fixed. We're back up and running. But really, the question is going to be how, why. And this is a company that was trading at a record high just at the end of October because it had started to win more big enterprises. They serve a lot of medium, small-sized enterprises on content distribution and on security. But they're also trying to put themselves as the new AI agent protocol and guardrail as you build out your AI offerings and Gen AI. They can help you get there. This is going to make people question just a little bit how effective that can be and what Matthew Prince is going to have to say to steady the nerves of many.
It doesn't sound great if you're billing yourself as the guardrail, but you're literally the reason and the biggest AI agent goes down, but also feels very old world meets new world. The fact that you have a train system go down at the same time you can't get into OpenAI's ChatGPT. I mean, does that show us kind of where this world is headed? That we're becoming so reliant on AI and it could have the same problems as the New Jersey Transit does.
Or indeed, we're so reliant on very few players to help our world work when it comes to infrastructure. Look, CrowdStrike, how many of our flights were delayed, how much of our world was upended when they had a particular incident, and we couldn't get onto Microsoft, we also couldn't board a plane. We are at this moment questioning that there are too many big players with too fewer roles. Not only are they all helping finance one another, but they're also just helping with the build out more broadly, not just in the United States, but worldwide. Europe is totally dependent on a few key big American players as well. The anxiety continues to build. I mean, we're all about one key stock really at the moment. Nvidia is in large part to blame for the 1.8 trillion that's been wiped off the Nasdaq since the end of October. It's contributed $500 billion of that erosion, and now we want to get some fundamentals. Are we baking too much on a few big companies that are going to be our future of production, productivity, and commuting?
I was going to say, lucky us, we hear from them on Wednesday.
I know.
Just quickly, Caroline, I mean, how are expectations set with the recent sell-off?
Well, sometimes it doesn't always matter. Jensen Huang has, for 12 straight quarters, beaten on revenue. We're expecting 57% increase in revenue. That's a great number for a company that's worth more than $4 trillion. But what can he signal about the future adoption? He's already told us a lot. What more can he say than I've got $500 billion worth of demand that I can see for my Rubin, for my Blackwell architecture? He's going to have to steady nerves, maybe tell us a little bit about China. But also, I think going back to that two fewer players and two bigger pies, he has still got a lot of concentration risk. Two key cloud companies are basically 39% of his entire revenue. How is that spreading out? How is he seeing sovereign AI get outside the United States and outside of a few key players? How are enterprises adopting it?
Yeah, it feels like a make-or-break earnings report, just given what's happened this week. Caroline, thank you so much for joining us. Bloomberg's Caroline Hyde. Coming up in the next hour, conversations from public to private markets. Stay with us on Bloomberg Open Interest.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
"30 minutes into your trading day." Bit of a painful trading day. It is Bloomberg Open Interest. I'm Danny Berger. Matt Miller is off. S&P 500 and the Nasdaq at the lows of the session this morning, trading at the lowest in a month. Coming up on the show, JP Morgan's Daniel Pinto warns that AI valuations are due for a correction, while a potential AI bubble was ranked the biggest tail risk in a Bank of America survey. This hour, strategist Anastasia Amoroso, tech investor Rachel Arnold, plus CEO of Kendrill all weigh in on the AI warnings as they stack up. And Saudi Crown Prince Mohammed bin Salman meets with President Trump at the White House for talks on defense, security, and energy. Now, we begin with that growing chorus on the warnings about a potential AI bubble. BlackRock's Gargi Chaudhry pushed back.
We're seeing about 66% of respondents are quite bullish AI, but unfortunately, or maybe fortunately, given the last couple of days, they don't actually reflect that in their portfolio. So they haven't quite had that overweight to AI and tech yet, but they want to have it. So that is what we're seeing from our clients.
Joining us now is Anastasia Amoroso, Chief Investment Strategist at Partners Wealth at Partners Group. Anastasia, thank you so much for joining.
Good morning, Danny.
God, it feels like a lot of angst right now in this market,
Yeah.
whether it's about the Fed or about the AI. When you look at sort of the downtrend we're seeing, how do you distinguish this is a narrative shift and there's a meaningful concern about AI versus a dip you'd want to buy?
Right. I mean, I think if you step back and you look at the chart of the S&P 500, it has been a picture-perfect rally, really, since that dip that we saw in April. And every pullback has been bought. And, you know, we sort of stayed above the trend line. So I think it's understandable that people are maybe even tired of this sort of perfection or scrutinizing, you know, some of the best performing trades, whether it's in AI or the market broadly or private credit. But I will say that when you take a
ओके गाइस, क्रूड ऑयल को देखोगे अभी भी रेंज के अंदर ही पड़ा हुआ है. नेचुरल गैस मॉर्निंग से कुछ खास किया नहीं है. थोड़ा नीचे आता है तो देखते हैं वापस बाइंग के लिए, या फिर थोड़ा सा ऊपर चला जाए तो सेलिंग का प्लान रखेंगे. कल एक सपोर्ट था, ब्रेकडाउन किया, रिटेस्ट भी नहीं किया, वापस नीचे फिर से रुक के ऊपर चला गया ऊपर. थोड़ा सा अगर नीचे आता है तो एक बाइंग का ही प्लान करेंगे, और तो कुछ इसमें दिख नहीं रहा है. रेंज ही लग रही है फिलहाल के लिए, अनटिल अनलेस रेंज ब्रेक नहीं होती. करते रहो गाइस, कोई क्वेश्चन हो तो कमेंट बॉक्स में पूछ सकते हो. इंडियन मार्केट भी आज बुलिश ही था ओवरऑल. स्टिल मॉर्निंग की फर्स्ट 15 मिनट की कैंडल के अंदर ही ट्रेड कर रहा है. करंट मंथ का फ्यूचर जो मैंने लगाया है वो नेक्स्ट मंथ का फ्यूचर है, तो कंफ्यूज मत करना, दिस इज नेक्स्ट मंथ फ्यूचर. ठीक है, दिसंबर मंथ का फ्यूचर है यहाँ पर ये क्रूड ऑयल में. आज इन्वेंट्री भी है, आज 9 बजे इन्वेंट्री भी आएगी क्रूड ऑयल की. कल ये वैसे भी रेजिस्टेंस पे आ तो गया था क्रूड, सडनली मार्केट अपसाइड जाने की कोशिश कर रहा था, इस पर्टिकुलर लेवल पे याद हो गए, क्लोज होते होते इसमें बड़ी बड़ी कैंडल बनने लग गई थी लास्ट आधा एक घंटे के आसपास। उसी रेजिस्टेंस पे एक्चुअली ट्रेड कर रहा है, वैसे तो कल ब्रेकआउट हो गया था बट स्टिल ट्रेडिंग एट दैट पर्टिकुलर लेवल। ठीक है, ऐसे इसको लगाएं तो वो ऐसा लगेगा कि ब्रेकआउट हो के फिर ट्रेड कर रहा है। यहाँ पर ये कल न्यूज आई, पता नहीं क्या हुआ, ओपन इक्वल टू लो बनाई कैंडल, क्लोज होने से पहले ब्रेकआउट कर दिया था। आज अर्ली मॉर्निंग उसके ऊपर ही ओपन हुआ था, अब ना नीचे जा रहा है ना ऊपर जा रहा है, उसी लेवल पे साइडवेज हो गया ये रेजिस्टेंस ही था कल वाला। या तो ये इसी रेजिस्टेंस को सस्टेन करे या फिर ये ऊपर वाले रेजिस्टेंस पे आ जाए, नया रेजिस्टेंस बनाए तो मेरे अकॉर्डिंग बेटर रहेगा। ये कल वाले दो रेजिस्टेंस थे, एक तो ऊपर यहाँ पर था, एक ये था, ये कैंडल ओपन इक्वल टू लो बनाई थी तो ये ब्रेकआउट हो गया लॉजिकली, तो इसको मैं वैसे रिमूव ही इसलिए कंसिडर नहीं कर रहा, थोड़ा ऊपर आता तो यहाँ सेल कर देते बट यहाँ पर भी नहीं आ रहा है। इससे पहले यहाँ पर सही ठीक ठाक सेलिंग आ रही थी, 2-3 बार इस लेवल से सेलिंग आ गई थी। कल ये फोर्थ टाइम आया था तो लग रहा है ब्रेकआउट करने की कोशिश में था, ऊपर वाले से लिक्विडिटी लेने की कोशिश कर रहा था, इसलिए अब होल्ड नहीं कर रहा है ये लेवल। अदरवाइज दैट इज़ अ रेजिस्टेंस जोन कम्प्लीटली। ठीक है, तो इसको मैं वैसे रिमूव ही कर दे रहा हूँ, या फिर देखते हैं इसको क्या दोबारा कंसिडर कर सकते हैं। लॉजिकली तो ब्रेकआउट हो गया खैर। यहाँ पर ये रेजिस्टेंस है ज़रूर, बट कल बिकॉज ब्रेकआउट हो गया है तो थोड़ा सा कन्फ्यूजन कर रहा है। हो सकता है रेजिस्टेंस स्टिल होल्ड करे और नीचे आ जाए प्राइस, बट बेस्ट के सिनेरियो क्योंकि ब्रेकआउट हो गया है ऊपर वाली रेजिस्टेंस से अगर सेलिंग आई है वो बेटर है, या फिर नया रेजिस्टेंस बना दे सो दैट ये बीच के लेवल को रिमूव कर दें, बिकॉज इस तरह का मोमेंटम होगा तो फिर एसएल कहाँ रखेंगे वो प्रॉब्लम हो जाएगी। इस लेवल को रिमूव कर रहा हूँ क्रूड ऑयल के, बिकॉज ये कल ब्रेकआउट हो गया है, तो इसको मैं अब कंसिडर नहीं कर रहा हूँ, क्योंकि ऑलरेडी वो कल ब्रेकआउट हो गया है, तो उसको फिर से कंसिडर करना सही नहीं रहेगा, लेवल डिस्ट्रॉय हो चुका है ऑलरेडी। थोड़ा सा अगर नीचे आता है क्रूड ऑयल में बाइंग ही करेंगे।
Gabriela Santos of JP Morgan, and Raj Danda of Ares Management. Plus, we'll have the CEOs of Fortress, TMX, and MFS Investment Management. That's it for Open Interest today. Tech is up next.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out in 10 minutes or less on the Markets podcast from Goldman Sachs. Listen now.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, after resisting the issue for months, Congress has ultimately made quick work of a bill to force the release of the Jeffrey Epstein files. By a 427-1 vote, the House has passed the bill to compel the Justice Department to make its documents public. The Senate then agreed unanimously to approve the legislation without changes once it arrives there. But Senate Minority Leader Chuck Schumer says that won't be the end of it.
We know there's a corrupt Justice Department. We know that Bondi and Cash Patel do just what the president asks and wants. And we Democrats, I just had a meeting of 10 of my colleagues, are going to do everything we can to make sure all of it comes to light.
Senate Minority Leader Chuck Schumer pushed for the unanimous consent motion, but Bloomberg Balance of Power host Joe Matthew reports the Justice Department could still push back against this bill even if President Trump signs it.
Knowing that the president has compelled the Department of Justice to investigate some Democrats, including Bill Clinton in this case, the DOJ could simply say, hey, we understand the vote, but we can't release anything because this is an ongoing investigation. A smokescreen, as some have called it here, and there's a question about whether or not this is how this ends, and maybe that's why, in fact, the president decided at the last minute to go for this.
It was Bloomberg's Joe Matthew in Washington. President Trump has said he will sign the bill, saying he has nothing to hide, and it's time to move on.
Well, Nathan, President Trump is also moving to deepen ties with Saudi Arabia. Saudi Crown Prince Mohammed bin Salman received a king's welcome at a White House dinner last night. The president used it to announce a new defense cooperation pact that'll make Saudi Arabia a major non-NATO ally.
A stronger and more capable alliance will advance the interests of both countries, and it will serve the highest interest of peace.
And President Trump's announcement came on a day that saw the U.S. offer sales of F-35 fighter jets, advanced AI chips, and nuclear tech sharing to the kingdom. Former U.S. Ambassador to Saudi Arabia Robert Jordan says the Crown Prince is not offering much in return.
What did he have to give up? Virtually nothing, because he still has in his pocket the promise or the lure of normalizing relations with Israel. So it seems to me that MBS has come out by far the winner here.
And former U.S. Ambassador Robert Jordan tells Bloomberg President Trump has touted $1 trillion in investment commitments from Saudi Arabia. That's nearly the size of the kingdom's annual economy. One other note from last night's White House dinner, Elon Musk was on the guest list. The Tesla CEO and one-time Doge figurehead was back in the East Room after his public falling out with President Trump over his tax and spending cut bill.
Let's turn to markets now, Karen. Futures are moving higher following 4 straight days of losses on Wall Street. A sell-off in the world's largest technology companies has led the way lower. Lisa Shallett is Chief Investment Officer at Morgan Stanley Wealth Management.
The earnings revision momentum, as we like to say, has slowed. And I think that that's one of the things that has catalyzed this profit-taking moment is that people are saying, wait a minute, perhaps, some of the leaders leaders of this market, the hyperscalers, are in fact, by dint of their aggressive spending, by dint of them now assuming some debt to finance that spending, maybe that earnings growth rate is going to slow.
That's Morgan Stanley Wealth Management's Lisa Shallot, and Goldman Sachs President John Waldron says markets are primed for possible further declines. We caught up with Waldron at the Bloomberg New Economy Forum in Singapore.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular. Markets heavily focused on this AI dynamic. Are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate.
Goldman Sachs President John Waldron says NVIDIA's earnings will be key for markets.
And Nathan, that NVIDIA earnings report, it comes out this afternoon after the closing bell. Analysts expect the AI chip giant to show more than 50% growth in both net income and revenue in its fiscal third quarter. Michael Ball is Bloomberg News macro strategist.
We know what their customers are doing. We know what the supply chain is doing. We've got the other chip makers who are part of that ecosystem. So I think they will match or beat. It's very sensitive to any misstep. And so NVIDIA basically has no room for error. And, basically the market's pricing is 6-7% move that day, which is higher than its normal earning day move. So there's even greater sensitivity this turnaround.
And Bloomberg's Michael Ball notes that NVIDIA shares have dropped more than 12% since hitting a peak 4 weeks ago. Stay with Bloomberg with complete analysis of NVIDIA's after the bell earnings report. And then at 6:30 p.m. Wall Street time, we speak exclusively with NVIDIA CEO Jensen Huang here on Bloomberg Radio and Bloomberg Television.
Turning to the economy now, Karen, President Trump says he thinks he's identified his choice to be the next chair of the Federal Reserve. The president spoke in the Oval Office alongside Treasury Secretary Scott Bessent.
I think I already know my choice.
Who is it?
Well, I liked him, but he's not going to take the job. He refused. You like Treasury better, right?
Much better, sir.
So we are talking to various people.
President Trump was speaking there alongside Treasury Secretary Scott Bessent, who has narrowed the pool of contenders to current Fed governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, White House National Economic Council Director Kevin Hassett, and BlackRock's Rick Reeder.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. LeBron James' record-breaking 23rd NBA season underway. He had been out with sciatica. In his season debut, played 30 minutes, scored 11 points, had 12 assists. The Lakers beat Utah. College basketball in New York. Michigan State beat Kentucky. Duke down Kansas. The College Football Playoff Committee now has Georgia as the fourth team and getting a bye. Alabama dropped after its loss last Saturday, but as of now, the Crimson Tide still in the playoffs. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out on the Markets podcast from Goldman Sachs. A breakdown of market moves and macro signals in 10 minutes or less. The Markets podcast from Goldman Sachs. Listen now.
This is Tom Keene, inviting you to join me for the Bloomberg Surveillance Podcast. It's about making you smarter each and every business day. We bring you a recap of what happened overnight in Europe and Asia, the day's economic data, and complete coverage of the U.S. market open. We cover stocks, bonds, commodities, currencies, even crypto, all the information you need to excel. Bloomberg Surveillance also brings you the analysis behind the headlines. We do that with lengthy conversations with our expert guests, the smartest names in economics, finance, investment, and international relations. We do all this live each and every weekday, then bring you the best analysis in our daily podcast. Search for Bloomberg Surveillance on YouTube, Apple, Spotify, or anywhere else you listen. On the East Coast, listen at lunch, and on the West Coast when you wake up. That's the Bloomberg Surveillance Podcast with me, Tom Keene, along with Paul Sweeney and Lisa Mateo. Subscribe today wherever you get your podcasts.
Hi, I'm Kim Vanell in Wanganui, New Zealand. It's Wednesday, November 19th. Today. In a White House meeting, Trump defends the Saudi crown prince over the murder of Jamal Khashoggi. And in the same meeting, threatens ABC News. The bill approving the release of the Epstein files is on its way to the president's desk. And more than $1 trillion has been wiped off the crypto market on fears of a tech bubble. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes, 7 days a week. Saudi Arabia's Crown Prince Mohammed bin Salman receiving a lavish red carpet welcome from President Donald Trump at the White House. It's the Crown Prince's first visit to the US in more than 7 years, since the murder of Washington Post columnist Jamal Khashoggi made the Saudi leader an international pariah. But in a stunning response to a journalist's question, President Trump said the Crown Prince did nothing wrong.
Things happen, but he knew nothing about it, and we can leave it at that. You don't have to embarrass our guest by asking a question like that.
Khashoggi, who was based in the US, was killed and then dismembered inside the Saudi consulate in Istanbul in 2018. US intelligence found the Crown Prince himself had approved the journalist's capture or killing. Trump says Khashoggi had enemies.
Job. You're mentioning somebody that was extremely controversial. A lot of people didn't like that gentleman that you're talking about. Whether you like it,
the visit marks a high point for Saudi-US ties, with Trump designating Saudi Arabia a major non-NATO ally, granting military and economic privileges. Mohammed bin Salman was effusive in his praise of the president.
We believe in the future of America. We believe in what you're doing, Mr. President, really creating a lot of good things and good foundation to create more economic growth, more business in America.
Later, Trump hosted an elaborate dinner for the Crown Prince. With high-profile guests including CEOs from Chevron, Qualcomm and Pfizer, footballer Cristiano Ronaldo, and Elon Musk, who returned to the White House for the first time since his falling out with Trump. And in terms of deals, Trump and Mohammed bin Salman agreed on arms sales, civil nuclear cooperation, artificial intelligence, and critical minerals. Deputy Foreign Policy Editor Humaira Pamuk has more.
Aside from Khashoggi, the conversation focused on a lot of investments. We have seen President Trump visibly excited when MBS increased his country's pledge of investment right there in the Oval Office.
I believe, Mr. President, today and tomorrow we're going to announce that we are going to increase that $600 billion to almost $1 trillion of investment, real investment and real opportunity by details in many areas.
But probably the most important deliverable from this meeting is the sale of F-35 jets to Saudi Arabia, something the kingdom has been seeking for quite a long time. Now, the tricky thing there is whether or not Washington sells the same aircraft that it sold to Israel, because that's going to be really important in terms of preserving Israel's qualitative military edge in the Middle East. And President Trump indicated that indeed the kingdom was probably going to get the same F-35s that Israel was getting. So we're going to have to see how that turns out.
President Trump also gave details on the plan for Gaza, saying the Board of Peace, which will oversee a transitional government, will include heads of, quote, all the major countries. He also says the Saudi Crown Prince gave a positive response to joining the Abraham Accords. That's Trump's effort to get Arab countries to normalize relations with Israel. But Mohammed bin Salman didn't completely commit.
And we want to be part of the Abraham Accord, but we want also to be sure that we secure a clear path of two-state solution.
A two-state solution, recognizing both Israel and a Palestinian state, is something Israel remains vehemently against. As Trump and Mohammed bin Salman dined at the White House, a bill forcing the release of the Epstein files made its way to President Trump's desk. He could sign off on it as soon as today. But it's not clear how soon after that the files will be released. The House of Representatives overwhelmingly pushed the bill through in a 427-1 vote, sending it to the Senate, which swiftly approved it too. It's an extraordinary turn of events and an outcome President Trump had fought for months before U-turning. According to two sources, the White House is caught off guard by how quickly the measure moved through the Senate. Trump called for ABC News broadcast licenses to be pulled after taking issue with a question a network reporter asked him about the Epstein files during that Oval Office meeting with MBS.
Why wait for Congress to release the Epstein files? Why not just do it now?
You know, it's not the question that I mind, it's your attitude.
Before the vote, about 24 survivors of Epstein's alleged abuse joined lawmakers to urge the release of the records, including Jenna Lisa Jones, who says Epstein sexually abused her when she was 14.
I voted for you, but your behavior on this issue has been a national embarrassment.
The Epstein files have become a serious political liability for Trump, taking a toll on his ratings. The latest Reuters Ipsos poll finds his approval rating has sunk to the lowest of his second term at 38%. Politics editor Scott Malone is in Washington, D.C.
So what we're seeing is that Americans are very concerned about the high cost of living and don't think that Trump is solving it for them. Just 1 in 4 respondents to the poll said they approved of how Trump is handling the issue. The other thing that's weighing on Trump is the Jeffrey Epstein situation. The poll found that about 70% of Americans think that the federal government is hiding Epstein client information. And this is a bit of a problem that Trump has dug himself into. He campaigned on a promise to release the Epstein files. He has long said, when he was out of power, that the government was hiding information about him. And now that he's back in it, he's under a lot of pressure to act. We find that just 4 in 10 Republicans support the way that Trump's been handling the situation.
A court ruling has handed a major win to tech giant Meta, ruling it does not hold a monopoly in social networking. The Federal Trade Commission wanted Meta to spin off Instagram and WhatsApp, saying it shouldn't have been allowed to buy them in the first place. But a US district judge found the FTC had incorrectly excluded YouTube and TikTok from the market, adding that including TikTok alone defeats the FTC's case. The floor has fallen out from under Bitcoin. The cryptocurrency has fallen below $90,000 for the first time in 7 months, wiping out all of this year's gains. The whole crypto market has taken a hit, with more than $1 trillion taken out over the last 6 weeks. Analysts blame doubts over US rate cuts and say investors are more cautious about risk. Here's fintech reporter Hannah Lang.
The concerns around Bitcoin and the crypto market as a whole have really been impacted by broader market jitters around AI that have really impacted risk assets like tech stocks and cryptocurrencies. Despite a really successful year for digital assets broadly, which have risen on the backs of the Trump administration coming into office and pledging to overhaul a lot of existing cryptocurrency regulation. Crypto and Bitcoin in particular are very volatile and new assets, and they're not really predictable in the way that they move. There are a lot of large investors here whose actions can really impact the rest of the market, and that's not really something that's super common in a lot of other assets out there. So I think people have to be worried about how enduring this trend is right now and whether there's ultimately too much leverage in the system. We've seen a couple of different trends this year where traders have really piled up on leverage. And if that implodes, it really could impact prices even further.
And for today's recommended read, China's travel boycott on Japan, one that could cost Tokyo $14 billion a year. And the small Japanese tourist companies that cater to Chinese clients are at the very sharp end of the backlash. The The travel warning was triggered by the new Japanese Prime Minister's comments about Taiwan, saying a Chinese attack on the island could trigger a military response. There's a link to that story in today's description. For more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favorite podcast player. If you're listening on a smart speaker, just ask for the latest news from Reuters 7 days a week. We'll be back tomorrow with our daily headline show.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular. Markets heavily focused on this AI dynamic. Are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate. We're going to see the NVIDIA earnings later today. That'll be a very important moment for the markets. Second topic I think is very much on the minds of investors is labor. We've had government shutdown, which is obviously behind us now, but the statistics will lag and the data will lag. So the market is not quite sure what to make of labor. So I would say labor is a major issue and a major concern. And the third topic, I think, is inflation, which remains pretty stubbornly high. And we obviously saw in the election cycle in the U.S. a lot of focus on affordability. And so I think those three topics are really shaping markets right now. Markets have had a good run, and so you're seeing investors kind of pull back and I would say protect gains.
Do you think we need more of a correction? Like, when do you know, or is the AI in an actual bubble?
Well, I think we'll find out in NVIDIA's earnings today, kind of what they say about their own prospects, which has been a bellwether, and I think will have some impact on the psyche of the marketplace. It strikes me that the market could pull back further from here. I do think that the technicals are kind of more biased for more protection and more downside, more short activity, more macro hedging, and kind of protecting the gains that have been garnered this year. So I think there probably is a bit more bias to the negative, but I don't know that it'll be that much more pronounced from here.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
All right, a check on cryptocurrencies. Bitcoin briefly falling below $93,714 to erase a more than 30% gain this year. It peaked, of course, at the record of more than 126,000 in October. Bitcoin, Ether, Solana in positive territory as we speak right now. Institutional buyers pulling back. after that Bitcoin tumble. Let's get perspective from Zen Kwan, Managing Partner and CIO at Revel Capital Family Office. Also with us, SB Powell, Head of Capital Markets and Strategic Intelligence at CERTIC. Good to have you both with us. Zen, let's start with you. What do you make of this, well, some say unraveling of cryptocurrencies?
Sure. If you look at what's happening in the data side, Bitcoin has just appreciated actually less than 5% this year on year, or since January, just slightly under 3%. And however, a lot of times you look at why do institutions get into Bitcoin or allocate into Bitcoin is to really deal with the debasement risk. So on the US dollar side, it has depreciated 9% this year. So in terms of that, -9 plus 3, so you are thinking if you are allocating into Bitcoin, you have allocated, even though in the backdrop of a weak market, you are already 12% up in that sense. So I think with that, and you have seen DAT, Digital Asset Treasury, building up, accumulating digital asset on their balance sheet, and also more institutions, including family office, allocating or rotating some from gold and some of the other asset classes into digital assets.
Esme, why the sell-off in the first place? It is a confluence of factors, right? Including, a revision of expectations of the Fed cuts.
Right, you're absolutely right. So what we're seeing in the market is that the investors are basically questioning whether they should be recalibrating expectations. So just going back to the October 11th and 12th pullback, so we can see that it's causing a vicious cycle of deleveraging and also liquidity air pocket. So for example, what we're seeing right now is that people are taking risk off away from risky tech equities and AI proxies and away from crypto assets and into safe haven assets, for example, gold. So what I see from here is I expect there to be a continuous recalibration as investors take profit from the year-to-date October rally, and also for them to shift to more safe haven assets.
Well, why haven't cryptocurrencies recovered fully from that October crash? When you take a look at, the equity markets, for instance, they've continued to test new highs.
Well, that's essentially the different ways in which the equity markets and traditional capital markets trade compared to crypto. So for example, crypto, there's a lot of macro linkages. So even when Trump announces a 100% tariff, that releases a shock that would cause a dominoes effect. And that essentially leads to liquidity squeeze in which market makers and also exchanges have more wider spreads and also them pulling out liquidity from the markets. As a result, we see a lot of thinning of price movements and also for a lot of forced selling. And that's causing a dominoes effect throughout the market.
Is there extreme fear in the crypto space then? I mean, we're talking about massive movements.
Sure. I think right now, if you look at the extreme of fear, greed index is at 10, which means it's an extreme fear. But if you look at what happened on October 10, you're talking about $1 trillion, 350 billion drop in market and 19 billion in a day liquidated. So with that, I think the market is still recovering from the scars of the 10-10 sell-off. But having said that, if you look at not just on Bitcoin, there are other segments in the digital asset themes that are actually doing not too bad, relatively actually gaining grounds this few days as some of the within the market, they are shifting away from some of the majors to other digital assets.
We're talking about a pullback at a time when there's so much optimism about President Trump's digital approach and regulation, yet this massive move downwards. How do you square that?
Okay, I think one is the correlation with the Max 7. If you look at the Max 7 correlation and Bitcoin, it is very correlated right now. However, so if you ask me, is there overselling this time in the short term? I believe there is. If you look at the technical analysis on that front and the macro side remains strong, right? We talk about a debasement risk, buying Bitcoin, allocating Bitcoin to deal with that risk. And I think now on the Clarity Act, which is going to sign into law, that itself will remove uncertainty. And what happened during the government shutdown is you're talking about 41 days of no data. I think that itself spoke the market. But having said that, we are, in terms of the next few months and quarter, we believe that Bitcoin will recover.
In terms of the correlation between Bitcoin, cryptocurrencies, and Max 7, Asmi, what are your own expectations? Because, when you take a look at the Max 7, some say that we're going to continue to see a correction in the market.
Right. So in terms of the correlation between risky assets, for example, crypto and also equity, so I believe that the fellow interviewer has already very clearly expressed the correlation. So what I'm expecting going forward is that there needs to be market structure change, and I think right now global policymakers has already been working on that. So for example, the FCA and also Bank of England has put out a joint consultation regarding stable coins. So I believe that looking forward to next year. So we're going to see strength around the ecosystem and also the infrastructure plays. So I'm positive in terms of infrastructure, custody, and also ETFs, new investment products, anything that's along the lines of regulation. And the second part to that is that with institutional capital flowing in with clearer guidelines, so I believe that the market is going to trade closer to fundamentals and also less mispricing and less reaction to X and also Twitter headlines.
But it's still going to be contingent on Fed moves. If the Fed fails to cut in December, we can expect that correction in the crypto space to continue. Is that a fair assumption?
Yes, I believe so. At the same time, I think there's going to be some looks.
Go ahead, Esme.
Yeah, at the same time, I think the market will be looking for two data points, which will be the litmus test as to whether it's going to be a prolonged sell-off or rather it's a recalibration of expectations short term. So number one will be around the empirical data around data books, order books, and also around data funding rates of exchanges. So that's going to be a testimony of the liquidity that's out there. And the second is related to pricing. So how wide the spreads are around the exchange rates will be a second factor that's going to influence the market.
And Zen?
I think I want to focus on Clarity Act, which will be coming into play. I think with that, we know that in the market, crypto exchanges market, the Wall Street could contribute from anything from 30 to 70%. So when regulation come out, we're going to, in a way, fix that, and that itself will remove some market manipulation and some of those market moves that will, in that sense, be not so volatile going forward. And a lot of price movement, if you look at for the past few months, a few weeks, cannot be explained to what are the strong macro underlying currents or the tailwinds behind digital assets, particularly Bitcoin. So with that, with I think the regulatory clarity coming out, that we think that will actually move the market, the entire market, into positive zone.
So you're saying less volatility can be expected once that happens, and will that encourage even more institutional interest in cryptocurrencies?
I think in 2025, we've already seen a lot of institutional interest at the sideline. I think a lot of family offices and also even listed company looking at allocating. So they are in a way getting ready. I think 2025 is the year of observation and getting ready. So I think 2026 is we will continue to see inflow, strong institutional inflow into the market.
So how big in terms of the holdings in a portfolio, for instance? What are you seeing? How much are people holding cryptocurrencies in the portfolio?
Sure. I think last year on the show, we talked about as much as 10%. I think there are some families and some institutions and, as I said, private company and listed co are allocating anything, I would say, that I've seen, or either from thinking about allocating to a few percentage below 5 to all the way double digit.
And what's your take on that, Esme?
So I'd like to quote from our conversations with the asset managers, for example, the largest holders and also the issuers of ETFs and also digital asset treasuries, as well as with stablecoin issuance and distribution. And then what I'm hearing is that obviously in the past market cycles, we've had multiple instances in which there were crying wolves, and then that didn't really materialize in terms of institutional inflows. But why I believe that next year is going to be different is because you can see that, number one, as San rightfully mentioned, so there's been a softening and also a warming up in stance when it comes to the U.S. and other also global jurisdictions. So that's number one. And number two is that in the back of tokenization, RWA, and also stable coins. So you can see that that's going to drive a lot more institutional inflow. Just quoting from a statistics, so looking forward to the next 4 years, so stable coins liquidity is going to be 50% dominated by institutions as a prediction, as opposed to 5 to 10% right now.
So we're potentially looking at a bull market ahead. I mean, it is a divided world. Some say we're actually looking at the start of a bear market. How do you start thinking about the crypto cycle? How do you make sense of it?
Right, so as we know, the crypto cycle is normally 4 years, and then next year would be the routine start of the bear market. But what I believe is that next year we're going to see a tighter hug around institutionalization. So that's going to lead to market structure change, which I do emphasize. For example, regulations, that's going to distort the regular bull-bear cycle, and now we're going to see fundamentals kicking in. So therefore, I reiterate my stance and being positive around infrastructure, and also those who are we're really seeing real use cases and also user activity, institutional activity, and also regulatory blessing.
So Zen, bull or bear? And when do you buy the dip?
Okay, so I think one thing that is stopping some of the flow coming in is the uncertainty around counterparty risk. I think when the families and institutions are doing due diligence on that front, that is what stopped them, because they don't know what to ask and couldn't see through what ultimately the counterparty risk is. I think with, again, the clarity in terms of regulation, that will reduce the counterparty risk, and which will also increase confidence. So in fact, when we talk about the 4-year cycle, the bull and the bear market seem to be lengthened. So the question is that, is there still a 4-year cycle? I think with that, coupled with what's going on the regulatory front and the macro scene, we are still bullish in the mid to long term. But I guess in the short term, there will be volatility until all this regulation settle in, as institutions also get comfortable in allocation and understand what to do behind the due diligence.
Are there factors that investors are not paying enough attention to?
Yes, that means that not all eyes on Bitcoin and some on Solana, but there are fragments of the digital asset on liquid tokens that could be bullish in the next quarter or the next year.
Such as?
Such as, for example, the privacy token segment.
And how high can they go?
Some people deem that as like what I call it the new Bitcoin, all had different use cases, what Bitcoin couldn't do. I think with that, one of the questions to ask on the OGs, on the digital asset source of wealth, where are they going to park their money? I think that is one question. If we could answer that, we could know or where to see where the bear market or the bull market is.
And Esme, in terms of where you should be parking your money in the crypto space, what are the best bets right now?
Right now, I always believe it's stablecoin issuers and also some private companies that are on the verge of IPO. So I'll be looking out for exchanges, custodians, and also tokenization platforms. So I'll primarily be looking at the intersection between traditional capital markets, equities, as well as with digital assets. I think that is the area to play for institutional money in the next 2-3 years.
One last question to both of you. Where will Bitcoin end the year? Esme?
I would say 12K, 120K.
120K?
Okay, I put the line between Chinese New Year and the New Year. I think between 140 to 150.
We have in Singapore the state-of-the-art technology, and then we export that technology into our metro.
For sectors like consumer discretionary, for example, we heard Home Depot that had some poor earnings. Can you buy into those sectors until you get confirmation that the Fed will be cutting and be cutting consecutively, or is it too early right now to start to play that?
No, I actually think it's a pretty good time to step into something like consumer discretionary, especially going into the holiday season. It should be a seasonally strong time period. And also, if we do look at consumer spending in October and early November, it's pacing well. So I think you have some positive momentum there. And that's despite the fact that consumer confidence plummeted in the midst midst of the government shutdown. But here we have the government that is reopened, the flight schedules that are also reopened. So we have the government workers that should get.
We don't see the robots taking over the jobs from human.
The Nasdaq off by 1.7%. Now, we have raised $1.8 trillion from this benchmark since the end of October, in large part because some of the key AI players have been on the downside. Bitcoin, though, recovers ever so slightly up percentage point. We're at 92,846. Move on to individual movers because it's all around some of our top story today. Cloudflare, we want to check in, and we're down 3%. That's after it's been fixed, but we were struggling to get onto NJ Transit. You were struggling to get onto OpenAI's ChatGPT. You were struggling to get onto many a website because of Cloudflare more broadly. And that's as we saw an outage that now they say has been fixed. We're still off by 3%. Let's talk about, though, the top story that we just mentioned. Microsoft and Nvidia both committing to invest up to a combined $15 billion in Anthropic, in a move that ties the AI developer closer to two of the biggest backers of its rival, OpenAI. Bloomberg's AI editor Seth Fiegeman joins us some more. It's a tough time to be announcing that you're going to be buying cloud from one company while they're going to be investing equity in another. Just more circular deals, it feels like.
This one feels very clearly following the OpenAI playbook that we've been seeing in recent weeks here. Yes, I think Anthropic is taking money from Microsoft and NVIDIA. Anthropic then plans to commit spending to Microsoft's platform using NVIDIA chips. Kind of textbook here, and I think will add to some of the anxiety there, but it is on a bit of a smaller scale. Also, our understanding at this point is that this financing is part of a larger investment round to be announced at some indeterminate time, so TBD how much Anthropic is actually planning to bring in here.
I mean, they only just closed a round that valued them at more than $180 billion.
This is the new normal. It's a bottomless need, and everyone is tapping everyone else. All the ships have to rise together or else they fail.
But what's interesting is Amazon had to make clear that they're still the number one provider of cloud and of training compute to Anthropic. Everyone seems to be in Anthropic now, but how are we seeing that rival the likes of OpenAI?
Yeah, I mean, again, this is not an either-or model. It's a yes and. I think we've seen OpenAI turn to Anthropic's backers, namely Google and Amazon. So Anthropic is doing the same. Now, there's a lot of intrigue there about what that means about the Microsoft-OpenAI relationship. But again, at this moment, everyone is tapping everyone else until the music stops.
And the music has been sounding a little jerky of late. I mean, certainly in the public sector, people have been worrying about these circularity deals on the actual productivity gains that we might ever get with AI.
That's right. I do think Anthropic, though, has messaged clearly in the last week or so that while they're kind of playing the OpenAI playbook here, we're investing heavily in infrastructure, in chips, building out more. We're doing it on a smaller scale. Now, as I said the last time I was on, $15, $20, $50 billion, these are massive sums, but when you compare it to OpenAI's $1.4 trillion, a bit more measured.
Well, we've also got other breaking news today from LLM innovations and improvements, this time coming from Alphabet. Shares are under pressure, down 2.3%, but they rallied hard yesterday because we know Berkshire Hathaway is getting into Alphabet. But now we've got Gemini 3, and it seems to actually be really rather good.
That's right. So at the same time that Google has been helping Anthropic and OpenAI compete, they're also still trying to be the best model on the market. And so I think with Gemini 3, they're really touting their gains in coding and in mimicking the process of human reasoning. Obviously, those are key aspects for Anthropic and for OpenAI as well. Interestingly, the Gemini 3 model also offers a more premium tier, I think it's $250, something like that, a month, and you get to do even more intense reasoning where you can test different hypotheses, and we'll see. But they're all competing with the same kind of benchmark claims here to try to be the dominant force.
And, well, we have news of LLMs getting ever more sophisticated. We're able to code, we're able to vibe code, and your team has been so busy because vibe coding startup, Lovable, which is actually a European startup, seems to be expanding and maybe even getting a really high valuation too.
Yeah, I think it's really probably the most promising, or one of the two most promising coming out of Europe right now. A lot of the vibe coding leaders are from the US, including Cursor, and you can argue Anthropic and others. I think Lovable has seen pretty strong organic demand and pretty promising growth in recurring revenue. But this is a crowded market, and if Google's model changes the game overnight for coding capabilities, that might have disruptions further on down the line. It's very much to be seen.
$200 million annual recurring revenue, and according to sources, a $6 billion valuation. We can have the CEO in a little bit later. Seth, amazing wrap-up of all things AI. Seth Fiegeman, of course, who helps edit across that team. Let's turn to Washington now. Guess what we're talking about? AI, but with the Saudi Arabian Crown Prince Mohammed bin Salman He's at the White House today meeting President Trump. We know the talks about deepening US-Saudi ties, but really there is such a focus on tech, on investment, on innovation. Let's do it all with Bloomberg's Tyler Kendall joining us from the White House. A lot of it's going to be about chip access.
Right, exactly, Caroline, and good morning to you. No doubt access to critical chip technology is going to be at the top of the agenda today, as Saudi Arabia has faced U.S. restrictions since 2023, in part over the kingdom's ties to Beijing. Now, I will point out that when President Trump visited Saudi Arabia back in May, the two countries announced a slew of investment commitments related to AI, related to data centers that are going to come to rely on access to these advanced semiconductors. But 6 months has gone by, and we have yet to see the U.S. greenlight those export licenses. Now, people familiar tell us here at Bloomberg News that the two sides are still hashing out, one, the security conditions for these shipments, and two, the specific reciprocal investments that Riyadh is going to commit to making when it comes to making good on their pledge for $600 billion in U.S. investments over the next 4 years. Now, perhaps adding to the pressure here is that we know that recently the UAE saw some of its export licenses greenlit when it comes to projects run by U.S. companies there. But, Caroline, this really does dovetail into the other key part of the conversations today, which has to do with defense. We are watching closely whether or not the two countries enter into a defense mutual cooperation pact, and also those F-35s that President Trump indicated that he will allow the sale of. Of course, this comes back to the chip conversation because there are concerns here also about whether or not China could have access to this advanced technology in these fighter jets. Caroline, I'll end on this. It's absolutely packed here in Washington. We're expecting tech leaders from across the country to descend and world to descend here, all leading up to tomorrow's U.S.-Saudi-led investment summit at the Kennedy Center here in Washington.
And we await that arrival of MBS to the White House. Tyler Kendall, thank you very much indeed. Let's get the wider investor perspective here. I'm pleased to say Margie Patel is with us, Allspring Global Investments Senior Portfolio Manager, Head of Capital Allocation. And look, we are thinking about how global narrative around AI continues to develop. Have you got any worries that we've been seeing, at least in the pressure on the stock market of late?
No, I think this is a little garden variety correction because we've had a few wobbles, bad news in the private credit market. I think that we'll have maybe 5% correction. I think the year will finish on a very, very strong note because really the trend for artificial intelligence is so strong for data centers. In fact, when you look at the companies that have commented, basically they don't have enough capacity for all the demand, and they've been able to raise prices. So that doesn't sound to me like a peak of a market that's ready to collapse at all.
I'm just going to go out to some sound that we heard a little bit earlier in a summit that Bloomberg's been having over in Africa. They had the JP Morgan vice chairman joining, David Pinto. Just listen what he said about a correction.
It's possible there is probably a correction there. And that correction will also create a correction in the rest of the segments in the S&P and in the industry, because you are probably, in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing.
Daniel Pinto there of JP Morgan, just speaking with our own editor over in Africa today, Margie, and I'm really interested as to, well, why you think this will just be, I think you called it a garden variety correction. What will be there to support it? Will it be NVIDIA's numbers that get us back on track?
Well, I'm not sure anything NVIDIA could say will be enough to assuage market concerns. But really, when you look at the big market corrections, the economic corrections, they've all been driven by, frankly, Federal Reserve activity, when they start to aggressively raise rates. So right here, it looks, you could say, well, the Fed is somewhere between neutral to slightly easing. And again, that is not the precondition. I think we've been through so many of these cycles, all driven by the Fed, that we think it's natural that we should have a big downward correction. And I don't think we will. I think we'll just have a continued period of slow growth for most of the economy. The tech sector is very strong because artificial intelligence is really a qualitative leap in the kind of technology that we've had over the last several decades. So we think it's just a small correction. In fact, if you look at NVIDIA, the stock really for this quarter, the fourth quarter, is really just about flattish. And all they are, except for Google, is the only one that's up for the quarter. So that says to me there's a lot of nervousness, waiting for NVIDIA, but I think after that clears the air, I think we'll have a strong finish because the fundamentals are still so strong as far as the eye can see, which I would say is at least for another year or so.
And look, we're looking at year-to-date, NVIDIA up 35%, but it has eroded about $500 billion of market cap since the end of October, Margie. So is that a buying opportunity?
Well, I think it's a moderate opportunity, yes, because at least you have some of a discount. The PE is around 40 times, and that's higher than the average stock, which is around 27 times. But on the other hand, they're leaders in their sector. They should have an above-average growth as far as the eye can see. So it's really not as high priced as it was relatively a few months ago. So I'd say, yes, it's a good time to add to NVIDIA because their fundamental position is really strong. I think it's just, as I said, market nervousness. Short-term traders have gotten badly whipsawed back and forth in the last couple of months, and I think that's what's really causing this downward wave in volatility.
Giving us the longer-term perspective, we always so appreciate it. Margie Patel of Allspring Global Investments. Stay well. See you soon, we hope. Meanwhile, coming up, gaming giant Roblox takes steps to expand age verification across its platform. We'll discuss the details of Roblox CEO Dave Vazzucchi. That's next. This is Bloomberg Tech.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Roblox, well, it's begun rolling out age verification technology for all users and is introducing age-based chat as the gaming platform expands safety features with further parental resources too. Roblox CEO Dave Vazzucchi joins us now. And Dave, this really builds on that big, ambitious September announcement. How is this going to be rolling out?
Hey, great to be here, and what an enormous responsibility with 150 million users every day coming to the platform. We're rolling out what we believe will be the gold standard for the future of internet safety. We're the first really major gaming platform to use AI to estimate the age of everyone on the platform who wants to use chat and communicate. We're going to start rolling this out in December, and then should be all rolled out by January. Basically, on whatever device you're on, take a quick image, we'll analyze your age with AI, complement it with a bunch of other signals, and use that really to figure out who might you be chatting with to keep the platform more safe. We're not going to be allowing minors, for example, to communicate with people who are adults, and we're going to roll it out to everyone on the platform.
I'm really interested as to how you're going to measure success here, Dave, because in many ways you're trying to prove a negative. But how are you going to be internally thinking this has worked, people are satisfied, and they're safe?
Well, I want to highlight things are already working in that we're a very unique platform in that we filter all of the text and communication on our platform. We don't allow the sharing of images. We have monitoring for critical harms. We work very closely with law enforcement. So I see this as an addition to everything we're doing and really to our vision of what we've been calling the gold standard. But we do estimate over the next few months, we'll know roughly the age of everyone on the platform, and we'll complement that with some of the other things we do, like trusted connections and things like that, to constantly build on our innovation. You know, we've shipped over 100 safety innovations in the last year, so it's really a continuation of that focus.
You're using a third-party vendor, Persona, I believe. And how are you going to be ensuring that that's robust enough? The AI, the underlying technology, is robust enough over in the UK. Well, some that are using Discord, for example, have managed to bypass previous facial recognition age verification tests.
There's a bunch of other signals we have in addition to the facial age estimation, and we do have the ability to estimate several times if we need to. So in addition to using the camera to do an age check, we have other ways to validate, and putting all of these signals together, we believe is pretty robust, really.
what's so interesting is clearly you're here with safety as a priority. You did mention back in the earnings, and your CFO in particular, that maybe you'll see some friction, maybe the numbers, the revenue, the growth might be impacted as people start to have to verify their age and maybe slower to come and adopt. Do you think that will bear out? How will it look longer term?
We shared this vision that we believe over 10% of the global gaming market, which is somewhere between a $180 and $200 billion market, is going to be running on Roblox. And in the earnings call we just had, we shared this amazing growth, both on bookings and DAUs, in the 70% year-on-year rate. Long term, we believe this is just the right thing for the platform. We're unique in that we have all ages. We have people under 13, over 13. Our over 13 is growing rapidly. This is the right long-term vision, and we're really optimistic about continuing our growth.
Okay, so this is the right balance from your perspective. What do you think the data will bear out as to the name, well, ultimately, the actual ages of people you have using it? Do you think you'll have more under 13s than you anticipated? Do you think you have more older users?
We can't estimate that exactly. What I can say is that the facial age estimation tech we're going to use is pretty reasonable and pretty accurate. I've tried it. Some of my kids have tried it. We've tried it within our staff meeting. So I think we're going to find out we're reasonably close, but over time we will get a better signal on everyone's age.
And this must be something that marketeers, that those that eventually will be buying more ads with Roblox are going to be looking at. Is this going to help, inject some fuel to that offering, because people will feel safer about what age group are going to be consuming such adverts?
We have shared a couple things. We don't target under 18 already on the platform, but there's an enormous number of older users joining the platform. We shared in our earnings call, I believe in Q4, we're literally, or in Q3, running at over 10 billion hours a month of engagement. That's an amazing amount of engagement. Our economy is primarily driven right now by our virtual economy powered by Robux, but advertising is a wonderful complement. And you're right, we're going to have a better, more accurate estimate of everyone's age, which for a lot of our advertisers that are starting to hop on with events supporting all kinds of things, beauty products, movies, things like that, they'll have a better idea of really the number of people over 18 on our platform.
Roblox CEO Dave Vazzucchi on the latest safety updates. We really appreciate you joining the show today. Thank you. Now, coming up, we're going to be speaking with the Lovable CEO, Anton Isika, as the company is said to be nearing a $6 billion valuation. This is Bloomberg Tech.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
AI coding startup Lovable is set to hit a $6 billion valuation. That's according to sources. The company is seeing rapid growth, reaching $200 million in annual recurring revenue and expanding with new offices in Boston and San Francisco. Joining us now to discuss, Anton Isika, CEO of Lovable. Anton, I go to the numbers that you've actually given to us, the $200 million the annual revenue run rate. That's a lot. Who's purchasing?
So we're seeing Lovable, since we launched just 12 months ago, have been powered by this consumer and prosumer movement of individuals that use the product and then they love it. So they put in their credit card and that's just the movement that's been then translated to us being pulled into the enterprise, where Fortune 500 companies like Klarna, HCA Healthcare, they're transforming how they work on top of just a completely new way to build software products and even software companies on top of the products that are being built.
So you're all about what you say, democratizing software creation for the 99%. But In the longer term, how many do you think will be those individuals, those individual entrepreneurs, or how much will it end up being enterprise? Actually, hold that thought for a moment, Anton, because we're just going to go out to the White House. We understand that the Saudi delegation has indeed arrived to meet with President Trump. As you can see him walking out to the lawn right now at the White House as we speak. Much of this is going to be a technology conversation between MBS, the Crown Prince of Saudi Arabia, and President Trump. Saudi Arabia in particular offering hundreds of billions of investment into America, but in return, in many ways, hoping for more access into United States IP, particularly when it comes to the latest, greatest chip innovations from the likes of NVIDIA. We're anticipating many tech leaders to be joining the White House at a dinner a little bit later. So we await what will be a key meeting between these two leaders. Of course, the first stop in the president's tour globally was with the Middle East and Saudi Arabia, and now Saudi Arabia coming to the United States. As you can see, the delegation arriving as we speak. We're anticipating MBS to be welcomed in for a one-on-one meeting with the president. As we mentioned, President Trump with a warm welcome for Saudi Crown Prince Mohammed bin Salman, known as MBS, as he enters the White House. The administration's got a close relationship, close ties with the Saudi kingdom, and the president aiming to lock in more major business wins. We're having a lot of technology executives likely to be attending visits. Even Cristiano Ronaldo, we understand, the soccer player, is going to be there as well. Of course, him playing his soccer over in Saudi Arabia now. But we can go out to the White House now, to our own correspondents from the White House. Michael Shepard is standing by. And it's interesting, we saw that very ornate flyover. We saw a significant welcome to MBS. What tangible are we expecting?
Well, we're looking for a handful of things from this visit, and MBS in particular is seeking to come away with a handful of things. One, of course, are the F-35 fighter jets that the administration has been dangling in front of the Saudi kingdom as a possibility of perhaps breaking the ice on sales of this very sophisticated and advanced defense technology. But there are some hangups, of course, and that is the concern that some of this technology could leak to China. So the president has indicated that the F-35s are a thumbs up. The other thing we're waiting for a thumbs up on, Caro, is computer chips, and specifically those used in artificial intelligence. You'll remember that back in May when Donald Trump visited Saudi Arabia and the United Arab Emirates, we saw this flurry of deals involving artificial intelligence as part of each kingdom's effort to break free of fossil fuels is the only identifying characteristic of their economies. They want to diversify beyond fossil fuels. And AI is really the path for each of them. Now, the Saudi AI venture, Humane, has reached an agreement with NVIDIA to buy a whole bunch of computer chips, but that is contingent on U.S. government approval. And so far, those licenses have not yet been granted. So we'll be looking to see whether there is approval for that, as well as those fighter jets as well, Kara.
I mean, this is a real moment with the context that this is the first visit to the White House since the murder of critic Jamal Khashoggi back in 2018, for MBS to be coming to the United States, to be so welcomed, but in many ways remind us of what's a business stake here. It is a tough one to navigate, but ultimately we're thinking about $600 billion, I believe it is, that's likely to be invested into the United States. And meanwhile, a U.S. company is looking for energy, for infrastructure from Saudi Arabia.
Well, Donald Trump has viewed this as a two-way street. It is not just U.S. investment and U.S. technology flowing into Saudi Arabia. He is fully expecting, as we've seen with other trade negotiations and agreements forged with top American trading partners, he is expecting a significant investment in the United States from Saudi interests as well. And those would also support areas of artificial intelligence and chip making here in this country as well. We have already seen investments from Mideast interests, Gulf interests in some of those AI ventures and data center projects that are unfolding now as we speak, especially in Texas and elsewhere in the country. So we'll be looking for signs also of what those commitments are, whether they've deepened, whether the checks have gotten even bigger, and where that money might be going, especially at this moment, Carol, when there has been a little...
ओके गाइस 6:30 न्यूयॉर्क सेशन की ओपनिंग होने वाली है। नेचुरल गैस को देखोगे तो वहीं स्टक है। क्रूड ऑयल, ये कैंडल यहाँ पर एक सपोर्ट था, ये कैंडल ही ओपन इक्वल टू हाई बना दी इसने। एंड कैंडल के बाद देखोगे नीचे एक और सपोर्ट है, कल वाला, इसलिए कल का सपोर्ट है, इट इज स्टिल होल्डिंग। बट क्रूड ऑयल, इफ यू लुक एट द क्रूड ऑयल, इस कैंडल ने बिल्कुल बेरिस कर दिया। अब ज़्यादा ऊपर भी जाने की उम्मीद नहीं है, मैक्सिमम यहीं तक जाएगा वापस अगर पुल बैक आता है। इसके नीचे नेक्स्ट सपोर्ट, अरे वाह, इसके नीचे नेक्स्ट सपोर्ट एक यहाँ पर है। अब थोड़ा बड़ा है सपोर्ट, बट यही दिख रहा है फिलहाल के लिए। कैंडल का ध्यान रखना, ओपन इक्वल टू हाई पे बाय मत करियो। कैंडल अगर लेवल के नीचे क्लोज होती है तो फिर ब्रेक डाउन ही है वो। सिल्वर फॉरेक्स में देख लेते हैं 1 आवर और 4 आवर टाइम फ्रेम पे। लेट्स सी, क्रूड ऑयल की इन्वेंट्री भी है आज, ध्यान रखना। सिल्वर को देख ले रहे हैं एक सेकंड फॉरेक्स में पूछ रहे हो ना बाकी नीचे वाला सपोर्ट तो स्ट्रॉन्ग ही है खैर ये पर लेट्स सी अगर थोड़ा ऊपर यहीं से निकल जाए और फिर ऊपर से वापस नीचे आए यहाँ पर नहीं रुकता है तो वही 5228 5200 इसमें कितना है लगभग लगता है नीचे ही आके मानेगा ये क्रूड नीचे अगर आ गया नीचे वाले लेवल पे तो एसएल बहुत बड़ा हो जाएगा। नहीं, होल्ड ही नहीं कर रहा है। पूरी सारी लिक्विडिटी एक ही साथ ले लेगा क्या?
Now, you may know this particular mechanical dog, we'll show you in a minute, for its viral dance routines. But Boston Dynamics' four-legged robot, Spot, is also playing an increasing role in law enforcement. According to previously unreported news, more than 60 bomb squads and SWAT teams across the US and Canada are now using Spot. Our consumer tech reporter Samantha Kelly joins us now for more. And Sam, I mean, how is this being adopted and what situations are we seeing them really take these on?
Yeah, this is really fascinating. So we've seen some headlines over the years of Spot showing up maybe at a crime scene, but now we're getting new data from Boston Dynamics that shows more law enforcement units across the U.S. and Canada are bringing these robotic dogs into their forces to help out in hostage situations or chemical materials that are sensitive, like going in to see if something is hazardous, basically to prevent law enforcement from entering somewhere. This dog can go in, it can climb stairs, it can open doors. It basically acts as a separate set of eyes. There's a live camera feed. So an operator standing quite far away from a scene can go in, assess the situation, and more law enforcement units, like I said, over 60 now in the U.S., but also we're seeing it overseas. Police in Italy are also using it, the Dutch ministry, and it still remains quite popular and manufacturing and other facilities as well.
They aren't cheap, starting at $100,000. So the reward needs to be large. But what about some of the ethical implications here, Sam, briefly?
Yeah, so it starts at $100,000 to your point, but it can go way up from that. We're seeing $250,000 in some situations. But yes, ethical implications here. Calling for more regulation around this from the state and even federal level down the line. Boston Dynamics has some rules in place, but perhaps some community guidelines are needed as well. Also, a lot of law enforcement units can't afford these different devices. So there's some, talking around that as well. So just really people trying to get used to seeing, something like this at a crime scene or at a situation, making sure that the public feels comfortable as well.
Bloomberg's Sam Kelly, fascinating on all things Spot. Well, the price of Spot is now quite well above the price of Bitcoin, it seems. Crypto sell-off has just been taking a pause, but look, we're still at $93,420, let's call it. It actually tumbled below $90,000 overnight for the first time since April. Bloomberg's crypto reporter, Miao Shen, joins us now. And it feels as though we've got a little line of stability. But do we know who's going to be a buyer in this market? Is it institutional or is it retail?
I think for now, what we're seeing is that there's definitely some buyers have stepped in, like as of today, because we saw sort of, as you said, a little bit of stability in the market at the moment. But what we're struggling to figure out actually who's going to be the new buyers, right? I think right now we have a lot of these like DATs, or the digital treasury companies, similar to Michael Saylor's strategy that perhaps going to coming out later this year or Q1 next year. I think they're expected to be the buyers of the market in the near future.
What's so interesting as well is during the government shutdown, we know that the list of ETF applications has been piling up over at the SEC. Many people want to have more ETFs that are related to crypto, but not always about Bitcoin. We know Bitcoin's taken a hit, but the altcoins have really been selling fast and furiously. Is that something just that the market's okay with? It stomachs that volatility?
I think it is quite concerning in terms of what's going on in the altcoins, right? Because I think they're still struggling to find support after the October market crash in crypto. Because some of the altcoins in the market crash went down to zero on some of the exchanges. Like, can you imagine as a retail investor just holding a token all of a sudden went down to zero during this like brief market crash, especially if you're holding leveraged positions, right? I think people ultimately need to figure out what are the fundamentals of these altcoins? Like, are the projects behind it like generating any sort of revenue, or they're just sort of like sort of created out of thin air, or sort of like being meant as a joke, right? I think that's the questions people have to sort of like find out.
Fundamentals. It's a key question across all of this market. Miao Shen, it's great to have you on. Thank you very much indeed. Meanwhile, coming up, more to come on what to expect from that highly anticipated meeting. It's kicked off between President Trump and MBS, of course, Mohammed bin Salman, the Crown Prince of Saudi Arabia. This is Bloomberg Tech. Let's return to Washington now, because Saudi Arabia's Crown Prince Mohammed bin Salman is at the White House today meeting with President Trump. The talks are expected to center on deepening US-Saudi ties and, of course, the focus on tech, on investment, on innovation. Bloomberg's Tyler Kendall rejoins us. You're live outside the White House, and there was much fanfare, a flyover, and a very warm welcome for the leader of Saudi Arabia. Why is this relationship so important from a tech perspective?
Yeah, hey, Caroline. Well, this is the Saudi Crown Prince's first visit to the U.S. in 7 years. So as you're alluding to, there's a lot of pomp and circumstance here today, as the White House has really viewed Saudi Arabia as a strategic partner when it comes to investments in the U.S., but also broadening out cooperation when it comes to tech and artificial intelligence. We know at the top of the agenda today, Saudi Arabia is looking for the U.S. to greenlight those export licenses related to advanced semiconductors. But we have reporting here at Bloomberg News, people familiar saying that right now those talks are centered around, one, what sort of security conditions will be put in place, and two, what are those specific reciprocal investments Riyadh is willing to make in the U.S. I have to say, I was at the FII conference back in February. That was a Saudi-backed investment conference in Miami, and it was President Trump's real first domestic trip since taking office, and he made the pitch that he wanted more money to be coming in from Saudi Arabia. A few months later in May, we saw him visit the region and secure a pledge for $600 billion in investments in the U.S. over the next 4 years. We know a lot of this the administration wants to see in these critical sectors that they have identified as being really important, particularly when it comes to our competition in China, such as data centers and AI. So we're watching really closely whether or not there are any specific investments announcements related to that. That, of course, goes hand in hand with the second bucket we're watching here, which is defense today, as President Trump has indicated that he's set to approve the sale of F-35 fighter jets amid some concerns, one, again, with those chips, access that China could have considering the close ties between the kingdom and Beijing, but then also what that means for Israel. We know that, of course, Caroline, that they have a monopoly over the advanced fighter jet technology in the region.
Bloomberg's Tyler Kendall, live from the White House. We so appreciate it. Busy day there. Busy day across tech. That does it for this edition of Bloomberg Technology. But do not forget to check out our podcast. You can find it on the terminal as well as online on Apple, Spotify, and iHeart. And keep an eye on some of those big tech names as we anticipate NVIDIA's numbers after the bell tomorrow. From New York, this is Bloomberg Tech.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out in 10 minutes or less on the Markets podcast from Goldman Sachs. Listen now.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, after resisting the issue for months, Congress ultimately made quick work of a bill to force the release of the Jeffrey Epstein files. By a 427-1 vote, the House passed a bill to compel the Justice Department to make its documents public. Then the Senate agreed unanimously to approve the legislation without changes once it arrives there. But Senate Minority Leader Chuck Schumer says that won't be the end of it.
We know there's a corrupt Justice Department. We know that Bondi and Cash Patel do just what the president asks and wants. And we Democrats, I just had a meeting of 10 of my colleagues, are going to do everything we can to make sure all of it comes to light.
Senate Minority Leader Chuck Schumer pushed for the unanimous consent motion, but Bloomberg Balance of Power host Joe Matthew reports the Justice Department could still push back against this bill even if President Trump signs it.
Knowing that the president has compelled the Department of Justice to investigate some Democrats, including Bill Clinton in this case, the DOJ could simply say, hey, we understand the vote, but we can't release anything because this is an ongoing investigation, a smokescreen, as some have called it here. And there's a question about whether or not this is how this ends. And maybe that's why, in fact, the president decided at the last minute to go for this.
That's Bloomberg's Joe Matthew in Washington. President Trump has said he will sign the bill, saying he has nothing to hide, and it's time to move on.
Well, Nathan, President Trump is also moving to deepen ties with Saudi Arabia. Saudi Crown Prince Mohammed bin Salman received a king's welcome at a White House dinner last night. The president used it to announce a new defense cooperation pact that'll make Saudi Arabia a major non-NATO ally.
A stronger and more capable alliance will advance the interests of both countries, and it will serve the highest interest of peace.
And President Trump's announcement came on a day that saw the U.S. offer sales of F-35 fighter jets, advanced AI chips, and nuclear tech sharing to the kingdom. Former U.S. ambassador to Saudi Arabia, Robert Jordan, says the Crown Prince is not offering much in return.
What did he have to give up? Virtually nothing, because he still has in his pocket the promise or the lure of normalizing relations with Israel. So it seems to me that MBS has come out by far the winner here.
Former U.S. Ambassador Robert Jordan tells Bloomberg President Trump has touted $1 trillion in investment commitments from Saudi Arabia. That's nearly the size of the kingdom's annual economy. One other note from last night's White House dinner, Elon Musk was on the guest list. The Tesla CEO and one-time Doge figurehead was back in the East Room after his public falling out with President Trump over his tax and spending cut bill.
Let's turn to markets now, Karen. Futures are higher following 4 straight days of losses on Wall Street. A sell-off in the world's largest tech companies led the way lower. Lisa Shallett is Chief Investment Officer at Morgan Stanley Wealth Management.
The earnings revision momentum, as we like to say, has slowed. And I think that that's one of the things that has catalyzed this profit-taking moment, is that people are saying, wait a minute, perhaps, some of the leaders of this market, the hyperscalers, are in fact, by dint of their aggressive spending, by dint of them now assuming some debt to finance that spending, maybe that earnings growth rate is going to slow.
Morgan Stanley Wealth Management's Lisa Shallett. Goldman Sachs President John Waldron says markets are primed for possible further declines. We caught up with Waldron at the Bloomberg New Economy Forum in Singapore.
I would say you're seeing in the markets right now a pullback, which I think is healthy. Markets have run quite a bit this year, U.S. equity markets in particular. Markets heavily focused on this AI dynamic. Are we going to get the returns on capital invested that the market expects and is priced in? It's a big debate.
Goldman Sachs President John Waldron says NVIDIA's earnings will be key for markets.
And Nathan, that NVIDIA earnings report comes out this afternoon. It's after the closing bell. Analysts expect the AI chip giant to show more than 50% growth in both net income and revenue in its fiscal third quarter. Michael Ball is Bloomberg News macro strategist.
We know what their customers are doing. We know what the supply chain is doing. We've got the other chip makers who are part of that ecosystem. So I think they will match or beat. It's very sensitive to any misstep. And so NVIDIA basically has no room for error. And, basically the market's pricing is 6-7% move that day, which is higher than its normal earning day move. So there's even greater sensitivity this turnaround.
And Bloomberg's Michael Ball notes that NVIDIA shares have dropped more than 12% since hitting a peak 4 weeks ago. Stay with Bloomberg with complete analysis of NVIDIA's after the bell earnings report. And then at 6:30 p.m. Wall Street time, we speak exclusively with NVIDIA CEO Jensen Huang here on Bloomberg Radio and Bloomberg Television. Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. LeBron James' record-breaking 23rd NBA season underway. He had been out with sciatica. In his season debut, played 30 minutes, scored 11 points, had 12 assists. The Lakers beat Utah. College basketball in New York, Michigan State beat Kentucky, Duke down Kansas. The College Football Playoff Committee now has Georgia as the 4th team and getting a bye. Alabama dropped after its loss last Saturday, but as of now, the Crimson Tide still in the playoffs. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out on the Markets podcast from Goldman Sachs. A breakdown of market moves and macro signals in 10 minutes or less. The Markets podcast from Goldman Sachs. Listen now.
Hello, I'm Caroline Hepker, introducing you to the new Stock Movers report from Bloomberg. There are so many big names in equities to keep track of, and our Stock Movers report is the best way to find out which individual names are making the biggest moves every day. Stock Movers consists of short audio reports, they're 5 minutes or less, delivered right to your podcast feed throughout the day. We'll bring you conversations on the day's biggest winners and losers in equity markets and explain the news and the data that's driving those gains and losses. Listen a couple of times throughout the day to find out what's moving equities and why. Just search for Stock Movers on Spotify, Apple Podcasts, or anywhere you listen. Get the latest stock news and data backed by reporting from Bloomberg's 3,000 journalists and analysts across the globe. Subscribe to Stock Movers wherever you get your podcasts.
है 6:30 होने वाला है, थोड़ा ध्यान रखना कैंडल का। नेचुरल गैस भी रेजिस्टेंस के पास ही है, इसको फिर से अपडेट कर देते हैं, एक सेकेंड। क्रूड ऑयल में एक ग्रीन कलर की कैंडल है ही नहीं वापस 4 पीएम के बाद 15 मिनट में इवन नॉट अ सिंगल ग्रीन कलर कैंडल एसएल चला गया इसमें, क्रूड ऑयल एसएल इज गॉन। इस वाले ट्रेड से निकल जाना, इसके नीचे का और सपोर्ट है वहां पर देखते हैं, कंटिन्यूसली फॉल आ रहा है, पता नहीं क्या न्यूज आ गई। अभी अभी पॉजिटिव था, अभी अभी ऑलमोस्ट 2.5% डाउन है। सो थोड़ा एक्यूमुलेट करे और यहाँ से वापस रिटर्न करे, ये भी सपोर्ट ही है। ठीक है, 6:30 हो गया है, 6:30 इज देयर, न्यूयॉर्क सेशन इज ओपन। ये सपोर्ट ही ब्रेक कर दिया, ये भी ठीक है, साथ सपोर्ट। ठीक है, ध्यान रखना है थोड़ा सा ये रीटेस्ट की तरह काम कर सकता है अब, ये जो सपोर्ट ब्रेक हुआ है। लेवल का ध्यान रखना, क्रूड में वो लेवल थोड़ा सा बड़ा है, ठीक है, ये लेवल ज़्यादा ही बड़ा है थोड़ा सा सपोर्ट के लिहाज से, क्वांटिटी का थोड़ा ध्यान ही रखिए, इतना नहीं है। बाकी बीच में ब्लैक कलर की लाइन ड्रॉ करिए, दैट इज़ अ रीटेस्ट जोन। नाउ सपोर्ट है वो ब्रेक हो गया है, ये वाला सपोर्ट, नाउ इट इज़ ब्रेक, सो इट एक्ट लाइक एज अ रेजिस्टेंस। कैंडल का ध्यान रखना, नेचुरल गैस में ओपन इक्वल टू लो कैंडल है, 6:30 की न्यूज़, 6:30 की मार्केट ओपनिंग कैंडल है, थोड़ा सा प्रेशर है अब बाइंग का, एग्जैक्टली ओपन इक्वल टू लो बनी है। लाइक क्रूड ऑयल ओपन इक्वल टू हाई, ओपन इक्वल टू हाई है कैंडल। वन आवर टाइम फ्रेम पे, 4 आवर टाइम फ्रेम पे, दोनों में ही वन ओपन इक्वल टू हाई कैंडल क्रूड की बिल्कुल ही गिरता आ रहा है लास्ट कैंडल। Supply fears reflected in middle distillate market.
LGT's investment solutions allow you to look to the future with confidence.
Let's all hide and run for the hills. Here is the issue. NVIDIA's gain. How often do we see this sort of perpetuate the idea that there is this real robust AI bet? At what point does it become emblematic of the pain elsewhere? The idea that Microsoft and Apple maybe not so much, but Amazon and Google are all racing to buy expensive chips that have a very quick depreciation schedule in order to just stay ahead of the next guy without necessarily an eye on what the ultimate goal really is.
Do you want a bullish forecast?
Please.
7,800 by year-end 2026. Mike Wilson of Morgan Stanley. Here's the quote. We're in the midst of a new bull market and earnings cycle, especially for many of the lagging areas of the index. Mike Wilson of Morgan Stanley looking for a big move over the next 12 months.
And overweighting small caps, seeing a rotation into some of the less loved areas. And one thing that he and other bulls that are coming out of Wall Street into 2026 are saying is it is helped by an accommodative Fed. This is the reason why it is so important to put this picture together and understand whether the Fed will have the justification to keep cutting rates, keep being accommodative in the face of the ongoing spending that we see not only from the consumer, but also from AI giants.
Stocks just about positive this morning, cut by 0.2% on the S&P. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock as stocks look to start the week on a firmer footing. Torsten Slock of Apollo on the case for a rebound in the economy, and the former White House trade advisor Kate Kalukowicz with the US saying all options are on the table for China trade talks. We begin this hour with stocks little changed as traders gear up for a key week of earnings and the return of longer-weighted economic data. Russ Kostrick of BlackRock writing, we remain long stocks into year-end. While valuations in parts of the market are stretched, many of the mega-cap tech names are still attractive. Russ joins us now for more. Russ, welcome to the program. We often play this game. If you're looking for the retail earnings later this week, there's tons. Nvidia in the mix as well, a delayed payrolls report. If you had to pick one this morning, Russ, as the driving factor for this market, which one would you pick?
Good morning, Jonathan. If I had to pick one, I'd probably pick payrolls because we haven't had any in a while, and the market's going to fixate on it for understandable reasons. But I was listening to Anne-Marie in the lead up to the broadcast. I think she said something very profound, which is a close second is going to be the retail earnings. And the reason is there's a lot of anxiety about the consumer right now. Part of it is some of the comments from other retailers and restaurants. Part of it is just the absence of any data the last month or two. So I believe that we are going to see a lot of focus on the big box retailers. What are they saying about the health of the consumer?
So, Russ, the White House right now is telling you they want to make America more affordable. Should we take that bet? Should we put that bet on and bet on their success over the next 12 months? They're leaning to some of these names?
Well, I believe that they're serious in that effort. And clearly, some of the announcements over the weekend lean in that direction. But, there are another couple things here also that are worth keeping in mind. The most important of which is we have seen prices remain sticky. Part of that is on the tariff side. We can say that because we know it's coming from the goods. Many of those increases are going to begin to fall out as we get into Q2 of next year. In addition, if you look at other components of the CPI, you look at some of the service areas, you look at housing, they are starting to come down. So the notion that inflation is just permanently stuck at 3%, I don't think that's right either. I do think that we are going to begin to see prices come down, the CPI come down as we get into Q2. And also, and this is a big debate, and it's also a longer-term issue, there is an argument, which I think is right, that AI is ultimately deflationary. And as we start to see more of an impact on corporations, on productivity, on efficiency, that's also going to help bring prices down, keep inflation below where it might have been.
Russ, let's say that the retailers come out with earnings that are pretty good, and they talk about a consumer that's strong, that's able to go out there and keep spending, although perhaps more choicefully or more limitedly is a more accurate way of putting it. And let's say that the jobs report comes out not showing that much distress. Can the Fed still cut rates?
Well, that's, I think, a great question. And this is why you might even get a weak payroll number. And depending upon how weak it is, the market may actually react positively. But I do think, the Fed has made it very clear. The December cut is now more in question. I do think the payroll number is going to be critical. But we know from the consumer side is that we do have a bifurcated consumer. There's definitely pockets of weakness. We've known that for some time. Part of that is a lagged effect of rate hikes a few years ago. Lower income consumers are struggling more. The flip side of that is you've got an older affluent consumer that has benefited from stock market gains. They've benefited from generally higher rates over the last couple of years because it's meant more income on their cash, and they're still spending. We are seeing that in travel and many parts of the economy where spending is holding up remarkably well.
So I guess that what I'm struggling with is if the Fed doesn't cut rates, doesn't have the accommodative backdrop that so many people are expecting, can you still be bullish on stocks? Or is the bullishness on stocks predicated on the idea that the Federal Reserve is going to focus on the bifurcated economy and then the lower tier of that economy and not worry about a bubble, not worry about inflated equity valuations, and just say, that's not our job?
I think it's a good question. There are three pillars in my mind to why stocks can go higher. One is the Fed, and as you rightly point out, if they don't cut, okay, that calls that a little bit into question. But there are two others that we're pretty confident about. One is the economy is in good shape. Now, obviously, the labor market is a bit soft. We don't know exactly how much, but it has softened. But the reality is, if you look at growth expectations, it's not crazy that you're going to see some acceleration in the beginning of 26 on stronger CapEx, on a very likely powerful refund season. So that's one positive. The second are earnings. And obviously, we continue to see that march higher. And a lot of that is driven by tech. Now, there are legitimate questions about valuations. There are legitimate questions about CapEx. But if you look at why tech has continued to lead, you don't have to look much further than the earnings we've seen in Q and Q3 and probably in Q4. That probably it continues into 2026, regardless of what the Fed did. Again, these companies, their earnings outlook is not really going to be driven or impacted that significantly by whether or not the Fed cuts a quarter point in December or they don't.
Ross, when it comes to tech, NVIDIA is going to be really important this week. An analysis of all the 13F filings, you see an even split amongst sentiment in terms of those that are bullish and taking some money off the table when it comes to NVIDIA. Why do you think that is, such an even split right now?
Well, I do think there are a lot of questions about the CapEx and the build-out. But the reality is the spending going to continue? Yes, we believe it will. So, you look at where we started the year. You're talking about maybe around $350 billion by the four hyperscalers. That's gone up for 2025. Again, it's very likely to go up again in 2026. Now, you can debate, is it an arms race? We do think a lot of this is ultimately going to lead to gains in productivity, and we're going to continue to see a broadening out of that CapEx spend. It's not just about the chips. It really extends further into the economy, in construction, in HVAC, in the industrial side, in energy. So again, I think it's a mistake to only focus on one company.
So in that sense, the Treasury Secretary talked about this weekend, this idea of parallel prosperity, Main Street and Wall Street both doing well. Could AI be the gateway to that?
Yes, I think it can. I think when you consider both the build-out we're seeing, but also, again, the long-term implications for productivity. There are a lot of concerns right now about the labor market, and there are anecdotal stories about our companies hire fewer entry-level individuals, workers because of AI. Truth is, it's early days. We don't know yet. What we do know is that we are seeing increased adoption. We are seeing early signs of productivity, and that's something long-term that I think, as the Treasury Secretary alluded to, is a positive for the economy.
Hey, Russ, a lot of people hope you're right. It's good to catch up, sir. As always, Russ Kostrick there of BlackRock on financial markets worldwide and the tech theme in credit over the past few weeks. Some select convulsions starting to develop in the credit markets. Is that a fair way of characterizing things?
I think that's a beautiful way of characterizing things. Select convulsions. You can see those select convulsions in Oracle bonds. You can see the select convulsions in credit default swaps attached to some of these names. And you see those convulsions in people pushing back on certain corporate debt issuance that just seems a little bit too speculative. The glut of bonds that has been sold by big AI tech companies has just been astronomical over the past 3 months. This is the reason why people are getting very concerned.
We often talk about healthy pullbacks. I think a greater scrutiny of the foundations of some of these spending commitments is a healthy thing. And it's a healthy thing we're starting to see in credit markets. Just that subtle pushback, just to say, you know what, we've got some questions here. Let's see some answers.
Are we going to supply debt to a company that's earning nothing, that's supplying CoreWeave, that's a speculative rated company, to supply NVIDIA and OpenAI with services that they don't have to supply themselves. It raises this question of the circularity, but also what the outlook is for how much energy use, data center usage, and what the paradigm is going to be in 5 years at a time where people can't see 2 feet in front of their face when it comes to AI.
NVIDIA's got to carry a lot of weight later this week when we get those earnings. Look out for that on Wednesday. Equity futures on the S&P 500 this morning, positive by 0.2%, with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump said House Republicans should vote to require the Justice Department to release its files on Jeffrey Epstein, reversing a previous position he had. Trump has been under increasing pressure from some within his party to release the investigative materials on the convicted sex offender. The House is scheduled to vote on it tomorrow. Meanwhile, tensions are ramping up between China and Japan. China's state media warning Beijing is prepared for economic retaliation for Japanese Prime Minister Sanae Takaichi's comments on Taiwan. This after Takaichi said a Chinese attack on Taiwan could trigger a Japanese military response. And U.S. airlines are resuming normal operations this morning after more than a week of government-mandated flight reductions. The FAA announcing it is lifting cuts across 40 major airports. The agency said staffing levels have continued to snap back since the shutdown ended last week. That's your Bloomberg brief, John.
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, taking game at Russia.
They're passing legislation, or the Republicans are putting in legislation that very tough. So any country that does business with Russia will be very severely sanctioned.
That conversation up next with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Payrolls Thursday just around the corner. Your estimates look like this. We're looking for 50K on Thursday. That's your median estimate. The range is pretty wide. The high is 75. Thank you, Deutsche Bank. The low is 40. And the estimates will keep pouring in going into that number.
And what do we do with them? We're not going to necessarily have an unemployment rate. We're going to have to wait for the real income levels when we look at Friday's data. That's when the inflation-adjusted real wage is going to come out. So what do you do with this? It's backward looking. It's messy. It's something that a lot of people are going to question. There isn't a reference point. It's already been messy. You know, pick your narrative.
Let's go with Neil Kashkari, Minneapolis Fed president, who came out recently and said that he didn't like the rate cut that was delivered at last month's meeting. And one of the reasons he didn't like it is that he was seeing signs of spending pick up again after the summer. Is that validated in the jobs number for the month of September? I know it's backward looking, but it's all we've got. And I just wonder if it validates some of the hawks out there going into the December meeting.
This is the reason why I think a big upside surprise could be the most negative for markets, because it would really edify this idea that there's a lot of pent-up strength that people are underestimating in the underlying jobs economy.
Equity futures on the S&P into all of that, just about positive by 0.3 on the S&P, on the Nasdaq up by 0.5, on the Russell so far this morning, up 0.1%. Under Savannah's this morning, taking game at Russia.
They're passing legislation, or the Republicans are putting in legislation that very tough. It's sanctioning, et cetera, on any country doing business with Russia. They may add Iran to that, as you know. I suggested it. So any country that does business with Russia will be very severely sanctioned. We may add Iran to the formula.
So here's the latest this morning. President Trump ramping up the pressure on Russia as he backs a proposed bill to sanction countries doing business with the country. Bloomberg's Mika Solner joins us now for more. So, Mika, I can think of some pretty big economies doing business with Russia still, and it includes the Europeans. Mika, who does this include?
Yeah, absolutely. I mean, this is a huge shift from President Trump when it comes to his posture on Russia, but this is going to include a number of countries, and particularly U.S. adversaries as well. So countries like China and India, and as the president just mentioned before, he wants to add Iran to it. So this is a key part of the president really trying to shape his foreign policy legacy here as well.
Do we know if there's going to be some runway provided to these countries to actually de-escalate, de-emphasize their relationship with Russia?
Yeah, I mean, I think that there's a lot of details that are still being worked out. This has been a long time push by Senate Republicans and Senate Democrats, I might add, on the Hill, who've had this bill and have been advocating for it. But I think that, this is largely indicative of the president's frustration with Vladimir Putin for him to try and escalate tactics like this on the global economy. So we're going to have to see, what happens here.
Mika Solna of Bloomberg down in Washington, D.C. We've heard this. It's been building for a while. The push against Russia, the push against countries, economies doing business with them, notably China, India. Who else does this apply to?
Well, I think really it's about China and India, because this is going to really force China to either have to go around some of the sanctions or deal the blow from the United States at the same time that the Treasury Secretary over the weekend talked about the fact that they don't have the final agreement in ink, fully in place, and they expect that to happen by Thanksgiving. Is this now another point of leverage Washington is trying to use?
Joining us now is Terry Haynes of Pangea Policy. Terry, welcome to the programme. What is the president's big effort around Russia all about, and will he actually follow through?
Good morning, all. I'm on Team Anne-Marie this morning to pick up on that point about leverage. This is about a lot of things, but one thing it is exactly about that. What you can read between the lines from Secretary Bessent yesterday in a long interview is that the supposed current deal that's happening between the United States and China is now taking a lot longer to paper than was widely thought, even that Bessent had said. So it's about that. It's about pushing India, I think, on getting a trade deal done. Secondly, thirdly, I think it's about pushing the Europeans on getting serious on Russia as well. The president has long said that the United States policy only works well if the Europeans are willing to pull equal weight here, and Europeans have been tap dancing on core questions around Russia and frozen Russian assets for years, literally. And either they're going to get serious or the Ukraine thing is going to drag on for even longer.
Terry, the administration is going to use this leverage as part of the destination. But when we get to the final destination, do you think Congress will end up passing this bill?
I think they can. Sure, the willingness exists. The votes exist. This is a lot more up to what the president wants to do in terms of how he wants to use that particular pressure point. One thing I saw in Trump's impromptu remarks there, frankly, was an ability to take the thing off and put it back, take the thing off the back burner and put it on the front burner. Russia may dismiss that, but I think they probably dismiss that at their peril, considering that the president has the ability, thanks to Congress, to actually get this thing done if he chooses.
The Treasury Secretary seems to be throwing cold water on a Wall Street Journal report that says China is trying to ratchet back rare earth minerals that go to companies that help the U.S. military. Do you think China will amend that, or is this something that they're going to stick with?
I think the track record here is that China has been, I think Bessent referred to April 6th in that interview as being the date in which the hijinks started on rare earths. I think they've been doing this for 6 or 7 months. I think the base case has to be that they'll continue to do it. So what from a market's perspective, you have to take that into account. You also have to take into account that the United States is going to continue to redouble every effort it can to get rare earths and start rare earths that are not of Chinese origin.
Terry, how much of a conflict is there between trying to get leverage in some of these trade talks and trying to get cost of living gains for the United States and for average consumers, given the fact that seems to be a renewed push by the president? Is there a conflict here?
I think there's an order of precedence here, and the order of precedence from the administration's point of view is that they need to get the trade deals done as many and as much as possible, and move forward from there. And they will they tend to put their stake out kind of far and in a pure sense and work back and cut back as they need to. And I think that's a lot of what you saw with the foodstuffs tariffs last weekend or last week. Besant talked about this as being mostly a matter of existing trade deals coming or new trade deals coming into force. I don't think that's quite the case. It's part of the case. But what they'll continue to do is continue to work on the trade deals with the idea that they can calibrate them pretty much in real time as they need to.
Terry, just to circle back, full circle to the beginning of the conversation, how much can this administration go really hard on China with sanctions on oil if it raises gasoline prices in the United States at a time where there's a real cost of living focus?
I think the priority for the administration, there's a balance here, but the priority for the administration is going to be making sure that China understands that it will use the leverage of it that the United States has, and that's certainly a big part of it. I think the president cares a lot about gasoline prices, but one reason why he talks up so much the price of gasoline coming down, frankly, I think is he wants to buy himself some wiggle room with the public to make sure that if he ends up having to drop a dime on China on oil, that people understand the what's and whys.
Terry, it's good to hear from you. Thank you, sir. Terry Haynes of Pangea Policy on the latest in Washington. One of the top stories in Washington, if you're tracking the Epstein story, many of you are. The president posting this on social media over the weekend, that House Republicans should vote to release the Epstein files because we have nothing to hide. And it's time to move on.
So this is a reversal from what the administration was trying to do, which was get Republicans to strike this down and not vote for it. I think the administration realizes that this was going to go through anyway. So you might as well say, I don't care, let it come out, because pushing it was not working regardless. So now at least take the high ground and then deal with the fallout after.
The president going on to say the House Oversight Committee can have whatever they are legally entitled to. I don't care. The word to the president over the weekend. Coming up on the programme, we'll catch up with Torsten Slock of Apollo on the case for a re-acceleration in the US economy. Plus, Danny has your morning movers. A big move on Alphabet today. The stock is up by almost 5%, leading the Mag 7 higher on a bigger stake from Berkshire Hathaway. That stock is up by 4.8% in the pre-market. Equity futures doing okay. Futures up by 1/3 following a very, very volatile week on Wall Street. The epicenter of that, big cap tech. From New York City, this is Bloomberg.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Not enough volatility to stop these equity market bulls. Mike Wilson of Morgan Stanley looking for 7,800 year-end 2026. Max Kettner of HSBC publishing earlier on this morning. We think the probability of a melt up into year-end, particularly in equities, is much greater now. Max Kettner of HSBC.
Yeah, just joining the fray, talking about how maybe you should be worried. No, just kidding. You absolutely shouldn't, because ultimately the earnings are going to be there. Lots of recent pushback on our continued constructive view are around potential canaries in the coal mine. Instead, the belt up really is what keeps on burning the bears and what will keep going.
Last week did not feel like a week of gains, but we squeezed out a week of gains on the S&P 500. Up again this morning, up by 0.25% on the S&P. On the Nasdaq 100, higher by 0.4. In the bond market, the 2-year kind of anchored around 350, 360, still in that range, 359.55, and a major debate developing at the Federal Reserve. On the FOMC, the chorus, the hawkish chorus, is growing louder and louder into payrolls on Thursday.
So on Friday, Dallas Fed President Lori Logan said, I think it would be hard to support another rate cut unless we were to get convincing evidence from the data. What is convincing evidence, especially without an inflation report, because it's unlikely we're going to get CPI, and we're not going to get a lot of key metrics around some of the data that does get released. So again, what is the reaction function from a Federal Reserve that's operating in the dark?
What is a good number? 50K is the median estimate on Thursday. Is that a good number? 50K is the median, the high 75, the low is 40. Payrolls Thursday is just around the corner. Trying to get used to that one. As we count you down to the opening bell, about 3 hours away, let's get you some morning movers with Danny for more. Here's Danny Berger. Hey, Danny.
Hey, John. Good morning. The good number for Alphabet is $4.9 billion. It's the amount of the stake that Berkshire Hathaway has built in Google's parent company Alphabet. Reported filings at the end of Friday. That's giving a boost to Alphabet shares. 4.8% is where we're trading in the pre-market. For what it's worth, Berkshire Hathaway also trimmed its Apple and its Bank of America holdings. Elsewhere, we got some earnings from the Chinese EV maker XPeng. They are listed here in the U.S. They had a disappointing outlook and a disappointing set of scores. The issue for them is that they had promised profitability, or at least their goal was for profitability next year. That throws them into question. Shares declined 3%. This company has also been spending a lot, much like Tesla, in trying to become an autonomous company and build things like humanoid robots. Finally, a little bit of sell-side action. Morgan Stanley out with a note on some hardware makers. It gives a double downgrade to Dell to underweight, to HPE. It's a downgrade just to neutral, saying that some of the memory chip super cycle, if there's downside risk there, and that has bad implications for the hardware providers like Dell, like HP. John.
Hey, Danny, thank you. Appreciate the update. More from Danny in about 60 minutes from now. On a radar this morning, President Donald Trump backing a Senate-proposed bill that would slap Russian trading partners with severe sanctions. The bill would hit countries that buy Russian energy like China, India and potentially Iran with 500% tariffs. Elsewhere, the US Trade Representative Jameson Greer heading to Europe this week after calling out EU trade practices. Greer pointed to European regulations and barriers impacting US exports into the continent despite the trade deal reach earlier this year. And finally, the Treasury Secretary Scott Bessent saying President Trump's $2,000 tariff dividend payment to US citizens would need congressional approval. One estimate saying the plan could potentially cost the US double what it's projected to take in for all of 2025.
So Treasury Secretary Bessent has been trying to thread a needle with respect to the $2,000 checks for quite a while. He's been talking about initially maybe we could just use some of the money that we've gotten in that people are going to be getting as tax rebates for the $2,000. That didn't work. So now he's talking about, well, maybe we can't do this unilaterally. And it goes to sort of the deep anxiety. How do you maintain a budget, balanced budget kind of policy while also providing fiscal stimulus? And this is going to be a conundrum right now for the administration.
Not only do we need Congress in order to do this, you also need to make sure the Supreme Court doesn't strike down your IEEPA tariffs in order to have those tens of billions of dollars you brought in from the tariffs to then redistribute them to Americans. That's the first thing that needs to happen. The second thing, it's very interesting hearing this administration talking about checks when for months, all I heard during covering the Biden administration, when inflation was sky high, that it was goosed by the Biden administration because they sent out checks during COVID. So if you're sitting at the Federal Reserve, you have to be concerned looking at this, that this might just impact inflation.
There is a bigger and bigger effort to make this too big to strike down at the Supreme Court. And the Treasury Secretary offered a curious legal argument that I'd love to hear from lawyers about over the weekend, that it's very difficult to strike down a signature policy of a sitting president. I'm not sure how that's going to stand up in a Supreme Court later on this year.
Having studied constitutional law, I'm not sure that a signature agenda by a president has legal clout for the Supreme Court or in the Constitution. That said, it does highlight how perilous it is for the Supreme Court to weigh wholeheartedly and undermine this particular policy because they will be accused of politics. And this will really make it difficult for them to do this in any kind of comprehensive way without also laying out exactly how any kind of remediation would take place, right? How do they do that while still remaining credible?
The other thing the Treasury Secretary said is he doesn't think the Supreme Court wants to wade in the mess that this would become if they have to start distributing funds back to businesses. But remember, even if IEEPA is struck down, they will find a way to enact tariffs, but it is going to push the timeline well into 2026, and that is going to come ahead of key midterm elections.
The economy very much in focus. Investors awaiting the delayed September jobs report due out on Thursday. Torsten Slok of Apollo making the case for a rebound in the economy, writing Liberation Day was almost 8 months ago. Fiscal and monetary policy are easy, and easy financial conditions point to a re-acceleration. Torsten joins us now for more. Torsten, welcome back, sir. Are you expecting to see some of that in the September jobs data, or is that too early?
That is too early, because the risk, of course, is that in October we had the government shutdown. And, of course, the chance is that there therefore might be some weaker data for the month of potentially November also once we do get that. But I do expect that once we look into next year, we have still relatively easy financial conditions with, of course, the stock markets. Been some wobbles more recently, but still very supportive. IG spreads, high yield spreads, loan spreads, very supportive. You also at the same time have tailwinds because Liberation Day is now 8 months ago. And finally, we also have general tailwinds because we are going into an election year. And therefore, if we do get the $2,000 stimulus checks that you just talked about, that will certainly also be helpful. So in total, I do think that the market is too negative on the economic outlook and the risks are actually rising, that we may have some reacceleration once we get into 2026.
Torsten, is that a reacceleration that comes with jobs growth or not?
I do think that it will come with job growth. It is actually very impressive when we think about it, that over the last 8 months, think about what we've been through, the shocks that the U.S. economy has been facing, not only when it comes to, of course, trade war, also the shocks coming from immigration. And as you just mentioned, Jonathan, the non-farm payroll equilibrium is now down at 50,000. According to the Dallas Fed, it's as low as 30,000. So therefore, the bar has been lowered. And therefore, I do think that if we get numbers that are in that range, then we should look at that and say, this is exactly where we should be. So in that sense, I do think that the economy has been remarkably resilient for the last 8 months. And I do think that as the trade war gets more and more behind us, I do think that a lot of the fog will be lifting.
Torsten, to Anne-Marie's point earlier, how important are the retail earnings this week? The Walmarts, the Targets, the Lowe's?
They are very important, and they do fit into the broader conversation about the K-shaped recovery. So it is still the case that higher income households continue to benefit from asset prices having been higher. And of course, also very importantly, because the level of yields is higher, that means that not only are high income households benefiting from asset prices going up, but they're also benefiting from the cash flow they get in fixed income is at the highest level in decades, both when it comes to public credit, but also private credit. So therefore, the tailwind to high income households continues to be strong. Lower income households have been suffering from interest rates going up. They have also been suffering from wage growth being weaker than what you see for high income households. But broadly speaking, again, with job growth still steady and stable, and again, the trade war uncertainty more and more behind us, and especially now, think about the one big beautiful bill. The CBO is estimating that will lift GDP growth next year by 0.9%. That's a very significant tailwind from fiscal policy. So all those things combined argue for the economy beginning to look better as we get into 2026.
And Torsten, conceivably, this could argue for the Fed not to cut rates and explains why there has been a more hawkish tilt to some of the communication that we've gotten from Fed officials recently. What do you think the consequences would be if the Fed cuts by another 50 to 75 basis points by mid-year next year?
Oh, that would be very serious because think about it. We already have an outlook. If I type ECFC Go on my Bloomberg screen and look at the quarterly profile, it is already the case that the consensus expects inflation to be 3% for the next 18 months, while at the same time growth is slowing down. So to your point here, Lisa, if we now see that growth is actually not slowing down and we already have inflation at 3% in a slowdown scenario, the risk is, of course, that inflation could be even higher than 3%. So cutting into that would, of course, be a major mistake. So I do think that the risks are rising, that we are again underestimating that inflation has a lot more tailwind over the next several quarters.
With that as a potential backdrop, what would it mean then if the government gave everyone $2,000?
Oh, that, of course, would provide even more fuel here to the economy. So if we already have the one big beautiful bill lifting GDP by almost a full percentage point, we have trade war uncertainty beginning to be more behind us. If we still have stock prices, we are discussing the AI bubble, all of us, very intensely at the moment. But given that there's still tailwind in the stock market that's supporting, of course, high-end consumer households in particular, all those things combined, they definitely argue that if you send out $2,000 checks, then you just run the risk that you will overheat the economy even more.
Torsten, then we're introducing a new Fed chair on top of all of this as well in May of next year. And I just wonder, Torsten, how difficult it is right now to offer any kind of outlook on Fed policy for next year, including that second half of next year, which includes that new Fed chair.
That's right, Jonathan, and that's exactly why I think that the FOMC members are really coming out with quite strong voices at the moment. Lori Logan, first of all, saying that she did vote for the cut, and then subsequently saying, well, I didn't really want a cut. And now also on Friday, it really begins to emphasize more that, well, we still need to get inflation under control. And whereas you have, of course, other FOMC members, Steve Moran in particular, of course, saying that we should be cutting sooner rather than later, the dots are really moving in very opposite directions here, and it's becoming much more outspoken from the FOMC members what exactly that their views are, because this debate, to your point, Jonathan, is really still very, very early, in particular when you have these very strong opinions about what are the tailwinds and what are the headwinds at the moment.
Torsten, do you think this is a new era for the Federal Reserve, where we're going to see greater dispersion, at least publicly, from policymaker to policymaker? And ultimately, what do you think the consequences are for financial markets?
I think it is a new era because we do get, by definition, of course, a new Fed chair in May of next year, because that's when Jay Powell has to step down. And then we will, of course, figure out if that Fed chair, of course, is going to take the same view as Steve Miran, or if that Fed chair is going to have the view of Laurie Logan. And if the risk is, of course, that Fed chair comes in and then begins to say, well, interest rates could begin to go down because maybe the economy can handle lower rates, then, of course, the fear could be that inflation is going to be higher. So the debate, exactly to your point, Jonathan, here around what should we put weight on, especially on the dual mandate? Should we put weight on inflation still being at 3%? Should we put weight on Challenger Gray and Christmas, showing that there are maybe a bit more announced job cuts? I mean, this is still a very, very important debate, and we will not know the answers to this before we get into January. Remember also the non-farm payroll numbers for November are normally collected in the month, the week of the 12th. And in the month of November, the week of the 12th was last week. So that means that we get closer to Thanksgiving. That means that even there may be some distortions on the data for November. Yeah. So that means that we may get all the way into next year before we really have a better handle at how strong is the U.S. labor market. So that's why we still have a fairly foggy situation for the next several months.
This will be fun, Torsten. That's for sure. Torsten Slok there of Apollo. Torsten, thank you. Appreciate it. Looking at not just next month, but of course next year as well. I think it's fair to say for most investors, for most economists, they assume the incoming Fed chair is going to be very close to Governor Myron and maybe less close to some of the hawks out there on the FOMC.
Which is the reason why a 50 to 75 basis point in additional rate cuts almost is baked into the market valuation expectations for next year. When you look at some of the forward-looking expectations, they almost all talk about accommodative conditions and that sort of code for Fed rate cuts. I just wonder, are we looking at a Fed with a new mandate? Are we looking at a very different Fed that is transforming akin to a 1977 style kind of transformation?
Well, they certainly weren't given a new mandate. Were they?
Well, they might be emphasizing other parts of the charter coming back from 1977. Just saying.
Just looking through hot inflation repeatedly, apparently. Equity futures on the S&P this morning higher by about 1/3%. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. Thousands took to the streets of Mexico City in protests of President Claudia Sheinbaum's administration and the slowing economy. The protests turned violent, causing the police to step in and regain control of the area. Mexico City's chief of police said that 20 people were arrested and 100 officers were injured. Meanwhile, former Fed Governor Adriana Kugler was found to have violated ethics rules and was subject to an internal probe when she stepped down back in August. Documents released over the weekend showed that Kugler repeatedly broke rules over securities trading by purchasing and selling shares of stocks like Apple, Southwest Airlines, and Kava. And Jeff Bezos is back in the entrepreneurial seat. The Amazon founder has created an AI startup called Project Prometheus, which focuses on the engineering and manufacturing of computers, cars, and spacecrafts. Bezos will help manage the company as its co-CEO. This is Jeff Bezos' first formal role in a company since leaving Amazon back in 2021. Can't just retire, right? That's Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. More from Yahira in the next hour. Up next on the program, progress between the US and China.
I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreement. We haven't even finished the agreement, which we hope to have done by Thanksgiving.
Up next, we'll catch up with the former White House trade advisor, Kate Kalukowicz, live from New York City. You're watching Bloomberg TV.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
There's been a shift down in Washington, D.C. around affordability. There's been a shift within this White House. Think about the policies that have emerged in the last week or so. Tariff relief, beef, coffee. We're talking about $2,000 checks. And on top of all of that, attempting to open up the mortgage market as well. Sort of a three-pronged effort over the last week, and I expect there's more to come.
The midterm elections were a game changer with respect to this administration's policies and a renewed focus. And the question for a lot of people in markets is, how much do you bake in extra fiscal stimulus in the first quarter of next year in response to this outcry from the population, clearly in the election results, showing a real focus on cost of living?
Treasury Secretary said over the weekend, we are not going to tell people how they should feel. They think that the Biden administration told people that this is just a vibe session. Prices are not higher. The problem is, that's what the Treasury Secretary is saying. Last night on the tarmac, the president came out and said, go to Walmart. Your Thanksgiving dinner is 25% cheaper. Now, maybe certain Thanksgiving items are cheaper this year, but the fact of the matter is, everyday items for kitchen tables of American families are higher. Bananas, beef, coffee. And this is why they're lowering the tariffs on some of these goods.
The Treasury Secretary learned the right lesson from the Biden administration. Don't gaslight the public. If the American public tell you they don't feel good right now about the U.S. economy, they don't feel good right now about the U.S. economy. You've got to do something about it. The problem that I think economists would have right now, the amount of credibility economists have left, I don't know, but the problem they've got right now is that some of the policies on the table down in Washington, D.C. have the potential to make the situation worse, to put up prices, not bring them down. The
issue has to be a supply-side response, which maybe is relieving some of the tariff barriers and getting more imports at the same time. That really undermines some of the trade agenda, which goes to the heart of what the president has been trying to do. Ultimately, there has to be a good look about how you can generate some sort of stimulus for lower-income individuals without causing the kind of inflation that we saw a couple of years ago.
Equities this morning doing better. We're higher by about 0.25% on the S&P. On the Nasdaq 100, higher by 0.4%. Trade very much in focus. Under surveillance this morning, progress between the U.S. and China.
I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreement. The magnets will flow freely as they did before April 4th. We are going to set up a dashboard of very quantitative metrics that they are going to have to meet. We haven't even finished the agreement, which we hope to have done by Thanksgiving.
So here's the latest this morning. The White House expecting a deal between the U.S. and China will be finalized soon. The Treasury Secretary, Scott Bessent, signaling both countries are still negotiating details over rare earths. Joining us now to discuss is your former White House trade advisor, Kate Kalukowicz. Kate, welcome back to the program. I just want to build on what we were discussing around the table just moments ago. $2,000 checks, tariff relief, attempting to do something about affordability in this country. Kate, how important is that developing backdrop for these negotiations with China?
Well, they're very important for the president's trade agenda. I mean, I think we saw over the weekend a number of new trade deals announced in addition to the progress they keep trying to push on China. All of these deals, these winnings for the president are important in the message that he's delivering to the American people that just stick with me. We're going to remake the trade agenda that will be better for the United States. We just have to weather these bumps. This has been the message all along. Of course, I think his team realized that, tariffs were increasing costs on regular goods for everyday consumers, and particularly on things we can't produce in the United States. And so this easing, I think, is a recognition that perhaps some of the tariffs are not in our interest long term, and it's an indication that he's willing to consider that.
Kate, what do you think is left to really understand between Washington and Beijing in order to ink this agreement?
Well, Anne-Marie, I think we just continue to return to this status quo problem because China and the United States keep failing to get leverage over one another. We have this discussion about rare earths, it seems, every time that the two sides get together, indicate progress. We have progress. The progress gets challenged by some sort of licensing regime, and we end up in the same place. I think we can all be hopeful that this is the real deal this time, but I continue to be a bit discouraged by every time the Treasury Secretary or Trump officials signal that they're not quite there. I think that's because neither side is fully prepared to give away the leverage it has yet.
Could the U.S. sign an agreement with China restricting rare earths to some companies that have ties to the U.S. military?
Well, I suppose anything's on the table. China controls these rare earth metals, which are so critical to the U.S. economy, from military to more traditional sectors like autos. China has kept a stranglehold on these and restricted who gets them through a pretty complicated licensing regime. What the U.S. would like is for China to get rid of that licensing regime altogether, of course. But I suspect in the midterm, there is a potential for some sort of let's say, situation where certain companies are given priority over others.
Kate, do you have a sense of how quickly the administration is moving to solidify trade deals with strategically important countries that have some of the resources that the U.S. would need to be more independent from China?
Yes, I think that is absolutely a priority for the Trump administration because, of course, to change the dynamic with China, they are going to have to change this dynamic on critical minerals. Of course, before the president traveled to Asia, we had a very huge deal with Australia around some licensing and critical minerals deals in Australia. Last week, the president's administration, he announced a number of trade deals, including with Argentina, which will be another very key ally when it comes to accessing these critical minerals we don't have in the United States.
Hey, Kate, good to hear from you. Thanks for being here. Kate Kalukowicz there, the former White House trade advisor, weighing in on the trade situation. Here's a name in focus, Alibaba. This from the Financial Times over the weekend. A White House national security memo claiming that Alibaba Group provided the Chinese military with technology support against targets in the United States. That's a report worth taking a look at.
How much is this actually something that they found that really does highlight the potential connection between Alibaba and the military, which honestly, how surprising would it be given the fact that there clearly are national champions in China that have pretty intimate relationships with different companies? At the same time, how much is this additional leverage to try to get a sense of just how much the U.S. is willing to crack down on some Chinese companies?
What's interesting, too, is that the administration potentially could then use something that would be more of a nuclear option when it comes to Beijing, and any of these Chinese companies that need access to the U.S. capital markets, potentially they will not be able to list anymore in the United States.
That's the next step. That's how this escalates. Not saying it will escalate, but that's how it could escalate. You cut off access for U.S. investors to invest in some of these companies. If you go there, that's a massive problem because these companies are absolutely humongous.
Yeah, and a lot of people want to invest in them because they want to invest in both the Chinese tech story as well as the U.S. tech story because they seem to be developing a bit more in parallel right now.
We've got a lot to get through this week. If you're just tuning in, welcome to the program. Stocks are positive by a third of 1%. Big week of earnings coming up, including numbers from NVIDIA. We'll catch up with Sarah Hunt of Alpine Saxon Woods, Henrietta Trey's of Vader Partners, Airbus executive Christian Schreier, plus Stephen Parker of JP Morgan Private Bank. The second hour of Bloomberg Surveillance up next.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
It is hard for me to see an economy that is not continuing to move forward in a world where the consumer is still so engaged.
The consumer spending numbers and the credit card data numbers have still been robust.
There's just this creeping level of inflation.
We do expect inflation to stay at least above what the Fed's target is anticipating.
There is enough evidence here for the Fed to continue to cut rates, at least one more time.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 adding some weight to last week's very painful rally. We're up 0.1% last week, believe it or not. We're up by 0.2 this morning. On the Nasdaq 100, up by 0.4. What a week we've got in store for you. Earnings from NVIDIA, some of the major retailers, Home Depot, Target, Walmart, plus a very, very delayed September payrolls report.
It's all cylinders that have been really driving this market. You have questions around the consumer, maybe some color from Target and Walmart and Home Depot that will give you a sense of what's going on there. Then when it comes to Fed rate cuts, you get, of course, the non-farm payrolls report, which is, of course, for September, not for October, let alone November. But we also do get some Fed speak when it comes through just all the speeches as well as the meeting minutes on Wednesday. And then, of course, you have NVIDIA. This question of how far the AI boom or bubble, depending on your perspective, can ultimately go.
I'm going to pick one. Let's run with chops. Here are the estimates right now. Median estimate 50K, the high 75, the lows 40. Torsten's Lock of Apollo on the programme about 30 minutes ago. Torsten making a case that 50's pretty decent. 50's better than good. 50 is enough to keep this Fed on hold.
That was actually something that one of the regional Fed banks talked about, the idea that because of the lack of immigration and the lack of population growth, you need a much lower break-even rate. What do we do with that number? We're not getting the unemployment rate. We're not going to get wages until the next day. And it raises this reaction function from the Federal Reserve. Are they focusing on the wrong metric at a time where they don't have a lot of other data, including the CPI?
Torsten making a case that we could see a reacceleration in early 2026. We asked the question, the obvious one, for the politicians out there right now. Please tell me that GDP growth comes with some jobs growth, because we've got a problem right now. That problem is affordability. And this White House has seen a shift develop, a real shift develop in the last week or so.
Absolutely. You can see that for how the president speaks, how his Treasury Secretary speaks. Scott Bessent over the weekend saying he is not going to do what he thought the Biden administration did, which was tell Americans how they are feeling right now. But what's the administration doing? They're thinking about $2,000 dividend checks when it comes to the tariff money coming in. That might actually increase inflation and become a problem. The other thing, notably, this administration did when they talk about their central policy being tariffs, they actually lowered the barrier when it comes to tariffs for certain products that consumers are saying are just too high. Coffee, bananas, beef. Omaha Steak CEO talking about $10 a pound for ground beef. That is going to be a problem heading into the midterm.
The good news for the Treasury Secretary is right now in the middle of November, 10-year bond yields are closer to 4 than they are to 5. Yields are down again today by 3 basis points, so let's call it 4.12. Everything we're talking about that the White House might be doing might be a case for high yields and not lower yields. And the Treasury Secretary has probably got the same idea, the same worry about what could develop if we start handing out checks for $2,000 here, there, and everywhere.
Which is the reason why you've seen Treasury Secretary Scott Bessent really kind of try to thread a needle, start talking about, oh, this is money that's already going back to people that didn't work, and then talking about, oh, yeah, guess what? This is actually going to need some congressional approval, so I can't do this single-handedly. This is clearly a difficult thing for him to swallow based on the balance sheet considerations as well as inflation.
Well, remember, the president comes out with sometimes unconventional, sometimes controversial, extreme ideas, and then it's the Treasury Secretary's job to go out there and soothe the market.
The market's been soothed. We're up about 0.1% so far on the S&P 500. Last week was crazy, so volatile, and squeezed out a weekly gain of 0.08% or something like that on the S&P 500. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Sachs & Woods as Wall Street looks to revive the equity market rally. Henrietta Trays of Vader Partners as the White House weighs tariff dividend checks, and Stephen Parker of JP Morgan as AI ignites a new era for investing. We begin this hour with stocks inching higher ahead of key earnings from NVIDIA. Sarah Hunt of Alpine Sachs & Woods writing earnings estimates still seem to be faring well. And absent any bad news from NVIDIA, markets could stay on track for a positive end to the year. Sarah joins us now for more. Sarah, good morning.
Good morning.
What are the lessons from the recent volatility, if there are any lessons at all?
I think that there was a whole lot of things that were going on that created some of that downdraft. And I think, there was an earlier question about what's the most important thing that's coming up this week. I think it's a question of timing. If the payrolls was coming before NVIDIA, I'd say payrolls. But because NVIDIA is coming first, that's going to set a tone. And either payrolls are going to help that or hurt that. And I think that, if you get any more downdraft in technology, it's going to be hard to rally through the end of the year because there is some concern there and there's some concerns about valuation.
We've been speaking for years about the K-shaped economy. This week's the K-shaped market. Consumers been struggling. You've seen that in some of the restaurant earnings. We're going to see it in the retailers potentially later this week. And then there's NVIDIA. Can we close that K anytime soon in the equity market? Never mind the economy.
It's a bit tough because people are, if the technology story stays on track, people stay away from some of the retail areas where you've seen weakness. If there's a wobble, then people start looking at staples. Like you saw that downdraft day, there was some of the stocks that were doing okay were the more value-oriented, more dividend-oriented, more like those kind of stocks did better. I think there's an argument to be made that going into next year with valuations where they are, there should definitely be a balance in the portfolio, and you should have some of that, because if you get volatility, that's going to act better than some of the technology. And I think the volatility is just going to stay and get moved around from data point to data point.
Is NVIDIA the last tech company to actually feel the pain if AI isn't delivering on some of the promise that people expect?
Well, it's interesting to see the number of people who are, going publicly talking about getting out of their NVIDIA stakes. And I'm not sure if that's one of those, we want to move on to the next thing, or we think that's the top for NVIDIA. I think NVIDIA is in a good spot in terms of being able to keep bringing money in because people still need these chips. There is, to your point earlier, also a big depreciation cycle on those chips. So there is a round robin. It's not like you buy it once and you don't have to buy them again. So I don't know that NVIDIA is going to be the problem there. I think the issue is going to be who's making money with those chips and how is that return coming? Because that is the big question into the next iteration of AI.
This is the reason why Oracle has been so interesting, why OpenAI has been so interesting, why the CDS spreads and how much they've been blowing out has been so interesting, because there is a question about whether the rank and file company in the average economy is seeing the monetization from some of the new AI tools that they've been getting and whether that's enough to justify the massive spending and investment. Is anything that you're seeing seeming to suggest that, yes, we are getting to a place where we will see massive sea change kinds of earnings from the rank and file companies that could lead to that broadening out and a justification for AI valuations?
I think the hard thing is that to believe that that is going to be the case in the near term, it has to be about, to some degree, productivity, which has to be about not having as many people on the payrolls. And that's not a great thing right now because we don't want to see that happen. I don't know that we are yet understanding exactly how those tools are going to play into a variety of things, including productivity and better earnings, except to get rid of people. And so I think that you need to see some work cases where it's very clear that this is less about getting rid of people and more about making them more productive. And I think that's still not quite clear enough from the investment side to say, oh, I can see this going into this industry and that industry and that industry. That's what people are hoping for. I don't know that we're there yet.
Lisa mentioned this earlier about how some Fed members are talking about the structural changes in the economy, like immigration, like these technology changes, which is why potentially there are shifts in the labor market. How does the Fed address that?
That's another question that having a whole bunch of 6 weeks of not having data does not help you at all, because that is trying to figure out what the right number is, to Torsten Slack's point, given all the things that are going on, is very difficult when you don't have enough data. You don't see weekly claims either, which also sort of informs you, even if it's not that week, the average of that starts to inform you. I think that's going to be one of the things that into 2026, if you need to see some earnings growth because that's what's being built in, but you also need to see a labor market that people feel comfortable with. And I think that we just don't have enough information right now. And that's where the timing of that data coming in versus other things starts to be an issue. And the faster we get some of it, the better off we are. But it's going to be about what's happening now. I don't know that September is that informative because people were looking at the ADP numbers for October.
Two pillars coming out this week in terms of Wall Street for NVIDIA earnings and then Main Street for when it comes to Walmart. Could Wall Street continue to do well if the consumer is really struggling?
It's managed to do it so far this year, and the consumer has been struggling for a while, especially on the lower end. I mean, you've seen some of that delinquencies on the lower end in auto loans, delinquencies on the lower end in credit cards, but not on the upper end. That upper end spend has really been able to carry things. Not so much for the retail sector, because as a whole, they need more than just the upper end, except the very high luxury stuff. So it depends on where that goes, and that's also where the labor market comes into play, because if you feel comfortable that you're keeping your job, it's easier to spend the money as it comes in. But if you don't, that's where people start to get a little bit more on the savings side.
Things are about to get really difficult for the American CEO. We've talked a lot about the difference between corporate earnings up there and employment down here. And the space between is where all the tension's going to play out. They've got to be very careful about how they talk about some of the progress and benefits they're getting from this technology. We've heard a lot of the banks talk about how they're going to keep the staff force, the workforce stable and get more revenue out of every single employee. I think they need someone, the head of Washington Affairs, alongside them whenever they talk about this issue, because the more you talk about greater productivity, greater technological advancements and fewer people, the greater the chance of the regulatory pushback developing down in Washington, D.C. And that would be a great shame, because what we've got in America, I think the secret sauce to this economy is fantastic labour market flexibility compared to, say, the Europeans. And I fear, it's my fear, I have this worry that we're just going down this path that just makes greater regulation almost inevitable if this is where corporate America wants to go. and you're going to see some regressive impact up front, some job losses early. Washington's going to push back. They're going to have no choice but to push back.
Which is the reason why every single CEO, you can listen to the earnings calls. Very few of them, except for Amazon, which really ballooned in terms of its staff recently, very few of them have actually said, we're going to cut jobs in response to AI. They say, oh, it's increasing productivity. Oh, potentially we could do more with just the same footprint.
Hours.
And you just wonder at what point that story will change or if the rhetoric is going to stay the same, but the numbers start to move.
Sarah, it's good to see you. Thanks for being here. Sarah Hunt there of Alpine, Saxon Woods, PR down in Washington. Imagine how much they're going to have to spend on that.
Yeah, you know, what they have to spend on it is trading programs because you can't fight a sea change. And that ultimately is what a lot of people are talking about. What's the strategy? There are plenty of jobs that are still required. And so you start to have to say, OK, do we need retraining? Do we need to focus people on different things? These are the questions that ought to take up more of the oxygen in D.C., frankly, and on Wall Street.
Unions have been fighting technological advancements for a long, long time. Talk to anyone down at a port in this country. Talk to the European train driver. We've had the technology to have driverless trains for a long, long time. You will get the labour force to push back and to stop certain companies and certain industries implementing this kind of technology. We've seen it before. Why won't we see it again?
The only difference I would say, and I don't know if this is optimism or pessimism, is the existential overlay to this. That if you do not keep up with this technology, there is this existential fear that you will become obsolete, that you will ultimately get overrun by China or by another power who gets better technology. So the only change in that narrative would be that there is this race, an almost arms race of technology going on that might supersede some of those impulses.
It's going to be the tug of war between the technology and the regulator over the next year and beyond. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Tensions are increasing between China and Japan. China's state media warning Beijing is prepared for economic retaliation for Japanese Prime Minister Sanae Takaichi's comments on Taiwan. This after Takaichi said a Chinese attack on Taiwan could trigger a Japanese military response. Meanwhile, Bitcoin has fallen sharply after topping 126,000 last month, briefly wiping out all of its 2025 gains before stabilizing earlier. Bitcoin's total market value fell by about $600 billion from an October high, with some traders citing the 4-year halving cycle, while others blaming global liquidity. And Apple is making big changes to its iPhone strategy. Sources telling us here at Bloomberg that the tech giant is developing a foldable model and a new high-end version with a hidden camera. Apple is also ending its traditional single fall product launch in favor of a new biannual schedule starting in 2026, releasing pro models in the fall and mid-tier models in the spring. That's your Bloomberg Brief, John.
Yahara, thank you. Appreciate it. Up next on the program, President Trump's tariff checks.
Is he going to be sending these direct payments to Americans of $2,000 or more?
We will see. We need legislation for that. And again, President Trump is all about solutions.
Lisa, you said this. This is the second consecutive weekend that the Treasury Secretaries had to dance around this over the weekend.
Oh, beautifully done, by the way. Really impressive.
So we need Congress for $2,000 checks, but they don't need Congress for IEPA. Interesting.
Up next, Henrietta Trace of Vader Partners, live from New York. Good morning.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Check out the week ahead. Retailers in America, look at this. Absolutely stacked, full of earnings throughout the whole week. Some of the highlights: Home Depot tomorrow, Wednesday Target, Thursday Walmart. The US consumer very much in focus, not just for Wall Street, but for Washington, D.C. and this White House.
Especially given how much they're focused on cost of living. Not only cost of living, but housing. You've got every story for politics in this earnings season that we have coming up when it comes to Home Depot and Lowe's, housing market flat on its back. Any kind of negative reaction from those earnings will just embolden some of the mortgage proposals that we're hearing from Washington, D.C. And then a question of how much consumers are able to absorb higher prices or whether they're really pushing back.
One thing, though, that is going to happen this week is an important meeting for the president. He's going to be meeting with the Crown Prince of Saudi Arabia, Mohammed bin Salman. And when the president is dealing with affordability, he can continue to tap into potentially lower gasoline prices. And there is one country in the world that still maintains this idea of a swing producer that could flood the market with barrels of oil if the president is in need.
Just getting a red headline across the Bloomberg terminal. I'm going to share this one with you. This one's interesting. This comes from the Financial Times. I'll read the lead paragraph of the story for you. The UBS chair, Colm Kelleher, and the U.S. Treasury Secretary, Scott Bessent, have privately discussed moving the bank's headquarters to the United States as the Zurich-based lender explores contingency plans to leave Switzerland if the government does not back down on new capital rules. That story just dropping from the Financial Times.
This seems like the nuclear option in the ongoing fight between UBS and the regulators in Switzerland. Just to give you a sense of what these proposed capital requirements look like, it would require UBS to hold an additional $26 billion of capital. In addition to what they already have, UBS has called this extreme and disproportionate and has been speculating that they could move elsewhere. How much is this a wonderful way to engender some sort of favorability in the United States at a time when that economy is doing very well and capital markets are robust, at the same time offering a threat to local regulators? It's kind of a perfect storm that makes a lot of sense right now.
This is to put pressure, and I just got back from Switzerland, and this is their crown jewel. This is to put pressure on the Swiss government to try to lessen some of these capital requirements so that UBS can operate in the United States and be competitive with the likes of JP Morgan, Bank of America, and all the other financial firms.
This is how you do it. That's exactly how you do it. That headline just crossed in moments ago. The UBS chair talked to Scott Bessent, the Treasury Secretary, about moving the Swiss bank to the United States. More on that in about 10 minutes' time. Under surveillance this morning, President Trump's tariff checks.
Is he going to be sending these direct payments to Americans of $2,000 or more?
We will see. We need legislation for that. And again, President Trump is all about solutions. And yes, everything is on the table. That would be for working families. We'll have an income limit. Those could go out.
So here's the latest this morning. The White House saying President Trump's plan for $2,000 tariff dividend payments will need congressional approval. The Committee for a Responsible Federal Budget estimating the proposal could cost $600 billion or double the expected annual tariff revenue. Bloomberg's Mika Salna joins us now for more. Mika, welcome back. Just how is this one going to work?
I think that the administration is beginning to realize that it's going to be very difficult to allow these dividends to occur unilaterally. So they're going to need congressional approval. Now, with that, it's going to be very, very tough sell for Democrats on the Hill and even fiscally conservative Republicans who have long been a thorn in Trump's side when it comes to trying to bring down the debt. When they see that sticker price of how much this could cost, that's going to be a huge issue for the president as well if they moves through Capitol Hill.
Mika, it sounds good, and obviously people like it. We all want our money back. We pay a lot of taxes. But Mika, is there a lesson from the Biden administration that sometimes there are some unintended consequences of doing things like this?
Yeah, absolutely. And I think that the White House is extremely focused right now on the affordability push, a term that they said that Democrats made and weaponized against them. But they're very cognizant of the cost of living impact that many Americans are facing right now, especially ahead of the holidays. I think that they're in a squeeze and really trying to message and say that, they're going to start feeling this relief as early as next year. But we're just going to have to see.
Mika Salna down in Washington, D.C. Thank you. Joining us now, Henrietta Trace of Veda Partners. Henrietta, that line from the Treasury Secretary, Scott Bessent, everything is on the table. Henrietta, what else is on the table?
I would recommend starting to take some of these tariffs off. That's really your first problem. It's the easiest way to get money back to the U.S. consumer. It eliminates some of these taxes that they've had to pay on. You've already seen it last week on coffee, on beef, on different agriculture products, bananas. Why not expand that? I think the Supreme Court's about to give them a really great opportunity to do that. We have 65% odds that SCOTUS is going to repeal the IEPA authority. Just let it stay lapsed. Boom, you got $1,800 back in the pockets of every household in America without the tariffs on.
Henrietta, when do you think we will get that Supreme Court decision? Because this may play into whether or not the administration continues to lower the tariffs on some agricultural and food goods.
Yeah, Anne-Marie, that timing is so critical, and I think will be impactful to determining whether or not the president re-ups the tariffs later on if the Supreme Court strikes down the AIPA authority. We're really optimistic that a mid-December time horizon is achievable from the Supreme Court. We take that guidance from watching the Court of International Trade and the Court of Appeals earlier this year take between 33 and 35 days to reach their conclusions that the tariffs were not permitted by the U.S. Constitution. So we're hopeful that after the oral arguments in early November, we'll get an answer from the Supreme Court in mid-December, but it's not a guarantee. They do not have to announce where they're going to land until the summer of 2026. So it could be a while, but we have fingers crossed it'll come in mid-December.
When it comes to $2,000 checks, and the Treasury Secretary is saying we need legislation for that, would Democrats sign up for that if it is for low-income individuals, as the president has highlighted in his social media posts?
It would have to be a really expansive bill in order to get Democrats on board. You have to add a lot of sweeteners just for that conference. So think extending the ACA subsidies, for example, which we just shut the government down for 43 days over. There would have to be a lot of sweeteners for the Democratic Party to get them to cross the aisle. And it's probably going to be mandatory because I think there's no way around authorizing a $2,000 tariff rebate check without tacitly acknowledging that you support the tariffs. And I'm trying to work through that with clients right now. But if you're going through the budget committee and you're trying to understand where the $600 billion in revenue, as CRFB estimated this weekend, is going to come from to provide those tax cuts, you're going to need to acknowledge where the revenue comes from. Let's not pretend that Republicans are deficit reduction advocates anymore. I mean, they just passed a $3.5 trillion deficit increasing bill and eliminated the current policy baseline. So I don't think the deficit is necessarily the problem, but the tacit acknowledgement that tariffs are okay and that they should continue to be collected is probably unavoidable in this bill in the budget committee level. And that's why potentially Jody Arrington announced he is going to retire. I don't see a path forward for the bill, mostly because you're not going to get those tariff votes.
Henrietta, we're talking about tariffs and cost of living measures coming from the administration because those are the most significant market-moving ramifications that could potentially be on the horizon. The headlines over the weekend were all about Jeffrey Epstein and the files that could be released. Are there any market implications for that, or are clients just sort of moving past that wholeheartedly?
I don't really talk about the Epstein stuff with clients. It's not our wheelhouse. I mean, as a macro analyst, but it's definitely in the ether. I would say the whole thing with Nick Fuentes and the president deciding to get around Tucker Carlson and the angles that they're going for there, they play a role because you always need a distraction and a deflection. And I think maybe the problem for the Republican conference is that Democrats are now associated with the concept of affordability. And when the top three issues are not Epstein and an island and, pedophilia or whatever, that's not what American voters are concerned about. They're concerned about affordability, the economy, inflation, prices, and that's what Democrats just won an election on by a pretty substantial margin, 12, 13 points in Virginia and New Jersey. That's your problem. So as long as you're talking about other stuff, you're not talking about affordability. And when you're offering ridiculous ideas like a 50-year mortgage, you don't have a message anyway on affordability. So it always is going to come back to these tariffs.
Henrietta, appreciate your take. Thanks for being here. Henrietta Trey's there, Aveda Partners. It keeps coming back to affordability. Credit to the Treasury Secretary, Scott Bessent. The fact is that at the moment, year to date, 10-year bond yields are down about 45 basis points. The Treasury Secretary's ability to manage the message, I think, has been a major contributor to some of the stability we've started to see in the Treasury market, which is why it keeps dancing around this issue of $2,000 checks. Up next, we'll catch up with the Airbus Commercial Aircraft CEO. That's just around the corner.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Stocks are doing okay, positive by 0.1% on the S&P 500. On the Nasdaq 100 this morning, positive by about 0.2 as we count you down to the opening bell. 2 hours away with your morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. Alphabet continues to be one of the big gainers in the pre-market this morning after, over the weekend, new filings from Berkshire Hathaway show that they took an additional stake in the company, now worth $4.9 billion. So that's up 4.3% for what it's worth. Berkshire Hathaway also trimmed its holdings in Apple and Bank of America. Elsewhere this morning, some earnings, quantum computing. There's NVIDIA. NVIDIA shares down 1.1%. There has been a little bit of negativity. Peter Thiel, for example, selling his stake in NVIDIA. So those shares down. Jeffrey Gundlach also throwing some cold water on the AI trade. Finally this morning, wrapping things up, we also had a little bit of take private news. Sealed Air, those shares falling 3.3% after it was confirmed after some Bloomberg reporting that CD&R will be taking the maker of Bubble Wrap private. I didn't realize Bubble Wrap was actually a brand name and not just generally what the packing thing is. Anyway, the price for Sealed Air from CD&R is just above $41. The shares had rallied beyond it, so they're starting to come back to that deal level, which is $10.3 billion, John.
Danny, thank you. Thanks for the update. That stock is down by about 3%. On our radar this morning, a story just developing. The UBS story picks up a notch, talking to the White House about moving the bank's Zurich headquarters to the United States. Sources telling the Financial Times that the Treasury Secretary Scott Bessent and the UBS chair discussed options if Swiss officials do not back down from new capital rules. Something about this fairly predictable, but what a move from the UBS chair.
And how serious is it, given the fact that they hope that the regulators will reduce some of the capital requirements, but at the same time, it's a convenient way to get a greater access to the U.S. market, which has been the most dynamic and is expected to be chock full of M&A and other deals activity over the upcoming 12 months.
This all goes down to the Swiss government basically saying that to be a Swiss bank, you have to have an additional $26 billion of capital that you wouldn't have to have if you are in the United States. So basically what the UBS says, this is way too extreme and we cannot compete in the U.S. So what do? They have some meetings with the White House, and then potentially this is going to force pressure on the Swiss government to maybe lessen those capital controls.
Isn't it fair to say that UBS wins either way?
100%.
Right? You know, either they get them to back down in Zurich and they back down and things stay the same way, or they don't back down and they move to the United States, and perhaps investors like that anyway.
At the risk of editorializing, this was a genius move. Absolutely 100% a genius move, because exactly the leverage they have is significant given the fact that they acquired Credit Suisse. So they now are the biggest by far and main national champion of the banking industry of Switzerland, and potentially they get access to the U.S. market more considerably, and they curry favor with the Trump administration. So pretty much win-win-win.
That story just dropping from the Financial Times about 10 minutes ago. Let's turn to this one. The feud between Japan and China escalating after comments from the Japanese Prime Minister suggesting Tokyo could take military action if Beijing attacks Taiwan. China warning it is preparing to retaliate by imposing sanctions and restricting trade.
So this is going to be challenging, especially as you see Japan really trying to walk this tightrope when it comes to how they speak about Taiwan, even though Japanese officials saying nothing has changed in terms of long-term policy on Taiwan. At the same time, Xi Jinping just met with President Trump, who also met with the new Japanese prime minister, talking about the strong relationship they have. It's becoming very tense right now with this trade agreement, given the fact that China is talking about not allowing rare earths to go to these companies that have ties to the U.S. military. And as Kate Kalukowicz said, we're basically just churning water in this status quo environment.
I remember speaking to the Malaysian trade secretary a couple of years ago or 2 years ago, and I said, what will happen if the U.S. and China force you to choose sides? And they were like, oh, we hope that doesn't happen. We hope that doesn't happen, right? I mean, that's essentially what's happening, right? Is you're seeing the U.S. and China forcing all of their trade partners to choose sides. And that's what you see in cold relief with China and Japan. And that's what you're going to see and have seen with other Southeast Asian countries in particular.
We've been asking the Europeans that question for a long time.
Yeah, Germany.
And they just carried on sitting on the fence. And then all of a sudden the industry starts to change. The industry starts to turn, the pressure starts to build on the national champions in Europe, and Germany and the rest of the Europeans are figuring this out for themselves without the pressure of the US.
Yeah, although the conclusion isn't necessarily so clear, because there was a story on Bloomberg the other day talking about how Germany is exporting so many vehicles into China right now and making so much money that they can't stop. So it raises this question of, are they going to be economically incentivized to potentially reduce their exports to China and reduce the reliance on that revenue? And if not, well, with our trade.
Do you want some good news?
Please.
US Airlines resuming normal operations today following government-mandated flight restrictions. The FAA and Transportation Departments say staffing levels are getting back to normal since the end of the shutdown last week. There's some good news. This morning, at least.
They're saying they're snapped back in terms of the staffing levels. What's critical and important about this is obviously we are just 2 weeks away from Thanksgiving. And the worst thing that could happen, not just for this White House, but even congressmen and women, senators, would be long lines at TSA, long lines at airports, and some planes not even being able to fly into certain airports because of the government shutdown. Just over 40 days, at least TSA and FAA starting to work again.
I think that I can say on behalf of all travelers, don't make us your political football. And that's what we heard from a lot of different airline executives. Don't make us the football, because ultimately pick a bit different pasture, because ultimately this is just a frustrating experience for everybody.
Good timing. Thanksgiving next week. Sticking with the skies, Airbus closing in on a major deal with Fly Dubai. Sources telling us here at Bloomberg the plane maker is set to win the majority of an order from the airline. Bloomberg's Guy Johnson joins us now from the Dubai Air Show with a special guest. Hey, Guy.
Hey, John. Yeah, the sun is setting on day one here at the Dubai Air Show. We're waiting to hear about these big orders. There's possibly one coming from Fly Dubai. There's possibly one coming from Emirates as well. We don't have much clarity on either at this point. Let's try and get some of that clarity now. Christian Scherer is the CEO of Airbus Commercial and joins me now. I'm going to apologise in advance. There's a French fighter just behind you, which is making quite a lot of noise. So hopefully everybody will be able to hear. Christian, is it getting harder to sell aeroplanes in this part of the world if you are Airbus?
No, it isn't. We're very successful around the world, including in this region. It's true that our backlog extends so far forward that it is getting a little bit more difficult to convince customers to buy airplanes 10 years in advance. But no, I wouldn't differentiate this part of the world from any other.
So President Trump, who has had a meaningful impact in terms of sales of your competitor in this region in the last year, is not having an effect at this point.
It is having an effect on the number of orders that our competitor is benefiting from. But it doesn't change the path, the successful path of Airbus selling airplanes around the world.
Do you have to work harder, though, because of that factor? Do you have to be more competitive? Do you have to be more price competitive, more efficient, whatever it is, to overcome that?
That's an interesting point. What I'm telling myself and my colleagues is, well, in the face of these forces, we just have to continue to be better, to be more innovative, to respond to our customers' needs. And that's a healthy thing.
But he is making a difference.
In terms of volumes.
Yeah, in terms of sales.
In terms of volumes, yes. But it does not change the fact that Airbus is nearing 9,000 aircraft on backlog and is serving our customers very, very well, and we're quite successful in the market.
Is he the biggest problem, or are you having actually, is your Achilles heel Rolls-Royce engines at the moment in this region? Your aircraft might be good, but are the Rolls-Royce engines holding you back?
I wouldn't call it an Achilles heel, quite on the contrary. We're very, very happy with the engines that equip our aircraft, be it the Trent 7000 on the 330, and then the Trent 84K and 97K, as we refer to them, on the A350. Very, very good engines. We have, indeed, an engine improvement program that is coming live now very, very soon on the 97K. That's going to make the engine even better in the challenging environment, for example, in the Middle East.
Enough to make Tim Clark over at Emirates want to buy the aeroplane?
Well, that's a question you have to address to Tim. But we've listened to him, to other customers. The engine is being improved, and Rolls-Royce is about to verify the testing on the engine. We're very hopeful it'll be a great engine. It already is around the world. It will be for this region.
It's just, this is a tougher operating environment for that engine to work in. So I guess there are different requirements for it. It does, though. Just if you'll bear with me for just a moment. 2 years ago we were here and we were waiting for a big order from Sir Tim Clark at Emirates for an A350-1000. I'm having slight deja vu this time around. 2 years later, are you having deja vu as well?
No, Guy. I appreciate you're asking the question here at an air show, but air shows regrettably don't just yet dictate engineering work and the laws of physics. We'll be ready when we're ready. It's just around the corner. The engine works really, really well, including in this region.
Yep.
And then Sir Tim can make his decision once he can verify that the engine has been upgraded to
Are there regions now where Airbus has a disadvantage and Airbus has an advantage? Is it, this is a tougher region, but maybe China's an easier region? Does one offset the other?
No, I wouldn't say so. You know, Guy, our company has won 2/3 of all competitive wide-body decisions in the last 3-4 years. So I wouldn't differentiate one region from another. That would be inappropriate.
You've also you are dominant in this region on narrow bodies as well. Fly Dubai has traditionally been a 737 customer. Are we about to see you breaking that monopoly? Is it about to become a mixed fleet operator, do you think, Fly Dubai?
Well, we'll see what surprises air shows bring.
Yep.
But I wouldn't say we're dominant. We're quite successful.
Yep.
And as we should be with a more modern, higher technology aircraft. Yep. But it is an air show. Air shows are made of surprises. Let's see. It's only day one.
Okay. It is with great regret that I say this next bit. You are about to step down as the CEO of Airbus Commercial. Do you think you took advantage enough of the opportunity that a weakened Boeing represented in this phase? Could you have done more? If I'm an Airbus shareholder, would I expected Airbus to have delivered more performance during this phase, or was that just not possible?
I don't like the words taking advantage
maybe that's the wrong word to use.
Somebody's weaknesses.
What words would you use?
So I would say that we were constrained not so much by what may have happened or not happened or the mistakes of our competitor. We're constrained by a supply chain, by an ecosystem that has suffered the worst crisis in modern times, the pandemic. And for this ecosystem, with thousands of suppliers, to reorganize ourselves, to recapitalize itself, that's the real challenge. That's what's been the brakes on our ramp up, if you like, in the recent past. Much more so than the trials and tribulations of this or that competitor.
Is your successor going to have to make some tough decisions, do you think? There are big, tough decisions potentially coming up. One of them could have reared its head today. Again, Tim Clark over at Emirates, placing an order for 777, what looked like a Dash 10. And I'd never heard of the Dash 10 before, but I'm assuming that is the next iteration of this aircraft that you might have to match. Are we going to have an A350, not 1,000, but maybe 1,100 fairly soon, do you think?
I wouldn't call that a tough decision. That's an exciting decision.
Okay.
What is true?
Are you looking at it?
What is true that the market, our customers, just like they did on the freighter, are telling us, guys, you have a really good platform with the A350, where technology matters most on these ultra long ranges, where the weight of the aircraft and the fuel burn efficiency of the airplane matters most. You have the A350, and you're opposing it to an aircraft that is arguably of much older generation. Use that platform. So we're looking at that.
Christian, great to catch up. Always a pleasure. Thank you so much for your time today. Christian Scherer, the CEO of Airbus Commercial, from day one of the Dubai Air Show. We're excited about day two to see what that's going to bring. Team Surveillance, I hand it back to you.
That whole experience was very Guy Johnson, wasn't it? Guy Johnson in Dubai with the planes behind him and the noise of a French fighter jet over the top of the interview.
With the sunglasses and very kind of James Bond, new technologies. Guy, great job.
We'll have more from Guy throughout the week on Bloomberg TV and on Bloomberg Radio from the Dubai Air Show. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. UBS is considering moving its headquarters from Switzerland to the U.S. The Financial Times reporting that UBS Chair and Treasury Secretary Scott Bessent discussed the move amid long-standing issues over strict Swiss capital rules. The report says the Trump administration is receptive to welcoming one of Switzerland's most prized assets. Meanwhile, the UN Security Council is set to vote on a Gaza plan that anticipates Palestinian statehood with a multinational stabilization force to demilitarize Gaza. It's meant to build upon President Trump's peace plan. Israeli Prime Minister Benjamin Netanyahu striking back, vowing no Palestinian statehood and that Hamas will be disarmed by force if necessary. And Peter Thiel's hedge fund sold off all of its Nvidia stake in the third quarter. The move comes shortly after it was revealed SoftBank also sold its Nvidia stake back in October. According to a 13F filing, the Thiel macro fund now counts Apple, Microsoft, and a reduced stake in Tesla as its main bets. That's your Bloomberg Brief, John.
Yahara, thank you. The hits keep coming for that major tech name. The earnings drop this coming Wednesday after the close. Up next on the program, the era of AI.
We are in the midst of a major technological transformation.
AI is going to be important someday. It's just going to take a while.
Right now, we're underestimating all of this.
Up next, we'll catch up with Stephen Parker of JP Morgan Private Bank from New York City. You're watching Bloomberg TV.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Global electricity demand is set to surge 75% by 2050. Infrastructure alone won't keep up. To power the future, we must change how energy is used, not just how it's generated. The missing link? Demand-side solutions that unlock efficiency, productivity, and resilience. The Bloomberg New Economy Energy Technology Coalition is uniting industry, innovators, and investors to scale these technologies for a future-ready energy system. Learn more at bloombergneweconomy.com/ntech.
UBS, that stock unchanged this morning. This story, though, from the Financial Times is getting everyone's attention. The chair, Colm Kelleher, and the U.S. Treasury Secretary, Scott Bessent, have privately discussed moving the bank's headquarters to the United States as the Zurich-based lender explores contingency plans to leave Switzerland if the government does not back down on new capital rules. Those words coming from the Financial Times this morning.
Taking the nuclear option at a time when they could potentially be forced to pony up $26 billion in additional capital to put aside. A question of how UBS is going to play their hand? Well, they just gave a sense of exactly how they're going to do it.
We'll pick up on that story later on this morning. For the broader market, equity futures on the S&P just about positive, rolling over in the last hour or so. We're just about positive by 0.1% on the Nasdaq 100. Under surveillance this morning, the era of AI.
We are in the midst of a major technological transformation.
AI is going to be important someday. It's just going to take a while.
The minute we don't see earnings supportive, that's when I think you'll see it all flip.
Demand for AI is very strong. Every Fortune 500 company, every enterprise has their own AI strategy.
Right now, we're underestimating all of this.
So here's the latest this morning. Profitability of the AI narrative whipsawing tech stocks as valuation concerns rise. JP Morgan's 2026 global investments outlook remaining bullish, writing artificial intelligence remains the defining force in financial markets. Stephen Parker, the co-head of global investment strategy at JP Morgan Private Bank, joins us now for more. Stephen, good morning. Good to see you.
Good to see you.
Should we talk about the three bogeymen?
Let's do.
Overcapacity, leverage, valuations. Your words. How concerned should we be into next year?
Yeah, look, we think that there's still a long way to run in this AI trade. If you look back since the launch of ChatGPT, 75% of the returns, 80% of the earnings, and 90% of the capital spending growth of the S&P has been driven by AI-related companies. And so the question now is, are we facing a bubble? And as you said, it's really those three factors. It's overcapacity, it's leverage in the system, and it's valuations that we need to focus on. And we think that we're still in the early stages of this story.
How much do you think that the extra editions of this story, the extra chapters, really will come from a Fed rate policy or fiscal policy or some sort of more accommodative backdrop that can allow valuations to get even more heady?
Yeah, look, I think we're in a world where there is still a lot of capital that is looking for a home. Investors are willing to make investments. But importantly, what we're seeing now is that these investments in AI don't look speculative like bubbles of the past. If you go back to the dot-com era, in the late 90s, there was 40 million miles of fiber that were laid to help support the internet. And by mid-2001, only about 1% of that was being used. It was supply in search of demand. AI, the story is reversed. The vacancy rates in data centers today is at an all-time low, 1.5%. and 3/4 of the demand for new construction in data centers is already pre-leased. So we're not seeing those signs of speculation, particularly from a capacity perspective, that gets us nervous.
So your base case for next year is 7,200 to 7,400 in the S&P 500. Your bull case is 8,000 to 8,200. What makes you either constructive or uber bullish?
Yeah, I think it all comes down to earnings. And we've seen a tremendous run of successful earnings results. 5 of the last 6 quarters, we've seen double-digit S&P earnings growth, despite the fact that we've had policy uncertainty, economic uncertainty, trade uncertainty. There's perhaps never been a bigger disconnect between the stock market, particularly large cap stocks, and the broader economy. We think that continues, and we see another year of double-digit earnings growth, which is going to support that upside that you talked about.
How do you think about all of this in an age when globalization is out of fashion?
Yeah, I mean, we're launching today our new 2026 market outlook, Promise and Pressure. And one of the key themes is this idea of global fragmentation. So post the Cold War, we were in a multi-decade period where it was all about globalization, cost control, efficient supply chains. That kept inflation down. It kept margins up. Increasingly over the last couple of years, as a result of the pandemic, conflict in Europe, trade policy, we're now in a world where countries are looking in. They're more focused on security and reliability, both in terms of defense, but also of supply chains and infrastructure. And that has ramifications.
US versus China. That's what this feels like. Where does Europe fit in the US versus China?
So Europe is an interesting sort of pivot point in the global landscape. When we looked this year, the announcements that we saw out of Germany in terms of the shift in fiscal spend, the willingness to embrace positive fiscal impetus is a huge change. One of the key themes when we talk about this idea of increasing fragmentation and a focus on security is what's going on in Europe as it relates to the spending on their infrastructure and their defense. We think that's both an important macro trend, but also an investable opportunity.
I think people have the sense they know how to play the US story if they want to play it. I think they feel comfortable playing the China story if they want to play it. After the first half of this year, I think they're sitting here looking at Europe into 26 and thinking, well, maybe that was the trade. That was just sort of like last year and now we're done with it and we should move on to other things. What is the trade for 26?
We still think there's opportunities in Europe. One, a lot of the fiscal policy that was announced this year isn't actually going to be put into place until next year. So there is a growth dynamic there. And in fact, we think from an economic perspective, we're probably going to see a convergence, meaning that a smaller discount of growth in places like Germany versus the US. But when you think about how you want to play the story, we continue to think that the European defense names are probably the most interesting opportunity that we're seeing.
Based on the framework that you just laid out, how are you looking at diversification? Is it from a regional basis or is it from an asset class basis?
Yeah, so we talked about the outlook, we talked about AI, we talked about increasing global fragmentation. The third theme that we think is really going to drive markets in the years to come is inflation. And these factors that we talked about, increasing fragmentation, increasing fiscal policy, means that inflation is likely to be more volatile and the floor is likely to be higher. And so when you think about building portfolios, the playbook of the past has to evolve. Stocks and bonds on their own are not going to be enough. Stocks can help you when you get recession fears and growth scares, but increasingly in a world where inflation is going to be part of the narrative, you need to look at things like infrastructure, real assets, and gold, not just on a tactical basis, but on a more strategic basis.
So sticking with the gold trade, even after the big boom over the last year?
We are. We continue to see upside. We think we can get over $5,000 an ounce on gold. And that has to do a lot both with some of these concerns around geopolitical issues, the concerns around the dollar, but most importantly, and from a sticky perspective, central banks around the world are continuing to realize that they need to diversify. And a lot of these central banks are still underexposed to the long-term targets that they're trying to achieve, which means more demand in a supply-constrained world.
Stephen, good to see you. Thanks for being here. Thank you very much. Stephen Parker there of JP Morgan Private Bank. What a year gold's had. And Stephen Parker talking up another big year ahead.
Yeah, and he's not alone. You actually see Morgan Stanley saying the same thing. China buying secretly. They're reporting much less than they're actually buying.
Coming up on the programme, we'll catch up with Jonathan Golub of Seaport Global, Alex Stratton of Morgan Stanley, Abigail Watt of UBS, and Ben Reitzes of Milius Research. From New York City, the third hour of Bloomberg Surveillance is up next.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
You do have almost an equal set of headwinds and tailwinds for the equity market. But
things got out a little bit over their skis here. They got a little white hot.
There's probably some room to see more pullback.
There are a lot of warning signs. There's a lot of froth in the system.
These pullbacks and corrections won't turn into something more nefarious.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just about positive by not even 0.1%. On the Nasdaq, higher by 0.14. A massive week ahead, stacked full of earnings from retail America, including Home Depot, Target, and Nvidia. Nvidia going to be the major one for big tech. Big tech is going to be focused on this name right here on Wednesday after the close. A lot of weight on the shoulders of Jensen Huang.
Just how insatiable is the demand for some of their chips? The idea of the hyperscalers feeling like they can't invest enough and they can't spend enough on exactly what they're going to do. To me, this could be the linchpin for the trade heading into year end. If they confirm the kind of double-digit growth that we've seen from NVIDIA, do we see new tailwind into the AI trade, even amid all of the bubble fears?
What is this story built on? The strong balance sheets of the hyperscalers, the Microsofts of this world, or on the promise of OpenAI? On not major revenues, promising some big spending over the next decade?
I think it's a great question. Another way of asking the same thing is, how much is NVIDIA's bet? The idea of practical efficiencies that companies are currently getting, and how much is it hinged on the idea of a revolutionary technology that transforms the way we engage with the world that we haven't yet seen? Is that sort of the bet that people are hinging NVIDIA on, or is it a very kind of banal, trying to make sure that you get the numbers more quickly and be able to do recipes more efficiently in different circumstances?
It's got to be bigger than that, Bramo.
Well, but that's exactly what it's actually doing right now. I mean, that's the point, though, right? How much is it sort of the sea change in how we experience the world around us and humanity?
NVIDIA's down by 1% in the pre-market. More on that in just a moment. Retailers in America, I talked about them, Target, Home Depot, Walmart, they report this week. The consumer in focus as well down in Washington, D.C. We get a payrolls report Thursday for September. I know it's been a long time. The estimate in our survey so far, 50K.
Finally, though, we get some data. It has been a desert when it comes to the data, which is why the payroll report is really important. Of course, to be determined when we're going to actually get the November payrolls report. Can they get the job done in time for the first week of December? A lot of these questions now going into the next Fed meeting, especially when it comes to the health of consumer, which is why, for me, actually, Walmart, Target, Home Depot, the most important data points of the week, not just for what's going on in financial markets, but for what it means for this White House.
Are you sensing some building pressure over the last week?
Absolutely. Pressure on this White House? Absolutely. When it comes to things like beef, bananas, coffee, why do you think Trump himself came out with this executive order lowering the tariff rates on more than 100 food items because there is concern about this idea of affordability? And then on top of it, throwing in this idea of $2,000 checks for those on the lower incomes of the United States.
The president sitting in the Oval Office in the last week uttering these words, make America affordable. Again, I think they get the message loud and clear.
Yeah, well, why do you think Walmart highlighted the fact that a Thanksgiving dinner was so much cheaper this year than last year? They're saying to the president, here, look, we're part of the solution, not the problem. How much does the rhetoric match what we see in the earnings? And that's what I want to see. How much are prices actually going down versus select prices? Maybe the turkey is lower, but maybe you're seeing your sneakers, 10% higher. Beef's going to be 10%. How much do you see the sort of select items? And that's what I'm very curious about from some of these retailers.
The American consumer is not tracking CPI. We haven't had CPI. It doesn't matter. They're not tracking that. We had a massive price level adjustment in the pandemic, and nothing's come down since. I say nothing, I'm talking loosely, but you know what I'm getting at. Inflation doesn't matter. The month-on-month inflation rate, that's not what this is about. It's about the squeeze that people have felt over the last 5 years, and they're not seeing the offset in the labour market.
And it's the confidence that the squeeze is over, right? How much do you get the sense that prices aren't going to rise that much more? My son came to me and he said, the Egg McMuffin challenge, and it's not necessarily the McDonald's one, but his bacon, egg, and cheese sandwich that he would get in the morning. He said it was a moving target in terms of how much he paid for it for a number of years. It's gotten more stable. That's the kind of thing people are looking for.
Did he vote Mum Downey? Don't answer that. Coming up on the programme, Jonathan Golub of Seaport Global. It's too young. As markets look to bounce back, Abigail Watt of UBS as the Fed emerges from the data hate, and Ben Reitzers of Melius Research with all eyes on Nvidia earnings. We begin this hour with stocks little change. Jonathan Golub of Seaport Global seeing the S&P 500 hitting 7,800 by the end of 26. He writes this: investors are concerned over elevated multiples. Market multiples are elevated because of a mix shift towards tech, not because individual stock valuations are problematic. Jonathan joins us now for more. John, good morning.
Good morning.
We've been talking about the lessons of the last week. Volatile week for big tech. What were the lessons for you?
Well, the most important lessons is we don't have an earnings problem, and people are concerned about some of the issues. At least you're talking about, like, what's the ultimate use case? But people are buying into this idea, just like you said, that there is a new thing, and it's not about spending by the hyperscalers. It's about that this is going to change the way that we do all kinds of things. And it's not about OpenAI being an enhanced Google search. It's literally about us being able to do things that we weren't able to do before. The first wave of this is going to be in cost savings by companies that can eliminate certain positions and save money. But then there are going to be things that companies can do that they just didn't have the ability to ever do without these technologies.
John, I think you know why people are nervous. To build on some of the things that Lisa was talking about, but also you mentioned OpenAI. OpenAI has got these massive, massive spending promises over the next 5 years or so. And the revenues don't seem to back it up right now. Now, that could change over the next 5 years. I get that. But there is a sense in the market that maybe we've taken things too far. And Lisa and I were talking about this. What are we actually building this story on? The balance sheets of the hyperscalers, the bigger cap tech names in America on the S&P 500, or the promise of OpenAI and the ecosystem that they've built up?
I think the key is that this is not, I mean, if you're looking at, if we invest in the S&P 500, you're in, if you look at the tech sector, it grew earnings 28% versus last year. I don't care what the promise is. It grew earnings 28%. If you look at the forward expectations on the S&P, it's up massively compared to where it was 3 months ago, 6 months ago, and a year ago. In tech stocks, the expectations are going vertical. What that really means is that Wall Street analysts and investors keep underestimating the earnings potential. So we could talk about the promise, but this is not a story where stock multiples are going up like crazy. And even people who are talking about valuations being high, the valuations, I think, on 8 of the top 10 tech names are lower now than they were a couple of years ago.
You think reality is good enough, never mind the promise?
Listen, I would love for the promise is all about will we be able to keep double-digit growth rates. But you and I know that that's a really hard one to keep over the long run. But right now, these companies are delivering, beautifully. The problem is the rest of the market is not. It doesn't look nearly as robust.
Just to put this in an analogy form, it's like a rocket ship, right? And you've got the hyperscalers, you've got the semiconductors all sort of pouring fuel into the rocket, hoping that it gets out of the atmosphere and then it can go on its own volition without all of that ammunition, all that investment, et cetera. When do you need to see that it's getting to outer space?
I thought the most important thing that we heard this earnings season was when Jamie Dimon made the comment that they are, profitable on their AI investments. That the turnaround to these things, becoming profitable was already here. That this is not a decade-long promise, but these are things that can save money and help companies become more efficient right away. So yes, we need to ultimately have real companies deliver profitability, but I think the cycle on this is going to be much shorter than people think. It is the uptake on these of this technology is so fast. I mean, I see with my own team, the things where it's not that we're saving money and we'll have a smaller team. We're doing things that we couldn't have imagined doing 18 months ago.
Like what?
We're customizing research for individual. So let's say, for example, we're doing work on corporate profits. We can go and say, tell me about your portfolio. We'll analyze profits only from your own perspective. And we could do that for hundreds of clients. We couldn't do that before.
So how much do you have to bet on a broadening out in equity performance if you have faith that the AI story is real? In other words, do you have faith that other companies are going to actually see some sort of delivery on their investments in a comprehensive way that allows them to outpace everybody else?
Well, let's step back because we're just talking about technology. Financials grew their earnings, I think, 24% year over year. Now, what's the backdrop there? A more favorable antitrust environment where, activity at the banks has been super strong. M&A activity is strong. Lending activity is strong. That's a really big chunky part of the market. Now, what was less strong is the old economy stuff, traditional industrials and energy and materials and defensive sectors struggled. And so I think the question isn't, will the market be healthy, but will it remain bifurcated? And I think that for now, I think it's going to remain bifurcated.
Last night, the Anthropic CEO was on 60 Minutes and talked about without intervention, it's hard to imagine there won't be some significant job impact here when it comes to AI, and faster than they've seen in any other previous technological advances. How big of a job impact do you think this is going to be in terms of losses?
It's hard to know. Things moving faster now than they were in the past. But if you went back to the Industrial Revolution, people were talking about how terrible it was that we were moving people into factories off the farm because we're going to have all these job losses. And what did we learn to do? We put people into other innovative jobs in society, move forward. So over the long run, these disruptions are all good. They will enhance our lives, and they will make these companies more profitable. But if it's moving so much faster than it has in other similar periods, we're going to have to focus on making sure that people remain employed. But by the way, the unemployment rate is low. I mean, you're talking about before. We have a 4.3 unemployment rate, so we don't have an employment problem.
I'll tell you where it's moving to right now, the debt market. Amazon. This news just crossed on the Bloomberg terminal moments ago, kicking off a $6 US dollar high-grade bond sale. We've seen it from Meta. We've seen it from Alphabet. Amazon joins the party this morning.
Yeah, and it's somewhat predictable. Robert Schiffman of Bloomberg Intelligence actually put out a note over the weekend that said Amazon could skip the tech debt party, but an appearance makes sense because ultimately they're getting rewarded for doing so. You have seen tens of billions of dollars of debt sales since September alone from these tech giants, and you're just starting to see some pushback a little bit around the margins, but for the most part, investors in the debt space want the income, and they see these behemoths as very able to pay, given the fact that they do have so much cash coming in.
These companies, Jonathan, are changing. You're familiar with that. You know that. It used to be a capital return story, very cash rich, very asset light. Feels like that's pivoting. What does that mean for the valuations of these companies?
Well, you raise a good point, because if you look, let's talk about margins. The net income margin, the EBIT margin on these companies are skyrocketing. The cash flow margins are deteriorating on the companies. And if you think about what they're worth, what we know is over the long run, you pay for cash flows, not for earnings. If there's a single question that the smart investors we're talking to are focused on is, are these is this cash flow issue going to become a problem? And if something goes wrong, that's going to be the issue, not whether they simply hit the top line.
We've seen some convulsions in the credit market already. Do you think it's too early to draw conclusions on where we are?
I'm like obsessed with high yield spreads. They're wider by a baby amount.
Still sat to 300.
Yeah, and I think that part of the reason the market is off by a couple of percent in the last few weeks is because spreads are up. But we're not seeing a wide set of, defaults and delinquencies and bankruptcies. We're not seeing anything. We're all, fretting over it, and maybe we'll be right. But we may be very, very early in terms of how much concern we're putting on it.
Jonathan, it's good to see you. Bullish for next year. Thank you, sir. Jonathan Golub there of Seaport. I'm looking at Amazon's 6-part offering, the longest portion of that 6-part offering. I can see some 40-year debt out there for you, Lisa.
Oh, my God. I mean, looking at this 40-year debt from this, you've got the 50-year debt that we saw just a bit ago coming, I believe, out of Meta, right? That they had a 50-year bond.
Alphabet.
Was it Alphabet?
Okay,
thank you. I wasn't remembering. Right? So Alphabet's 50-year. We've got Amazon 40-year. What are these companies going to look like? Are we even going to have humans doing anything in 40 or 50 years? Are we all going to be just, sitting there and having having robots fan us while we eat dates?
I've got no idea what we're doing
Sounds nice.
50 years' time.
I
hope that's what the future looks like.
I know. That's a very optimistic take.
On the beach somewhere with robots taking care of us.
I
don't think that's what it's going to look like.
It actually could be really helpful, especially if, we're older and need taken care of.
Good.
I think that the robots could be very good caretakers.
Sounds like a conversation for a commercial break, not live TV. We'll do more of that in a moment. All right. Amazon up in the pre-market by 0.4%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump is reversing course, telling House Republicans they should vote to require the Justice Department to release its files on Jeffrey Epstein. Trump has been under increasing pressure from some within his own party to release the investigative materials on the convicted sex offender. The House is scheduled to vote tomorrow. Meanwhile, trade tensions rising with the European Union. People familiar with the matter telling Bloomberg EU's trade chief will raise the issue of higher steel and aluminum tariffs with Commerce Secretary Howard Lutnick next week. European officials are concerned the moves may cut against the spirit of the trade agreement signed between the two sides earlier this summer. And in sports, the Denver Broncos won their 8th straight game after beating Patrick Mahomes and the Chiefs at home. The Philadelphia Eagles and LA Rams both improved to 8-2 after strong defensive performances. Elsewhere, the Baltimore Ravens won their 4th straight game to move into second in the division behind the Pittsburgh Steelers. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Up next, the Morning Calls Plus. Alex Stratton of Morgan Stanley with a busy week of retail earnings on deck. That conversation up next. Live from New York City this morning. Good morning.
I do expect that once we look into next year, we have still relatively easy financial conditions with, of course, the stock market, with some wobbles more recently, but still very supportive. The market is too negative on the economic outlook and the risks are actually rising, that we may have some reacceleration once we get into 2026.
Interesting call from Torsten Slok of Apollo there a little bit earlier on in the programme about a reacceleration in 2026, a call that the St. Louis Fed president has also endorsed. That's his worry that things pick up just as they begin to continue cutting interest rates. That's why he's pushing back at the moment. If you're pushing back, you're looking for an equity market that's a little bit higher. Not this morning. Just about unchanged on the S&P 500, on the Nasdaq as well. Amazon in focus in the tech world today. Moments ago, this headline. Amazon kicking off a 6-part US dollar high-grade bond sale, the longest piece of that 6-part offering. 40 years.
Ultimately, it is cheaper for these companies to borrow in the debt market than to raise money through the equity market. And they want to raise enough money that they can be competitive in this huge arms race to get enough data center capabilities to be the leaders. Amazon, AWS trying to remain in the front seat here. And it highlights how the debt market is facilitating the next phase of this build out. That to me highlights just how much and how ambitious some of these tech companies really are.
We discussed selective convulsions in the credit market.
Great phrase.
Amazon doesn't come to market often. I think it's been 3 years since they tapped the debt market. In fact, our story points out bringing the first investment-grade bond sale in 3 years. That's Amazon. Not everyone's got the balance sheet of these hyperscalers that we've been talking about more recently, the alphabets of this world. Not everyone's got the balance sheet of a Meta, say. It's the smaller companies, the more highly leveraged companies that you've been pointing out that are a little bit more problematic.
And that are getting real pushback from credit markets. The likes of Amazon is getting a warm welcome. I mean, I'm sure that people will eat this up because ultimately they are a high-grade issuer that has plenty of money to potentially fund whatever they need to do. It just raises a question. Is this the tip of the spear? Is there a lot of other financing going on in other capacities? And the best and the brightest are tapping the public corporate debt market. What else is going on and how far can it go?
The pre-market story for Amazon, we're higher by 0.6%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley cutting Delta underway alongside a number of hardware makers, saying a memory super cycle increasingly poses a risk to hardware manufacturers. Next up, JP Morgan raising its price target on down to 170, expecting near-term revenue and earnings positivity from AI-leveraged companies. And finally, Barclays upgrading Gap to overweight ahead of earnings this week, believing the company is executing a strategy for long-term recovery. That stock is higher by more than 3%. Let's stick with retail. A big week of earnings on deck, including Home Depot, Target and Walmart. Alex Stratton of Morgan Stanley saying we expect another quarter of sales-led third-quarter EPS beats, albeit with less upside surprise. Alex joins us now for more. Alex, welcome to the programme. 3 big retailers this week, a bunch of others as well. What are you and the team focused on?
Sure. So I think bigger picture, you hit on our overall view, which is that I kind of sum it up as the headlines will be better than what's actually going on with the underlying fundamentals and how we see the stock reactions playing out. And we take that view for a couple reasons. One is just, yes, we are expecting, as you pointed out, another quarter of sales-led EPS outperformance. But at the same time, we're not projecting as large of outperformance as we've seen in the last few quarters. And you're actually going to have profitability eroding quarter over quarter as tariffs start to work their way into the P&L. So that's the positive headline, and then the give and take to it. And then secondly, another positive headline is third quarter outperformance should enable some of these businesses, and most of them, in fact, to reiterate or raise. But to me, those will mostly be flow throughs of the third quarter upside, which means fourth quarter is unchanged to worse and mostly being set below consensus. So all in all, what you have is sentiment that's been fairly negative on the group in recent months and might continue to be that way through year end with that dynamic. So expecting third quarter to mostly be neutral to negative catalyst across our group.
Alex, parsing through what you just said, it sounds like you expect to see some pass through when it comes to inflation to consumers and them absorbing some, but the companies are absorbing even more on the margins. Is that the ultimate takeaway that you're expecting to see from these earnings?
Sure. So I think from a pricing perspective, we've seen a little bit taken so far post-Liberation Day, nothing out of the norm of what's within historical levels. So for apparel, that's about low single-digit price increases. For footwear, that's about mid-single-digit. We haven't seen our businesses necessarily surpass that yet. And what really the biggest headline on tariffs has been and how they're managing it with the consumer for the last 2 quarters has been better than feared. They're finding ways as time moves onwards to offset the incremental cost. That doesn't mean there's not an impact. Profitability has certainly compressed into the back half of this year and will continue to do so next year. But we haven't seen the majority of price increases I think that we might see happen. And to me, that'll most likely happen either this month for my a retail type business models or next year for the wholesaler type business models.
Alex, is Walmart still representative of the consumer and the health of the U.S. economy?
I think Walmart is certainly a bellwether in the space that we look to outside of our traditional apparel and footwear coverage to understand how the consumer might be pressured or behaving in other categories. So I think, certainly still a bellwether. For me, I like to watch it in the context of the off-pricers, which I do cover, who have that value orientation as well.
Alex, you said that we potentially are going to see very shortly higher prices because of tariffs. Well, what happens if the Supreme Court strikes down IEEPA?
Sure, I get this question quite a bit, the implications of IEEPA. And it sounds like if you were to take the Morgan Stanley U.S. public policy view on this, is that there's very many other kind of actions he could use to continue to keep some form of tariff in place. So the way I view it is it might be an initial pop for our group on this idea of there could be refunds that quickly shifts as we learn either the degree of uncertainty that comes with it or that there's other ways in which you can keep some degree of tariffs in place. The other thing I would just highlight, as we've learned from tariff experts in the last year, is that this concept of a refund is not something that happens immediately. There are things from the 2018-2019 trade wars that are literally still being litigated now. So to me, I think it's a kind of a headline fake, followed by probably a continuation of tariffs in some form or another. And if there are to be any refunds had, it'll be a long process. 2018, 2019, 6-7 years ago, and it's still being litigated for some companies.
Well said. Alex, thank you. Alex Stratton of Morgan Stanley on the retailers later this week. I'm not even sure how the Supreme Court suggests how you remedy any of this, even if they do strike it down.
They're going to say, hey, lower court, why don't you figure this out? Thanks. Get back to us.
We'll move on. See you in the new year.
Exactly.
Yeah. We're moving on. Up next, Abigail Watt of UBS as the Federal Reserve awaits long-delayed economic data. Counting you down to the open in about 60 minutes away this Monday morning. Equities just about unchanged on the S&P 500. Pretty flat through last week, but last week incredibly choppy, particularly for the big cap names on the Nasdaq 100. The Nasdaq 100 this morning also going absolutely nowhere. With some morning movers, Some stock moves this morning. Here's Danny Berger with more. Hey, Danny.
Hey, John. Maybe the reason the Nasdaq, though, is slightly able to outperform is because of what's happening with Alphabet this morning. Shares are up about 3 3/4%. Berkshire Hathaway in filings over the weekend showing that they are taking a new stake in Alphabet worth about $4.9 billion. So again, those shares go higher this morning. Elsewhere, some earnings to work through. Quantum computing, a huge gain for this stock, up 15.8%. To be fair, this thing is down 34% year to date, but had earnings that were positive profit, positive earnings versus a negative one at this time last year. The CEO is saying that they had a revenue so far this year that's grown 280%, and that includes a deal with what it said was a top U.S. bank. It didn't name the bank, but we know banks are getting more into quantum computing, so that's the latest with those shares. Finally, rounding things out, a story breaking in the last hour or so that Novo Nordisk is looking to undercut Eli Lilly with a cheaper price for cash buyers of its obesity drug. Now, at the entry level, it's the same price as what Eli Lilly is offering, but once you get to the higher doses, it is significantly cheaper. It's also trying to fight off some of those copycat pharmacies, those compounding pharmacies, which do offer cheaper products for cash buyers. But that extra competition sending Lilly shares down by 1.25%, John.
Danny, thank you. Appreciate the update. More from Danny, Matt Miller in about 30 minutes from now on Bloomberg Open Interest going into the opening bell. Let's turn to the economy. Investors are waiting the long-delayed September jobs report due Thursday morning. The median estimate in our survey calling for an increase of 50,000 payrolls. Bloomberg's Enda Curran joins us now for more. Enda, good morning, sir. We've got one question. What's a good number on Thursday? Is 50 a good number?
Well, 50 would be the break-even rate, according to some economists, including our own Bloomberg economist, Jonathan. So if it came in around 50, say, and the unemployment rate is 4.3%, then it probably leans into the idea that maybe the Fed will hold off cutting rates in December. We know that pricing has fallen back for that move to around 40-odd% last week after that hawkish Fed speak. So a jobs number that comes in around that area will be seen as, I think, as tolerable. There will be a lot of focus on leisure and hospitality, see what they contributed to the September numbers. Also, people will be keeping an eye out to see any impact of those DOGE cuts that were announced way back at the start of the year but are expected to start filtering through to the numbers towards the end of this year, maybe kicking on from September onwards. But ultimately, we have to remember this is now September jobs data. It's quite stale, quite dated. The focus will quickly turn to the October jobs data, and whenever that's released, that's only going to be a partial read. So still plenty of choppiness when it comes to trying to get a picture on where the jobs situation is at.
We get some timely commentary from Federal Reserve officials later on this morning and also some Fed minutes later on this week. This morning, we'll hear from the New York Fed President John Williams, Jefferson Kashkari-Waller also speaking. And we spoke to Torsten Slock of Apollo earlier on this morning, and we had a conversation about a new era for this Federal Reserve. The amount of dispersion that you're seeing in the dot plot in the SEP when they put out those forecasts seems like it's getting wider. The Fed speak feels like it's getting messier. And you've covered the central bank story around the world for a long time. Do you sense this is a new era for Federal Reserve communication?
Well, we're certainly seeing play out in public now what Chair Powell hinted at that last policy meeting, John. If you remember when he came on the press conference and he said, look, December is no done deal, far from it. Now we know what he means. Clearly, several policymakers and officials behind the scenes were lukewarm at that cut last month at best and certainly don't see scope for a cut going forward from here. Now, there are those who say this speaks to the idea that maybe Chair Powell is using his influence, maybe the board is starting to fracture, it's all spilling out into the open. That's one interpretation. But another view is that we are at something of a moving feast, a complicated moment in the economy. Is the labour market reflecting major layoffs, or is it reflecting the supply and immigration story? Is inflation broadly tracking okay, even if it is above the Fed's target, or does it reflect persistent inflation that the Fed can't keep its eye off of, in particular maybe in some of the service sectors and some of the tariff inflation as well? I mean, there are very different interpretations in what's going on in the economy. That's clearly now playing out in the policymakers' public comments. But there's no doubt, if you're looking at this from the outside in terms of a unified, single, coherent narrative from the Fed, well, there clearly isn't one right now.
Enda, thank you. Enda Curran of Bloomberg down in Washington, D.C. There's good reason, Lisa, for that division on the FOMC.
It's a complicated moment. And as Enda said, especially with the jobs creation or the lack therein, how much is this due to technological changes? I just wonder what the mandate is of the Fed. The tacit mandate has been, yes, price inflation as well as the jobs backdrop. There also has been this financial stability overlay, and I wonder how that plays into things, too. We heard about that from Jeff Schmidt of the Kansas City Fed, and I wonder how much we hear about that from other Fed speakers as well.
My takeaway on the approach is as follows. Say that you really care about the inflation side of the mandate. Say it a lot. then ignore it and focus on jobs. And focus on jobs. And any time there's any weakness in the labour market, step up and cut interest rates. That's the observation of mine over the last few years, at least, with Chairman Powell.
And frankly, the data that we're getting kind of plays into that, given the fact that we're going to get the non-farm payrolls, but we're not going to get CPI. So how much do they have going into that meeting in December, and how important is the figure that we get in terms of influencing these Fed officials?
It was easy for the chairman to talk about pain in that speech a number of years ago in Jackson Hole because there wasn't any. There wasn't any pain in the labour market, so he said, there might be some pain. We've got to go through that pain to get inflation down. The moment there was pain in the labour market, the moment you saw any, they cut 100 basis points. The moment you saw some more, they cut another 50. Now, I think it'd be hard to push for me to believe that going into 2026, that if you saw further labour market weakness, that they wouldn't cut interest rates again, even with inflation closer to 3 than to 2, because they've been doing that for the last 18 months.
And they say that there are some disinflationary impacts down the line. San Francisco Federal Reserve came out with a paper over the weekend talking about how in past periods, tariffs have been disinflationary, that you've actually seen a real sort of demand shock as a result. So there is this feeling that in the past, any kind of inflation they do see, they want to look through. What is the ramification of that? A lot of bullish estimates coming from Wall Street.
Big time. 7,800 from Morgan Stanley for the end of next year.
Pretty
That's not bad, is it? All right, let's stick with payrolls. Abigail Watt of UBS writing the headline game we expect in employment could add some division to the FOMC, currently split between calls for more cuts and calls to stay on hold. Abigail joins us now for more. Abigail, good morning. Good to see you.
Morning. Thank you for having me.
You heard me ask undercurrent the question, what's good? What's good in the September jobs report? What is a good number in 2025?
Look, I mean, we're currently sitting above consensus. You referenced consensus is around 50K. We'll see, I guess, if there's been any change in that, as we potentially get some more estimates in. It's been a while. We've been waiting for this report. But we think that, a 95K gain in total payrolls could be possible. That's our base case forecast. And I think the key thing to note for the September report is their expectations are that there's a potential for residual seasonality to support this data rather than this necessarily signaling a significant improvement in the pace of job gains. I think it's probably that September number reflects the fact that you've seen job gains that would have been spread across the summer. So it's essentially a bit of catch up for something that previously would have been spread by the seasonal factors across the summer months. So I don't necessarily see it as a kind of good print. I think it's not as necessarily a big shift in the pace of job gains. And I think it's something that, we'll have to put in that context, I think, when we're thinking about what does this mean for the go forward.
Abigail, are you giving the perfect rationale for why we could see a better than expected number at a Fed that still cuts next month?
So that is our base case. We are expecting that the FOMC will deliver that 25 basis point cut in December. I think for the Fed, the key thing here is that if you look at not just the kind of BLS data that they've been waiting on after the shutdown, if you look at a range of indicators, you really have seen the labour market, Chair Powell himself has said, it doesn't look any better, it doesn't necessarily look any worse, and it already looked pretty soft. And I do think there's a sense that when we look at the go forward from that kind of potentially supported September number and then think about what we could see in October and November, our sense is that we continue to see that weakness. One of the things we've been watching closely is obviously retail hiring. And if you looked at the Challenger report, the kind of pace of September, October hiring intentions in the retail sector looks very soft versus previous years. Now, it could be that retailers are not reporting their hiring intentions. Maybe the data isn't quite capturing the full spectrum of what's happening, but it does look very soft. And so I do think that's something that we're watching closely is just the whole spectrum of labour market indicators.
How much do you buy the fact that interest rates above 4% have been really restrictive for a lower income cohort of the economy? That this really is pain that Chair Powell was talking about in that one speech in 2022, and we've seen it come to the fore, and it's exacerbating the K-shaped economy. Do you believe that? And do you believe that rate cuts will help mediate that?
Yeah, so I do believe that you are seeing this bifurcation in the U.S. consumer. I think when you look at the data, you can see that for those lower income groups, you can see that savings have been drawn down significantly. You can see that for upper income groups, balance sheets look really healthy still, right? So I do think there is this sense that there is that bifurcation. And I think when you look at kind of things like delinquency rates, you can look at delinquency rates across the income spectrum for credit cards, for example. You've seen a significant rise for those at the lower end of the income spectrum.
But is that because of Fed policy?
I think it's partly related to the fact that you've seen interest rates remaining relatively elevated. I do think that is part of the story. And I think if you look at not just the consumer, if you look at, say, residential investment in the US economy, right, it's a very interest rate sensitive sector. And you've seen it contracting for most of the past 18 months. So I do think there is a sense that there is interest rate sensitivity within the economy. Yeah.
Abigail, you don't think the impact from tariffs is over? What more are we going to see?
I think the next wave of this is the pass-through from businesses wearing the cost of those tariffs in their margins and passing them on to the consumer. I think the reason we've seen that process being relatively slow is because, one, businesses didn't have a great sense of what the tariff policy was. There's been so much flux and so much change that I think businesses were reticent to pass on a price increase to consumers before they knew what they needed to pass on. I think we're kind of reaching that point now, potentially. And I think if we think about how businesses are going to manage that cost increase, I think the sense would be is that they would begin to pass it on at a point where they think potentially demand could be a little bit stronger. So you think holiday season could be one area where you start to see some of those price pass-throughs coming through more readily from businesses.
How much do you project?
So we're expecting that by the end of next year, we think tariffs will have added around 80 basis points to core PCE inflation. So we're expecting that you still have a significant amount of pass-through to come through. And that's why, you know, we get this sense that we think through the end of the year and into the beginning of next year, we think we'll be seeing this bigger real DPI shock for the US consumer. And I think that's where we start to see a little bit more of a slowing in the consumer. And then I think the next big thing is going to be what happens with fiscal policy. Do we see fiscal policy coming in? Is that something that we think would then support the economy going forward? Our expectations are that we see a really healthy refund season next year. So our sense is that by Q2, you could see a pop higher again in the US consumer, supported by that big, beautiful bill act that was passed earlier this year.
Is that a good enough reason for the Fed to sit this out? The anticipated pickup in growth we might see early next year?
I think for the Fed just now, the sense is that the risk of making a weak labour market even weaker, I think, will ultimately outweigh the risk of potential second round inflation effects at this juncture. I think if you think about the way that FOMC members are talking about that balance between the labour market and the inflation risk, they're clearly focused on this kind of weakness in the labour market. And then when they're thinking about inflation, I do think there is this sense that the tariff-related pass-through will be a one-off kind of price level increase, and this sense to kind of look through that. But I think the question will be what we see in the data. I think if they were to see a significant improvement in the economy and they were more concerned about those second round effects, that could be a reason to kind of pause and take things a little bit more slowly.
So you and the team are at 95K
yes.
Thursday? OK. Abigail Watt of UBS, 95K. That's the largest estimate I've seen so far. There's only 8 others. There'll be more still to come going into Thursday.
Yeah, but it's a 95 with a huge asterisk, which is that it's playing catch up and it's not really that good. So the Fed can still cut rates, even though it's a high headline number, which just goes to the point of what are these numbers that we're looking at? And the interpretation is going to be as important as the actual figure itself.
The jobs report just around the corner. Thursday payrolls for you. There we go. A new flavour to the jobs report. Equity futures on the S&P 500 negative by 0.2% as we count you down to the opening bell. Here's your Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. Amazon has launched its first U.S. dollar corporate bond offering in about 3 years. According to a person familiar, the company is selling debt in as many as 6 parts, and initial price discussions for a 40-year bond are about 1.15 percentage points above Treasuries. Proceeds from the sale are for general corporate purposes. Meanwhile, U.S. airlines are resuming normal operations this morning after more than a week of government-mandated flight reductions. The FAA announcing it would lift cuts across 40 major airports at around 6 this morning. The agency said staffing levels have continued to snap back since the shutdown ended last week. And Bitcoin has fallen sharply after topping 126,000 last month, briefly wiping out all of its 2025 gains before stabilizing earlier today. Bitcoin's total market value fell by about $600 billion from an October high. While there's no clear trigger, some traders are citing the 4-year halving cycle, while others blame global liquidity. That's your Bloomberg Brief. John?
Yahara, thank you. Some more details on that Amazon debt offering. The news dropped earlier on this morning. Yahara went over it a few times already. A 6-part bond offering, the longest piece of that, 40 years. They're looking to raise about $12 billion from that US bond offering later on today.
Yeah, and just to give you a sense of how well this is priced in terms of what the value proposition is for Amazon, that 40-year bond is offering 1.15 percentage points above benchmark Treasury yields. In other words, the premium that they've got to pay over what the U.S. government has to pay is about a percentage point. which highlights why they're doing this now.
Saw something very similar from Alphabet in their long bond offering as well.
Exactly. Very well priced.
Amazon this morning on the equity side of things, positive by 0.2%. Up next, we'll set you up for the day ahead. Plus, Ben Reitzes of Melius as markets count down to Nvidia earnings later on this week. They drop on Wednesday after the closing bell. From New York City, you're watching Bloomberg TV.
There's still a long way to run in this AI trade. The question now is, are we facing a bubble? It's overcapacity, it's leverage in the system, and it's valuations that we need to focus on. And we think that we're still in the early stages of this story. Investors are willing to make investments, but importantly, what we're seeing now is that these investments in AI don't look speculative like bubbles of the past.
That was Stephen Parker of JP Morgan Private Bank. Going into the opening bell, equity futures just about unchanged on the S&P 500. We're down by 0.2% on the Nasdaq 100. For the Nasdaq, for the S&P, for equity markets worldwide, all eyes on Nvidia earnings due on Wednesday. Ben Reitzes of Melius Research reiterating his buy on the stock and price target of 300, expecting further upside to data center revenues, writing Nvidia's commentary around AI demand trends get more important each report, given wide-ranging concerns around end demand, energy availability, and China's role in the AI race. Ben joins us now for more. Ben, good morning.
Hey, good morning. Great to be here.
Great to have you with us. Talk about China's role in all of this. Some interesting comments from Jensen Huang in the last few weeks regarding the race over AI, and China may be leading the US. It was in the Financial Times. Has he got some massaging to do, the PR for Washington, D.C. and the White House?
Well, he's been trying hard to get himself back into China, and it's not looking so good. I think that the hawks have Trump's ears right now, and so we're not looking for any of that, and don't think they'll put any of that in their guidance. We were hoping, but there could be a case that others outside of China need to invest even more to stay ahead. And I think while Jensen says that about China, I think we're pretty well ahead. The chips there. There's news and propaganda that comes out from time to time, but I still think we're pretty well ahead. I think we don't want to relinquish our lead, but I think that we're well ahead right now.
Ben, I know you've done the research on this. Talk to us a little bit about how they'll use their cash, whether it's capital returns, buybacks, or whether it's going to be to continue investing in the build-out of this ecosystem. How do they choose between one versus the other?
Yeah, about a year or two ago, we kept writing that they're going to have to do the mother of all buybacks. And now it looks like they'll do probably less than half of their free cash flow will go into buybacks, and more than half will go into either acquisitions, which are more unlikely because they're so big, but also investing in the ecosystem. And we think that is going to be a much bigger place where they put their cash. And we've seen it already with OpenAI, with a few other things, CoreWeave and whatnot, and we think they're going to keep doing that. But I think that it's going to have more scrutiny because we got to make sure that they're picking the winners that actually deliver and it doesn't look as circular. So there's going to continue to be that debate. Are you investing? Is it just circular? You hand them cash, they buy your GPUs. Or I think people will actually look at it more favorably if those companies do tend to win. Like if we start seeing OpenAI's valuation continue to go up, people say, hey, it's a good investment. CoreWeave, like to see, that stock recover, that kind of stuff, then people will be happy about it. But if they're investing in things that crumble, then the market will be very harsh. I think Jensen is going to be explaining that a bit more on this call as cash is piling up.
Who do you think the winners are? Do you think that OpenAI is the right bet, or do you think that somebody else would be better?
I think right now there's people say 5 or 6 model companies. It's not sure who's going to win, but OpenAI has the most consumer usage. Anthropic's doing very, very well in the enterprise. We wrote about them today. Very promising. And then obviously there's the large language model companies, Google, Meta, Microsoft actually has access to OpenAI and their own models. I think it'll be a combo of those 5. And those are the ones that I think are going to keep investing throughout the next several years. And I'm not sure a winner will shake out probably until we're 3 to 5 years more down the road.
I remember a year or two ago, people were saying that the concentration of NVIDIA buyers in just a handful of names was a bug, was a problem with the investment thesis for NVIDIA. Are you seeing it more now as a feature because these are cash-rich investors that are increasingly going to be compelled to buy more from NVIDIA?
Well, yeah. What also happens too is, when you hear about these plans from Sam Altman, while they look cartoonish, at the 1.4 trillion by 2033, Google's got to look at that and go, gosh, I have to invest. So does Amazon. So does everybody. And Microsoft, and they all look at that and they go, we have to invest to keep up. Like, what if they win? We can't afford to lose. But half of the revenue from NVIDIA, at least, is coming from these massively cash-rich companies. It is a little scary to some to see OpenAI now being such a big part of the growth. And I think if OpenAI, and I think they will, raise the money they need to just keep going, that will assuage a lot of concerns.
What about cash-rich countries? You talked about how you're basically not banking on NVIDIA getting back into China. Does the Middle East fill that hole?
Yeah, I think that the peace in the Middle East type stuff is actually way more important than people think. I mean, we need the Gulf nations to be allied with the United States so that they can receive licenses to build data centers and use their energy-rich economies to build massive data centers so that they can power their own sovereign AI. And I think President Trump and his administration see this, and that's what we're hoping for. So instead of filling up the void, what could fill the void from China is these cash-rich Middle Eastern nations, especially the Persian Gulf ones, buying a ton of NVIDIA chips. And so far, so good.
Likely that'll be on display tomorrow with the Crown Prince coming to Washington. But do you think the China hawks have a point in the administration about potentially the tech leaking to Beijing?
I think that, when you talk to NVIDIA and you say, what are the workloads, it really doesn't seem like China's going to put their entire national defense on an NVIDIA stack because it's an American company. I mean, we have to be realistic here. I think that some of it gets overblown on the Washington side, but it's tough to say that. I mean, what if something does happen? So I don't want to be the one responsible. But in terms of the whole scare, I think it's a little overblown. What I worry about, and I do think Jensen has a point, is if China does develop their own tech stack and then selling it to our allies across the Middle East and Europe, and then we have that issue there. I don't know if that's a hole we want to go down. So there's really no good answer to the whole thing, and I think it'll continue to be a hot debate.
Ben, great work. Enjoyed the note as well. Thank you, sir.
Thanks.
Thank
Great
you very
to be
much.
here.
Ben Reitis there of Melius with a buy rating on NVIDIA and a $300 price target. NVIDIA reporting earnings Wednesday after the close.
Very curious to see what they say about OpenAI and how much they want to diversify and who they want to support and what the programming capabilities are that they're kind of getting behind. I think that's fascinating.
What a week coming up. NVIDIA earnings later this week, earnings from retailers Target, Walmart, Home Depot, and a payrolls report this coming Thursday. Coming up tomorrow, Peter Chia of Academy Securities, Liz Ann Sanders of Charles Schwab, Kate Herr of JP Morgan, Elisa Shallett of Morgan Stanley. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
गाइस यहाँ पर क्रूड ऑयल में एटलीस्ट हाफ प्रॉफिट बुक कर सकते हैं, ठीक है। यहाँ पर ये जो सपोर्ट था उसका ब्रेकडाउन हुआ था, मोस्ट प्रोबेबली यहाँ पर रीटेस्ट करेगा प्राइस, थोड़ा सा ऊपर और जा सकता है 5275 के अराउंड, तो यहाँ पर एक हाफ प्रॉफिट जरूर बुक कर लेना। देखते हैं ट्रेल करने में क्या और ऊपर जाएगा या फिर यहीं पर क्लोजिंग देता है आज। बाकी अगर सस्टेन कर गया 5290 के ऊपर तो वापस डे हाई के चांसेस हैं, 5290 के ऊपर अगर सस्टेन करता है। ठीक है, तो यहाँ पर हाफ प्रॉफिट बुक कर लेना, रिमेनिंग ट्रेल कर सकते हैं, बड़ा ही टारगेट हो जाएगा इतना, तो लगभग हाफ इसका बुक करके रिमेनिंग देखते हैं, ट्रेल करते हैं। बाकी नेचुरल गैस भी साइडवेज ही चला गया, कोई मोमेंटम नहीं है। अगर ये थोड़ा नीचे आता है तो ये बाइंग का एरिया फिर से सेम ही रहेगा, ऊपर गया तो फिर नेक्स्ट रेजिस्टेंस 410-12 के आसपास है। Five killed in Russian strike on apartment building in West Ukraine.
Silicon Valley is all in on the AI revolution, and so is Wall Street. It's leading some to warn about an AI bubble. So how worried should you be? What is an asset bubble anyway? And what happens to the real economy when one pops? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Will the AI bet pay off? That's the question everyone's asking, in quarterly earning calls and at the IMF meetings in DC. And it's hanging over the broader economy. An economy that has so far proved resilient as it navigates trade risks and geopolitical uncertainty. But what about the risk of a potential AI bubble? It's something investors and policymakers are trying to figure out. This week's podcast is all about bubbles and how they affect the real world. To find out more, I spoke to Mike Dolan, Reuters editor-at-large for finance and markets. Morning, Mike.
Good morning, Carmel. How are you?
I'm good. We're talking bubbles today. Are you feeling effervescent?
Not after Friday. It was less than bubblicious, I have to say.
Indeed.
But maybe that sort of move is exactly the reflection of what some people fear, is that we're in frothy territory.
Well, it's interesting, isn't it? like market bubbles, they sort of follow a pattern, don't they? They have a sort of an ebb and flow to them. There's the kind of the innovation stage, there's the boom stage, the euphoria, then there's the savvy investor getting in, selling, and then there's the panic, right? How do you define market bubbles?
Look, it's a neat way that you've just described the stages of bubble blowing,
right?
But it's usually impossible to tell whether you're in a bubble in the first place, because in effect, it's a little bit easier, I think, in physical markets like commodities and so on. So there's a finite supply, and then you get a wave of overexcited demand that shoves prices way beyond what you can see, and that's the supply and demand equation. It's much different, I think, when you're dealing in financial stocks and in companies that could well be the future, because ultimately what people are betting on is what the value of that stock or that sector or that idea, even some cases, will be in years hence. And where we are at the moment, of course, is very much like that. People do think there's a quantum leap in artificial intelligence and all that goes with it, and a need to rethink where the entire economy, not just that sector, might be by the end of this decade or even sooner. So the idea, I guess, of easily being able to identify a bubble is wrong. It really depends on your time horizon in many effects, right? So if you think that a company is even not making any money now, which was the case in probably the most famous bubble of our era, in the dot-com bubble in 99, 2000, many of those companies were trading at 100 plus times their earning, because many of them weren't even earning very much. There were some of them were even loss making at that point. So when you look back at an era like that, you think, okay, that should have been obvious to everyone. However, as many people point out, if you'd picked the leading lights of even that gigantic bubble and held on to them for 5, 10, 15 years, if you were holding Amazon or Microsoft, even if you bought them at the peak of that bubble, you'd be very wealthy now. So there's so many different factors to get into. It's about really how far ahead you're willing to look as to whether the stocks in particular are going to be part of that transformed economy. And I think that's the essence of it. The inevitability, of course, in the meantime, is that you lose a lot of money on stuff that doesn't make it. And I think therein lies the danger. Then you have another problem that comes around, that it's not only a question of time before it delivers, but maybe it doesn't deliver at all. Maybe it's not what people assume. So more questions than answers than that. But the idea that you can easily say, we're now in bubble territory, just is not the case.
It's not easy to identify the exact stages of a bubble at the right time, but as someone who's covered markets for a long time, is there like a particular metric that you lean on? Is like there's something that gets your spidey sense tingling?
Yeah, I mean, look, there's no one thing, but I suppose, as many people would say in markets, there's always a kind of a feel about it.
Right.
And I know that sounds ludicrously non-specific, but you can go to try and get the metrics, which is basic valuations of stocks that are pricing things way beyond what their intrinsic value, as people would say, right?
Yeah.
And for that, you've really just got to look at basic valuations. However, there's a behavior around it that I think is more of a touchy-feely thing than it is necessarily something you can measure. But I suppose more recently we would have called this FOMO, right? So it's the whole fear of missing out.
Yeah.
And that sort of behavior, and also this kind of idea that the narratives are endlessly positive. You see a lot of this in the crypto world. There is a feeling that the investment is based on just that price going higher, rather than any real analysis or change in the underlying story of what's happening with the technology or the idea or whatever it is that you're betting on. And, right now there's a lot of that. I mean, we've only had 2 years really of this generative AI boom, but already we've seen just unbelievable price moves, most obviously in the leading light of NVIDIA, which is the chip designer at the center of the whole piece. But it is that behavior thing, and it is in narrative, and it is in endless cheerleading where you do get really worried about it. And I suppose the famous phrase that crops up all the time, which is, this time it's different. So when you see valuations stretched to the degree to which they are, for the acolytes, it's often, this time it's different, that this is not like previous bubbles. There's something very dramatically new and fresh and something everyone else doesn't understand. So those sorts of phrases pop up.
Right.
One very interesting note that was done by Deutsche Bank recently, actually, was quite a clever way of looking at it, where they looked at the amount of searches for AI bubbles.
Right.
So it was, to what extent is AI bubble a bubble, or at least the fear of it a bubble?
Getting into quite a circular thing there. Yeah.
It starts speeding on itself, much like all speculative frenzies. You really have to watch things that are related to it.
Yeah.
So it's really just a feel. It's a notion.
Okay, so thinking of one of the most notorious speculative frenzies of recent times, it's the topic of this week's quiz. Which dot-com company was one of the biggest flops of the early 2000s, having raised $375 million in its IPO and reaching a market cap of over $6 billion before going bankrupt less than a year later? Was it A, Boo.com, B, Webvan, or C, Pets.com? We'll have the answer for you at the end of the show. Up next, Silicon Valley's FOMO. So, Mike, the big question, of course, everyone wants answered is, are we in a bubble now? Right?
Mm-hmm.
Easy answer?
No, there's no easy answer. Sorry to disappoint. There is no easy answer. So the inevitable discussion about a bubble is interesting in and of itself, right? Because people will look at valuations. They will look at them being historically very high. That's not in doubt. We're running at, for the S&P as a whole, over 30, or for at least the leading lights of it, over 30 times forward earnings.
Yeah.
These are not quite historic or all-time highs, but they're up there, and we're still a little bit from where we're.
And not as high as the dot-com level either, right?
Yeah, we're still a little bit off that. Yeah, still a little bit off that. But that was nuts. I mean, you really have to look at some of those valuations at that time. We're talking individual stocks trading at 100 plus, 200 in some cases, times earnings, and many valuations on companies that weren't even making money at the time. So the whole piece, and it was stretched across the whole market, or a very large part of the tech market, the Nasdaq as its relative infancy back then. And now it's concentrated in some very big stocks indeed. And when you strip out lots of those valuations from, say, the top 10, 20 leading stocks, it starts to look less frothy.
Right.
So the big question comes back as, are these companies capable of sustaining these valuations? And there is a reasonable argument, I think, from the tech people who are eulogizing AI, that these are companies that have very big cash flow. They're investing that cash. It's not leveraged in any great degree. And there was that famous, or now famous, quote from Mark Zuckerberg recently, which said that he was quite happy that they would be potentially misspending hundreds of billions of dollars, because it's worse than not being involved in something as transformative as this.
Right, you want to have that first mover advantage.
Yeah, and I think you can understand that implicitly, but also that sort of behavior is also something that unnerves people, because it's reflective of this idea of FOMO, this fear of missing out. And from a corporate level, that's a lot of money, hundreds of billions. They may have it, but it's a lot of cash to be burning if it doesn't work.
So the action in the gold market is interesting, right? What does that tell us about how people are feeling about this kind of AI revolution?
I think the gold move is fascinating as a reflector of what might be going on, because there's little doubt that within the stock market itself, there is a certain amount of chase it, FOMO, call it what you like.
Yeah.
But there's also an awareness. So it's not as if people are deaf and blind to all the bubble worries that might be around them. And so an aspect of this could well be that people are beginning to chase what could be another 2 or 3 years of exponential rises in any AI-related stocks, but also mindful of the fact that you want to hedge that. So adding some gold to their portfolio as a way of
hedging their bets.
Yeah, kind of keeping you. But they're both rising in tandem, and I think that is something that you really got to look at hard. There are potentially other reasons for this, that global inflation itself is running hot, and policy geared towards a world where inflation just stays high, which is good for gold and good for stocks. Anyway, so you could make that prosaically.
So you've got concentration risk in that a lot of money is riding on just a handful of companies spending a lot of money to get this like AI revolution off the ground. But then more fundamentally for the global economy, is it going to deliver big productivity gains for the rest of the corporate world?
And that's the bigger question. So it's one thing building the infrastructure to be able to deliver some of the capabilities in this area, but does it actually make companies any money when they adopt it? Does it actually enhance returns on the rest of the corporate world once it adopts it? And I think that's the juncture at which we get a reality check on this whole story. Because on one level, if they do adopt it and it does enhance returns, well, that proves the case.
Right.
It proves the investment, it justifies it. It will then, for everyone in the world, everyone who's going to be affected by this, whether it's in banking or whether that's in any other industry that you're going to be dealing with, AI is going to be part of what you experience, and it will transform the world in the way in which people imagine it might, or those who are its supporters imagine it might. If that doesn't happen, then, what is the use case? Where is all that money gone?
Yeah. I mean, there's a number of issues, isn't it? There's A, is it going to live up to its potential? B, are they even going to be able to get all the energy that they need, all the how they're going to fund it? And then I suppose the kind of the unknowns, right? The risk that what we saw earlier this year with DeepSeek, that someone can come along and do it for far less money.
Yeah.
These are all potential shocks to the story, right?
Yeah, and that raises an interesting question about, the risk, the individual corporate risk involved. And I suppose then by definition, the investor risk is that you may believe in the technology. And so the DeepSeek example is a very good one that you raise. The Chinese claim this is almost just as good and it's done cheaper. And it certainly questions the sort of investment that's already being put into it in the States. But you have to separate then the degree to which that technology is therefore embedded, but the individual investments for the individual stocks may not be successful. And for that, we have to go back to the dot-com bubble as our great recent historical example. And it is that fact, isn't it? It's that the whole market was taken down by a fear of a bubble burst and the overvaluation, and it wasn't all going to hit. But ultimately, the internet, which essentially it was a bet on, is now the part of everyone's lives. It's integrally involved in pretty much everything that we care to think of.
Yeah.
And it is the sort of future that people were betting on at that time. And the leading stocks that survived it and were successful in navigating it have performed and were worth the investment. But you might have lost an awful lot of money if you hadn't picked the right stocks. And that's the bit about closing your eyes and just buying anything that's related to it.
If you're enjoying listening to Mike, maybe you'd like to check out his columns as well. You can find them on Reuters ROI, a one-stop shop for analysis and commentary on the Reuters app and Reuters.com. Stay tuned to hear how the wealth effect from rising stock prices feeds into the real economy. Talk to me about the real-world impact if this is a bubble and it bursts, right? Because we talked a lot about the stock market, but the excitement over AI, it feels like it's bled into almost every aspect of the economy, like equity, but also debt, energy markets. Yeah. What is the potential fallout here if this is a bubble and therefore it bursts?
The impact on the wider economy. So we talk a lot, we're focused a lot about on stock markets, right?
Yes.
But there are other bubbles in financial markets. And probably the biggest of them all, by some distance, certainly in our lifetimes, was actually a credit bubble. And the credit bubble that led up to the banking crash of 2007, 2008 was gigantic. And it was something that did very quickly take down the entire world economy. And we saw a world recession at the end of 2009, early 2010, just unfold from the scale of the damage done to credit and lending around the world. But stocks are different because ultimately it's whoever's invested in them. If people lose money, it goes to zero. That's kind of tough luck in most people's eyes. So for the economic impact of the loss incurred for people buying into that, then it just depends on how widespread investment is. And then people look at kind of wealth effects of the stock market at large. So if this were a bubble, or if this we're in that territory, then what's happening is it's dragging up the entire stock market, not just people who want to bet on those individual stocks. Although they are very popular stocks generally for lots of reasons, anyone invested in the S&P 500, for example, is now going to necessarily have a massive exposure to this,
right?
Because they're something like 34% of the entire market cap. Magnificent Seven, as they're known as, those mega caps who are leading the way, over a third of the entire market cap of the S&P 500. So if you're just simply putting your money away into an equity investment fund, you're going to suffer if this one goes down, right? Or if this reverses or there's a major correction. And from that, we talk about the wealth effect on the economy then. And people have done lots of interesting kind of number crunching on this over the last few years. Even last year when stocks were rocketing, I think people estimated that the wealth effect, which is essentially doesn't mean that people sell those stocks and then buy other things. It just means that people feel wealthier,
right,
by virtue of the fact that their paper savings are so much higher. So when they look at their bank accounts or their savings accounts or their investment portfolios and they see everything's up 20 or 30%, then they feel more emboldened to go out and buy cars and holidays and all the other things that fuel the economy. So if you reverse that, then you can work it out.
It affects consumer spending. Is that wealth effect, that feel-good factor, is it amplified now because of the rise of, trading platforms like Robinhood? You've got more retail investors involved. Like traditionally, wealthier people held a larger, stock of their wealth in stocks. But has that changed now? And therefore, is the potential impact greater on the economy because everyday ordinary people now have stock trading accounts?
Yeah, I mean, there's two ways of looking at it. I think direct exposure to stocks has risen. I think the last numbers I saw on this is now above 20% of Americans, at least, have direct exposure. And so people will be more aware of it and more sensitive to it, you would imagine, in that regard. I think there's also been a rise in the more and more people who get involved in the digital economy itself. Many of those companies pay, the compensation is in stock itself. So their wealth effect is related to the kind of annual compensation that they have.
Right.
So there are many directions. How does it affect the overall? I think the problem is largely to do with the skew of wealth generally. If you think about 10% of the highest 10% of earners in the US drives about 50% of the aggregate consumer spending. It's incredible. So,
wow.
And they are naturally most exposed to stocks because they hold most of them. So if you see a very big correction or even the slightest of retrenchment amongst people in that kind of cohort, then you will have a ripple effect across the economy. And then inevitably company investment suffers when you get a very big market downturn. So employment, hiring plans start to grind to a halt for a period. And we saw that very much after the dot-com. It wasn't a huge economic recession. There was a short and shallow technical recession, but there was a big business recession.
Yeah.
And that affected hiring and the economy for a number of years after that.
Yeah.
So there are numerous ways in which a bubble burst will filter through the economy, but probably the wealth effect is the most immediate. And people just look at their savings and investments and see them.
There is also the business side of those. Well, you mentioned that in relation to the dot-com, but even in relation to now with AI, we have seen that like spending on AI has helped drive US economic growth, spending on business equipment, spending on intellectual property, right? That is another big risk factor, right? Beyond people losing money on their nest eggs.
Yeah. I mean, that's very true. Yeah. And I think, you can see that while consumer spending has been, as it always is in the US, a very big part of the economy and therefore crucial to any expansion, that a lot of the GDP surprise, if you like, over the last year has continued to come in areas that you wouldn't have expected. So in that sort of business construction area and the physical aspect.
Yeah.
But I think that one of the things that people do worry about, or at least spend a lot of time kind of trying to assess, is the extent to which these big companies that are spending all this money are the digital giants that we're all familiar with. And these companies often had very little physical parts of their operations. They were quite essentially generating enormous amounts of income from intangibles, as we know them as, right?
Yeah.
And suddenly now they're being forced to invest in very real things, in bricks and mortar, in data centers, in energy and so on. And it does leave them also more focused on what happens in the real economy as well. So there's a reconnection of the digital world as well as everyone else being affected by it.
Yeah.
And how you value those stocks, I suppose, maybe is changing also.
Yeah.
And as you mentioned earlier on, perhaps once they've used their cash low or their free cash piles at the moment on this investment, then to what extent will they be borrowers in the future as well? So that is another aspect that can come back to affect the wider economy as a whole.
Speaking of the wider economy, did you know there's a newsletter to go along with this show? It's called Reuters Econ World and it lands every Thursday. We'll put a link to subscribe to it on the show description. You can also find it on the Reuters app. Just go to menu and scroll down for newsletters. In the final part of the show, we look at bubble's legacy effect. You mentioned in the wake of the dot-com, the dot-com bust, that there was a shallow recession. At that time, though, the Fed really stepped in, right? Dropped interest rates ultimately to 1%. The government cut taxes, raised spending. If the AI boom is a bubble that's going to burst, the US government isn't in a great position to help out, right?
Directly, you'd say no. The Fed's not in a terribly bad position to help out because obviously we've got interest rates much higher than they have been for much of the decade prior to the pandemic, for example. So they have dry powder, as people would say, to step in. And if you go back and look at that whole episode around the late 90s and how the Fed reacted or how policy reacted, it is an interesting comparison because one of the aspects about bubbles generally is that, of course, whether you're correct or incorrect in identifying one, you can't time it. It's impossible to time.
Yeah.
And if we remember, and I remember very well when former Fed Chair Alan Greenspan raised the red flag with his irrational exuberance speech back in, that was late 1996.
Mm-hmm.
And, the peak of that bubble did not kind of hit until March 2000. So we're talking about, 4 or 5 years. And even interestingly, after having raised concerns about overextended markets at that point, the Fed then went on to cut interest rates about 18 months later because fearful of other global crises coming back to hit America. So it actually ended up inflating those final throes of that bubble. So, but it did floor interest rates to respond to the kind of business-led recession, which in a sense held the whole economy up because what happened at the time was that it helped inflate the housing market.
Mm-hmm. Right, which led to another bubble.
And as we know,
a bubble begets a bubble.
That then 5 years later, we ended up back in a housing bubble that came unstuck in the credit crash.
Right.
So these things they mirror themselves. How policy reacts to them tends to explain how they pan out. But as regards government at large, I think the fiscal situation is very, very different than it was back then. If you remember, the US went into 2000 with a budget surplus.
Surplus, that's right, yeah.
And they were retiring the long bond, et cetera, et cetera. That's certainly not the case at the moment. So probably would come down to a monetary rescue, at least at first order, if there was a need to.
Are they ever a good thing, bubbles?
Yeah, that's a good question. Perhaps they're necessary. I mean, they're mostly related to transformative changes in technology. I think if you go back even beyond the periods in which we were looking back, you go back 100 years or even further, whether it's railroads or whether it's electricity or whatever else,
We won't mention the tulips. We won't mention the tulips of Amsterdam. That wasn't... That helped.
No, it didn't. There wasn't a transformative technology related to tulips that I'm.
No, they looked pretty, but
yeah. Maybe we should go back eating them.
Yes,
but it is typically about technology, so it is interesting. And so the fact that it's AI now is no great surprise. If it is, as people suggest, the next real quantum leap in tech's driver of the economy, then look, this sort of thing is inevitable. Of course, you'd want to be across the next big thing.
Yeah,
and to some extent, the sort of capital that flows into this territory is what's needed in that regard. So if you really want to speed up the degree to which a new technology is adopted and rolled out, then this is what happens. There is an interesting aspect, again, not to go back for the 100th time to the dot-com, but what happened around that big internet boom in the late 90s was that even though the leading stocks or even some of the frothier stocks got hammered and the NASDAQ as a whole collapsed, And it was a big 3-year bear market. You got to remember that. And
Yes.
I don't think the Nasdaq recovered its peaks for at least 10 years afterwards. So
Yeah.
the broader aspect of tech at the time, as the real technology, was that at the time an infrastructure had been rolled out around the world. So a fiber optic cable was the real big infrastructure kind of transformative thing at the time. And even though lots of these stocks went by the wayside and lots of these companies went by the wayside, the infrastructure was left. And what it did was it cheapened the access to that. And so the technology continued to expand, continued to be used, continued to develop at much cheaper rates than there would have been at the peak.
Yep.
So if there are good aspects of them, there can be. It can accelerate the technology, but it can be very damaging to anyone involved. And of course, that's we're talking about equity bubbles. I think with credit bubbles, it's a very different story. It's hard to see anything positive
from a credit bubble.
Credit bubbles, or at least credit busts, because when credit busts happen, it can take an awful long time to repair.
I suppose it's perhaps the legacy, the bubble's legacy can be good, even if it can be very painful along the way.
Yeah, it can be a way to accelerate the investment in that area. But like everything else, if you knew what the winners and losers were at the beginning, then we'd all be rich.
Listen, we wouldn't be sitting here talking on this podcast, Mike, right? We'd be we'd be on our yacht.
Yes, indeed. Yes, indeed.
A big thank you to Mike for his time and insights. You can catch his work on Reuters.com and the Reuters app. Now for the quiz. We asked you which .com company was one of the biggest flops of the early 2000s. Was it A, Boo.com, B, Webvan, or C, Pets.com? And the correct answer is B, Webvan. Webvan was one of the most ambitious .com startups, aiming to revolutionize grocery delivery. But despite raising hundreds of millions of dollars, it burned through the cash and filed for bankruptcy in 2001, becoming a cautionary tale of the era. This is Reuters Econ World. Every week, we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. Sound design, music composition and engineering on this episode was by Josh Summer. Our podcast team includes Kim Vanell, Tara Oakes, Gail Issa, Christopher Wall-Jasper, Jonah Green, David Spencer, Abasoy Adelusi, and Sharon Reich-Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts. Hey there. It's only been a few weeks since we took a look at the debate around an AI bubble in financial markets. But honestly, there's just so much more to discuss. The investment we're seeing in new semiconductor chips and data centers is getting bigger and bigger. AI's impact on the economy is deepening, and its role in national security is growing. So where's this all going? And if it is a bubble, what does that mean for the economy? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week, we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, the debate around an AI bubble, Part 2. So to get into all of this, I spoke with our very own Mike Dolan. He's editor-at-large for finance and markets at Reuters, and you might remember him from the last time we covered this topic. Mike Dolan, hello.
Hello, Carol.
It's wonderful to be here with you in London.
Yeah, strange to have you over. Nice to have you in person.
It's nice to be here. So we talked relatively recently about the debate around an AI bubble, but Mike, there's so much more to talk about. We felt we had to get you on again, right? Because it feels like it's all anyone can talk about when it comes to the global economy, the US economy, and looking at the US economy, which of course we all do. It's in a funny place right now, isn't it?
Well, it's a very funny place in the sense that we don't really know what's going on. We've had the longest government shutdown in history. Been a long time since we've seen any update of economic data. We got a little glimpse of inflation numbers for September, but that's about it.
Right.
So we're pretty much reliant on lots of private sector cuts and surveys and so on. But when last we knew, the GDP, annualized GDP in the States was running around 4%. And so for all of the near heart attack we had in April and all the forecasts of recession and
fears around the Trump tariffs
and all of that disruption that that was prevalent really hasn't materialized, at least not up until the point at which we lost data. But we would have known, I think the Fed officials are very open about this, that, had there been a major turn since the government shut down, it would be clear from other cuts of data and other things that they look at, kind of alternative data.
Right. I mean, in terms of US GDP, we actually don't know how the economy did in the third quarter. We haven't had data for that. But it seems that people in the market seem to think that the AI boom is helping to prop things up, is helping the economy to motor along in the US.
Yeah, it's a big factor, but it's very complicated this year. I think for the first half of the year, the rough estimate that people have been working with is that something like 2/3 of that 1.6% expansion averaged over those 2 quarters was AI related in some shape or form. There are questions about that. The first half of the year was very distorted, largely for international trade reasons because of the tariffs.
People scrambling to import, right?
Yeah, absolutely. And there was a huge front loading of that in Q1, which led to a contraction of GDP. So strange kind of GDP maths that kind of got all mixed up. There is a point being made that a lot of that import rush made it look like a heavy amount of AI spending was going on because it was imported computers and other things.
Which were exempted from the tariffs, right? In order to keep that AI boom booming.
Absolutely. So I think, that raises a question. So it might not be quite the 2/3 of the first half growth that we thought, but either way, I think most people can read fairly clearly that it's a big factor in construction, certainly on data centers. It's
corporate investment.
On what's happening with the stock market and the stock market in its own right. If you're looking at consumer spending, which is held up in the first half as well, it is a big factor in that. The wealth effects of people who suddenly see their stock portfolios rising sharply or recovering, as the case may be in the first half, suddenly feel emboldened to buy again to some degree.
It feels like there's a bifurcation in the economy. You've got the AI boom boosting stock market, making people who have stocks in their portfolio feel wealthy, encouraging them to spend. But then you have a whole host of people who maybe don't have that kind of income, who are still struggling with the cost of living crisis, right? Still, and maybe struggling to find a job if they don't have one, right? We've had the no hire, no fire sort of economy, right? So there is this interesting bifurcation.
It's very true. And I think there are lots of aspects of the economy that just don't add up completely. I would say, on aggregate, consumption has been okay this year. And so, the US is driven by consumption.
Yes, 2/3 of the, but is that consumption driven by wealthy people? I mean, there was a very interesting stat, came up actually in one of the previous pods. I think Moody's said that the top 10% by income account for nearly 50% of consumer spending.
Close on that.
I mean, that is extraordinary. So It could be that consumer spending is trotting along quite nicely due to a small portion of people who have stock portfolios.
Almost certainly, but that has been the case for 20 or 30 years. And it's the aggregate that really people watch and monitor every month. It's what the markets look at, it's what investment looks at. And if, as you say, which is very true, the top 10, 20% of income earners do the lion's share of retail then that's almost certainly the case. And they're also, of course, the stock holders also.
Right.
So that's not to say there isn't stress and problems at the lower end of the income scale. It probably is. I mean, you can see during the government shutdown alone, with the absence of food aid, how much damage that can do to people's lives. But that won't register on GDP or macro data. Maybe it should, but it doesn't.
And that really hammers home, doesn't it? The kind of the risk, the recession risk, if this is an AI bubble and if it does burst, sort of the impact on demand in the economy.
Yeah, I think you can look at it different ways. I mean, AI may well be the future. I mean, it may well be the economy of the future. So what the market is trying to price is essentially where we'll all be. I mean, look at the difference if we go back to the dot-com bubble, and it was a bubble, but it is the economy that we ended up in. You know, what is it that you do that doesn't involve an iPhone or a smartphone of some sort, or involve the internet and digital world to boot? So that was a bet on the future, and it did transpire. If AI is equivalent to that, then this is going to be the economy, whether you're rich, poor, or otherwise, that everyone lives and works in and operates on. So if that is the future of the economy, and bear in mind that AI is something that we've riffed on for 2 years now, with ever since the ChatGPT arrival in 2023. But people are now talking very clearly about quantum computing as the next big kind of tech wave. Even the Trump administration is talking about taking stakes in some of those startups and companies. And quantum computing, again, if you believe the acolytes, could totally transform the way we operate within the digital world. It certainly changes the entire infrastructure that we've been used to. So there are big things happening. I was looking at a very good piece of research from Societe Generale during the week, and they were just doing some number crunches, but they looked at what the AI boom stocks really are. And they were looking at 63 stocks. Now, that's about 50 more than I was thinking of. But it's quite a broader range of companies than you might think when you look at the Magnificent Seven or the 2 or 3 mega caps. So I guess that's also people's bet on the economy as this starts to be rolled out and starts to affect different sectors, from legal to media, all sorts of logistics companies. And you can see with Amazon themselves developing their own AI capabilities, that sort of area is bound to become part of the economy that we live in.
And of course, Amazon recently said they were going to axe 14,000 roles, and they did cite AI as one of the reasons for that. Are we beginning to see the labor market impact of AI?
Be nice to be able to see anything from the labor market. We will get actually something today, this month, a little glimpse this month of some private sector numbers. But it is a question that has been around for some time. Can you possibly have 4% growth and 0 jobs? Right. So is that the AI economy?
Right. That's it. Are we in the AI economy? Yes.
Potentially, yeah. I mean, certainly there is, it wasn't just Amazon. I think there were a number of other big job cuts announced as well. Maybe they're not all related to AI. Mm-hmm. What you look at from an economics point of view is the productivity boost that goes with that. And
that's the golden aspect. In theory, for the cheerleaders of AI, it's the productivity gains. That's what drives economic growth.
Absolutely. Right? So basically you get more output per worker.
Yeah.
I guess people will look historically at any tech innovation for the last 200 or 300 years and say there was always fears that automating anything from steam engines to electricity to whatever that we've seen, big quantum leaps in technology, would always make people redundant. And it hasn't, because in effect it boosted the economy more broadly and has created other jobs. So there's a sort of creative destruction going on. And that is, again, a hope at this point. I think we're in the early stages of that.
I mean, this is all happening right now in Donald Trump's economy. And, one of the big kind of mega trends this year in the US economy, we've had tariffs, of course, but is also the crackdown on immigration. And in a way, that's having a massive impact, isn't it, on the US labor market? I mean, there are less people coming into the US, which means that it's shrinking the labor supply, right? So in a way, that unemployment rate it's not leaping up perhaps the way one might expect. There's less people to be employed.
Absolutely,
right?
Yeah. And I guess it's the flip side, you could argue, of AI, right? So if there's fewer workers, which inevitably, if you
he's kind of working with the vision. I mean, I don't think that was on purpose, but there is a sort of a blending there, isn't there? There's less workers, and then AI coming in and boosting output. Allegedly.
It is really fascinating, though, isn't it?
Yeah.
Because if you think of this as the kind of great playbook of the reordered world of Trump, that's a world of balkanized economies that are much more dependent on themselves. There's much less movement of people and trade because you've got protectionism, and it's America first, and then is it Japan first, is it China first, is it Europe first? And if that happens, then do you also need less workers? If AI is a future for everybody, then is that also one that starts to see barriers go up to people coming in? In the US context, yeah, absolutely right. The numbers are actually stark, the extent to which immigration has been halted virtually completely.
Yeah.
But also there's a net outflow of people through deportations. And compared to what we were seeing in recent years, that's a dramatic turnaround. So people talk about it, what's called a break-even rate. What is that amount of new jobs that can be created without changing the unemployment rate? And they reckon that the monthly break-even rate for payrolls now is below 50,000. Some estimates are as low as 25, 30,000. So that means that the US only needs to create 30,000 jobs to match the available workforce. And that would have been as high as 170,000 this time last year.
Okay, quiz time. A lot of banks failed during the 2008 financial crisis, but one of the first lenders to go was Lehman Brothers. At the time of its collapse in September 2008, Lehman Brothers was one of the biggest banks in the United States and a Wall Street stalwart. But it wasn't founded in New York. So in which US state was Lehman Brothers founded back in 1850? Was it A, Alabama, B, Pennsylvania, or C, Massachusetts? We'll have the answer for you at the end of the show. Up next, how the AI investment boom is changing the US economy. Mike, since we last spoke, we've had tech earnings. And one of the aspects of the rally that we had seen, which was different maybe from the dot-com era, was that it's being led by a small group of companies that have strong balance sheets, big cash piles. They're financially, they're pretty well armed to deal with this AI arms race. But we are seeing more leverage coming in, aren't we? We are seeing these tech companies going to the debt markets to fund what they're doing.
Yeah, I've seen the beginnings of it, as we spoke about maybe in the previous episode on this. That is one of the big arguments as to why this is not a bubble in the same way.
Right.
These are very profitable companies, at least the ones doing all this massive spending in infrastructure and capacity. And they are cash rich and they're using their cash. And we talked a lot about Mark Zuckerberg's famous, now famous quote, which he says he's quite happy to misspend a couple of $100 billion rather than miss the whole trend. But
it's a very expensive form of FOMO, isn't it?
It's a lot. But, Zuckerberg's comment reminds us all of Chuck Prince's famous line on Citigroup taking part in the credit boom in 2007. Of course, his phrase at the time was that as long as the music's playing, you got to get up and dance.
Got to keep dancing.
So it does remind you a little bit of that. If you're making decisions based on keeping tabs on your competitors, then is that the wisest way to spend a couple of $100 billion? But it is Meta who are borrowing, interestingly, and they're borrowing partly to fund this gigantic data center in rural Louisiana, a thing called Hyperion, that would be the size of a major city. This is an enormous undertaking, and the $30 billion or so in a joint venture with Blue Owl Capital is what that's about. Now, these companies are able to afford this, and they're able to raise this debt quite easily. Alphabet raised $20 billion this month as well. The question is, does that come out somewhere else? And there is an interesting story around that for the broader economy, which is that the big borrower on capital markets, the big kind of user of all this investment capital, has been government. So that's an interesting thing to watch. Maybe not one for this quarter or next, but certainly going forward, that does change the sort of economy that we've seen for the last 15 years.
I mean, that's a concept in economics called crowding out, right? You're crowding out. So are we seeing that in other aspects of the economy? I mean, yes, you could be potentially crowding out Uncle Sam, but you're also crowding out other companies, other sectors, maybe beyond AI, who are looking for investments, who are looking for capital for various projects, who maybe aren't getting it because the market is so focused on AI. Are we seeing that? Is crowding out happening in other senses as well?
It could be the case. I mean, the real issue with crowding out is just makes everything more expensive, right? And I would say the interesting idea of crowding out comes usually that government starts to crowd out its corporate sector.
Right.
This one may well be that some
reverse.
very, very highly rated companies, which are probably as highly rated as the US government at the moment, may well be starting to crowd out and muscle in on the turf that Treasury would want for itself. So the cost of borrowing for Treasury goes up. And as you know, not just since Trump's second term, long before that, since the pandemic, certainly, the worries about the scale of debt accumulation in Treasury is something that everyone's had on their mind for some time. If this makes it more expensive, then does that add to the problem?
I think this year there's an estimate that something like $400 billion will have been spent on kind of AI capital expenditure. It's a huge amount of money. And obviously it needs ultimately to yield a return. So I suppose the question becomes, how much do these tech companies need to earn in order to justify that type of capex? So an estimate from Bain saying that it could require $2 trillion by 2030, like $2 trillion. And I was checking back to see, what has OpenAI earned in terms of revenue, say this year. First half of this year, we're talking $4.3 billion. So that's a vast disparity. I mean, is that something that investors are worrying about, or are they just sort of parking those fears and just buying the dream?
There's a lot of big numbers being thrown out there, and there's a lot of kind of futurology that is barely knowable, I think, at this point. I think their calculation right now is you simply have to be part of this, because if you're not and you're left behind, it will be more devastating for any sustainability of your business model in that tech space. But it's a big risk, and that's why people worry about bubbles. If that return doesn't come through to match that sort of spend, have you just burned about $1.5 trillion cash?
Yes.
That's gone. And if you're borrowing the rest, it's one thing betting cash on the future. It's another thing borrowing for it. You're in a different place altogether. It really does have to work then. And if you look this month at what there's nervousness on Wall Street, not because of any trigger, not because of any shock, but just that the valuations have just gone stratospheric.
Yes.
And one of the leading lights this time round is a company called Palantir, which you may be familiar with. It's been the darling of everyone because it combines defense with AI. So it kind of has its fingers in all the pies that are trendy at the moment. And its valuation, as of now, is 230 times forward earnings. Its stock has quadrupled.
That's .com levels.
It is, absolutely. So the question has to be, do you deliver? And if you deliver eventually, maybe so. But does the stock price hold that?
I hope you're enjoying the show. If you like listening to Mike, why not read what he has to say too? Mike is a columnist at Reuters Open Interest, a one-stop shop on Reuters.com and the Reuters app for financial analysis and commentary. One aspect of, and we spoke about this on the previous show, about the TMT.com bubble was a lot of fiber optic cable was laid. It lay dormant for a long time, but then it did get utilized as the internet economy took off. Would the same thing happen with the AI economy? We're seeing these vast data centers. You mentioned the one that Meta wants to build in Louisiana, these huge hubs. I mean, will they become white elephants if this thing doesn't work, or can they be utilized as the fiber optic cable ultimately was?
It's a good point. And I would say that one of the things about fiber optic back in the day was that as the dot-com bubble burst, that actually using that became super cheap. compared to what was being priced originally as it was being built. So not only did it have that infrastructure that was durable and usable going forward, it became much cheaper than it had been in the late 90s.
Yeah.
And I suppose maybe there is something there as well from an inflation point of view and from a price point of view and a margins point of view from companies. But you're right, the build out of these data centers could well be that similar infrastructure, because the scale of them is extraordinary. It's not just building more buildings. It's the scale and the computing and the power with them. And also power is a huge factor of this boom and investment boom. I think BlackRock have been advising this for some time, that you're buying AI stocks, but you're also buying energy stocks because of the amount of energy needed.
Right.
And there's all discussion of small nuclear reactors attached to these data centers to create the sort of power that's necessary. So that sort of investment, even if AI didn't deliver the sort of business returns immediately that everyone hopes it will, that sort of infrastructure is going to be available.
Right.
That's for sure.
And then for other things. For something.
Exactly.
I mean, because the other issue, of course, is, and obviously it's a very expensive part of the whole equation, is you've got the data centers, but then you've got the chips that go into them. And my understanding is they become obsolete pretty quickly as well, right? You're sort of constantly innovating on the tech as well. So it's not like it can hang around for a long time to be used for other purposes. You sort of have to move quickly with it.
Absolutely. And I would add more as well. We talk an awful lot about Wall Street's bubble, right?
Yeah.
Because all of this is concentrated so much in US tech companies who have dominated the space in everything to do with tech for 20 years, right? Certainly over the last 10, 15. And those last 10, 15 years, prior to the pandemic at least, were years of great globalization and free trade and alliances between countries. That's a different world now.
Yeah.
So if the US is developing, and we saw this in some of the big outages in recent weeks with AWS and Azure, the Microsoft, and these are the big international global cloud providers. In a world that's worried about national security, in a world that's worried about exposure and supply chains, it seems inconceivable the rest of the world will look at the world that Trump is creating in that regard and say we rely on US tech for everything we do. So my point simply is that this tech development, whatever's happening on Wall Street, will have to be replicated elsewhere.
In other countries.
China's already doing it. We know that. It's developing its own ecosystem in tech that's not reliant on chips from the States, which it doesn't believe it can rely on anymore.
Yeah.
But Europe's going to have to do this as well. So, and the building of data centers, it's not going to be one big European data center. There's going to be a data center in Germany.
Right,
France,
because there are those national security issues.
Of course.
So that's kind of a bull case, actually, right?
Absolutely.
No matter what's happening in the US, this stuff has to be built over this side of the pond.
Absolutely. And I think there's a global picture here.
Right.
Now we look at kind of things like JP Morgan's announcement of 1.5 trillion of America First investment over the next 10 years.
Yeah.
And you can see this investment boom coming down the pike really, really on a vast scale. But multiply that across the world, Germany's spending €1 trillion on defense and infrastructure spending. How much of that will be technology? There's nothing in the defense world these days that won't involve technology. And if you are spending big to fight the wars of the future, then you're going to be spending big on things like AI and drones and other aspects of it. Far from a world that's getting into shock over being balkanized on trade and national security issues, there's an investment boom coming, not just on AI, but on a whole range of issues.
So do you mean that balkanization is kind of driving, it's driving investment because everything has to be sort of duplicated? It has to be, each country has to have its own.
Absolutely.
Right.
And you can see that in a globalized world, we can rely on Apple or Microsoft or some of the big, if the US is an open and friendly country, why not? Why go to the trouble of investing vast amounts of money in your own tech infrastructure when you can pull it off the shelf?
Yeah.
But it's a different world if there's not those same alliances, if there's not those same dependencies, if quite the opposite, if you get into major security issues with the hegemon, the world's biggest economy.
Yeah.
Certainly China feels that way and is thinking along those lines. And I'm sure that's not the only one. It may be a bit different in Europe, but maybe not that far away either. So it does create a world which the IMF told us only a few weeks ago in its annual meeting that despite all the worries, it forecasts 3% growth for the world economy this year and 3% next year.
Right.
Which on the surface isn't boom boom, but
No.
it's certainly reasonably stable
and eye-catching in a period when we've got so many sort of trade tensions.
Absolutely.
Right.
So trade is going to drop. If you believe the WTO, trade growth next year will be as low as 0.5%. It revised it down more than a percentage point in its latest update. So this is not about trade. So this is happening somewhere else, right? Yeah. And I think that's the point I would make. If we go into investment booms that are driven by international rivalries, defense, national security issues, they do involve tech, they do involve construction, they do involve energy, and they do involve all those things, but they'll be done at home, not necessarily. And the big question then I would kind of lead to is, does capital remain globally mobile in that environment, or does it also go home? And I think the incentive for governments to bring their own investment capital back and bring it to bear at home will be very, very high. You're already seeing a lot of that going on. And most of that capital has been invested in the United States over the past 15, 20 years. That's where it's gravitated towards. The big surplus countries of Germany, Japan, China, that's where the money's gone. If it's needed at home, does it get repatriated?
If you like this podcast, why not subscribe to the newsletter that accompanies it? Also called Reuters Econ World, it spotlights our best coverage of finance and economics, and it's published straight to your inbox every Thursday. We've put a link to the sign-up in the description of today's show. In the final part of this episode, we hear about what could happen if this is an AI bubble and it bursts. Mike, there's been two bubble bursts in the last few decades. We had the dot-com bubble, then we had the US housing bubble. And each of them were very dramatic. But in the case of the dot-com bubble, there was a recession, but it was pretty brief. It didn't last very long. Not so for the housing bubble bursting, right? That had massive repercussions in terms of recession globally. If this is a bubble, if it bursts, are we looking more at a kind of financial crisis, housing crisis type impact to the economy? What do you think? Would it be shallow? Will it be deep? If there was a recession?
I mean, this one to me, at least, and looks much more like the late 90s, the dot-com.
Okay.
Because if you think about what happened in 2007, 2008, this was essentially a credit bubble.
Right.
And even though mortgages and housing were at the center of that, the reason it had such devastating impact on the whole world was that it hobbled the banks.
Right.
And so the banks almost came to their knees. They actually did come to their knees. There was almost a collapse of the entire banking system simply because of the scale of lending that had been done into housing. What happened in 2000 was different. It was essentially caused a business recession or a business investment recession at the time, and didn't have as much impact on generalized consumption in the economy as we've talked about it early on. And one of the things that helped an awful lot at the time was the fact that the Fed was able to cut interest rates quite considerably into that downturn, and it boosted the housing market.
Right. Yeah.
So there is an argument that what went on after the dot-com bubble led to the subsequent one in credit.
Right.
But that's maybe another day's podcast.
Yeah. But it is interesting because as this AI investment, keeps going on, deepens, spreads to other countries, in terms of the funding for that, you're going to see more leverage, you're going to see more debt. Maybe it's from the banks, maybe it's from the shadow banking sector, right? So the private credit. And if the sums are to be believed, if trillions are needed, that doesn't it raise the risk of systemic financial risks, like systemic issues? If you've got a lot of leverage spread across the global economy, which was what happened in the financial crisis.
Yeah, it's true. The leverage aspect is worrying. There's no doubt. It does create a different picture as to how. But you could also make the argument that it then becomes too big to fail.
Right. Well, I mean, and to that point, If it is a bubble, if it does burst, we've spoken before about, who could come to the rescue, and the US government is not in a fiscally healthy state to help. So it would likely fall to the Fed, right? So cutting interest rates, perhaps, that can then just sort of further fan the flames, right?
Yeah, but I think, first stages first. The US government, I think in particular, and as we suggested, probably the case around the world too. But if you
true,
just look
not just a US problem, that's true.
If you look at the Trump administration's approach to this, it sees technology and the chip sector and AI and quantum computing all as essentially part of its great reindustrialization of the America,
right.
of this America First idea. And it believes that, government is integrally involved in it. It's taken stakes in Intel. Correct. It is taking stakes in these quantum computing firms, or at least that's reportedly prepared to do that. And is talking openly. This is industrial policy par excellence, right? This is return to the 70s. And even though we saw a lot of that post-pandemic, even from the Biden administration, this has gone up another gear again. And so this is now a government issue. It's not just the private sector punting away on some newfangled toys in the corner that may or may not fail. This is now being integrally built into the system at large. And if governments are investing to that degree in this, the idea that AI disappears in a puff of smoke just isn't conceivable.
Right. This is the Pentagon, not pets.com. And so therefore, it would be a brave person then to bet against it, because you're effectively betting against the US government.
Well, you can bet against the stock valuations. And Michael Berry this month, famous for his big short on the credit bubble, is doing that against Palantir and Nvidia, as it happens. Now, he's been wrong many times in the interim, but it shows you that some investors think this is a time to short the stock. But that's different from whether AI emerges as a usable, dominant technology. And I think you can have both.
Mike, thank you so much for your time.
You're welcome.
A big thank you to Mike for his time and insights. You can catch all of our great economic coverage on Reuters.com and the Reuters app. Now for that quiz. I asked you to name the US state where Lehman Brothers Bank was founded back in 1850. Was it A, Alabama, B, Pennsylvania, or C, Massachusetts? And the answer is Alabama, in the state capital of Montgomery to be exact. It was initially started by Henry Lehman, a German immigrant, but his brothers Emanuel and Meyer joined shortly after, hence the name. The business started as a dry goods store before moving into cotton trading and then finally to finance at the American Civil War. Its failure in 2008 was the biggest bankruptcy in US history. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. If you want to tell us what you thought of this week's show, please drop us a line in the comments section of your favourite podcast platform. You can also reach out to me on LinkedIn. This episode was produced by Ethan Plotkin and Eliza Davis-Beard. Sound design, music composition and engineering was by Josh Summer. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our daily show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.
Exchanges on navigating macro uncertainty. Exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on Exchanges, the Goldman Sachs podcast. Listen now.
News when you want it with Bloomberg News Now. I'm Nathan Hager. After months of pressure, a bill to force the Justice Department to release its files on Jeffrey Epstein is on its way to President Donald Trump's desk. Annie Farmer is one of the late sex offender's victims.
I feel hopeful not because I have a lot of trust in the political process, but because of what I've seen what is possible when people come together and demand something and pressure is placed by the American people.
Annie Farmer spoke to CBS News after the House passed the bill yesterday with all but one vote. The Senate received it this morning and approved it without debate. Pangea Policy founder Terry Haynes says the Justice Department could still push back against this law.
The Justice Department could take a long time tap dance. The Justice Department could bring up what it's already got and make that the basis for whatever it does in the context of release. There's no way to tell which it will do. I suspect my gut is probably a little bit of both, frankly.
Hear more from Pangea Policy's Terry Haynes on the Bloomberg Daybreak U.S. Edition podcast. In light of Epstein documents that have already come out, Harvard University is opening a new investigation into its ties to the late pedophile. Former Harvard president Larry Summers has said he's stepping away from public commitments after his emails with Epstein came to light. OpenAI announced today that includes leaving its board. Larry Summers is no longer a paid contributor to Bloomberg Television. In Washington, a U.S.-Saudi investment forum is underway.
AI and humanoid robots will actually eliminate poverty.
Tesla CEO Elon Musk is speaking at the event alongside NVIDIA chief Jensen Huang. President Trump will be there as well, a day after he announced a major defense pact with Saudi Crown Prince Mohammed bin Salman. Bloomberg Government's Jack Fitzpatrick has more.
There's an agreement for the U.S. to sell F-35s to Saudi Arabia. That's a big thing, but that can take time to negotiate. The number, the price, whether it comes to fruition, we don't know. The Saudis said they'd agreed to invest up to $1 trillion in the U.S. We've heard a lot of those kind of promises during tariff negotiations and that kind of thing. It leaves a lot to be desired in terms of details.
Bloomberg Government's Jack Fitzpatrick in the nation's capital. On Capitol Hill, the House Administration Committee is debating a bill that would ban members of Congress from trading stocks. Republican Tim Burchett's a co-sponsor, but he doubts it'll pass.
Yeah, everybody talks about this place being a dadgum swamp. A swamp is something cool God created. This is a sewer.
Republican Tim Burchett's bill is not receiving a committee markup. Conservative Congresswoman Anna Paulina Luna has threatened to force the bill to the House floor through a discharge petition. Ukrainian President Volodymyr Zelensky is in Turkey looking to revive ceasefire talks with Russia. Zelensky says Ukraine wants to resume prisoner swaps. Turkish President Recep Tayyip Erdogan says U.S. participation in the process will be important. Ahead of Zelensky's arrival in Turkey today, Russia launched a massive drone and missile strike in western Ukraine that left at least 20 dead. Singapore Prime Minister Lawrence Wong says tensions between the U.S. and China are likely to continue, but the recent meeting between Presidents Trump and Xi Jinping in South Korea provided temporary stability.
Intense competition and rivalry will continue, I'm sure. The mutual suspicion and distrust remains, but the guardrails will ensure that the rivalry does not slide into a full decoupling or worse, confrontation and conflict.
Prime Minister Lawrence Wong spoke with Bloomberg News editor-in-chief John Micklethwaite at the Bloomberg New Economy Forum in Singapore. On Wall Street, all eyes are on NVIDIA ahead of its earnings report after today's close. The AI chip giant's expected to post more than 50% growth in revenue and net income, with some of its biggest customers projected to add a combined $440 billion in AI spending over the next 12 months. Mandeep Singh covers tech for Bloomberg Intelligence.
Everyone has talked about building more gigawatts when it comes to AI data center capacity, whether it's OpenAI or any of these hyperscalers. And the question that investors will ask is, how much is NVIDIA's share in that gigawatt build out? Because that's how they're going to generate, more revenue.
Bloomberg Intelligence senior tech analyst Mandeep Singh. Stay with Bloomberg for complete coverage of NVIDIA's earnings and an exclusive conversation with CEO Jensen Huang. All that's coming up at 6:30 tonight, Wall Street time, on Bloomberg Radio and Television and on the Bloomberg podcast page on YouTube. Ahead of those earnings, NVIDIA shares are up more than 2%. The broader market is mixed. The S&P 500 is up 0.3%, but the Dow Jones Industrial industrial average is down 0.2%. The tech-heavy NASDAQ composite is higher by 0.6%. And that's news when you want it. With Bloomberg News Now, I'm Nathan Hager, and this is Bloomberg.
What's driving the markets this week? What's on investors' minds as they look ahead? Find out on the Markets podcast from Goldman Sachs. A breakdown of market moves and macro signals in 10 minutes or less. The Markets podcast from Goldman Sachs. Listen now.
Join Bloomberg in San Francisco or online for Bloomberg Tech Presents, Empowering Business Growth in the Digital Economy, December 10th. Hear from top finance and technology leaders as they share strategies, tools, and insights.
It's Wednesday, November 19th. Today, in a White House meeting, Trump defends the Saudi crown prince over the murder of Jamal Khashoggi. And in the same meeting, threatens ABC News. The bill approving the release of the Epstein files is on its way to the president's desk. And more than $1 trillion has been wiped off the crypto market on fears of a tech bubble. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes, 7 days a week. Saudi Arabia's Crown Prince Mohammed bin Salman receiving a lavish red carpet welcome from President Donald Trump at the White House. It's the Crown Prince's first visit to the US in more than 7 years, since the murder of Washington Post columnist Jamal Khashoggi made the Saudi leader an international pariah. But in a stunning response to a journalist's question, President Trump said the Crown Prince did nothing wrong.
Things happen, but he knew nothing about it, and we can leave it at that. You don't have to embarrass our guest by asking a question like that.
It's just you ask, Mr. President.
Khashoggi, who was based in the US, was killed and then dismembered inside the Saudi consulate in Istanbul in 2018. US intelligence found the Crown Prince himself had approved the journalist's capture or killing. Trump says Khashoggi had enemies.
Job. You're mentioning somebody that was extremely controversial. A lot of people didn't like that gentleman that you're talking about. Whether you like it,
the visit marks a high point for Saudi-US ties, with Trump designating Saudi Arabia a major non-NATO ally, granting military and economic privileges. Mohammed bin Salman was effusive in his praise of the president.
We believe in the future of the United States of America. We believe in what you're doing, Mr. President, really creating a lot of good things and good foundation to create more economic growth, more business in America.
Later, Trump hosted an elaborate dinner for the Crown Prince. With high-profile guests, including CEOs from Chevron, Qualcomm and Pfizer, footballer Cristiano Ronaldo, and Elon Musk, who returned to the White House for the first time since his falling out with Trump. And in terms of deals, Trump and Mohammed bin Salman agreed on arms sales, civil nuclear cooperation, artificial intelligence, and critical minerals. Deputy Foreign Policy Editor Humaira Pamuk has more.
Aside from Khashoggi, the conversation focused on a lot of investments. We have seen President Trump visibly excited when MBS increased his country's pledge of investment right there in the Oval Office.
I believe, Mr. President, today and tomorrow we're going to announce that we are going to increase that $600 billion to almost $1 trillion of investment, real investment and real opportunity by details in many areas.
But probably the most important deliverable from this meeting is the sale of F-35 jets to Saudi Arabia, something the kingdom has been seeking for quite a long time. Now, the tricky thing there is whether or not Washington sells the same aircraft that it sold to Israel, because that's going to be really important in terms of preserving Israel's qualitative military edge in the Middle East. And President Trump indicated that indeed the kingdom was probably going to get the same F-35s that Israel was getting. So we're going to have to see how that turns out.
President Trump also gave details on the plan for Gaza, saying the Board of Peace, which will oversee a transitional government, will include heads of, quote, all the major countries. He also says the Saudi Crown Prince gave a positive response to joining the Abraham Accords. That's Trump's effort to get Arab countries to normalize relations with Israel. But Mohammed bin Salman didn't completely commit.
And we want to be part of the Abraham Accord, but we want also to be sure that we secure a clear path of two-state solution.
A two-state solution, recognizing both Israel and a Palestinian state, is something Israel remains vehemently against. As Trump and Mohammed bin Salman dined at the White House, a bill forcing the release of the Epstein files made its way to President Trump's desk. He could sign off on it as soon as today. But it's not clear how soon after that the files will be released. The House of Representatives overwhelmingly pushed the bill through in a 427-1 vote, sending it to the Senate, which swiftly approved it too. It's an extraordinary turn of events and an outcome President Trump had fought for months before U-turning. According to two sources, the White House is caught off guard by how quickly the measure moved through the Senate. Trump called for ABC News broadcast licenses to be pulled after taking issue with a question a network reporter asked him about the Epstein files during that Oval Office meeting with MBS.
Why wait for Congress to release the Epstein files? Why not just do it now?
You know, it's not the question that I mind, it's your attitude.
Before the vote, about 24 survivors of Epstein's alleged abuse joined lawmakers to urge the release of the records, including Jenna Lisa Jones, who says Epstein sexually abused her when she was 14.
I voted for you, but your behavior on this issue has been a national embarrassment.
The Epstein files have become a serious political liability for Trump, taking a toll on his ratings. The latest Reuters Ipsos poll finds his approval rating has sunk to the lowest of his second term at 38%. Politics editor Scott Malone is in Washington, D.C.
So what we're seeing is that Americans are very concerned about the high cost of living and don't think that Trump is solving it for them. Just 1 in 4 respondents to the poll said they approved of how Trump is handling the issue. The other thing that's weighing on Trump is the Jeffrey Epstein situation. The poll found that about 70% of Americans think that the federal government is hiding Epstein client information. And this is a bit of a problem that Trump has dug himself into. He campaigned on a promise to release the Epstein files. He has long said, when he was out of power, that the government was hiding information about him. And now that he's back in it, he's under a lot of pressure to act. We find that just 4 in 10 Republicans support the way that Trump's been handling the situation.
A court ruling has handed a major win to tech giant Meta, ruling it does not hold a monopoly in social networking. The Federal Trade Commission wanted Meta to spin off Instagram and WhatsApp, saying it shouldn't have been allowed to buy them in the first place. But a US district judge found the FTC had incorrectly excluded YouTube and TikTok from the market, adding that including TikTok alone defeats the FTC's case. The floor has fallen out from under Bitcoin. The cryptocurrency has fallen below $90,000 for the first time in 7 months, wiping out all of this year's gains. The whole crypto market has taken a hit, with more than $1 trillion taken out over the last 6 weeks. Analysts blame doubts over US rate cuts and say investors are more cautious about risk. Here's fintech reporter Hannah Lang.
The concerns around Bitcoin and the crypto market as a whole have really been impacted by broader market jitters around AI that have really impacted risk assets like tech stocks and cryptocurrencies. Despite a really successful year for digital assets broadly, which have risen on the backs of the Trump administration coming into office and pledging to overhaul a lot of existing cryptocurrency regulation. Crypto and Bitcoin in particular are very volatile and new assets. and they're not really predictable in the way that they move. There are a lot of large investors here whose actions can really impact the rest of the market. And that's not really something that's super common in a lot of other assets out there. So I think people have to be worried about how enduring this trend is right now and whether there's ultimately too much leverage in the system. We've seen a couple of different trends this year where traders have really piled up on leverage. And if that implodes, it really could impact prices even further.
And for today's recommended read, China's travel boycott on Japan, one that could
Hey there. Javier Milei has really made a splash since sweeping to power as Argentina's president. He's famous for waving a chainsaw about to highlight his opposition to government spending. And Milei's libertarian agenda has clearly won him lots of friends around the world, none more powerful than US President Donald Trump. So when the peso came under huge pressure this fall, Trump's treasury did something remarkable. It stepped in, buying pesos and promising billions of dollars in support. That was a big deal.